data point or metric, as it could be a real guiding post for the rest of the year. Anything come to mind for you there?
No, I mean, I don't really like to hang my hat on any one particular indicator, right? I look at a whole multitude of options market related factors. Obviously implied vol, skew, realized, all those things to try and get a holistic view of the market. And then when there's action in different pockets of the market, that's what I look at basically. And I try to identify opportunities. So right here, right now, I've highlighted that I think oil vol is cheap and oil upside is not pricing any real risk of an explosion higher in oil. I find that a little bit surprising given the state of the world. So for me, owning that upside tail in oil looks like something worth having. So there's value there for me, right? Where I think things are expensive is probably copper right now. I think copper's gone a bit parabolic. It's probably gone too far. I'm long copper and I'm happy with the move, but I'm probably going to put some hedges in place now via selling upside and buying downside to try and play a tactical mean reversion move in copper because it looks like it's gone a bit too far. And then it's single stocks. Like I said, I think the opportunity right now probably looks like Apple because it kind of went off everyone's radar for a while, slowly starting to come back, and it's still got a lot of room to go to get back up to that 200 sort of level that it got to, and it's got a catalyst coming. So I don't think the earnings are the catalyst for Apple. I think the June conference is the catalyst. I don't think it's being priced as an event, and I think as we get closer to that event, people will wake up to the fact that that probably is a catalyst for Apple, and it will probably rally into that event.
Yeah, and then obviously Amazon tonight. You got any view on the Amazon earnings? It's up about 1% pre-market here.
It was super overbought a few weeks ago. We flagged some risk reversals to our subs. They worked. I'd probably be buying back the call strike right now just because, it's evaporated, lost most of its value, and why you want to be short calls going into earnings when these tech stocks can do 10%, right? That'd be all. So I don't have a strong view on it, but if you were short calls when we told you to get short calls, I'd be covering them now.
That makes a lot of sense. I like those views. All right, checking the feeds here. One thing we want to do, we want to pause here. If you like these conversations, again, we are doing today's PNL for a purpose for charity, and the way that you can donate is if you go to our YouTube channel, that's youtube.com/SpotGamma, or if you go over to the Excess Returns YouTube channel, there's a donate link, and if you click that donate link, all proceeds from today's event will go directly to the Susan G. Komen Breast Cancer Foundation. We're very excited to work with them, and we're very excited to get all of... I don't want to classify everyone as the Fin Twitters here because we can't use the word twit anymore, I don't think, but we're very excited to get everyone together for that. So Imran, I can't thank you enough for joining us today to kick things off. Really excited to have you here. How can people get a hold of you in the future?
Sure. So options_insight or at options_insight on X. That we put pretty regular content on there to give you a flavor of what I'm looking at, what I'm thinking about regarding markets. And then if you want to come and check out our website and see what our actual products are and kick the tires and test them out for a free 1 month trial that we offer everyone, that is options-insight.com.
Awesome. Thank you so much. And so very shortly here, we'll have Jack, my co-host, pop on. And then we're going to be joined at 8 a.m. with Andy Constan, who we're extremely excited to talk to. There he is. Hey, Jack, how you doing?
I'm back. I'm ready to go.
Yeah, we're excited. Excited is the word of the day here, without a doubt. Andy had a lot of exciting stuff to say on his Twitter feed last night. He's been calling the 5260 top. That sounds like quite a way. So far, he's been correct about that. But Jack, why don't you kind of give everyone an overview of what's going to happen for the rest of today, and how they can obviously, again, donate to the Susan G. Komen Foundation.
Yeah, let me share my screen here. Give me 1 second here, and I'll share my screen, and we can look at what we got coming up. As you mentioned, we've got a stacked lineup today. We just had a great presentation with you and Imran, and we've got another 24 to go to get us through the rest of the day. And like you mentioned, we're going to start with Andy Constan. We've got a really big week on macro. We've got the Fed meeting. We've got the QRA announcement. Andy is really the perfect person to start talking to about that stuff. And then we're going to follow with Mike Taylor, who runs an ETF for Susan G. Komen through Simplify. We're going to talk to Jem Karsan. We're going to talk to Katie Stockton about technicals. We'll go through the rest of it as we go, but we've got a wide variety of experts from macro, from value investing, from options. I mean, we're going to basically cover everything you could conceivably cover in the course of a day here. So we've got a big day ahead of us, and we hope everybody will tune in. And like you mentioned, we hope everybody will give to Susan G. Komen. If you're watching us on YouTube, you can do it via the link that's attached to the video. If you're watching us on Twitter, or if you're watching us on LinkedIn, you can go to YouTube on the SpotGamma or the Excess Returns channel. And we will have the donate link there. So we hope everybody, if you get any value out of what we're doing today, we hope you'll support Susan G. Komen.
Absolutely, and we should mention Simplify ETFs, obviously, who is helping to sponsor this today. They're heavily involved with that charity, and so thanks very much to them for co-sponsoring, let's say, today's event.
Yeah, and is there anything, Brent, you're particularly excited about today? I mean, we've got so many great guests. We've got so many different wide areas. I mean, I guess you probably are excited about some of the options stuff, but yeah, we're going to cover pretty much everything.
Yeah, I mean, a lot of these people are people I've been aware of, obviously, from research pieces they've written in the financial Twitter sphere. But I got to highlight the guys at the very end there, the latest in technology and innovations. Obviously, as Imran and I were just mentioning, as everyone knows, that chip sector, the AI sector, was really just kind of going crazy. Everyone's talking about GPT-2 today. We got a couple of stocks, reporting today, and so that last but certainly not least thing comes in theirs, because those guys I think are going to expose or talk about some things that I think will be really interesting. So again, we really cover the gamut of factor, value, macro, option space, and then we're going to round it out, I think, with some really kind of thought-provoking conversations with Doug and Gene. So I'm looking forward to those.
Yeah, we wanted to change it up. We couldn't do options and macro all day, so we're going to do a lot of that stuff. But we wanted to also, bring in some different people. And Gene and Doug are really smart, and we can find out: are people going to wear the Apple Vision Pro? Is that going to change the world? What's going on with Tesla's self-driving? Is that going to become mainstream? I mean, we can ask them all the questions. People like you and me who are outside of that world that we don't know the answers to, and they can tell us what's coming. So yeah, that's going to be really cool. It's going to be cool to talk to Perth Toll. She's running an ETF, that invests in freedom.
Incredible story there.
Yeah, really good story how she got there, which is really cool. Like from the beginning, and I'll let her tell the story. I won't tell it now, but yeah, I mean, we're gonna have Jim O'Shaughnessy, who's gone from the factor investing world I'm in to being a venture capitalist. Matt Ziegler is going to talk to him about how he got there. So yeah, we've got a ton of stuff to cover, and yeah, we'll have Andy Constan here in a couple of minutes, and we'll get things kicked off. But as a reminder too, before we start with Andy, I just want to read something about the mission of Susan G. Komen, because again, that's why we're here today. Susan G. Komen is the world's leading nonprofit breast cancer organization, working to save lives and end breast cancer forever. Komen has an unmatched, comprehensive 360-degree approach to fighting this disease across all fronts and supporting millions of people in the U.S. and countries worldwide. Founded by Nancy G. Brinker, who promised her sister Susan G. Komen that she would end the disease that claimed Susie's life, Komen remains committed to supporting those affected by breast cancer today, while tirelessly searching for tomorrow's cures. So that's why we're here today. We want to keep that in mind as we go here. And hopefully anybody, again, the donate link is right next to what we're doing. I mean, I feel like one of those guys on the telethon that has the phone bank behind them. We couldn't put a phone bank in on short notice, but we are, and we have Andy here, so I think we're ready to go. So let me bring in Andy.
Oh, there we go.
Andy, thank you for joining us.
Hey, how are you?
Good.
Thank you
we appreciate you. I think you're probably up very early in the morning anyway. So
yeah, awesome to have you, Andy. I've been watching your Twitter feed a lot the last 24 hours. You have a lot of fun things to say, so I was excited to talk to you. And the Bye Felicia thing always makes me laugh, so I'm excited to dig into that with you as well.
Okay, great.
Yeah, we picked the perfect time to talk to you. Let me get my screen share off here. There we go. Yeah, we picked the perfect time to talk to you. We've got the Fed this week. We've got the QRA, which, to be honest, before you pointed out on Twitter about a year ago, I didn't even know what that was. But it turns out it's a very market-moving event. So we're going to cover a lot. But before we start, I just wanted to intro you. You're obviously you're Andy Constan, the founder of Damp Spring Advisors. And you have a perfect background to talk to today, because you've got kind of a mix of the systematic and the discretionary on the macro side. You were at Bridgewater, you were at Brevin Howard. You can kind of come at this from different directions. So We really appreciate you taking the time. And just a reminder to everybody, we're here to benefit Susan G. Komen. If you're watching us on YouTube, there's a donate link next to the video. You can click that donate link to give money. If you're watching us on Twitter or on LinkedIn, you can go to YouTube to donate. If you do get any value out of what we do today, we would greatly appreciate it if you would give money. It's a great cause. But before we start here, Andy, and get into all that stuff I talked about, I just wanted to talk a little bit about your framework, because you have a great framework that makes macro, I think, easy to understand. And this idea of islands. And you've always been talking about the different islands that exist, and you've moved a little bit between the islands, although you were in one for a really long period of time. And now I think you're kind of lost at sea, maybe thinking about where you're going to go next. So can you talk about your island framework and how that applies to macro?
Well, I mean, stepping back from the islands for a second, I look at changes in growth expectations, changes in inflation expectations, what the value of assets are by measuring term premium and risk premium, and then by using data on flow and positioning. And in this particular environment, the flow and positioning has really been driven by expectations of a soft landing. And there are good reasons for that. You know, we got through COVID, and then we had this inflationary burst as everyone came back and spent at the same time as supply chains were disrupted. And then over time, you know, inflation has cooled. It was, in fact, transitory at many levels. And so now the question is, will the economy go back to and land softly? And what that means is that inflation goes to target, and growth doesn't turn down so heavily as to create a recession. And that's a pretty unusual outcome, particularly after the sort of meaningful stresses and significant flows of capital that have occurred, and the changes in a 4-decade-long secular globalization to a less secular globalization pressure, and possibly even a deglobalization, at least cyclical deglobalization. So all those cross currents, those winds at sea, are make it a soft landing, very difficult. And yet, for most of the last year, the pricing of financial instruments has favored the idea that we will, in fact, soft land. Pretty much all of last year, the Fed's rate cut projections were overshot by financial markets. They expected more cuts sooner. And equity prices, normally cuts happen when the economy weakens, and yet equity prices priced in significant growth in earnings. So those combinations of things, made me think that we're priced, flow and positioning is priced for a soft landing. And so I was on an island I called higher for longer, and that was really about 18 months old. Soon after the first rate hikes, I coined that term, and used the Dumb and Dumber thing, higherer and longerer island to differentiate from higher for longer. In that place, the Fed raises interest rates but doesn't slow the economy, and the economy doesn't land, and inflation ends up being more sticky for longer. And what that means is that the Fed has to keep pushing. And so far, they haven't turned the economy. And so my view is that inflation has still some legs to it, and we'll see. But really, at the end of the day, I left higher for longer island and went out to sea because market pricing now has less cuts priced in both 2024 and 2025. Only 100 basis points of cuts are now priced in for all of the next 20-ish months, 13 Fed meetings, 100 basis points of cuts. So the market has already moved to higher for longer island, and in fact, positioning now expects the Fed to cut less, and I think that's ridiculous. So I've left.
Do you have any feeling where you're headed? I mean, I don't think you're headed to soft landing island based on what you said. And we did get, after we talked to you last on excess returns, we did get like some higher inflation readings. So, I mean, are you kind of turning the wheel a little bit back to higher for longer island?
I am not. I think that what matters, and this is where the QRA data that came out yesterday and will come out on Wednesday matters. I think what has to happen for inflation to be killed is not the Fed hiking more. They've hiked enough. Time at higher short-term interest rates and supply of treasuries, which we've now are beginning to get and have been getting since last summer, has weighed on bond prices and caused longer term yields to rise closer to current short-term yields. And that, to me, is the pressure that slows the economy. Not what the Fed has done on the front end, but what the market is doing on the back end. And that will cause the economy to slow. And I do believe that for inflation really to be killed, interest rates, long-term interest rates have to be well over 5% and persist there for, give it 3-4 months. We had that situation for 2 weeks in October. And of course, the economy slowed in the following months, but came roaring back in the first quarter. So I think we have to have a period of time where long-term interest rates are high enough to slow the economy for inflation to be killed. And I think that's the direction we're heading. Unfortunately, it'll slow the economy, not necessarily to a crash landing, but certainly a stall. And it may take more easing than you might have expected, and certainly more easing that's priced in to offset that stall so we still achieve a soft landing. But I think the more likely thing is I end up at recession island.
Given your focus on longer term rates and how much more important they are to the economy, I mean, do you think the Fed should have been focusing on QT more here? Or should they be focusing on it more now?
I've been writing that for 2 years. And I think they made a huge mistake tactically replaying the 2019 QT runoff strategy versus what the BOE does, where they actually sell bonds off their balance sheet to the market in auctions. I think they should have done that. I think they should have done that with mortgages. There are lots of offsetting factors because a lot of the banks would be stressed if they had sold those bonds. But by giving the runoff, by doing runoff, they gave the ball to the Treasury. And the Treasury has had reasons why they couldn't issue coupon bonds in size. And so that transmission mechanism was muted in the United States. And so, yeah, I've been saying for years now that the QT runoff strategy created problems.
Can you talk more about this idea of handing the ball off to the Treasury? Because this is something I learned from you. I was really focusing on what the Fed was doing, and you were focusing on what Janet Yellen was doing the whole time. Can you talk about why that's more important right now?
Well, ultimately, what matters to you can believe in supply and demand matters. I do. There's some people that don't. I think that supply of long-term treasuries that are new treasuries have to be assumed by someone who was perfectly happy to own risky assets before that and now has to choose to lever up to buy those risky assets or spend cash or whatever it is. And by taking on more risk, they want an excess return. And so when the BOE sells bonds to the market, long-term bonds to the market, that process works. And the BOE, Bank of England, pays investors an excess return over their cash to lever up to buy the bonds. When you do runoff, the Treasury, Fed did no selling. All they did is let existing bonds mature. And so so what gets sold to the market? How do they get their money back? Well, when the Fed gets its money back, it is paid for by the Treasury. And the Treasury goes into the market and borrows from the private sector. And so that is somebody sells bonds, but it isn't the Fed. It's the Treasury, and the Treasury gets to decide what to sell. And to the extent they sell bills, that doesn't require investors to take on much risk because they mature in 7 days to 364 days. To the extent they sell longer term bonds, particularly if they were to sell all 30-year bonds, there'd be a huge impact in long-term bond prices because 30-year bonds are super risky and people don't want them. So what they do is they sell a variety of bonds. And what has happened in the past, since October of last year, not last year, 2 years ago, is the Treasury has had other impacts on their issuance, which prevented them from issuing bonds during the debt ceiling, from November of 22 through June of 2023, there was a debt ceiling, and so they were limited in terms of how much coupon debt they could issue, long-term bonds they could issue. They still issued some, but they couldn't issue much. And then what they ended up doing is using their checking account, the Treasury General account, during this time of crisis in which they had no choice but to honor our obligations as a country while they negotiated with Congress to avoid the debt ceiling. And so that resulted in a stimulative effect to both assets and the economy, which ended up generating a 4.9, I think, percent GDP, real GDP in Q3 of 2023. So the things got pumped as the Treasury stopped issuing, muting QT, and spent what they had in their checking account, stimulating the economy. And so then they announced, hey, we're going to issue a ton of bills to rebuild our Treasury General account. And that didn't have any impact because bills, the RRP was a supply of demand for bills. And so there wasn't really any impact on issuing a ton of bills. And then finally in July, they said, you know what, we're going to issue a bunch of coupons. And that's when the market really began to sell off. And that's how that transmission mechanism worked. And then in October, they said, whoa, interest rates just increased by 120 basis points from the lows in July when we said we're going to issue a bunch of coupons. And they said, wait a second, we're just going to hold on and we're not going to increase coupons this quarter. Well, look what happened. Massive rally in financial assets. Bonds even rallied. Though they peaked in January, and soon after Christmas. And the economy heated up. And so it really is clear to me that the economy operates with a very short lag to changes in long-term interest rates. And so that's where we are today. And I think the economy will continue to act in that way. So if we see, for whatever reason, long-term Treasury, but without a change in the economy, but market forces pushing long-term Treasury yields down below 4.5 again, the economy is going to heat up. And if
it's
not,
been amazing.
The economy should weaken.
Yes, it's been amazing to me how market moving this is. And you didn't need, and one of the things you talk about on Twitter is you don't need to necessarily predict what the Treasury is going to do. You sort of react to them once they do it. So it's not something you have to try to front run, but definitely it's been amazing to watch this and to watch the market go up, when they're issuing less duration and the market go down when they're issuing more duration. So it's been eye-opening for me to just see this happen.
Yeah, I mean, I think that's, so normally news gets discounted and there is no advantage. You have to be able to predict the outcome to make money in markets, and that's super hard. And so most things, whether it's Amazon earnings or the employment cost index that we're about to get, all of these things you have to predict to be able to make any money because they're fully priced in. These flows, and the QRA was a sleepy report for most of my career, 36 years career. It only became interesting about 2 years ago when QT was announced and the budget deficit was so large. So those combinations have caused it to be relevant. But the flows around quantitative tightening and quantitative easing just cannot be front run. They are too large for everyone to say. So for instance, we had QE after COVID. At 2,800 on the S&P, people were like, this doesn't matter. QE is not going to be a big deal. Look at COVID. It's going to be all the thing. And in fact, that was the easiest buy in history post-COVID, because the quantitative easing was going to elevate financial assets. On December 15th of 2021, the Fed said, we're looking at our balance sheet. And then in the minutes in 2022, they said, in January 2022, they said, yeah, we're going to do quantitative tightening. And even though that took 6 months for them to actually engage in quantitative tightening and continued to do quantitative easing for 3 months, the markets reacted, and that was the high for 2022. And we all know what happened to bonds during that period of time, and equities followed. So these massive flows just cannot be front run. And so you have to be patient and, willing to take some short-term pain as you position against the news, knowing that you're likely 3 months from now, you're likely to look back and say, yeah, those flows matter.
It's amazing to me. We can have these indicators that we don't pay attention to for our whole careers, and then suddenly they're really important. I remember the CPI report for most of my career, nobody cared. And the same thing with this funding announcement, and then suddenly it's on the radar and everybody cares. I don't know what that means, but it is interesting that this type of stuff happens.
Well, we'll see. I mean, because these happen so infrequently, and there's still, quite a lot of people who don't believe me, who look at these QRA and say, man, what the hell's the difference? And that's because they tend to be very short-term in their thinking, that they think it's going to have a signaling effect and cause a market reaction instantaneously. And that's just not the way this indicator works. So, I don't expect it to last forever. What I actually expect is the QRA becomes less relevant because it becomes more stable, which is as QT ends, which is probably going to happen within the next 12 months, but not soon. And the budget deficit stabilizes, the impact of issuance is going to, and Treasury extends its duration, stops using bills as a plug, but extends. The effect is going to be significant and put pressure on asset prices for the next couple of years, but it won't be as volatile.
So to get to the question everybody wants us to ask, the announcement is tomorrow. What do you expect?
I expect them to keep coupons the same, though the announcement yesterday regarding the total issuance was much bigger than anyone expected, which indicates it's almost certain they have pressure to increase coupons, but I don't expect them to do that. And I expect them to announce the duration neutral Treasury coupon buyback program, which is going to be small. And then we'll be on to the Fed. So I think most of the news broke yesterday, which is that the coupons sizes are not getting smaller. And the Treasury General account is getting larger. And both of those things are sort of anti what some have been calling for regarding political usage of the issuance, Treasury issuance to ensure a Democrat victory. I think that narrative is dead based on the QRA we got yesterday, and thus tomorrow's QRA is actually, really just confirmation of what I think I know now. And then we'll see what the Fed does, and I expect the Fed to delay tapering QT for another meeting. One of their big concerns is the level of the RRP, and it dropped to $325 billion on tax day, but is now up to $500 billion, and it doesn't really call for any concern about financial stability at that level. And so I think they delay taper at least one more meeting, but ultimately they're going to taper, and ultimately they're going to stop. And but the important thing is they're tapering runoff. Treasury has a bigger problem. It has issued far more bills than it normally does. And they're going to need to lock in term funding over time. And so even though taper happens, remember, the mechanism has nothing to do with runoff. It has to do with what gets issued. And so as long as what gets issued is coupon debt, assets are going to be under pressure until they're priced better.
It's funny. You would put a poll on Twitter. You just explained what's going on with the QRA, but you'd put a poll on Twitter about will Janet, 1, materially reduce coupons, 2, spend down the TGA to well below 700 billion, 3, fund buyback of bonds with bills. And you had 1 pump, 2 pumps, or 3 pumps, and pretty much everybody picked 3 pumps. And it seems like we are getting the opposite of what people thought we were going to get.
Yeah, that's what I did that because I knew what the answers were going to be. I knew people were going to say they're going to pump because, Twitter's a political place. My clients that are, though some of my clients did think that there's, some political agenda, but my large hedge fund clients were not surprised by both the results and my view that they weren't going to pump at all. And so we'll see whether again, no one's front running it, so it's still going to have to take its time to play out. But Twitter is a place where political narratives are, you're going to get that result. And I got it in spades. And obviously they're wrong and badly wrong.
Andy, so do you think there is no kind of election effect? Obviously, you just sort of say the Treasury related stuff, but do you think that there's any sort of positioning or flows that change just around that election, even if it's just energy or whatever it may be?
Yeah, I think so. One thing I think matters is policies matter, politics don't, and I would expect changes in policy if there's a change in the administration, and certainly changes in policy if there's in either case, a unified Congress and presidency. I don't know if those outcomes are going to occur, but you have to begin discounting them. And so certain sectors are going to do better under one unified party versus the other unified party. And so it's not my lane to care about, well, I care about it, but it's not my lane to invest on single names. But single names are going to have significant issues around this. As it relates to macro, policies matter. And so, but what I would say about either unified outcome, the deficit's going to go up. Who pays for that increase? In one case, you're likely to see corporations and high net worth people see lower taxes, and the spending will potentially be cut, but not in enough to reduce the deficit. While on the other hand, you might see higher taxes, but higher spending, and that will continue to increase the deficit. So I think either party is going to have policies that are deficit increasing because no one is willing to take the pain. Our elected officials get paid for providing a bigger pie for current voters at the expense of a smaller pie for future voters. And I don't think anything of that will change. And so, yeah, I mean, I think that's, there are small issues, there are country issues, tariffs, et cetera, that might be worthy of, anticipating the outcome of the election. But also anticipating the outcome of the election is a low odds bet for me. I think really the election is going to hinge on 4 to 5 states and 2 to 3 counties for each of those states and how that falls out, because that's really all that matters when it comes to an electoral college decision. And I just can't predict that.
And I had seen recently you had mentioned that the equity top is in specifically the S&P, and I take from our conversation here that that's not just maybe a statement for this year, but possibly for several years out in time. Please correct me on that if I'm wrong.
I would say this. I would say that I think equities are going down. I think bonds are going down, and at some point, central bankers may, or policymakers may, address the decline in asset prices and in the economy, particularly if we have a recession. And in that case, you could have a rally. And at any moment, in any time, animal spirits can cause us to blow through Felicia's top. So, this is, the direction is the idea.
Sure.
Do I think it'll be a long-term top? I don't know, honestly. I hope not. I've been a bull for most of my career. and I would much prefer to be a bull. And so what I'd like to do is see bonds with a term premium that makes them attractive relative to cash. They don't have that. And I'd like to see stocks with a equity risk premium or whatever sort of metric you want that I'd like to see earnings that are likely to rise instead of fall relative to expectations, and multiples that are more in line with where Treasury yields are. And if so, I'm going to be a raving bull. And I hope that happens soon.
And so can we just also think along those same lines in terms of volatility, that we've been in a pretty low volatility environment, generally across all assets, particularly before April. Is that regime likely to now shift in your view, kind of cross asset vol just generally picks up from the lows we've seen recently?
Well, if I'm right on supply mattering, that tends to create positive correlation with all assets, which tends to mean diversification benefit goes away and you start to see individual asset volatilities rise. So if I'm right on that, yes, I think mostly portfolio volatilities will increase because of lower diversification benefit, like we saw in 2022. But individual asset volatilities, that's a different thing. And I wouldn't say that, gosh, you got to go out and buy calls on VIX, on VIX futures. Frankly, I think what that assumes that this happens, this deleveraging I'm describing, which I think happens fast. And I don't think it's a fast thing. I think it's a slow thing. And the economy weakening will be a slow thing. And so I'm not pounding the table on vol here. I do think portfolio vol's going up, though.
As we wrap up, we have one closing question we want to ask everybody today in the couple minutes we have left, and it's, what is one interesting thing you're seeing right now that you think others should be paying more attention to? And it could be outside investing or inside investing, however you want to take it.
I didn't come up with a good answer because I think I look at the thing that no one's looking at, and so I would say the QRA and the supply and demand of assets. But I guess what I would say is that I think it's getting a lot of attention now, but I do think that China is oversold, and it is the year of the dragon. And I wrote something about that before the market rallied in early February. I think that's going to be the most interesting thing, whether China assets outperform U.S. assets in the next year.
Well, thank you again for joining us and for helping raise money for Susan G. Komen. If people want to find out more about you or about Damp Spring, where can they go?
Well, I'm at Damp Spring on Twitter and dampspring.com on the internet.
Well, thank you, Andy. We appreciate it.
I appreciate what you're doing for the charity. My dad passed away with cancer 2 years ago, and this charity means a lot to me.
Thank you so much. All right, Brent, we are complete with one interview, and we are ready to keep going here.
We dove into the deep end of the pool there to get started.
Yeah, exactly.
With Andy, great
I think we're going to be in the deep end of the pool all day.
Yeah, that's right. It's a lot of deep thinking there, for sure. And so we're going to get ramped up here next with Michael Taylor from Simplify ETFs, and he's got a little bit of a different background, I guess, from Andy. If you want to kind of give us a background on him.
Yeah. Let me let Mike in here, and we can. I'll give you his background while he's here.
Awesome.
Mike.
Hey, how you doing?
Good. How are you? Thank you for joining us. We appreciate it.
Back so my head gets smaller. Like it's big enough already. I'm trying to get the pink in there. Okay, we won't. We're just going to get my goddamn face.
Well, we really appreciate you taking the time to talk to us today.
Oh, my pleasure. Thank you so much. Thank you for putting this together.
Yeah, it's our pleasure. And as we'll talk about in a minute, you're doing, we're doing a one-day thing here for Susan G. Komen, but you're doing something every day for Susan G. Komen, which we'll get into when we get into the interview. But first, I just want to intro you. You're the manager of the Simplify Healthcare ETF. You've worked at a lot of hedge funds that would never hire me under any circumstances. You were a scientist, so if we wanted to talk to somebody about healthcare, you are definitely the guy to talk to. So again, thank you for joining us.
Thank you so much for having me. And healthcare is a humbling because we don't have it all figured out. I don't have all the answers. In fact, my wife would tell you I have none of the answers, and if I did, they're wrong anyway. So it's a pleasure to be here, and thank you so very much. And I'm so glad to help out.
But there are so many cool things going on in healthcare right now, and we're going to get into those with you because from someone on the outside, I probably don't understand them that well, but there's definitely some groundbreaking stuff going on. So as we go through the interview, we're going to get into that. But before we start, I just want to mention again why we're here. We're here to support Susan G. Komen. If you're watching us on YouTube, there's a donate button next to the video or under if you're in mobile. If you're watching us on Twitter or on LinkedIn, you can go to YouTube and donate. If you get any value out of what we're doing today, we would really appreciate it if you would donate. It's a great cause. And we'll get into that in a second. But if you can donate, if you're watching, we would greatly appreciate it. And with you, we're actually going to start out with Susan G. Komen because you actually started an ETF for the benefit of Susan G. Komen, which is really, really cool. So I'm wondering if you could just talk about Simplify, the Simplify Healthcare ETF and what you're doing there.
Sure, absolutely. So Simplify approached me several years ago to put this together. And it is the first ETF actively traded by myself. And the fees associated, the profits that would go to Simplify, go to the Susan G. Komen Foundation for breast cancer. And so I get the honor of giving to the Susan G. Komen Breast Cancer Foundation every single day. And this is what I do for a living, essentially trade this fund and give it away. And so our investors get to keep the returns, but the very modest fees that are associated with this will go to that charity. And I should add that it changes every day, but I'm among the very top shareholders in the Pink Fund. So I trade it as if it is my own money because very much it is my own money.
It's such a cool idea. Like, where did you come up with the idea? Like, it's really interesting.
Mike Green and I had been kicking it around. For those of you that don't know the much esteemed Mike Green, he's brilliant. He's as brilliant as he is tall and good looking. And he a wonderful guy, and he works at Simplify, and you can see him on almost one or two financial programs every single day. Incredibly active in the community and a very, very good friend. He and I have been close friends for got to be 15 years or so. And we talk about it every day. But he approached me about this many years ago, what to do, how can we get something together, and this was the result of those efforts.
Can you talk about your background in healthcare? Because you were actually a scientist, right, before you were a money manager?
Sure. Yeah, I did drug development, old school, belly to the bench, as we call it. And so I developed drugs in the 90s. And then discovered that this job existed. I didn't know. I lived in a laboratory, so please don't blame me for not knowing every job that's out there. As soon as I discovered this job existed, that was the moment, aha. And I went to business school to learn what finance was. And then I went to Wall Street, and I was very fortunate to right away get a spot at Oppenheimer Funds as their head of healthcare in a very short period of time. And then just ran with it from there. Ended up at hedge funds in the 2000s, and then spent most of my career at Citadel and Millennium. And that's where my fund, Critical Mass, came together at Millennium, and I ran that for most of my career, and really for the past 20 years. So doing the Pink Fund is certainly not a big leap from what I normally do.
Do you think your background as a scientist helps you a lot in investing? Like, you see a lot of really successful money managers come from an area completely outside of investing and then be really successful. I mean, do you think that helps you?
For the most part, it helps. You always have to be conscious that over time, being an expert in something, you garner biases. And those biases can be, I don't want to say, they can be good and bad. Good because I can weed out things that very quickly probably can't work. But bad in the sense that the rest of Wall Street can't do that. So you can have tremendous trading opportunities that I might overlook because of my biases. And that's something I try to stay very, very conscious of, is that it's not what I know versus what they know. It's when are they going to figure out what I know? And that is the trade. Early is being wrong. So I have to be very keen to the perceptions as to any new technology out there, and just if I think it's not going to work, that doesn't mean it can't be a great trade to the long side. Or if I think the market is much smaller than the street believes, that's a different trade. There's a run-up trade into the great anticipation. And those are the things that I have to really monitor and think about in order to make money for Pink. Because at the end of the day, my job is not to be right. My job is to make money. Being right is for people who write books, for the most part.
That was a really cool quote from our original interview with you that I shared on Twitter, which is this idea of you go big when they figure out what you already know, which is in terms of position sizing, which is a really interesting way to look at it. It's not a way I'd thought about it before.
Yes, I'll give you an example today. There's a chemicals and materials company called 3M. And they just reported today, and it is coming out to, they are figuring out what I know. And this is a big position in Pink that's way outside of the benchmark, meaning that it's not represented in the benchmark, so it's a meaningful bet. And it's up, I don't know, 6, 7, 8% today, and I think that this probably has 50 to 70% upside over the next year as new management takes over, and we have a management turnaround for what has been a troubled and forgotten company for a very, very long time. It's extremely cheap, and I think they're going to be beating on revs and margins, and maybe meaningfully on margins as management improves the throughput at the company. These are the sort of things that I will spend a lot of time on, figure it out, have a position on, and then wait and watch for that moment that they start to figure out what we've done the work on. And that's a great example, and it's represented in very large size in the Pink Fund.
Can you talk just at a high level about what you're seeing like in healthcare right now, what you think the biggest opportunities are at a high level?
At a high level, so there's always going to be new product stories. And that's one of the great things about healthcare, is that there is always new innovations that are coming and going because they expire on their patent life. And so that's one thing that's ongoing all the time. And that's part of my job, is to dice through that and figure out what's going to work and what's not going to work. The other piece that's very meaningful is what the macro economy is going to do. Healthcare is sort of stuck in between defensives and offensives, meaning growth stocks when the economy is good. And we are very likely moving into a transition where the economy is going to decline very, very quickly. And so I have to think very hard about how to position for 2025. And that's what I'm spending an awful lot of time right now. Just about every single really, really great trade that I've ever had is a year to a year and a half in the making. And that's what I really try to time things out, is understanding what's going to happen in a year and then when to put it on. And so I'm thinking an awful lot about how to put this book together for the fall, thinking about not the fall, but thinking about 1Q, 2Q next year. So those are the things that I'm working on and thinking about from a top-down level.
Yeah, I can assume that's a pretty challenging thing, because you've got these great companies doing really innovative things, but then on the other side, you've got the economy, and they're influenced by the economy like everybody else. So balancing those two things, I would assume, is a huge challenge.
I have to be very, very selective and nimble. And I treat it like it's my money. So I'm just going to pull up while we're talking here my portfolio in Pink so I can speak to it if you need me to speak to it.
Can you talk about just some of the innovation you're seeing in healthcare? Like people like us who are outside of it, I mean, we know there's world-changing things coming, but we don't know exactly what they are. Like, what are the areas where you think healthcare is going to change the world the most, in the coming years?
Healthcare is incremental, like many scientific projects. It's all baby steps, and there's rarely giant leaps. Now, a giant leap, though, could be a big product like the GLP-1 class for weight loss and heart disease. But that's not a new class. For instance, it'll be an innovation maybe to the public because they're now finding out about it, but it's been available for 7 years in different forms. More than 7, in fact, 10. So it's all incremental and it's baby steps. But I will submit that those baby steps over the past 20 years have added up to profound results for patients and payers and doctors and productivity for the world. When I started, the antibody, that was new 25 years ago. There was only a handful available, and they can, for the most part, turn off certain protein or signaling pathways that delivers tremendous results to a disease, specifically cancer, autoimmune, things like that. And now, over the past 20 years, now we have viral gene therapies, RNA gene therapies. We even have kind of gene therapies that will insert new genetic information into certain types of cells to have a profound impact. This is all new. When I came onto Wall Street, I was a molecular biologist and a virologist. And if you went to the textbooks that I just walked out of and the classes I just walked out of, we thought we had it all figured out. We knew how a cell went from a signal to the nucleus to change the DNA read profile, to make the RNA, to make the proteins, to have an impact in development or a morphological change in the cell. And we learned that, yeah, that's totally not how it works. There's many, many, many more layers of editing that occurs in between here and there. And so even the dogma of how things work in the cell has changed profoundly in the past 25 years. I submit that it will change even more so in the future, and we will learn new things about how our bodies work. What's significantly different, though, is the velocity. The velocity has changed. The toil that I used to do at 2 a.m. in the laboratory in 1998 is epic. And it was one guy with pipetters and going from heat bath to cool bath to a fire to whatever, to a machine that could code out my DNA and read it. And I have to go with a ruler going through and say A, T, G, G, G. You know, I'm literally reading it by hand. They don't do that anymore. Machinery has taken over much of this. And so you don't have the guys in the lab at 2 a.m. toiling as much. Now you have 100 machines doing 2 million times the output of what I could have done by hand 25 years ago. That's what's changed. And that has changed the velocity and the, let's say, the fidelity of what can be done. We can go now from the whiteboard over here, from an idea to the whiteboard to a drug concept screened pretty darn quick now to animals to human in sub 3 years. That's incredible. And I don't mean approved in 3 years, but I'm saying you're in humans from an idea on a whiteboard within 3 years or sooner. And that is breathtaking, how fast the velocity is. So the amount of content that has come out scientifically is stunning and overwhelming for an analyst trying to keep up with all this information that's constantly getting poured out. And that's really part of the battle, is how fast can I learn? How fast can I process and then trade for the pink fund?
You mentioned GLP-1s. I mean, to an outsider like me, it seems like that is a game-changing thing. Is that the case?
Well, in my view, there's probably about 75 million Americans that should be on a GLP-1. So about 25% of the entire population or so. And so that's profound. Look, humans are designed to pack on the weight because, through evolution, genetically, our biggest fear of our bodies and our primal mind is don't starve. And so we are programmed to overeat and put on weight. And while that will keep us alive in the short term, while there's no food in the winter and we're in a cave, in the longer term, it has terrible impacts on the body, around the cardiovascular and so forth, and a lot of inflammation. This is the first class of drugs that can, let's say, fool the body into thinking we're sated. Not all the time, not completely, but for most people, you simply eat half your lunch instead of all your lunch. And that reduction in caloric intake has a profound impact on the body and the mind. So, and it's a good one. So I think that it's going to be a gigantic drug class, the biggest ever, and I can't wait to see what comes out next. And again, it's all incremental. We're going to see these injectables go into more of a pill format over the next 3 to 4 years, and that will extend the IP life for many of these companies. And then that too will go generic. And so 15 years from now, we're going to have a whole suite of drugs that are going to be for pennies every day and can have a profound impact on the weight and cardiovascular health of patients. So that's incredibly powerful for humans to live better and live longer. So GLP-1 is going to be big. It already is. It'll be much bigger.
Mike, can I ask on that point? I mean, I think LOI, it's up 5, 6, 7% this morning. Is that trade likely done because that information is fairly well known at this point, or do you think that there's more kind of life left in that trade?
Oh, there's tons of life in that trade, in my view, and the reason is it's not covered. The drug is not covered largely for Medicare patients, and that's really where the big market is everybody 62 and over. You know, of the folks that are 62 and over, probably half should be on a GLP-1. It will greatly improve their lives. They're sleeping. It'll improve sleep apnea. It'll improve their hearts. It'll improve their liver. It'll improve their kidney. It'll improve their mobility. It'll improve their hips, taking the weight off of those old hips. So, and that will be covered incrementally throughout the year and years in the future. The government doesn't tend to do it all at once. They like to take their time with these sort of things, especially when it's really good for humans. They like to say, well, maybe not, in my experience. They're more concerned about the financial impact than the health improvement in their patients.
Another area that people mention a lot in terms of something we're going to see a lot of innovation is this idea of aging. I don't know if it's going to be too late for me, but it seems like we're going to be doing a lot of stuff in that area. Like, what are you seeing in the area of aging?
I see a lot of early science for the most part, but I do think that is very likely in our lifetimes going to be the next really big drug class. Just because I think we're getting closer and closer to having a plan on how to attack aging, and part of it is figuring out what is aging. That's what is it. For a while, I thought it was because the caps of your chromosomes start to decay, and that's a sign of aging. And so they tried a number of drugs to extend the caps of your chromosomes, things like that. Didn't work. But I don't want to go into all the details of it because I don't want everyone to fall asleep. But that is something that I'm watching. And you know, the thing is about science, which is so great, is that I won't miss it because I will be watching this like I have been for the next 20 years sitting here reading, just like I did for the previous 20 years sitting here reading. And it's all small increments as we move forward. So it won't surprise anybody. I don't think there's going to be any big shocking drugs that come out. One that's extremely interesting to me that I should bring up is Regeneron is going to have go into patients for a drug that may be able to cure allergy. That is really, really, really big. There are millions and millions and millions of patients that suffer from severe allergy. And that'll be the first time we can see an outcome from here. But I'm looking forward to those first patients. And I think on paper, when I write it down and I go through it, I'm like, that's probably going to work. So we'll see. But those are the sort of things that I'm very interested in, and everything else, honestly. But I just wanted to give you a couple examples that are big.
How about cancer? I mean, we're here today to support Susan G. Komen to help fight cancer. Like, what is your outlook for cancer? I mean, is this something we're going to be able to cure or at least reduce to something you can live with over the next, 10 years or so?
I think that's the key. It's developing a relationship with cancer where it's there, but it doesn't own you. And I don't know if we'll ever be able to get rid of it for many patients. I think it'll just be let's say an armistice where we simply have agreed to the lines and we will not cross them. So the cancer is there, but it's in check. And so we have this ongoing battle in your body of we're fighting the cancer back, and it stays pretty small. The drugs are there to help, and you can get on with your life and live a pretty darn normal life. And we've seen that in many classes, especially leukemias, where patients will still endure a leukemia for a very, very long period of time, and they will live to a ripe old age and die of something else. So we're getting there, and it will be incremental from one cancer to the next. But when you look 20 years down the line, we're probably going to see that for most cancers, where these things will just simply be in check and you can get on with your life. And diagnosis will play a very big role in that, finding it early. Right now, we're at the spot where there's been a lot of efforts to try to find cancers, detect cancers early with a blood test and so forth. Unfortunately, they're not very good, and honestly the results that you get are not terribly useful because your cancer level may be so low that they can't find it. So what do you do with that information? Do we treat? Do you just live under a scary cloud for the rest of your life, knowing that maybe kind of sort of somewhere you have cancer and maybe you don't? So we're not at the point, I think, where that can be prime time. But again, it's incremental, and we'll get there into the future.
You pulled up your holdings, so I want to give you an opportunity to use them. Like, how do you think about taking all of this innovation we're seeing in the healthcare space and turning it into a portfolio?
Look, our job for making a portfolio is to deliver asymmetric returns. And sometimes it requires having a lot of innovation in that book that is not well understood. And there are other times when you want to not have that innovation in the book because that's not the right time to do that in a macro sense. So I do move it around an awful lot, like I would and do my own money, figuring out what is correct in the risk-reward paradigm. So, for instance, right now, our largest position is a gene therapy company called Sarepta, and I believe that they are going to get a very large label at the FDA for Duchenne's muscular dystrophy. And the over-under is that most folks don't think so because the data that they came out with in their phase 3 was imperfect. And that's sort of the argument. I looked at this and said, no, the FDA is going to sincerely like this. And that's the debate. And so I can think about what the risk reward is there. And so we have a meaningful position. That information, what's called the PDUFA date, the approval date, will come in June. It might come a little sooner. But I think that the MPV, when you take a look at this company, for instance, I think that they're going to do over $5 billion in revenue next year, and it's around a $12 billion market cap company. And what the investors are getting wrong is that there's a meaningful residual. There's a meaning that there's a large population, well, it's small, the population for Duchenne's muscular dystrophy, but the incidence of DMD, Duchenne's muscular dystrophy, the incidence of DMD will still garner for them about $1.5 to $2 billion a year in residual revenue once they go through the DMD population. So when you add up the sort of NPV of this company in their market, I think that this is worth closer to $30 billion rather than 12. So I would anticipate it doing extremely well this year on the numbers that are going to come out and the label that'll come out. So those are ways how I think about our investments. Normally, I wouldn't be as large in a company like this, in this book or even my book or any book. But when you do find you have asymmetric understanding and you believe that you have the nuts, you have to bet like you have the nuts, because my job is to make money for you and make big donations to the Susan G. Komen Foundation. So that's what we're going to do.
Hopefully both with the ETF and today we're going to do that. Just in the couple minutes we have left, just a couple quick questions. You had mentioned earlier you're not very optimistic on the economy, so I just wanted to give you an opportunity to talk quickly about why that is.
Well, let me phrase it like this. I am optimistic that the innovation that comes out of the U.S. economy and the United States in general is unparalleled. And so this is really the place to be investing for the most part. Smart people, an accommodating government, and meaning that they allow business to flourish for the most part. And you put those things together and it generates great things. And we've seen this now for 200 years out of the US. But for the past over a decade, we have had a command economy, which we've never really had before, especially during non-wartime, a non-crisis moment. And the government has determined what the GDP is by overspending, and overspending in a grotesque way. And it's fine until the bill comes due. And we are witnessing right now that bill coming due. Think about the government, how it's financed. It's financed essentially for the vast majority on 5-year paper, like a ninja loan, right? It's a teaser rate, and it begins to roll over every year. And we had tremendous spending, and as this debt rolls over, they're having to pay higher and higher and higher interest rates. So that next year, the interest, the coupons that they'll have to pay is about $1.7 trillion rather, and in total. And that's as much as Medicare and Medicaid put together. So that number used to be a much, much, much smaller number of the budget. Now it's huge. And we don't get anything out of it, meaning that there's no fiscal spend that gets drilled into the economy with them paying those coupons. This is sort of the downfall of government largesse. And so next year, in order for us to have similar GDP growth as we did this year, which was modest, the government is probably going to have to spend $3 trillion of excess fiscal spend, meaning that they'll be bringing in about $5 trillion of taxes, which they spend, and then $3 trillion on top of that, and maybe more. I don't think that can happen. I don't think they're going to get a budget that even remotely looks like that. I think it'll be a more sanguine and a touch more balanced outcome. Well, people might applaud that and say that's great. Well, it's not great when you're in a command economy. That spending reduction, or let's say less of a comp, the reduction in growth, will have a profound impact on the overall economy. So I think we're setting up for a very, very difficult 25.
Well, thank you so much for joining us. We really appreciate it. This was awesome. Thank you for helping us raise money for Susan G. Komen. We really appreciate your time today.
It was absolutely my pleasure. And we went to Susan G. Komen because they can deliver big results from big checks. And many of the funds, charities out there can't do it. They don't know what to do with a $5 million check. And that's where we want to be. So I applaud them for doing such an amazing job and putting that money to work in a great way. And we'll just keep forging ahead and putting up the numbers, all right?
That's great. It's a great cause. Thank you again for doing this.
All right. Thank you, guys. Have a great day.
You too. There should be a little red leave button, I think you can see.
Oh, you want me to leave?
Yes.
Okay. I'll leave.
Thank you again. We appreciate it.
Thank you again. I'll leave.
All right, Brent, we should get right into croissant time here, I think.
Yeah, that was an awesome conversation with Mike. I found myself more just so like tied into what he was saying and talking about. It's such an interesting sector.
It's really interesting. Everything that's going on in healthcare right now is so interesting. Like the world's going to change in so many great ways. So
Yeah.
it was really cool to be able to dig into that.
Yeah, and a couple
So-
stocks to look at too, so that's always good.
Let me let in Jim.
It doesn't look like him.
He's not here yet, but we will. So there he is.
Hot swapping.
It'll be a good time for us though to talk about what we're doing here today. So just a reminder to everybody, we're here for Susan G. Komen today. If you're watching us on YouTube, there's a donate link next to the video or under the video in mobile. If you're watching us on Twitter and LinkedIn, you can go to YouTube and you can donate. You know, if you get any value out of what we're doing today, you're about to get some breadcrumbs here. So if you get any value out of that, you know, please do donate. It's an awesome cause, and it's why we're doing all this today. And with that, Jem, thank you for joining us.
Hey guys, good to be here. I just want to say my little bit about that as well. Obviously, for those of you that don't know, I lost my wife about a year and 3 months ago to cancer. And just want everybody to know, like, there is no higher cause, right? The amount of pain and suffering that cancer causes in this world, you know, it's something that we are making great strides towards. So hopefully, if we have been able to help any of you over the years, any amount, $10, $20, $50, whatever, it's such a worthy cause and much appreciated.
Yeah, we're so sorry for your loss, and it is a great cause, and you know, hopefully everybody will donate if you can. Hopefully everybody will donate today as we go 12 hours to try to raise some money for them. So just briefly to intro you, I assume our YouTube feed is spiking uncontrollably right now, so we probably don't need to intro you, but we will anyway. You're the founder of Kai Volatility Advisors, and you have a very unique blend of being able to look at the macro, but also being able to look kind of in the short-term options world. And so I'm going to handle the macro today, asking you some stuff, and we actually have an expert who could ask you better questions on the options world than we usually do with Brent here. So I'll handle the first part, talking about macro, and then Brent will dive in, and hopefully we'll get some breadcrumbs for people. But first, I just wanted to talk about where we are in general. I mean, you've been in the higher for longer camp for a long time. Inflation has definitely remained stickier than people thought. It's even spiked up a little bit recently. Like, where do you think we are? Can you just give us an overview of where you think we are in the macro landscape?
Yeah, I think it's important to zoom out. Jack, you and I have talked about this a decent amount, but so I won't tell that, I can go into 30 minutes just about the background of where the inflation is coming from. But the core point here is that populism is a reaction to 40 years of inequality. And that's a global phenomenon. This is not the first time this has happened. You can look back to 100,000 years of history. This is how things work. Stratification expands, inequality, and then you get a reversal. And the reversals tend to be quicker than the expansion. The important part is labor. Youth is labor. And the older generation, baby boomers in this case, are capital. And so what that ends up doing is it creates cycles. And we're entering, we've been entering a cycle of populism. It really started about 12, 13 years ago with Occupy Wall Street and the Tea Party, right? But the millennials had not reached political dominance yet. And so they were not able to move the needle. It took the bringing of not just the left moving left with AOC and Bernie Sanders, but importantly Trump, to kind of bring the right left and eventually start passing massive fiscal stimulus and protectionism. Protectionism is tied intrinsically to populism. People care about countries care about their own people, but when we talk about capitalism, we rarely protect our own companies. We're more profit seeking than anything with our corporations, and that creates globalization and whatnot. During those times, we are in a period of now protectionism and deglobalization. That tends to drive global conflict, higher labor costs, less expansive supply chains, all kinds of things, commodity scarcity. If you look back at this, the last time we had that period, 68 to 82, which I often reference, that's the last time we saw inflation go bottom left to top right, and interest rates do the same. We saw the same things that we're seeing now. We saw a Great Society program and massive fiscal stimulus. We saw, paired with that, a Vietnam War, a Cold War that was a massive expansion, and an OPEC crisis and commodity scarcity. Any of those sound familiar to anyone? Those sound like some things that we're seeing now. It's not a coincidence, right? And so once these things get started, they tend to feed on themselves. This is not a 1 or 2 year thing. This is not a 4 or 5 year thing. This is a 10 to 15 year phenomenon. And that creates structural inflation. Now, that doesn't mean we're going to have inflation every year that's going to be high. If you look at 68 to 82, inflation went to 7%, came all the way back down to 2, actually below 2%, 69 to 70, 70 to 71. Took back off when the Fed and stimulus came back to support a recession, a multi-year recession. That eventually took inflation to 12%. We then, in 75, 76, created another recession, a deeper, more powerful one, and inflation came down to 4.5% again. Well, the next leg up was 22% at its peak, I believe. So this is kind of how it works. And in my view, if you ask where we are in this, I believe we are in the end of the first inflationary push, and we are now in the process of trying to battle that inflation. And it is driving, it will lead to some significant growth slowdowns like we're beginning to see. As that happens, inflation will come down. It will probably get to 1.5%, and we will declare victory. We've already tried to declare mission accomplished here in December. I believe the Fed will be forced to pivot. This is an election year. That's very relevant to the macro conversation. It's relevant to 68 to 82 as well. During those election years, during that period, we saw greater than 20% returns in markets, double digit every time, 21% on average. Those were because of massive fiscal and Federal Reserve support during that time. I believe we will see that again, but in the context of that, we saw 0% nominal returns, 70%, 67% negative real returns over that time period. And I do believe this is a very poor time for equities broadly, in a bigger macro picture, despite what is likely a positive year within the context of that. So we'll stop there, and I'll let you ask some more questions, but that's the big, broad macro framework in 5 minutes.
You mentioned the 70s, which is everybody's worry right now. Do you think you mentioned some similarities. Do you think there's some major differences as well between now and the 70s?
Absolutely. It rhymes, right, because of this inequality and the populism that's a result of it. But market structure is very different, and we've talked about this. But there were no, derivatives were just being launched in the early 70s, right? They weren't, there were no structured products. This market is a very different type of market than it was, when we had that last similar political reality. So I think that has a major feedback loop. We've talked about how dispersion has been driven by structured product supply and vol compression. That has a feedback to that equity complex, which helps support the equity complex and can extend cycles longer than they used to be and reduce volatility. I think that's a critical, important point. The other one is, a lot of people talk about this. I think this is less important in terms of real returns. I think it'll affect nominal returns. But I do think that the two other things are very important. One, the U.S. debt, right, and how that will play into the reaction functions of government. We're at a very different governmental debt level than before. And then obviously we unpinned from gold in 71. And so that also had some distinct effects during that period that may be slightly different now that the Fed has more experience, more dominance, et cetera. So I would highlight those three things as probably the most important factors that are different, and that will help affect kind of some meaningful differences in how things react this time around.
How do you think about, for many years we had these structural forces that were keeping inflation down. We had technology, we had demographics, and we had globalization. And at least that third one seems to be reversing now. But how do you think about all those in terms of like the structural inflation? Like you mentioned, we're going to have cyclical moves up and down, but how do you think about those in terms of the structural inflation we might see going forward in a longer period?
They're all related. You said technology, globalization. What was the third one you said?
Demographics.
Demographics, that's right. So they're all related, right? Ultimately, if you look at what's happening demographically, we have a dominant baby boomer generation dying off, right? So that's reducing labor supply. That's important. On top of that, we're getting financial support for people, which is allowing baby boomers to retire and stop working, not to mention broadly at large population. Globalization, as we talked about, is tied to protectionism or a lack thereof it. Populism is tied directly to protectionism, and that's leading to deglobalization, which we're seeing in global conflict. But technology, which people think is completely divorced from all of this, like the AI boom, everything seems like, oh, we've never seen this before. If you think that, you haven't seen the progress of time or understand how technology and expansion works. They happen as a function of investment. If you invest, which we did at 0% interest rates in duration, we allowed companies for 40 years, to go out and make no money. Right? If you look at Amazon, Amazon would not have existed. It's the biggest business in the world. I would argue it would not have existed if we didn't allow the corporation to not make money for 24 years. Uber, Tesla. I can go on and on about all of the corporations that didn't make money for over a decade and would never have survived in a period of higher interest rates. They just wouldn't have existed. Now that they're here, yes, that technology will continue to grow, but I believe it'll grow at a much slower pace than people expect because it'll lack investment. Much like we saw a boom in 97, 98, 99, 2000. We had a massive expansion. The internet was critical. It was important. It changed the world. Nobody ever had any doubts about that. But the irrational exuberance part that Greenspan talked about was the exuberance that anybody could make money, that it was just a free-for-all, and that you just threw money at it and you would win because the internet was so important. 96% of internet companies went bankrupt in 2000. 96%. The NASDAQ lost 91% of its value. I mean, AI is a critical change. Blockchain, critical. It is going to change the world. We will go to a metaverse at some point. All of these things will happen. But the pace at which it will happen will slow. And there will be so much losses profit-wise along the way that people are disassociating the importance of technology and the growth relative to the rate and the speed and the profitability of those things. So my view is that yes, we're getting massive technological innovation. We always have, since the time the wheel was invented. But these are all. It seems like it's faster and more ridiculous than ever, but it's constantly that way. We're at an increasing rate of change, but that has always been the case. And I think that's important to note. So I think technology, and the advancement of technology will significantly slow as interest rates increase over time.
Just one more for me before I hand it back to Brent for the breadcrumbs that everybody I think is looking for. But I want to ask you about the Fed, because they are meeting tomorrow. They seem to be in a tough position right now. You've talked about them being in a box. Like, what do you think the Fed is going to do going forward, and what do you think they should be doing?
Well, what I think they should be doing and what they are going to do are different things, and what the Fed is going to do and what they're going to say are also probably different things. It's important to remember that the Fed has now said the word transitory 3 times since 2021, and in my opinion, not because they actually thought inflation was transitory. I don't think the Federal Reserve is stupid. I think they know they need to use their power of their verbiage to try and control as best they can the outcomes. And in telling, one of the biggest problems with inflation and these things is that it's self-fulfilling. If there are expectations of inflation, that pulls forward demand, right, and that increases inflation. If markets reflect an inflationary environment, then you can invest and you can buy things, real assets, with cheap interest rates, and it doesn't allow the Fed to keep interest rates lower. So there are natural consequences of admitting that we are in structural inflation. So the Fed won't admit it. The Fed won't. They're not incentivized to do that. They're incentivized to play Pollyannish and stupid. They are fully aware of the circumstances. Now, when you're in a box and when you have to no longer just, the way things were set up before, we had structural deflation caused by 0% inflation. Again, we used to send money to what I call Planet Palo Alto. We used to keep sending money to supply, and that would create all these goods back onto our shore, right? We would get Ubers and Teslas and Amazons, and those are deflationary. And so the Fed was able to stimulate with monetary policy cyclically, right, to battle that. And so it was very easy in a deflationary period. They had one mandate, which is to just make sure growth hummed along. The cost of that was inequality, right? And we could keep doing that forever. It's a great system if people weren't in the system, and we could just keep sending money to the top 0.1%. But we're not in that situation anymore. Now we have a dual mandate, that the Fed has a dual mandate that they have to battle. And so they have to choose at any one moment. And that is that's a high wire act. That's something we haven't seen for 40 years. The Fed is in an unenviable situation. And any given time, they're going to have to go from one side to the other. And it's probably most driven by politics, because there's no right answer. What's worse, inflation or recession, poor growth? It's a political question. And so ultimately, when the political winds push towards growth, as they are during an election year, this is why we get positive election years in the context of what's otherwise a structurally weak period for equities and risk assets. But in these periods, you'll get stimulus, and they will favor growth over inflation. And I believe that's what they will be doing this year, and that's what they've told us as of December of last year. They were pretty clear. Took a lot of people by surprise. That's what they're going to do. Now, do they have to still kind of, when inflation continues to be hot 5 times in a row, do they have to kind of back off of that a little bit? Sure. It's a political story, and they can't be seen as ignoring inflation. But you better believe their interest, as soon as they can, is to try and continue to stimulate and make sure this economy continues to rumble along, and if not, be hotter than it would have been in other periods. So I believe that's where they are this year. Now, again, the next bout of inflation will lead to a abandoning of growth for inflation. And again, I think that will eventually come, but it's probably for next year.
Yeah, thanks. So nice to meet you officially.
Same, Brett.
There's been a lot of conversations about call overriding, let's just say fairly low equity volatility or the impacts of 0DT and whatever it is. But the CBO pointed out that globally, vols are pretty low if you look at cross-asset and global vols. And I'm curious, and that was particularly the case in the end of March, start of April. And now we're starting to see like rolling bouts of vol picking up. Yen was going crazy, we had gold going crazy, FX, so vol seems to be having these spasms whereas, let's just say over the last year, things were fairly quiet. Do you think that's a trend that's going to kind of continue here as we move to the election and as things are changing with FOMC and those types of things tomorrow, or is that likely to get, smoothed out into the election this year? Like, is there like a changing of regimes, I guess is the question.
So if we zoom out to 2.5 years, not just the last year, right? Mm-hmm. We have had significant dispersions in volatility, not just dispersion in equity markets, et cetera. That is, in my opinion, partially because interest rates, as they went higher, right, increased risk premia and are naturally supportive. And not to mention we have rotations due to changes in the world right now. Those are naturally, the interest rates increase is naturally supportive for that volatility. How I've described this is, and again, I know, Brent, you're familiar with this, but the structured product issuance and the move away from equities into bonds, right? It used to be just a one-way street just into bonds. Now it's a move into bonds plus collateral that you can then use to compress risk. The interesting part is that compression of risk through structured products and other similar vehicles is going to the center of equity indexes primarily. That vol supply is really pinning, S&P vol and vol that is central. That the FX world, right? That world, for example, is not as deep and does not have this type of supply, and it is really on the fringes. But yet at the epicenter of this deglobalization reality and the move of money. So FX, if you look at 1968 to 82, what vol did the best on a realized basis and an implied basis, it's not what people would think like oil and commodities. It's not equity vol. It's definitely, it's not even bond vol, which did quite well. It's actually FX vol. It's gold vol. It's the currency vol. The dollar vol was incredibly high, right? Those are the volatilities that are less likely to also be pinned by this supply. And we argued for this about a year ago when gold was on its lows and the vol was compressed in gold while oil vol was through the roof, right? Commodity vol actually did, like oil vol and other commodity vol did very, very poorly in the 60s and 70s, despite it being very strong because it was underpinned, instead of the Fed selling puts, which really, reduced the volatility of the dollar and bonds and all these things for 40 years. Now you have commodity producers able to sell puts and underpin price. So vol and those centers was actually very compressed over that time period. I believe that will also be the case in this time period. That whether it's oil or copper or other industrial metals, the volatility in those are a sale. You should be selling puts in those. Best way to benefit from the uptrend there. Much like it was good to sell puts broadly over the last 40 years in a very profitable trade. In equity land, I do believe equity vol will not do that great. What it did in the 60s and 70s, which I believe it will do again, is you'll have spasms, like you were saying. You'll have short-term volatility. But again, I want to remind you, 68 to 82, 14 years, the market went nowhere. What does that do to long-term vol, right? Yes, you had a lot of declines, you had a lot of rallies, but at the end of the day, those were short-term spasms. And long-term vol was really did not perform. And so one of the best trades you could have done, 68 to 82, was to sell calendars all day long, and just keep selling them because it would mean revert, and it kept mean reverting again and again now, and that way you'd have the gamma, but the Vega would not perform. And I do think that's likely to be the case. I also think skew, which we've seen at very low levels lately, right, that's actually efficient. I think skew is overvalued in this regime. I think you'll see a much flatter skew going forward, despite these short-term spasms. I think it is because long-term vol and long-term skew is the most overvalued of all. You'll begin to see a significant reduction of skew, I think, structurally going forward.
So I think sort of somewhat related to that may be the upcoming election, and I just wanted to get your insights on volatility into and around the election. There's obviously a bunch of kinks in kind of term structure if you start to look at that. What, from a volatility perspective, do you think the election impact is? I mean, people are obviously anticipating more volatility around the election. I remember in the last election, there was some pretty wild movements, or something 2 years back of the Trump election. What are the effects? Are there knock-on effects that we can start to look at now? Are we still a little bit too early before the election period, and how vol may impact things? How do you start, or when do you start to think about those?
Yeah, so in terms of the event vol tied to elections, it's still pretty far out. Right? It's not nearly as liquid and hard to make any money now, nor do you need to be positioning for that now, in my opinion. That said, elections and event vol are a critical part of market microstructure and drive short-term, are one of the biggest inputs to short-term moves. The world hedges for events. Time is not linear in the sense that a second is worth the same amount of volatility. Basically, we can have weeks where vol is very compressed and there are no hedges and there's no big structural buyback of some of the deltas tied to that in the equity market. And then we can have a massive day or two where months of implied volatility come out of the market. So the election is always a hedged event, a watched event, which means dealers take naturally massive insurance on it and are short stock. In the absence of some really unexpected outcome, right? And just a marginally unexpected outcome is not the same thing. And it's hard in an election where there's two people, right, to have a dramatically unexpected outcome. It can happen, but it's not just the president that matters. It's the government and everything that comes with the mandate. So at the end of the day, those tend to be positive events. People get bearish, get scared. But again, there tends to be very positive support coming out of that. And I think, over a short period. Now, it doesn't mean that's positive for the next year or 3 months even. It really coming out of that maybe for that option cycle in a month or so. Now, a squeeze out of that period, into the end of the year. It's in November, early November, right? Then we have some of the most seasonally positive periods that also bring supply and have other. We had the December expirations are always the biggest expirations. They have a lot of other positive flows coming out of it. So I would expect this year, the post-election to be very positive, and particularly in an election year, there'll be some exuberance. Now, to be clear, my view on after this year, how this market looks is, it's set up for potentially after a big rally, a very dangerous setup here structurally. And when you zoom out to a more 5-10 year picture. So it makes sense after a big rally this year to start to see something I would expect in January or February of next year as a potential target. If we do rally like I expect, to really be placing hedges and thinking about the next move.
As we wrap up in the couple minutes we have left, we have a standard closing question we're asking everybody today, which is, what is one interesting thing you're seeing right now that you think others should be paying more attention to? And it could be inside or outside investing.
Yeah, I think there's so many interesting things going on right now, but I think the thing that people really aren't talking enough about is skew, and how flat and how compressed skew is in the market. As we talked about, I think structurally that makes a ton of sense. But there's also some very important reinforcing realities of that circumstance. It means it's very easy to hedge any tail downside, and it makes declines in the market easier to buy. That doesn't mean that we are going to turn around quickly into whatever decline or swoon we've seen, but it does mean that the decline is likely to not be structural, and at some point, also not meaningfully catastrophic or a vol event. I think that's very important. It is way too easy at this point to get hedges in the market, and I think that's a very, very important thing that people are missing. Now, to be clear, a lot of times when skew is flat, declines can last a bit longer than expected, right? Because you don't get that impulse, that fear impulse, and you don't have that vol spike that then leads to that buyback that we've talked about from the Von and Charm flows. So ironically, if you go look at the timeline, 2015, we had the yuan devaluation, big vol event, screens went black. That was a big vol event, not a very big decline, all in about 8-9%, followed by Feb 16, which was the opposite, right? A very vol compression, skew flat decline. That was the biggest decline we had since 2009, and it was 12.5%, right? But not a vol event, much more tick, 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 tick. Similarly, you roll forward to 18, we had the Volpocalypse, not that deep a decline, right? But very, very meaningful. Got about 9% decline, and then but quickly responded. What happened in OC Nov D's 2018? Skew flattened. People were hedged because of the last event, and what happened? We had a 19% decline. And people talk about the Volpocalypse and the fear of it. It's less than half the decline of the OC Nov D's decline in 2018. So you can get bigger declines with a flat skew. Because you don't get that vol reaction and that feedback loop to feedback. But ultimately, they do tend to be buyable dips, and do tend to eventually resolve themselves. It just may take a bit longer. So I think the skew out there is telling you something. I think if you look at history and the circumstances of that skew, you'll have a better clue about how this next several months will play out.
Well, Jem, thank you again for doing this. We really appreciate you taking the time and coming out to help us support Susan G. Komen.
Couldn't think of a better cause, and couldn't think of two better people to do it with. So I appreciate you guys having me. Take care.
Thanks a lot.
Thank you very much. You can just hit the red leave. All right, Brent, 3 down.
Yeah, a lot of similar themes that are starting to pop out here a little bit. Equity headwinds kind of next year seems like there's a little bit of a consensus forming around that. And and some other incredible insights. I found myself listening a lot as opposed to think about questions to ask. So
Here are people have probably heard enough from us. So now we've got Justin and Matt in here, and they are going to talk to Katie Stockton.
Good job so far, guys. Excellent.
Thank you. So we will clear out, and you guys can get going.
Katie, good morning.
Good morning. Can you hear me okay?
Yes, we can hear you fine. Yeah, great. Matt and I want to welcome you to PNL for a Purpose. Really appreciate you joining us today.
Of course, happy to.
By way of introduction, Katie Stockton, founder of Fairlead Strategies, a market and technical research firm. One of Katie's strategies actually sits behind a strategy that's within an ETF wrapper. Katie's considered what I would say an expert in technical analysis, regular contributor on CNBC as well as other programs. So this will be a fun and interesting sort of discussion here with you, Katie. But just as a reminder why we're here, and the purpose of today's event is to support the Susan G. Komen Foundation to help fight breast cancer. One statistic that they sent us a bunch of stats. 1 of 8 women in the U.S. will be diagnosed with breast cancer in their lifetime. So your support today can certainly help against this sort of important cause and fighting against this disease. There's a donate link at the bottom of the YouTube page. So anyone, maybe that's on Twitter or that's listening some other way, they can scoot over to the YouTube channel, Excess Returns or SpotGamma, and donate. We really, really appreciate it. So Katie, technicals. Let's kind of dive into it. But it's always what I like about our discussions is we'll get into what's going on in the market and everything, but it's kind of good to take sort of a higher level view with technical analysis. So to start, we want to ask you, for those that are listening, to help get their arms. I mean, a lot of people know what technical analysis is, but some people don't. But how do you go about defining technical analysis, and what do you think it's most valuable for?
Well, first, Dustin, I have to say kudos to you all for doing this event. I think it's awesome, and it shows your character and obviously a very good cause. So I'm happy to support it. But in terms of technical analysis, I mean, it's a very narrow discipline in a way. I see it as defined as the study of price trends, and price trends will reflect the supply and demand in markets. And so it's really kind of mathematically driven in a way because we're using technical indicators that are derived from price. So there'll be things like moving averages that would probably be in the simplest form, up to a very complicated type of stochastic oscillator or something like this. So these indicators can help us navigate markets and therein manage risk. So I'd say primarily we see technical analysis as a risk management tool and something that acts as a great complement to other disciplines, fundamental research, macro analysis, political inputs. That is all important, and we see the technicals as equally important and something that can help us really avoid drawdowns and to help time market entries and exits.
What do you think the biggest misconception is for those that don't really follow technical analysis? The biggest misconception is in the market from that standpoint.
I think they see technicals perhaps as being overly predictive. They say often, even to me, they'll say, well, do you have your crystal ball? And it's really not like that, quite frankly. And I see you smiling, Matt. It's just the same as every other form of analysis where we're looking at historical information and it's just trying to stay on the right side of things. We have ways of gauging upside and downside, but those metrics are not set in stone. We are very dynamic in how we're tracking markets. I have no idea what level at which the S&P 500 will be on December 31st. I just don't know. But I do get asked that quite often. So I think that's the misconception. But rather, we're here to help people understand what the prevailing trends are across different time horizons And then with all that in mind, of course, we look at key levels and key indicators, and therein can help people manage risk.
So all that being said, can you tell us the level of the S&P on December 31st?
Yeah, exactly.
We'd really like to know.
Me too, trust me.
I want to ask about something that you just said because I think it's really important. So not just the price trends, but then the supply and demand component. Because like as a risk control, like what's supply and demand mean from a technical analyst's perspective?
So it's interesting, right? Because it's not from like your Econ 101 class, right? But rather,
this is probably why they get offended, right? They're like, those are my words. Why are you taking my words?
They're trying to fit it into something that they were taught, right? And technical analysis is actually working its way into curriculums, interestingly, but it's still not usually a course. But what I would say with the supply and demand input, it's every bit of information out there does boil down to a buy or sell decision. So that's simply what, we're talking about is for any given security, and we'll talk mostly about equities today, but it can apply to other asset classes. There's, is that buyer willing to pay a higher price or not, right? So that's your demand. So it's really very simplistically regarding the demand for that security.
When you think about it and granted, we don't have to get too deep into this, but like, because there's the past looking basis of here's where supply and demand was, but then no crystal ball. You're trying to also understand what the forward supply and demand looks like. How do you differentiate between those two time perspectives? So
maybe the, folks that like physics will like this. A trend in motion, I feel like it tends to stay in motion. I think.
Newton is really happy here. It feels represented.
So, that's the force of momentum, and that price momentum, I think, is something that we all can collectively agree is there. And that's what we're trying to respect is momentum behind these price trends. So we're assuming that trends will remain in force until they show signs of exhaustion. And those signs of exhaustion can be indicated by those tools like the stochastic oscillator, like the MACD indicator, momentum metrics, overbought, oversold metrics, relative strength metrics, all of those taken together can add some real value there. So we feel like that's important. And then in terms of historical support and resistance, right, that's what we're using to determine where there might be buying pressure or selling pressure on a chart. And just think about it. There's probably a fundamental driver behind these levels. One would hope, right? So if you see a stock continually, meeting a top around a certain level, my guess is that the valuation is probably fair at that level or near that level. So you have to trust the market to be rewarding stocks and other securities, in certain ways up until a point when they become less attractive to them.
Talk for a second about the indicators. I love the framing of trends to exhaustion. And I'm thinking about probably like stochastic indicators or things like that are actually, what indicators give you a sign that the trend might be overextended?
Yeah, that sell discipline, by the way, is what we help a lot of our clients with. It's one of the hardest things to do because you put all this sweat equity into analyzing a company, and then you make a commitment to it, and then it stops working, right? So this is where we can step in and remove maybe some of that emotional bias with the indicators. And those indicators that we're using typically for a sell discipline would usually be of the overbought, oversold nature, and that it's kind of an overused word, overbought, but it is measurable from our perspective. A stochastic oscillator is one of our primary tools to that end. And when it's above 80%, it's overbought, but it's when you get the downturns that we have a so-called sell signal. And we also use something called the DeMark indicators. Tom DeMark is a brilliant guy. He's developed a suite of tools that measure that trend exhaustion through running counts of price bars. And in those indicators, oftentimes the Fibonacci sequence is manifesting itself, which is pretty cool. Maybe a little too nerdy and technical here, but
it's not too nerdy.
Okay,
we
good.
love Fibonacci.
And so we feel that adds value to our process, and it can be at times incredibly precise. But we are big believers in combining different tools to put the most probabilities in our favor. And really, that's what we're all trying to do with any kind of research, right? We're trying to put, more of that research behind our positioning.
So I think I've heard it said that, a trend can remain overbought or undersold longer than you can stay solvent, or some variation on that. What happens when something just won't stop going up, when it hangs out in overbought territory way too long? And maybe this comes back to you looking for that first downtick indication you mentioned
Yeah,
a
so
second ago.
it's the downturn, and we usually use a weekly bar chart for the stochastic oscillator. So if we see that stochastic downturn, that would be one indication. But we also, for like a parabolic uptrend, we would use something like a 20-day moving average, and just something tight like that, like a tight moving average that's tracking pretty closely with price. And when it starts to roll over, well, at least we know there's enough of a loss of momentum to dictate some either repositioning or some hedging. So we use the very tight moving averages to that end, and I feel like that adds some value. And will you get sort of whipped around at times? Sure, of course, but you'll also be able to avoid the big corrections that way, right? So if you have to take all of this within the context of a broader portfolio, of course, you have to consider, the risk metrics associated with that portfolio and also any tax implications. So there is more to it than just simply watching the 20-day moving average, but it can add a lot of value.
And specifically in this case, so something goes parabolic, meaning it does one of these, it hockey sticks or whatever. You would apply a different tool, like you'd put that 20-day moving average, you'd pay attention to it differently after you see something's going parabolic?
Yeah, I think so. It's just one of those things where with a parabolic uptrend that there's gonna be a lag time for that any loss of momentum to really manifest itself in some of the indicators that we use actually to reduce noise intentionally. So let's say a weekly MACD indicator as one. This is the moving average convergence divergence indicator. It's great at eliminating noise and identifying important shifts, but if you're looking at a stock or security in a parabolic uptrend, you can be down 20% before that MACD flips over to a sell signal. So these crossovers are used for sell signals. So we want to have something a little bit more refined in that kind of situation. So it's just a matter of how much we're weighting different indicators.
So there's different tools that you pull out or different weightings depending on what's happening? Is that?
Yeah. Mental weightings. So this is not
Okay.
super scientific, because the environment's always changing. And I think that's the challenge is we wish it was simpler in that we could just say, okay, we're going to weight, the MACD this much, the stochastics this much. But it really isn't that simple because in a different environment that will change.
Different environment and different securities can trade different ways against different macro environments too, right?
Yeah. And just think about they say in general, and I think it's true, that an overbought oversold metric like the stochastic oscillator will be better in trading ranges or add more value in trading ranges. I don't disagree with that. It doesn't mean we don't pay attention to it during trends or trending environments, but we'll probably give a little bit more weight in those environments to the moving average-based tool. So, and then the hard part, of course, is knowing which environment that you're in, because that can be a question mark too.
Now, what about another word that I feel like people get angry at technical analysts for stealing? Sentiment. What does sentiment mean to you?
Oh no, we own that word actually. So
You
it's
own
ours.
it.
It was ours first.
It's yours first. Okay.
So sentiment, listen, it is what the driving force is behind the market from multiple dimensions, but we have ways we can measure it. And that's what I love, these transactional gauges of market sentiment rather than the investor polls where you can go around and ask people how they're feeling. How they're feeling is maybe different than how they're positioning, which is what we concern ourselves more with. And there's a lot of different metrics you can use. We like the volatility index and we like the fear and greed index as two primary transactional gauges of market sentiment. And, sometimes you'll hear in the media, they'll say, well, oh, this is a technical move. Well, it's really never a technical move. The technicals are measuring and responding to what's happening. But I'd say rarely ever is a move driven by technical analysis. It sort of seems to be a misnomer to me. The only situation in which that would make sense would be, let's say you had a breakout above a 200-day moving average that was incredibly widely followed and that exacerbated a move. Yes, maybe that is a technical move, but in general, The move can be attributed to market sentiment, right, which is sort of a technical force, but not technicals themselves. So the sentiment is often one of the biggest risks to the market, because when you have people, become overly bullish, if you will, it's that sort of crowd mentality. The positions can really turn on a dime. So we watch those sentiment gauges very closely, and we often watch them almost like a stochastic oscillator, like a contrarian perspective.
So it's really interesting because you're weighting like the sentiment side against the stochastic, like the price angle oftentimes. Is that fair to say?
Yeah, and we'll always give the most weight to price. Price is the data that's reflecting the supply and demand. So that's what the market's giving us. And then the rest we feel is, secondary to that. So sentiment would be secondary to us, to price.
Okay. So I'm going to give technical analysts precedence over Duke Ellington in a sentimental mood. I see your point. But what about breadth? Breadth is another one where I think about these things, and that's a word that I feel like isn't well understood. What's breadth?
Yeah, so breadth, think about that as very simply market participation, right? Like how many stocks are up on up days? How many are down on up days? How many are down on down days? So that is often what breadth is measuring. And it doesn't really discriminate on the market cap front, which can be very interesting, because we, of course, have had a market at times that's very narrow in terms of its leadership, with the mega caps doing so well. But the breadth is almost the health of the market when you look beyond those leadership stocks. And when you see breadth rallying, or these cumulative measures of market participation moving up alongside price for the major indices, that's usually a more sustainable uptrend, and vice versa, because you can see an uptrend during which breadth is contracting. Breadth too for us would be more of a secondary metric, so price will always take more precedence for us, but we do feel that breadth can be really informational. In fact, it's in part why we've been so on board with the uptrend that we've had up until this point year to date, because the breadth improved so notably both on the stock level and on the sector level in Q4 of last year.
So let's talk about that. Like right now, it's like we're starting to see there's some weakness. There's some breadth that seems to be missing. Maybe sentiment shifting. What are you seeing now, April 30th, 2024 in markets from this perspective?
The breadth has contracted a little bit. We're expecting a little bit more of that as an indication of a corrective phase to come. And, the breadth metrics, one of the ones that we track is called the cumulative advanced decline line for NYSE securities. And it had come right up against final resistance. And it was a natural place for it to pull back from a technical perspective. So we don't see it as an unhealthy development, except maybe for the next 2 months, maybe 6 to 8 weeks, something of that nature. So the pullback can be a setback shorter term, but we don't see it as something that's likely to be a longer term setback. So we definitely frame it within the bullish context longer term, because both breadth and the major indices, of course, are in long-term uptrends. And even with the breadth improvement that we saw after what I'd call sort of a bear market cycle in 2022 and coming out of 2023, that gave way to a breadth breakout in a way. So we like to see, just in the same way that we're often looking for breakouts in price above resistance levels as catalysts, we can see the same type of action in breadth metrics like that cumulative advanced decline line. And that can get us to a place where we can, feel more confidence perhaps in like an uptrend. But yes, a pullback in breadth seems likely. It's already sort of manifested itself to some degree and would be natural to see a downdraft during a corrective phase. But we think that'll be pretty short-lived.
So short-term corrective is not bearish. Short term, you're expecting like this trend to, dare I say, consolidate or something like that.
Yeah, I know. And we've been unaccustomed to volatility over the past few months, if not longer. So it's always hard when these corrective phases come, but we've already seen, 5 to 6% downside from the S&P 500 and a pullback. This rebound, we're essentially trying to take advantage of the rebound to reduce some exposure temporarily, right? So yes, a correction for us is basically a major pullback within an uptrend. A bearish reversal, well, that's another thing. And that would be something that would be indicated by our longer term metrics. And we don't have indications of that right now.
The crystal ball does not say
Yes.
that just yet. Okay, so long as I have that straight. And what about like in tech? So I think this is the other thing because, I mean, was there any volatility if we just think about the tech sector in a hot second here?
Yeah, so I mean, we've seen some relative weakness from technology of late. It's still within the context of a long-term uptrend. So think of it as looking just like the NASDAQ 100 itself. It's a pullback within a strong uptrend. We think that we'll see in the very near term tech outperformance associated with mega cap leadership. And of course, anything can go with Apple's earnings coming, but that's how it sets up on the charts, at least for right now. And after that, we're looking for one more down leg, which would represent leadership on the downside from technology. It is often the technology sector that exhibits both upside leadership in uptrends and downside leadership during corrective phases. So it's sort of a normal thing, and it's in part, they tend to collect most of the high beta names within the marketplace. But also, you know, the tech sector is looked to as just one of those sort of most promising long-term investments. It's where we get the most questions. I think if I had to, you know, break it down in terms of our client questions, I'd say, I don't know, 60, 70% are about technology stocks. Somebody asked me about GE the other day, and I was like, whoa, what is happening?
Flash from the past.
And have you seen that chart? I mean, it's incredibly strong. So technology is of great interest, but it will also be penalized in a correction because these are the relatively overbought areas of the market. So that's what the corrective phase should work off.
It's so interesting, especially when you say that about tech, because it feels like how long has tech just been the thing that led on the way up and got smacked around on the way down? It's like the trials and tribulations of like reality television stars or something. Like, has this been, how long has this been with us forever? It doesn't feel like 20 years.
I don't, you know, it's hard to say if it's forever. I guess I don't have forever under my belt, but, you know, since I started in the late 90s when we lived through the tech bubble, it certainly felt that way then. By no means I want you to perceive that as saying this is a bubble. It's nothing like that in my opinion, but yes, tech it can be relied upon in a way to exhibit upside and downside leadership in different environments.
What other changes in sort of sector leadership have we seen this year?
So more recently, just in the past, I'd say few weeks, if that, I guess since the beginning of April or so, we have seen more defensive rotation kick in with the pullback that we saw. And the rotational work we do, which is derived from something called a relative rotation graph, the rotation has favored cyclicals to some degree, so like energy, materials, financials, perhaps in certain segments. But now the rotation actually favors the likes of utilities and staples and potentially even real estate and healthcare, which have really been out of favor versus the broader market. And what it's to the detriment of, and you can probably guess it, would be technology. The tech sector has rotated out of favor from an intermediate term perspective. That doesn't make a comment on the next couple of weeks where we think we could get a little upside, but for the corrective phase that we're anticipating, we would expect to see that defensive sector rotation, but it's something that would be temporary. We tend to be able to hide in some of those more defensive sectors, but they're not going to run away from us in absolute terms in a corrective phase either. So we are generally recommend to navigate corrections to simply be hedged to a partial degree from a top-down perspective if you have the liberty to do that. And you'll be well served by doing that rather than just trying to change your sector positioning. Because as you know, with a downdraft, even relative outperformance doesn't mean you're making money. So we think a correction is just something to be better reduced throughout broadly.
What about other asset classes? Like I'm thinking gold, maybe bonds. Like what's showing up, I guess, in the charts with those other areas?
Yeah, so gold, I mean, we had a major multi-year breakout from a range, and those tend to be actionable from a long-term perspective. So that's a good thing for gold bugs out there. And we think we like the sort of I guess, diversification that gold provides. In terms of its actionability near term, I think it's probably going to consolidate further alongside other metals. But we are really encouraged by that long-term breakout, and we think it will outperform equities if they do correct. For bonds, I mean, listen, we have what looks like a basing phase being built by the likes of TLT, and then if you look at Treasury yields across the spectrum, they've lost long-term upside momentum to suggest that this year, maybe for the balance of the year and part of next year, should be like a corrective phase for yields. So we think there's a secular shift higher, but that for even up to a couple of years, we could actually get yields coming in a bit, so maybe sideways to lower, and that obviously would provide some opportunity in fixed income. But we also think that, that corrective phase should yield ultimately a higher low. I think we're in this environment in which many of us haven't lived through, where we had this downtrend like channel in yields for multiple decades. And I think now we're probably in the start of an uptrend channel. But as mentioned, within that channel, you can get pretty big counter trend moves.
I think it's worth just kind of going back and highlighting too, like the importance of sort of the disciplined buy and sell that technical analysis gives you, and it kind of removing those emotions, right? It's like, it's not only reducing risk when it's important to do that, but also the buy back in is probably maybe even more important in terms of long-term returns. So I think that point, if you want to comment on that, is really strong with strategies like these.
Yeah, I think, and this is part of what we're trying to do with our own ETF, is to make sure that we're there to come on the backside of a bear cycle or a big corrective phase, that we're getting back to the equity exposure that the market warrants, that probably before psychologically we're ready, because we've all been through these types of corrections and we get really shaken by them. And I think COVID, as an example, is probably one of the most obvious ones, where it took a lot of people way too long to get back into the market, right? Because it was, first off the March low, well, no, this can't be it yet, and then, we were running away, right, in July. So it felt like the market just took off. And what helps eliminate those emotions, of course, are just momentum-based gauges. So we're trying to understand, is this momentum strong enough to take advantage of? And the momentum metrics will not be as precise, perhaps, as like a DeMark indicator might be at a pivot point, but they'll help you identify what are important lows that you'd want to take advantage of on the buy side. So we find incredible value in those indicators and helping us know when it's kind of safe to get back in, and that indication can help reduce your own emotional biases that are certainly affected by the corrective phase. I mean, we've all probably talked to people who have been out of the market for even years just because they lost too much in the last bear cycle, and they feel so sort of stunted by that. So the charts can help, I think, avoid that and just keep us on the right side of things.
And so just in closing, we are asking all of our guests today, what's one interesting thing you're seeing in the markets that others may not be paying attention to?
I think probably there's attention to it, but the commodities lifting out of these ranges, this is a big deal. Not only gold, silver, look at copper. Copper has broken out from a long-term trading range or triangle formation, and I understand that could be a positive comment on the global economy too. So big breakouts in some of the metals prices. There's a trading range still in place for crude oil, but it has positive momentum and improving long-term momentum within that context. So if crude then joins in lifting out of that range, it could really look like a sustainable bull market cycle for commodities that we haven't been accustomed to in a long time. We see even signs of life in natural gas, dare I say, and agricultural commodities like corn and soybeans and wheat, things that have really been under pressure, seem to be, I guess, gaining some confidence from perhaps the other commodities and how they're acting. So I think it's interesting. I would say just a stealth kind of commodity bull cycle potentially emerging.
Interesting. Thank you very much for joining us today, Katie. Sorry it's so quick, but we really appreciate it. Yeah,
Great to be here.
Thanks, Katie.
All right, nice seeing you.
Take care. Good luck with the event.
Thank you. Jack will come back in. All right.
We will.
All right, fellas.
Thank you guys. That was awesome.
Yeah, we'll see you all shortly.
See you soon.
Bye.
We'll see you guys again in a minute for another switch. Let me let in. So we got Mike Green coming up, Brent.
Yeah, we're rolling along here. That was a great conversation. I really enjoyed listening to that.
More macro analysis.
Yeah, nice.
Justin is frozen. We got to figure out how to get him out of here. But let me let Mike in here.
At least Justin's smiling.
Mike. Thank you for joining us, Mike. Can you hear us? No, we can't hear you. So let's just while Mike's getting his mic going here, let's just talk about again why we're here. We're here to support Susan G. Komen. If you're I think he'll be with us in 1 second. But
yeah, Mike, we can't hear you if that's what you're asking. We cannot.
If you're watching us on YouTube right now, there'll be a donate link in the desktop to the right of the video and in mobile underneath the video. If you can give anything to Susan G. Komen, we would greatly appreciate it. That's what we're here for today. If you're watching us on Twitter, which I think based on checking the streams afterwards is what the majority of people are doing. If you head over to YouTube, either the SpotGamma channel or the Excess Returns channel, you can see a link there to donate. Same thing if you're on LinkedIn right now. We appreciate any donations we can get. Susan G. Komen is an awesome cause, fighting to try to end breast cancer. That's something that's touched all of us, in one way or another, probably in our lives.
Yeah, absolutely. A few of our guests have already mentioned that. And the donations are coming in over there on YouTube. We could see that. So thank you all very much for people who have given. We really appreciate it. And hope you all are enjoying the content. So we wait for Mike to come back on here. If you go over to the spotgamma.com/PNL for purpose, we have that link on Twitter or on YouTube. You can see the rest of the schedule for today. Jack, we're still going till 8 p.m. So 8 Eastern time. Yeah. So we're
basically just getting started here.
Yeah, we got a lot of stuff coming up.
Let's kind of talk about what we got coming up next, though, because we obviously will have Mike on here in a minute to talk macro with us once he gets his mic resolved. We have Corey Hoffstein coming up after that, and he did a really interesting Twitter post where he talked about the 15 biggest lessons he's learned from his 15 years in the money management business. And so Justin and Matt are going to come back on, and they're going to work through those 15 lessons with Corey. And they're all really, really good. I mean, I don't know if they'll get through 15 lessons in 30 minutes. I think one of the things we're learning today is it's hard to get a lot of content into 30 minutes, but that'll be really great. After that, Jerry Parker will be on talking about trend following. So that'll be another really cool appearance. And then you're going to talk to Noel Smith, and we're going to get rid of me because I am not qualified to talk about the topics that the options topics that Noel Smith will talk about. But what are you guys going to talk about?
Yeah.
Well, what are you guys going to talk about?
There's a lot happening in the volatility space. Obviously, we just come off of a relatively large VIX spike, and we got the FOMC tomorrow. So Jim before was talking about event volatility. There's a little bit of event volatility to the FOMC tomorrow, and so seeing what he's seeing, and obviously in the earnings season, we have a lot of just single stock vol. So again, we have AMD and SMCI today. So a lot of interesting single stock names to trade. So hopefully we'll dig into that. And hopefully we got the mic situation squared away here.
Can you hear us?
I can hear you.
Yes,
can
you
hear
hear
me?
you too. Awesome.
We are good to go. Awesome. Well, we're very excited you decided to join us today. We're happy to be here to support Susan G. Komen. We're also excited to have somebody that your colleague Mike Taylor just called, I believe, tall, handsome, and brilliant.
Yeah, well, no, he's right
twice
about the tall part. No, I actually had the pleasure of listening to Mike talk. I think he's, everybody forgets how incredible he is from just an insight standpoint. Really privileged to consider one of my good friends.
Yeah, he is really smart. I mean, the ability to blend macro with what he's doing on healthcare. It's very, very cool what you guys are doing with Pink.
Well,
raising money
he
for
is
Susan G.
he is
Komen like
really,
that,
really
right?
smart, but it is actually important that people understand that he was the single last person admitted to Gettysburg State University in his class. So brilliance was not what he was known for early on in life. He was a snowboarder, and he ultimately changed the trajectory pretty amazingly. So one of my favorite interactions on a regular basis.
Well, it's good to get you on here and get a little bit of the inside info on Mike here after the fact.
Well, I represent the non-snowboarder demographic. So
Yeah.
anyway,
I'm
let's
over
go.
myself. But anyway, yeah, we only got 30 minutes, so we probably should get going. Just a reminder to everybody, we're here for Susan G. Komen. And if you're watching on YouTube, there's links to donate. If you're watching on Twitter or on LinkedIn, you can come to YouTube to either one of our channels, SpotGamma or Excess Returns, and give. And if you can give, we'd greatly appreciate it. So, Mike, I think we want to start off in macro with you. We're in a pretty interesting space right now. We've seen at least the measured inflation numbers have come up a little bit. The higher for longer camp seems to be winning in the markets a little bit more now. More people seem to be, as Andy Constan calls it, the island. More people seem to be moving over to the higher for longer island. Can you just give us your take on where you think we are right now?
Yeah, I mean, look, I've been very straightforward and candid about this. I think one of the unique dynamics that's going on right now is people very much want things to be bad, right? They want things to have high inflation. They want the Fed to be trapped. At the same time, they're using that really as a narrative to describe why markets are higher, right? The Fed is ultimately weak. The Fed is going to be forced to cut. The Fed is going to do X, Y, and Z. And meanwhile, this idea that inflation is persistent and continuing certainly can be true, but it is absolutely a projection. If we look at the underlying components of inflation, the areas in which we're seeing inflation today are the follow-on components to it, right? And so I'll just give a really simple example of that I've walked people through before. But if you think about what happens to auto insurance, for example, when the price of a car goes up, the cost to replace that car under an insurance framework goes up as well. Ironically, you're not paying any more for insurance. You're insuring a more valuable asset, and you should see your insurance costs go up to reflect that. And unfortunately, that is what we're seeing at this point. We're now seeing the pass-through effects of higher auto prices, higher auto part prices that are already in the price level into things like insurance. That's a regulated industry, and so the insurance regulators are looking at it from two standpoints. One, we have to defend the profitability of the insurance companies because we want to make sure that they are viable in terms of meeting the coverage that they have sold, and so they will allow a price increase of this type of magnitude in response to the increase in the costs that are realized that showed up as very poor fundamental performance for insurance companies roughly 2 years ago. But the difference is high insurance prices don't cause auto prices to go higher, right? So we're at that second stage in this. In fact, what high insurance prices do is they cause auto prices to fall for the very simple reason that people turn around and say, hey, I'm not going to buy a car. And it perversely shows up, unless you hedonically adjust these things, who are the people who can't afford to insure their cars? People who are poor and at the lower end of the spectrum and are already struggling with this. So this shows up as effectively a regressive tax that then reduces their access to cars in a way that actually creates all sorts of other ripples through the system, but largely involves a slowing down, right? That is different than a cost increase for cars. And it also ironically shows up in things like the demand versus supply components, because those are not properly tuned to capture this dynamic, right? If you think about the way those are supposed to work, they say, did price increase, and did that price increase cause demand, or did quantity consumed rise or fall? That's how those types of things work, right? Well, if I buy a car and my insurance cost goes up, am I buying more or less? I actually am not changing anything, really, right? And so there's a slight increase in the quantity in force that shows up as, oh my gosh, this is a demand-driven increase in prices, right? Unfortunately, like, it just doesn't work that way. And so there's limitations to all this sort of stuff that happens at every turning point in every cycle. Some people want to project forward on a linear path towards inflation. Some people want to project their political outputs, and that's really what we're ultimately seeing in the inflation data, where it has become effectively a political argument. Biden causes the inflation, or Trump caused the inflation, or XYZ, right? And we see this. If you look at the Michigan report in terms of the outlook for the next 5 to 10 years, the really notable component is not the change in the median expectation, which has actually been fairly constant. What's really remarkable is the growth of the tails. And so something like 20% of respondents all of a sudden are saying, we expect inflation over the next 5 to 10 years to be 10% plus, right? Why do you think that? Well, because it's inevitable, money printing, right? Like these are not fact-based statements. We've introduced an extraordinary degree of emotionality into it that just doesn't really match the underlying data that we're seeing.
So I mentioned before the rise in the reported inflation metrics recently. I mean, do you think what we're seeing in those reported metrics is overstating the true level of inflation we're seeing right now?
I don't think there's any question about it, and I find it ironic that people who 2 years ago or 3 years ago would criticize owner's equivalent rent and say it doesn't report true inflation are now suddenly defending it and saying, oh, look, owner's equivalent rent, and that's not coming down anytime soon, right? Even as metrics that are incorporated within the owner's equivalent rent look at what's happening on the margin where all prices are ultimately set, and things like the Cleveland New Tenant Rent Index are falling very rapidly.
Do you think there's a better way to do inflation? I mean, we have things like Trueflation right now that are trying to do it in real time. Do you think there's a better way to measure inflation than the way we're doing it?
Well, I think unfortunately inflation is one of these things that's a little bit like pornography, right? Everybody has their own taste and experience in it. It was a joke, obviously, when you see it, right? Nobody actually knows what my inflation experience is or what your inflation experience is. We all have independent ones that are tied to where we live in the country, what we desire and what we like. And if you happen to be somebody who is basically tied into the marginal behavior around that, right? So let's talk about a population expansion like millennials. Well, if you're buying the same thing as an expanding population, you're going to, by definition, experience a rising inflation component to it, right? On the flip side of that, if I look at a lot of the things that people really do buy in their lives on a continuous basis, things like automobiles, things like durable goods, things like televisions, things like speakers and entertainment centers, things like milk, eggs, etc., all of those have largely retreated. I mean, the simple fact is wheat prices are at the same level that they were 50 years ago. Right? Just stop and think about that. When we start talking about the deflationary forces in the 19th century, we're largely talking about a basket that involved things like wheat. We're talking about scraps of cloth, right? Jack, how much did you spend on your last scrap of cloth?
Yeah, it's been a while. I guess you could call some of my shirts a scrap of cloth, but
that's exactly right.
And I didn't spend that much on this
so. Now because we have so much, right? So our consumption baskets have changed. They've become far more complex. They've become far more effectively protected by intellectual property. That's the only thing that keeps an iPhone cost up, right? It's the fact that I can't slap that label onto a Huawei phone and call it an iPhone and be able to sell it in effectively the same thing. They're all functionally identical except for walled gardens that are created by intellectual property restrictions. And the dynamics of the inflation component, the price of wheat has no material impact on American consumption patterns anymore.
So when you look at the Fed right now, do you think they're too tight? I mean, there's different camps in that. One looks at like the rate relative to what might be the neutral rate and say the Fed's really tight. Other people look at like financial conditions type indexes that include the stock market and things like that and say the Fed's not that tight at all. Like, how do you think conditions are right now?
Well, I think conditions are, again, split by who you are, right? So if you are somebody who has borrowed and currently has debt outstanding, we typically call those young people, you are struggling, right? If you are somebody who has accumulated savings over your life in anticipation of spending down those savings in your retirement, you're suddenly sitting golden because the assets that you had accumulated are now offering you an income stream that is far above what you would have expected just a few years ago. And so this is exactly what we ultimately see. We see boomers benefiting, the older generation benefiting, the wealthy benefiting from this dynamic. And those who are at the lower end of the socioeconomic strata, they've actually seen, or at the younger end in particular, they've seen their prospects deteriorate materially.
So when you think about what the Fed should be doing here, I mean, they're meeting tomorrow. What is your view? I mean, do you think they should be cutting rates right now?
I think they should be cutting rates, but again, It's something that is totally up for debate depending on what your objective outcome is, right? If you think, as the Fed does, that higher interest rates are contractionary and that they should ultimately be driving inflation lower, then it becomes a question of how do you interpret the inflationary data that we've received. And what we're seeing are things like insurance costs going much higher, the cost of banking services, what's called the imputed cost, going much higher. At the same time, we're not seeing the same material benefit from the retreat in things like oil prices or energy prices that we saw last year. And so that's showing up a bit more in the headline and even in the core data, where again, that is effectively being pulled forward, right? We show insurance costs as core, we show banking services as core, even though nobody is actually writing a larger check to JP Morgan for their banking services, they're actually just receiving less relative to what they could get at a money market fund. And that's interpreted as a big increase in the cost of banking services. The fact that we now have to pay higher rates for securities lending because of an increase in the prime rate and the consolidation in the brokerage industry, that's interpreted as inflation, right? As far as I can tell, that's caused by the Fed and by our failure to enforce antitrust dynamics.
How much control do you think the Fed has here over inflation? You know, you could argue long rates are much more important for the economy. Do you think they have? You could also argue in like a fiscal dominated world, they're less powerful than they once were. How much control do you think they have over the rate of inflation?
So I don't think they ever really had that much control over the rate of inflation. If they actually did, we wouldn't have seen the structural dynamics of inflation behavior that's been largely tied to demographic features for the past 70 years. Right? Like it feels insane to say this to people, but when you actually think about how powerful the Fed is, what the Fed does control is the front end of the curve. And if the Fed decides to keep the front end of the curve elevated, let's just say randomly, Jerome Powell is reinstituted for a 20-year term and says, at no point in my term will the front end curve fall below 10% interest rates. Right? Well, what has to happen to the 10-year bond?
Yeah, it's going to go up.
It has to go higher in yield. Does that mean it's the right yield? No.
Not necessarily.
Right. It's what Jerome Powell thinks. And so that's really what's actually happening right now is the uncertainty that's being created in the front end is actually transmitting itself to the back end. It's not that the economy is getting markedly stronger or that we're seeing an improvement. The first quarter GDP growth, which by the way, the now casting components on a nominal basis missed by over 250 basis points. That's an extraordinary miss when you really think about it. It's not so much that the headline being at 1.5% versus expectations of 2.5% was the big miss. It's that the nominal number was such a huge miss. Right? That's actually a really important development in my view.
How do you think the election affects economic policy? I mean, people will argue the Fed is trying to juice the market in the election or government officials are trying to juice the market in the election. How much do you think that affects policy?
Well, I don't think there's any question that the political leaders, which would include the Secretary of the Treasury, right? So remember, there is no independence for the Treasury. That is an appointed position that serves at the pleasure of the president, subject to confirmation, obviously, by the Senate. If you think about that entity being political, there's nothing new there, right? And so do I think that it has an impact? Of course it does. Do they have degrees of freedom that allow them to do anything that they want? Of course not, right? They don't have the capability to meaningfully cut taxes or to meaningfully raise taxes. They can propose it and it can be passed under Congress, right? But Congress ultimately controls that path. There's a legitimate concern that fiscal policy has increasingly moved to the executive branch because of the fears of the inability of Congress to act. Things like getting rid of student loan payments through executive orders or mandating that regulatory agencies don't report things like delinquencies on student loan payments. Those can absolutely be accomplished politically. But it's really fascinating to actually look at what's driving the increased level of deficit. At this point, it is all about the interest rate policy. All of the increase in deficit is being driven by the Fed itself at this stage. So ironically, all the concerns that people have around very high deficit levels would be largely solved if the Fed started cutting rates. And that in turn would then cause a secondary feature. If the Fed starts to cut the front end of the curve, then you can actually finance the back end of the curve. Right now, it's very hard because of the inversion in the yield curve to take a levered position in something like 10s or 30s. You can do that as the front end, and particularly in 2s, by the way, but you can do that as the front end of the curve falls in price, falls in yield, to be more accurate.
Just one more before I hand it over to Brent. I wanted to ask you about, you mentioned the deficit, and that's something many people are worried about right now, both the deficit and the large national debt. And some people will say that is a huge, huge issue for our country going forward. How big of an issue do you think the national debt is?
So I don't think that all right, first of all, let's separate them into two components. The national debt can most easily be thought of as failed economic policy that didn't contribute enough growth versus the initial expectations, right? If you actually had made investments that drove significant growth in the United States, then we wouldn't actually be looking at the debt levels that we have. So really what the debt is telling you is this prior policy was not particularly good. That should not be a surprise to anyone who has actually observed policy over the last 20 years, right? Going forward, now the question becomes, do we spend that money well or do we spend it badly? And unfortunately, there's a ton of evidence that we're not spending it particularly well, right? That's what occurs when you effectively, as Lacey Hunt says, increasingly have to devote the resources to paying off the mistakes that were made in the past. Had we spent that debt to build more roads, had we spent that debt to rebuild our nuclear industry so that we had unlimited supplies of low-cost baseload power, had we decided to spend that money on productive capability and effectively created a competitor to China that we're now being forced to suddenly reevaluate, right? Or to make investments in education that actually caused children to be better prepared for the workforce today, we wouldn't be struggling with these issues. But we didn't do that. And so now we have to deal with the ramifications of it. So is the debt a problem? Yes. But what it's telling you is that policy is the problem, not the actual debt itself. The debt is really equity when it's happening at the sovereign level, right? Saying, what are the claims on the resources of our economy? And we've got a ton of claims that are tied to prior mistakes.
Do you think that policy can be adjusted to address that, or is that unlikely to happen?
So Adam Smith has a very famous line. There's a lot of ruin in a country, right? Particularly a country like the United States, which has extraordinary physical resources, which really does not have to spend that much of its national defense on defending itself because it has oceans on either side of it, relatively secure borders with relatively favorable neighbors, right? We don't have to spend that much protecting what we have. We're spending an awful lot of money basically trying to protect everything around the world and create conditions under which the world order doesn't change all that much. I'm not sure we're spending that money particularly well, is the argument that I would make. And it just comes back to the same thing. I don't think people are thinking in these terms, right? They're thinking in the terms of this is impossible. We can't demand more. The system is ultimately totally corrupted. We need to get by with less, right? We've just lost the growth mindset. We'll eventually recover it. I think I'm highly confident that we will eventually recover it. But how long that takes, I can't tell you.
I know that you know Chris Cole, and I was listening to an interesting podcast interview with Grant Williams from November of 2020, and it was really interesting to listen back to that because he really forecast a lot of the things that I think were playing out today. And if I frame this correctly, he thought that we basically come to this situation where we're going to have to choose sort of a left tail or a right tail. And that had to do with, monetization of debt or sort of, taking the pain for, some of our past mistakes, so to speak. You seem to think from your conversation, from what I'm pulling from what you're saying, is that we can kind of hit the ball down the fairway. It doesn't necessarily have to be this left or right tail, outcome of everything that's happened really post-COVID. Are you familiar with that sort of idea, and am I reading you correctly there?
Yeah, no, I think we're saying the same thing, right? Which is the debt is effectively a measure of how much of the resources you have to put towards prior bad policy, right? And one way of getting rid of that debt is to effectively hyperinflate it away, right? Or to take advantage of the dynamics that we print our own currency and effectively cancel out the debt. The irony is the way that would take place is through, you can't actually just inflate the debt away, right? The great irony is if I look at the decrease that we've seen in the debt to GDP number, it's been a function of growth right? Not just a function of inflating, right? We haven't done that much damage in terms of inflating at this point. And candidly, I would highlight for people, like, remember, we expanded our money supply 35%. We shut the entire world down. We started a war in Europe. We started a war in the Middle East. We are currently engaged in conflict with China. We shut down the Suez Canal. We had to reroute everything around the Cape of Good Hope. The water levels in the Panama Canal are limiting transit through that mechanism, et cetera, right? Basically, everything's going crazy wrong. And we're arguing about 2.5 versus 3.5% inflation numbers, right? Now, have we had a cumulative inflation of 25%? Almost certainly. Has the price level shifted to reflect those prior mistakes and the fact that we did not contract demand adequately in the face of lower supply? 100%. But like, people should really be thinking about all the things that we screwed up and how little impact it actually had. Like, that gives you some idea of that degree of how much ruin there exists in a country. And again, like, I'm in this weird position where I am hypercritical of the choices that we're making from a policy standpoint, but also highlighting for people that, like, to immediately project the end of the system, that the world is coming to an end, that inflation is going to run rampant, that they are in charge and are acting against our interests. Like, this is just political paranoia.
It's a very pragmatic view they have there.
Well, it's pragmatic to the extent that it actually ends up being right. And so, I'll just say very quickly that it's been wrong. I mean, the simple fact is that the U.S.'s financial house is in much better order than China's, much better order than Europe's, right? We actually know these things. And yet, weirdly, we talk about the collapse of the dollar.
Well, I would also say, to your point, we talked about this several times with some of the other earlier guests, that volatility has really been pretty contained, even through 2022, I guess you could argue, even though we threw so many problems, right, at it, politically and fiscally and everything else.
Well, yeah, I mean, you've heard my explanation for 2022. I think that 2022 was much more tied to systematic portfolio rebalancing. And candidly, I think the lack of demand for interest rates is tied to the same thing. So if you build portfolios that say I'm going to be 50-50 equities bonds, right? And nowhere in that statement do you include, but I'm going to actually look at the level of yields, right? Or I'm going to consider valuation in equities before I make that statement of 50-50, right? Then you would actually expect exactly what we saw in 2022, which is the Federal Reserve hikes interest rates. Mechanically, that lowers the price of bonds. If I'm running a 50-50 bond equity portfolio and bond prices fall, what do I have to do? I have to sell equities, buy bonds, right? And so that's what we saw in 2022. Did we see a recession? Did we see a significant retreat in profitability? Did we see corporations stop buying back their own shares? In some cases we did. But for the most part, it was largely a story about a match in behavior between bond prices and equity prices that's consistent with this dynamic of systematic portfolio allocations. If I look at what's happened since, the Fed has paused interest rate hikes, right? We've increased the supply of bonds and we've decreased the supply of equities because we ended the SPAC nonsense and we've started shrinking share counts again. Well, if I'm running a 50-50 allocation in which my demand is largely fixed and the supply changes in the way I describe, I expect to see equity prices go higher and bond prices to go lower. And unfortunately, I think that's really what we've seen. I just don't think there's information content in the way that people think there is in the behavior of financial markets at this point.
Well, is that due to a lot of the financialization of markets, essentially?
I think it's due to a combination of financialization and also the rigid application of rules that, if you stop and think about them, don't make any sense, right? The idea that I'm going to allocate my portfolio on a fixed basis after we've seen the type of change in interest rates that we've seen is extraordinary, right? But if I look at a Vanguard website and I look at the expected return to bonds in their portfolio construction techniques, it's totally unchanged from where it was in 2021.
Right. Fascinating.
Right? So why would I change my portfolio construction if my expected returns remain the same? Even though we know that that's prima facie absurd. We've gone from negative 3% real rates to positive 2.5% to 3% real rates. And everybody's saying, well, bonds are certificates of confiscation still. Well, they have to be at least slightly less certificates of confiscation, right?
Right.
But nobody's thinking about them that way.
Well, Mike, thank you for doing this. I guess you have proven Mike Taylor's compliments correct.
I am tall. You're right.
Yeah. Well, you're not standing, so we don't know that, but the brilliant part you have. So thank you again. We really appreciate you taking the time.
My pleasure, Jack. Thank you for having me.
Nice talking to you.
You can just hit the little red button.
That's what I'm doing.
All right, you guys are back.
We're back.
We back, baby.
15 lessons from 15 years managing money with Corey
We can do that in
Hoffstein.
30 minutes.
Yeah, my over-under is about 8. We'll see how you do.
Rapid fire.
But Brent and I will get out of your way, and we'll let you guys do that. I'll let Corey in.
All right, guys.
Enjoy your
nice work.
time.
How's it going?
Corey, good morning.
Good morning.
Thank you for joining Matt and I on this special day for PNL for a purpose.
Pleasure. Thanks for organizing it.
For sure, man. Let me give you a quick intro for those that might not be familiar with who you are. Founder of Newfound Research, quantitative investment firm and research firm, creator of the return stacking concept, which is offered to investors through multiple ETFs. People can learn more about those on returnstackedetfs.com. And lastly, the man that's on the sole mission to defeat the dad bod creep by rowing 12,000 meters a day.
Yeah, something like that. Something like that. Trying to preemptive strike at least.
So just a quick reminder, today's event is to support the Susan G. Komen Foundation. Quick statistic on breast cancer. It's the most common cancer among women in the US, accounting for 32% of newly diagnosed cancers. If you can and are able to, we really appreciate people supporting this. You can use the donate link right on YouTube and donate right through YouTube. And so it's for a great cause. And people like Corey, are willing to come on and give their time. And, we can learn along the way while doing something good. So appreciate that. So Corey, it's going to be a little bit rapid fire with you. Let's see if we can do it. We're using your post, which is found on your website. It's blog.thinknewfound.com. It's 15 ideas, frameworks, and lessons from 15 years. And what you did with this is you reflected on all of these things that you've learned over the 15 years in your career. And so we're going to have to hammer through. Hopefully we can get through all of them, but I highly recommend people go to the blog post after and read it because there's so much really good stuff in here.
15 ideas in 30 minutes. We're rapid.
This is going to be lightning round here. All right. So the first one, which is, you're sort of known for this. It's maybe not your tagline, but something that you talk about a lot. And risk cannot be destroyed, only transformed.
Yeah, I love this idea. This is something that came to me in graduate school. So I went to Carnegie Mellon's Masters of Computational Finance program. It's one of the earliest financial engineering programs ever. And it's all about, at that point, it was all about pricing derivatives. Eventually, Wall Street derivatives hiring fell apart and it's become more buy side. But at that point, it was all about pricing derivatives. And the constant pattern I saw in the homework and the practical work that we did was what we were effectively trying to do was, identify, isolate risk, price it, package it, and sell it. And when I took a step back and looked at what finance really is, it's my view that all of finance is really just risk transfer. And it's a question of, are you paying the right price for that risk? Whether you're talking about investing in a seed stage company, buying a public company, going long or short futures contracts to hedge exposures, it's all about risk transfer and the price of that risk transfer. And then as I got further and further into quantitative modeling, what I saw was that those decisions of risk transfer exist in the modeling side as well. These are all trade-offs that we have to make when we make decisions in our investment process. And there's almost no times that risk is truly ever destroyed. There's nothing you do that ultimately destroys that risk. It's just a trade-off of the risks that you're willing to bear and those that you're not willing to bear, or risks that you think you're fairly compensated for that you want to keep, and risks that you're not, that you'd like to get rid of. And so this is sort of one of those big overarching philosophical concepts that stuck with me in my career.
So important. Number two, and value investors can certainly identify with this one, no pain, no premium.
taking a hit of coffee so I can get through this.
Gonna need more than coffee there.
Yeah, no pay, no premium. Very similar concept to a certain degree, which is particularly for investment concepts that get held in mutual funds or ETFs that the vast majority of people have access to. You're talking about investment strategies that aren't typically exploiting arbitrages in the market. They're exploiting, hopefully, mispricings, either behavioral mispricings, or they're tapping into risk premia for which you are being paid for holding risk. And so at the end of the day, for you to earn that return, you have to be willing to bear that risk. And it's an expected return on an ex-ante basis. And there are some times that premium that you're going to earn is not going to offset the risk that you bear. One of the ways I like to think about this is for those lower Sharpe ratio strategies, and those are strategies that are typically packaged up in ETFs and mutual funds because that's where they can live, 0.3 to 0.6 Sharpe, you're talking about investment strategies that have to go through periods of prolonged drawdowns, in my view, to ultimately shake out the non-believers for you to be able to earn that premium over time. That sort of weak hands pass the premium to the strong hands over time. It also means, unfortunately, there's a large degree of faith baked into this. You have to truly believe. You can't rent the conviction. You have to truly believe in the process and just stick with it, because from a statistical perspective, we'll all be long dead before we know whether some of these concepts actually truly played out the way we expected them to.
Such an important point, because if you invest in something and then you sell after a long period of underperformance, you're just probably hurting yourself in most cases. So that's excellent there. What about number 3? Diversifying cheap beta is worth just as much as equally diversifying expensive alpha.
Yeah, we love alpha in this industry. And I always kind of laugh because at the end of the day, like for anyone with a mathematics background, alpha just comes from this linear regression, right? It just happens to be the Greek letter that was chosen. There's alphas and betas, but we love alpha, even though all it really is just the intercept term, the unexplained returns in a linear regression. At the end of the day, though, when we think about building portfolios, we should be agnostic as to whether we're adding true alpha or some new form of beta to our portfolio, if that beta represents a source of return which we're not getting anywhere else and is uncorrelated to the things we're already doing, right? And it's probably far easier to do. So very simple example, if you're an equity investor, it's probably a lot easier for you to add bonds to your portfolio than it is for you to add alpha through security selection, right? Or easier to add some form of commodities to your portfolio than it is to add alpha through security selection. And I think that idea gets looked down upon, right? Because our goal in active management is to always be adding alpha. But I think we shouldn't look past the low-hanging fruit when it comes to portfolio construction. Diversifying beta is hugely valuable, and quite often we have much higher conviction in the expected return of beta than we do of any source of alpha.
This next one seems obvious, but you kind of approached it from a different lens, and that is diversification has multiple forms.
Yeah, so diversification is one of those things everyone learns about earlier in their finance career, but it typically takes the form of what you're investing in, right? So we've all heard the idea, for example, you can invest in 30 stocks, and that will get rid of all the idiosyncratic vol, and you'll be left with sort of beta component there. And that sort of diversification is typically good, and you're looking for a trade-off of getting rid of idiosyncratic risk you don't want while keeping the idiosyncratic risk that you think you're compensated through for alpha. But that's only one form of diversification. So another form of diversification might be the process by which you invest. We'll go back to the umbrella of value investors, for example. You could have a value investor who takes the very antiquated academic approach and sorts on price to book. You could take a value investor who takes a much more modern machine learning driven approach. They are probably going to be somewhat correlated, right? Tied to the fundamental tenets of value investing. But in the short term, their returns can look very different. And if you have several approaches by which you think work and you don't have higher conviction in one approach versus another, then you should diversify. Similarly, and this is a passion area for me, and anyone who knows me knows I'm absolutely obsessed with this concept. I'm Don Quixote tilting at windmills. Diversifying when you make investment decisions is also hugely critical. It's something I call rebalance timing luck. As a very simple example here, let's say you are a value investor that refreshes your portfolio once a quarter. you might end up with a very different portfolio if you rerun your screens mid-quarter than if you run them end of quarter. And you can run the exact same screens and end up with very different portfolios. And in coming up with very different portfolios, you will end up with very different returns. And so the question is that sort of randomness something you want to bear? Well, it's uncompensated randomness. And so why wouldn't you, for example, take half your portfolio, rebalance it mid-quarter, and take half your portfolio and rebalance it end of quarter and get rid of that timing luck? So that's a whole other axis of diversification that people typically don't think about, but can play a profound role in the impact on long-term returns.
Let's clarify. You're not the Don Quixote tilting at windmills. You're the Sancho Panza of statements about the industry here.
I appreciate that. Thank you.
Okay. The philosophical limits of diversification. Talk about
Yeah,
that.
so this is another one where people, again, it goes back to the sort of maybe risk can't be destroyed, only transformed. People are constantly looking to keep diversifying their portfolio, and they want that perfectly smooth lineup. And the point that I like to make is if you could build a portfolio that you diversified away all the risk, you end up in one of two places. One is a very expensive risk-free rate, or two, you found an arbitrage. I'll hope for you it's the latter, but that's very unlikely when you're talking about diversifying with very common investments, right? So at a certain point, you can't create a perfectly smooth lineup. You have to have some of those peaks and valleys and some of that roughness in your P&L stream, because you are, for the most part, again, talking about the investors who are investing in things like ETFs and public securities and mutual funds and lower sharp strategies, you are bearing risk. And that risk is going to manifest in some manner, whether it's day-to-day volatility or big events that occur, and that's going to create drawdown in your P&L. And that is just a natural component of expecting to earn a return. If you don't expect to have any risk, why would you earn something higher than the risk-free rate, right? Short-term T-bills. And so, again, we can't just manage to diversify away all the risk without also potentially hurting our return.
So that's the intended bets. What about the unintended bets? And why can those be the ones that blow you up?
Yeah, so this is an area, again, I think when people look back on the history of financial catastrophes or manager blowups, it's often not the things the managers were trying to do that get them in trouble. It's the things they didn't expect. It's the unintended hidden bets in their portfolio. And that's, I don't know, I don't want to say it's a tautology because it's maybe not technically a tautology, but it makes sense, right? It's the things you're unaware of that are ultimately going to cause the greatest catastrophe. And so I think it's our job to constantly be on the lookout for those things. So as an example, right, we talked about the different forms of diversification, that process diversification or that rebalance timing diversification can be killers to your P&L. There's a story on the timing one that I'll tell about research affiliates back in 2008, what was called the immaculate rebalance. At that time, research affiliates was only rebalancing their portfolio once a year. And they happened to rebalance in March 2009, which was the perfect time for them to rebalance. And I think they created 900 bips of alpha that year. Had they rebalanced in September instead of March, right, just arbitrarily a different quarter, they would have underperformed the S&P by several hundred basis points. And that has obviously not only a profound impact on the long-term returns of that strategy, that fundamental indexing strategy, but I would argue probably would have changed the trajectory of the firm at large, right? Probably would still be a very successful firm, but maybe not as successful. And so those are some of the unintended bets that as a PM or an investor, those are small things that can really ultimately blow up your performance unless you constantly are trying to find what am I exposed to that I didn't think I was exposed to.
It kind of makes me think of like if the Immaculate Reception hadn't happened in football, would Terry Bradshaw have gone on to have the same career? What about its long-short portfolios all the way down? How very Buddhist of you.
Yeah, this is one I stole. What's the phrase? It's turtles all the way down from philosophy. This is the
and
concept,
Dr. Seuss. But
yeah, the concept here for me is thinking about any portfolio change can be thought of as a long-short portfolio. So very simple example, if I've got, say, a 60-40 portfolio and I want to think about tilting that to a 70-30, that is functionally equivalent to holding my 60-40 and adding in a long short portfolio that's long 10% stocks and short 10% bonds. Similarly, any active manager can be thought of the same way. An active stock picker is just the market plus a long short portfolio where you're long the things that they are above market weight and short the things that they are below market weight. And this is really important because it helps distinguish what their active bets are and the true active risk they're taking and isolate it from beta. And so thinking through portfolio changes, thinking through active managers, thinking through different exposures through this lens of, well, it's all just long short portfolios that are being added together at one point in time or over time can be a really useful framework for isolating some of these effects.
As an allocator, that's one of my favorite ideas you've ever explained.
I appreciate it.
Just
Thank
for
you.
the record, I really love that idea. The more diversified a portfolio, the higher the hurdle rate for market timing.
Yeah, so I will say I was a big market timer earlier in my career, and one of the things you find is that as you add more diversification to your portfolio, as you add more uncorrelated sources of return, the accuracy with which you have to be able to time switching between those different diversified sources of return continues to go up. And so again, when we think through this lens of, you know, what's better, finding a source of alpha or finding another cheap diversifying beta? What's better, adding more diversifying beta or trying to come up with a more accurate market timing signal? You know, again, I think all the evidence suggests more diversification tends to work in our favor versus our ability to increasingly add accuracy. I am a lot more confident that I can find another diversifying asset class or strategy than I am in my ability to consistently improve my ability to time markets.
Well, it's never too late to go try again.
That's right.
Katie Stockton was just talking about this an hour ago. Certain signals are only valuable at extremes. What's that mean?
Yeah, so I think a good one here, we'll go back to value stocks, for example. When we look at value stocks, we can look at the growth, the spread, the value spread between growth stocks and value stocks. And we've seen them get to all-time highs, past all-time highs. But well before that, people were starting to say, hey, it looks like value's cheap. And then we saw value get cheaper and cheaper and cheaper and cheaper. And with some of these signals, they're very coarse signals. They're not highly precise. And so there's a whole bunch of reasons that we might be able to explain why these coarse signals at 1 degree or 2 standard deviations aren't really necessarily giving us much power. They are potentially, that could be explained by noise. It could be that we haven't appropriately accounted for industry differences or measuring value in certain ways or whatever it is. But at a certain point, when those measures start to get to real extremes, the probability that they are explainable by noise or explainable by a factor that we've missed starts to diminish, and it becomes much more likely that it is the true thing we're trying to measure has actually gotten out of line. So, right, value spreads between growth and value stocks at 2 standard deviations, maybe not that interesting. At 5 or 6 standard deviations, suddenly you're saying, okay, this is a signal I need to pay attention to because it's no longer explainable by all these potential things that could be causing this deviation.
The poet-philosopher Ron Swanson once said, never half-ass something you can whole-ass. Corey Hoffstein once said, under strong uncertainty, halvesies can actually be the optimal decision.
Yeah, halvesies probably doesn't sound like something a quant would say a lot, but
No.
halvesies has been a driving factor of my career. So an example I will give here, during the smart beta wars of the early 2010s, there was a question as to whether it was better to take what was called the integrated approach or the mixed approach. The idea here being, if I have a value signal and a momentum signal and a quality signal, is it better for me to find the stocks that have the highest intersectionality of those signals, or is it better for me to build a value portfolio, a momentum portfolio, a quality portfolio, and equal weight those portfolios? And you had academic proponents and practitioner components on both sides making phenomenal arguments. Just as an example, AQR was on the integrated side, Goldman Sachs was on the mixed side, right? So we're not talking about, like, we're talking about intellectual powerhouses here who are disagreeing. And as far as I could do my own research, rely on the practitioner and academic research of others, I could not justify one approach over the other. And so my answer was halvesies, right? I knew I wanted the factor exposure, but I had uncertainty as to which, and no high degree of confidence as to one approach over the other. And so halvesies ended up being the way to go. And I think all too often we feel compelled to choose something when in reality halvesies is a perfectly valid option of what we can do. If we don't have one conviction in one particular signal or one particular portfolio design approach over another, halvesies is very powerful.
What about always asking what is, not just the next question, but what is the trade?
Yeah, what is the trade? So this one, I am not a big lover of macro. And maybe this, I'm going to show some bias here, but I get very frustrated when I see a lot of macro proponents on Twitter talking about macroeconomic signals, and they say things are wrong. The world is wrong. And you hear that a lot. And what I realized was when you tried to press someone as to what was wrong, why were markets wrong, or why is the world wrong, the most important question I could really ask is, all right, if the world's so wrong, what's the trade? Right? Because if the world is wrong, there should be some way for me to profit from it. And if they can't tell you precisely how to profit from it, then their view isn't really worth much. So as a very concrete example of this, years ago, we saw a whole bunch of people talk about Greek sovereign debt having a lower yield than U.S. sovereign debt, right? Sort of, and the claim was, oh, isn't this crazy? You know, U.S. debt is now the high yield asset of the world, right? The problem is what that misses is the fact that yield is not really the measure. You're getting paid a coupon in a certain currency, right? So if you ask what's the trade, well, the trade would be go long, right, or go short the treasuries and go long Greek debt and capture the spread. But if you actually accounted for currency differences and tried to neutralize that currency exposure, you would have found actually on a currency adjusted basis, the yield of Greek debt was substantially higher. And if you measured Greek debt versus a more relevant benchmark, like what maybe German bonds or just Eurozone bonds in general, you found that there actually was a significant credit spread there. So the point is, like, when you get this macro story that, oh, that seems wrong, when you try to dig into the trade, it can actually make the macro story fall apart.
Number 12 is the trade-off between type 1 and type 2 errors and how they are asymmetric in nature.
Yeah, so we are obsessed, particularly in academic finance, with trying to avoid false positives, right? We want to find these alpha signals, and we want to say we have 95% confidence in the signal. And I think what that misses is that there's this asymmetric trade-off that if you think about trading a strategy that doesn't actually have any alpha to it, what is the cost of that? Well, unless I think there's a reason that I'm finding that strategy that leads to adverse selection, I would argue it's just noise plus trading costs, right? But on the other hand, what is the cost of missing a false positive? Like if there was something that actually has alpha, but it didn't meet my threshold, false negative, then I'm missing out on alpha. And so Marcos Lopez de Prado talks about this quite a bit, that we're so obsessed with this 5% certainty threshold in financial publications, but actually if you think about relaxing that constraint because of this asymmetry, in one case we're just getting noise minus trading costs, in the other case we're missing out on true alpha, right? We would actually trade a lot more strategies that we have less certainty in because of that opportunity cost of missing out on the alpha.
I think this next one is very important and something that we all can identify with as being in the markets and working with investors. But the point you made is behavioral time is decades longer than statistical time.
Yeah, I 100% stole this one from Cliff Asness. When you work in quant finance or academic finance and you're working on these investment strategies, you build these back tests that can span decades. And often we're drawing these back tests on log charts with thick crayon lines, and they look like straight lines up. And even in those decades, there are drawdowns. You go, yeah, but that's just what happens. This is a 0.4, 0.5 sharp strategy. You expect there to be a lost decade, so be it. Living through a lost decade and keeping clients through a lost decade is very, very, very different, right? So it's easy for me to look at a back test and go, yep, that would have been tough, moving on with my life. Whereas in reality, behavioral time is like dog years. Asking someone to sit with you through a 3-year drawdown in active strategy, particularly if they don't have a high degree of confidence as to how the strategy truly works and they don't have the conviction to stick with it. Again, earlier I said you can't rent conviction. That's going to feel like 21 years of a drawdown to them. And so I think for those of us who are not just managing money, but bringing product to market, we have to be very aware in running our businesses. You know, a decade-long drawdown might be totally possible for any active investment strategy that we're putting into an ETF or mutual fund. And yet we have to understand from a client's perspective that is non-tenable. And we will lose a tremendous number of clients. You look back at someone like Warren Buffett, right? Probably the most genius thing he did was not run a public fund. If Warren Buffett was running public money, he probably would have lost all of investors in the late 90s, right? And so you just have to be very aware, like these processes, they go through long periods of drawdown. Behaviorally, that's really tough to stick with.
So I'm going to jump to number 15 because you brought up back tests, but the point you made is a back test is just a single draw of a stochastic process.
Yeah. So look, markets are random. I think Mike Green has a great quote, and I think he might even attribute it to someone else's. All markets are is just a logbook of where price is traded, right? But there's so many things that could happen in the world, in so many ways the world could have unfolded, that when we run a single back test, all we're really doing is seeing one potential draw of a potentially infinite set of worlds that could have happened, trades that could have happened, different market prices that could have occurred. And so I think it's just a good reminder that we're trying to build certainty over time, but we're missing the breadth of all the parallel universes that could have happened. And so to me, it's a reminder not to emphasize, like to me, a back test never confirms a strategy works. A back test only sort of, you can't accept the null hypothesis. You only fail to reject, right? You just fail to reject it didn't work. And you just need to be aware of all the randomness that could have occurred. And I think if you run a good backtesting engine, you try to inject some of that randomness to see what happened if that company never went public? What happened if I didn't trade on that date? What happened if I didn't have that data in time? All those sorts of things. What happens if that whole month never existed, right? And you can start to manipulate and inject randomness in all these different ways to try to create a more stochastic view of what your return stream would have looked like.
This last one was basically a bonus, but the market is usually right.
Yeah, I guess over my career, I went from a very arrogant young person who says the market is wrong and there's tons of alpha to be had to saying the market is pretty efficient. There are certainly cases where it's wildly inefficient. I think we all just lived through one of the post-pandemic bubble in meme stocks, where it's easy to say these valuations are absurd. Not easy to trade though, right? Lots of people lost a lot of money trying to short against that. And so, but in the long run, I think, again, maybe it ties back a little to asking what's the trade. When you start seeing things like, oh, U.S. Treasuries are trading at a yield that's higher than Greek sovereign debt, right? Like, is the whole world lost its mind? Is that a rational conclusion that global capital markets are so broken that U.S. Treasuries are trading at the wrong price? Or is it more likely that I'm missing a piece of the story? Is it likely that European stocks are trading at a discount to U.S. markets because they are profoundly cheap and the entire world's capital markets has missed the opportunity? Maybe. Or is it that we're failing to adjust for things like sector differences and profitability and acknowledging regulatory differences and legal differences and cultural differences that lead to divergences in economic growth? I go back to, I think where my view has changed is I've stopped looking at things and saying the market's broken, and I've started looking at things and saying what part of the story am I missing? And I think that's helped sort of reframe how I approach markets.
Corey, you came ready to play, delivered in spades. Thank you very much, sir. This has been great. Really appreciate it.
Appreciate you guys having me. Fantastic, fantastic event, and I look forward to listening for the rest of the day. So thank you.
Thanks, Corey.
Thanks, Corey. Justin, who we got next?
So we have Jerry Parker at 11, Darius Dale at 12:30, Meb Faber at 1. Rafael Resendez at 1:30, Wes Gray's coming on at 2:30. The list goes on and on. We will be here all day.
A lot coming up. How was my over under? By the way, we're gonna let Jerry in a second, but how was my over under?
We got through. I skipped one, but we basically got through 15. Yeah.
If you count the bonus question.
He did great.
Oh, then you did get 15.
We got the bonus. Yeah.
Well done.
Yeah.
See you guys in a little bit.
All right, Matt.
All
We'll
right,
see you in a
Matt.
minute.
All right.
Let's let in Jerry. Hey, Jerry. How are you?
Hey, good morning. How are y'all doing?
Good, Jerry. Camera. Do you see Jerry, Jack?
Yes, I do.
Oh, you do? Okay.
Yep.
Well, as long
Yeah.
as you see him, if you see him, then we're good. We're good to go. Hey, Jerry, thank you for jumping on with us, joining Jack and I on this event today. PNL for Purpose to support the Susan G. Komen Foundation. Just a quick intro. Jerry is founder of Chesapeake Capital, one of the original trend followers and turtle traders, sub-advisor to a new ETF that utilizes some of his trend following concepts in an ETF wrapper. And just as a quick reminder, this event is to support Susan G. Komen. A fact about breast cancer: there were more than 11.5 million breast cancer survivors in the world as of 2022. This is a disease that affects millions and millions of women, and today's event is to help show some support for the organization and doing a little learning from folks like Jerry along the way. So appreciate if anyone is listening or watching can donate directly on YouTube. There's a link right below the video. So thanks again, Jerry. We appreciate it.
Oh, thanks for having me.
So first, let's get into a couple of just definitions, because I think it's important to define this stuff up front. So can you just explain the differences or define trend following, managed futures, and what a CTA is?
Sure. From my point of view, obviously all of this is from my point of view. Trend following, I think the core of trend following is this old cliche, letting profits run and cutting losses short. It's hundreds of years old, probably. I think it's accepted that that's can be a successful strategy if you have outlier trades and take those small losses. But you've got to make a lot of money on maybe 5 or 10% of the trades that really go a long, long way. We've had a few of those here recently. I know we'll talk about. Maybe trading in a lot of markets is important, long and short, for trend followers. But I think that pretty much sums up trend following. Managed futures is a sort of the industry term for the collection of CTAs that trend follow, and they do lots of other things too. Some of those CTAs in managed futures don't trend follow, and they don't hold positions long term. They may, and some do, and they may add other strategies to the trend following. I looked up CTA yesterday. I love that term. It's like my favorite term of all time. It's from 1936, so almost 90 years old. It's my preferred term. It doesn't mean what the letters stand for any longer, which is fine. IBM, International Business Machines, is not what IBM is all about anymore. But I think that's one of the secrets of having a good name, is that it's very old. People know what it stands for. It's just a regulatory term here in the U.S. When they started regulating futures traders, I guess, that signifies those type of managers and how they have to register with the CFTC and the government in particular.
What did it mean originally?
Commodity trading advisor.
Okay.
So we trade a lot of other things other than commodities, although we are known for trading commodities about as much as anyone else.
In your Twitter bio, you refer to your style as the vintage retro classic trend following type of approach. What did you mean by that? And I guess how is it different from what maybe newer trend followers are doing?
I think, like I said earlier, the managed futures is made up of a lot of CTAs, and some of them trend follow, and some of them have altered the way they handle the trend following approach. My approach is to have a stop loss. That's not always the case with a lot of CTAs and trend followers, and to let profits truly run. So like in our cocoa trade, we have kept the same position on here for over a year, even with the increase in volatility and maybe some risk to the portfolio of this one position that has just grown to be an outlier in terms of profits and in terms of volatility. So it's really dominating performance sometimes. And we just sort of say, let it ride, let it go. Don't reduce that position. And I think 99% of managed futures CTAs, they are more like reducing that position, especially as volatility increases, to tame it down a little bit and make it more of an equal producer and participant in the portfolio. So we don't do that. We sort of try to stick with the old-fashioned classic trend of really letting profits run.
So the new version of trend following is more around risk management. You had a quote on your Twitter, which is interesting. It was, I think it was from a news source. It was, the top was put in by CTA trend followers who were selling into new highs, which doesn't seem to make any sense because trend followers should not be selling into new highs. So is that indicative of the new type of trend following?
Right. I think this was a quote from someone else that I really liked. And it was basically them saying, there was a podcast where they were describing what's happened in cocoa this year. And someone said in the podcast, CTAs have been selling cocoa every day since this whole year and reducing their position dramatically, once again, because of this volatility. And he coined this term mean following, which I thought was pretty humorous. Trend following versus mean following. So the Sharpe ratio looks better, and the sort of quote unquote risk volatility, if you think volatility always translates into giving you an indication of your risk. That is why they do it. And that in the Sharpe, like I said, the Sharpe ratio is going to look better, but I think, we like to let those profits run. And once it's a profit, I don't really consider it a risky situation or part of my risk any longer. If I take a small loss, that's my risk. Volatility is, in my opinion, not risk.
I want to ask you more about cocoa later, but I want to ask you about this idea of risk management around cocoa. Like you just mentioned, like if you're practicing the old version of trend following, if cocoa runs up a ton, now you've got an overweight position in cocoa. I mean, is there a certain point where you do want to bring it down in a classic style, or you just want to let it run?
I think, you kind of want to let it run. I think when you get something like cocoa, which is so outrageous and so such an outlier, I think it does destabilize you. People get destabilized by losing money. They get destabilized by letting profits run, and a big, huge profit that kind of dominates the daily performance. It's no fun. I've been there. I think it's just fine. You're not going to really have a dramatic impact on these outlier trades, and taking some off the table, even in a discretionary way. Just if you can't sleep at night, you can't follow your system, it really is causing you trouble psychologically, go ahead and take some off, and just, I wouldn't really worry about it. I wouldn't even have a rule for it. I don't think it's can be rule based, because there's not much of a sample size for these trades that are so crazy like this and so volatile like this. Just take some off and don't even worry about it. Because I know that it is difficult to hang with these profits sometimes.
I'm just curious. I was thinking about Wes Gray's work around momentum when you were mentioning that, which is a different thing. But one of the things he found in like momentum investing is when the momentum's more consistent, it tends to last longer or be more predictive of the future. Do you see that in trend too? I was thinking about something like cocoa that just skyrockets. Is that less predictive than something that's maybe just grinding its way up over time?
I don't think so. I don't think any of it's very predictive, especially the outlier trades. We do so many trades and so few of them make very much money. And so trying to slice and dice those and gather some meaning from the ones that are the only ones that are meaningful seems like something I probably don't want to do. So I just try to ignore looking at the outlier trades and trying to glean some sort of idea from them, as if they're going to sort of tell me later how to treat them. So I sort of ignore what goes on in between the entry and the exit. And that's me trying to protect myself psychologically, because some of the volatility in some of these markets is crazy. But sometimes volatility is just a stopping point to see if you're bold enough to hold on to your trade and to follow your system, because there could be another leg up. We've seen that in cocoa too. It's had some dramatic sell-offs in the past couple of years, only to make new highs. So I don't think these things are predictable.
I believe you were an accountant before you became a trend follower, and then you met Richard Dennis and you got involved in the turtle trading program. And so I'm wondering if you could just talk about that story of how you got involved with that.
Oh yeah, I read an article. I read an ad in the Wall Street Journal in 1983. I was in a public accounting, and I had studied, read about trend following and trading. I knew it was something I wanted to do, so I answered this ad, and I got an interview, and I was one of the 12 people out of 1,000 resumes that were sent in to get hired. And it was, we got there, and it was a 2-week training course in a hotel. And it was, so yeah, we would just sit there and given all this great information, and given all the rules and ideas of what it would take to be, have a lifetime in trading. It wasn't just here's what works now, because they were like, yeah, this is not going to work forever. You're going to have to change, evolve over time, and we're going to show you how to do that. We traded about 20 markets at the time, a few currencies, some commodities, the grain markets and metals, and maybe crude, a few bond contracts, the S&P. So it was quite fun, quite amazing. These were genius people who taught us everything they knew. I have no idea why. They should not have done it. I don't think we didn't deserve to have all of this great knowledge and given to us.
Do you know why? Like, why were you selected as 12 people out of that many? Like, what was there a test or something? What did you do? Do you know?
There was a test, and so you sit your resume in, and you got the test, 100 true/false questions and some discussion questions. And I did really well on the test, and maybe my resume was not that exciting, so I got in probably based upon the test, and then some people got in because they had great resumes, Harvard or blackjack player, backgammon player, an actor, a guy who worked for the company that created Dungeons and Dragons. So a 17-year-old kid in the computer business who was the best trader initially. So it was a large group, a different group of people, all probably smart people, but different backgrounds. They really didn't. They asked us, "Are you a CTA? We don't want you to be a CTA. We don't want you to know anything about trading. We don't want you to be corrupted yet. We want to pour into you everything we know and have you actually believe it." And that was one of my keys as well. I actually believed everything they said, and I think I still do. Yeah.
So I assume the test had nothing to do with investing.
Oh no, nothing to do with investing. The true/false test had things about futures trading and trend and psychological. How do you think about markets? And one of the questions was, it takes money to make money, true or false? So it was a little contrarian. So putting all that together, I was like, yeah, I think that's false. And that is false. You want to have people who don't have that mindset, like, well, I'm kind of a failure, or I'm not really doing very much because, it takes money to make money and I don't have money. So it was questions similar to that. So it was kind of random, that I did well on the test, I think.
I would assume most people got that wrong. I would assume pretty much everybody put true, right? I mean, I probably would have put true.
Me too.
Yeah.
What were your biggest takeaways from the turtle trading program? Like, what are the biggest lessons you carry forward today from what you learned back then?
Oh, I'll tell you, because we asked Rich that question straight up, I asked him, what's the biggest mistake we're going to make? And he said, getting knocked out of a trade and not getting back in, when the signal hits, when the system says, get back in, not doing that. And of course, I did that many times early on. But the two things I think that were most important, and still are most important, one is to your trading size, trade small, don't trade too large. And the number two would be to follow your system. They kind of go together, because many times I've traded too large and lost too much money and had too much volatility. And that in itself kind of prevented me psychologically to continue to follow the system. I had to override the system and not follow the rules. And So I think those two things are really, really important. Trade small, follow your system, even if it's an average system. Rich would say, yeah, if it's just an average system, it's going to work better if you just follow it every single time rather than the best system that's not followed all the time. And if you miss one trade, it's probably going to be an outlier. So you cannot miss a trade. That's very important for a trend follower. Don't ever bypass a trade. Don't have anything in your system like a filter that filters you out of cocoa. Yeah, cocoa can teach you a lot of good lessons. You know, Rich used to say you learn more from your losses than your profits. But if you're not in cocoa, or if you botch that trade, you're going to learn a lot, and it's really going to be a problem to get over that. Yeah.
How different is your approach today from what it was back then? I mean, I assume you might have more indicators now. You might trade more markets now. I mean, is that along the right lines?
Yes, shockingly, not as much as you would think. I like to stick with the basics and not have too many rules and parameters. Definitely longer term. The turtles were pretty short term traders, 20, 40-day look back. And we like to trade long term, trend following, an average holding period of about a year or so. And that's totally based upon the back test and the research we've done. But yeah, we were told very early on that diversification is a key to trading. And so I was just extreme in that, trying to find as many markets to trade as possible. And we're one of the few CTAs that use our trend following approach. In our main trend following program, we trade securities, stocks and ETFs and things like that. So we just have about 400 markets that we trade in our portfolio.
We might have a lot of listeners who are in something like the 60-40 portfolio right now. How would you explain the risk return profile of something like trend following relative to something like that?
Well, I think we've seen the problem with 60-40 in 2022 when everything went down. So I'm in favor of lots of stocks, lots of bonds. I like to throw in the currencies and commodities as well. But you got to have a trailing stop. You've got to have a short position. You know, being long bonds or long stocks is just you can't get it low enough. The only reasonable thing to do is to be short. And so no matter what you did in the bonds and stocks in 2022, it's not going to work out. So if you don't have shorting and following the trend and using stop losses, you know, we trade the stocks, we trade the bonds. They're there. They're in the portfolio. The currencies and the commodities are great additions, but not having that trend approach where you're paying attention to trend, taking the small losses, and being able to have a trailing stop to know when you're going to take the profits or even be able to do the shorts, that's going to just cause problems for any sort of portfolio. Even 60-40, that's basically long only and long always. So that's why I've never done that. But I love the stocks, I love the bonds, just not long only all the time.
Just one more from me before I hand it back to Justin. Why did you make the decision to do the individual stocks? Like, I think, and correct me if I'm wrong, I think a lot of trend followers will stick to the major asset classes and they won't get into like the subcomponents of individual stocks within equities. Like, why do you think it's advantageous to do that?
There's more diversification. I have shorts on now in my portfolio, and there's no index that's short now. Outlier trades, you're going to get an outlier in some of the individual markets easier than you would an index of lots of markets. Some of those markets, some of those stocks, I'd like to be long from a trend following perspective, some short and some flat. So no CTA would trade the dollar index only. They're not going to do that. They're going to trade all the currencies, as many as possible. Or commodity index. No CTA would ever trade a commodity index versus all these wonderful individual commodities like cocoa. You know, can you imagine trading a commodity index with cocoa in it and looking around at all your friends going, what was I doing? I need cocoa, not cocoa in a big index. So it's the same with stocks. It's really probably because getting out of managed futures, which says right there in the name, it's futures. It's just a struggle for people to break away from that and trade these wonderful stocks.
I'm just curious on the stock side, are you like limited to large caps, or are you kind of just full market, can go down to even the micro cap stocks?
I trade all from small to mega cap. The mega caps are more suitable for shorting, and the small ones do better on the upside, and with the ability to have the outlier trends. But yeah, I think that's a little bit different from the CTAs are not really used to having to worry so much about borrowing and the fees for borrowing stocks. That is kind of a bummer that it's not as easy to short stocks. But shorting the big companies is very, very easy and very, very worthwhile from a portfolio diversification point of view.
That makes sense. One of the ways that people think about trend is sort of like I guess maybe a core and satellite approach, or like a supplementary allocation to trend. So, you have a slice of your portfolio and you follow trend with that. But I think you kind of are taking the stance that a little bit more that trend can be more of a core sort of allocation for investors. Do you just want to kind of shake that out a little bit?
I think so. Like I said, we trade stocks of the 400 markets we trade. 200, half of them are stocks. So we have the stocks. We have a lot of bonds. They're very correlated to each other, Europe, Asia, US bond markets. We have them in there. It's a question. Do you feel better with the trend wrapped around it? Where you're going to take a small loss, you're going to go with the trend. You may be short in a downtrend, or do you feel very comfortable being long only all the time? I'm smiling because it's a silly choice in my opinion. Of course, I want that risk control that even the most basic, classic, vintage, retro trend following offers. Do you really think that trend following is going to do worse than buy and hold? I mean, that really is the question. And I don't think it will. It has over certain periods of time. For unfortunately long periods of time, it has. But I would go with what the computer says and do the back test. And that's probably going to be like 20, 20, 60, something like that. I do think that long only does have its day in the sun, even taking this almost unlimited amount of risk and drawdown when you're just going to be long only stocks and bonds. It probably is not going to devastate too often, but and it will contribute some. But it certainly seems to me that you should start with the fully diversified trend following and then start adding things to it that may not have the sort of risk control and profit opportunities that trend following has.
I think the nice thing too is if you can kind of get that exposure in a tax efficient way, like via an ETF, for taxable money, you might find more investors sort of allocate to it in more of a core type fashion because, if they have a lot of wealth in non-retirement accounts, like that's just a very efficient way to deploy it tax efficiently.
Right, and I think once again we do make all of our choices based upon the back test, and the best strategy for trend following that we found is the longer term approach. And so most of the big trades, nice trades, we're going to hold for over a year anyways in those securities, so they're going to qualify for favorable tax treatment, hopefully.
Is there any evidence that shows certain types of asset classes sort of work better with trend following? Like I'm thinking of like maybe commodities, these things that can have these sort of super cycles.
Honestly, I don't think so. I don't think that's the proper way to look at it. There's trends in all of these markets. We've seen the yen. We went through the yen, certainly some stocks out there. And we've seen long periods of time where commodities didn't work very well, long periods of time. And all of a sudden, then they do start working. So I think that's another thing I wouldn't put too much emphasis on. I would put all the markets in one batch, run the back test, look at what the average did, the whole group did, and not try to single out any one sector or any one market. And the reverse of that is cocoa was probably the worst performing market, not even commodity, but market over the past 10 or 15 years. You could easily have just said, well, that tells me what I need to know about cocoa. And I'm saying, no, it doesn't tell you anything. Your best idea of what works in cocoa is what the average trade looks like over all of those markets. What's the average trade? And now cocoa is showing that it can it can change what people think about it with one big trend, albeit a huge trend, one of the biggest ever. But now cocoa is probably back to being a pretty decent market if you throw in this most recent trade.
How long have you been managing money at Chesapeake? When did you start?
1988.
Okay.
So the total started at the end of 83. So 40 years total, but 1988 for Chesapeake.
How did you, or what's your approach to dealing with sort of the behavioral downside of what clients can sometimes go through? I mean, if they're in a strategy, they're paying fees, if they go through a period of underperformance, we just had Corey Hoffstein on the 1030 block, and he was talking about, you know, the difference between behavioral sort of time periods and statistical. Like, it's sometimes easy to look at a backtest chart and say, you know, this has like 40 years of outperformance or 60 years of outperformance, and the drawdowns or the trailing periods are like little blips on a chart. But when you're actually managing clients' money and you go through three years of underperformance, it can be tough. So I'm just wondering, like, what has been your strategy for effectively dealing with clients when they have seen those periods of, you know, kind of lackluster relative returns?
That's a good, I think getting on the phone with people, talking to people, telling them what you're doing, letting them see the performance, the statistics of how everything's working. But I think most importantly is to educate people up front and find the people who love trend following. I loved trend following when I first heard about it. I was 23 years old and I thought it was the greatest thing ever. I've only fallen in love with it more each and every day since then. And for some people, it clicks, you know, taking the small losses and letting the profits run and diversifying and having an objective approach, rules-based. It really is just something that it really, maybe for a small percentage of people, unfortunately, 5 or 10% of the people really love it and they get it. But I think for everyone else, it's a huge struggle. So maybe investing in a fund that has multiple CTAs in it, or just putting a little bit of money in. And but it really is the problem. I think eternal problem for the entire industry has always been, it's hard to do, it's hard for us to do, and then it's hard for the clients to hold on to it. Because if they were good at holding on, then they may qualify as being a trader, but they're probably not going to be a trader, and they're probably not good at holding on. So it's really a struggle for the hot money and for people to really love. You know, one of the questions on the turtle test was, should a trader love their losses? And the answer is yes. You should love your losses, because losses and every characteristic of your system is part of the system, and you should love your system, and you should love, no matter what happens, you should just not care about performance so much. And you're just asking people to do, I think, too much. And it's just very hard for most people.
Yeah. This has been great, Jerry. We're asking all of our guests today a standard closing question, and you can go anywhere with this. It doesn't need to stay in the investing or trend following lane, but what is one interesting thing that you're seeing right now that you think others should be paying more attention to?
I love that question. And I started off with something like, people should realize that if we're getting 5% in our money market fund, then inflation's really high. But then I said, well, wait a second. What I really want to talk about is college football. College football is going to 2 conferences, just like the AFC and the NFC, with about 35 or 40 teams in each one of them. There's going to be a union. There's going to be contracts. There's going to be free agency. There's going to be big paydays. And I'm really wondering how these colleges and universities are going to handle owning these professional teams. But that's where we're headed. We're headed to an NFL style college football. And I really don't know what's going to happen. I think it's fascinating.
Interesting. Love that answer. Thank you. Thank you very much, Jerry. We really appreciate it.
Yeah. Thanks a lot, guys.
Thanks, Jerry.
Thanks.
You just hit. There's a red button in front to hit to click out.
Okay. Oh, leave?
Yep.
Yep.
That's it.
Okay.
All right, Jack. Well, that was an interesting last question. I think that's very different.
Yeah, that was great. Taking it outside of the world of investing. Let me look right in here.
All
Brent
right.
is back.
Brent is back. Brent, you're solo on this one, right, buddy?
Hey guys.
All right.
That's right. I'm going to hold it down myself. I'm going to let Noel do all the talking.
I don't think either you or I, Justin, is qualified to do this interview, so
No,
it's going to have to be Brent.
All right. Good
all
luck,
right, cool.
Brent.
Well, we'll head out.
Thanks, guys. We'll see you in a little bit.
All right, see you in a little bit.
There he is, the man of the half hour, Noel Smith, Convex Asset Management. How are you doing?
Hello, how are you?
We're doing great. So far, so good. Limited technical glitches, which is something that we can always say is a positive. We've had some great conversations. And so I've been left solo here because you are the vol practitioner, and in theory, I can ask you some qualified questions.
I feel abandoned.
You shouldn't feel that way. You've scared everyone out of the room.
Yeah, I doubt that. That's usually only up to the girls.
Yeah, right. Well, I have a multitude of things to talk to you about today. For everyone who is, maybe new to Noel and what you do, why don't you give a little bit of a background so people know what we're going to be diving into over the next 30 minutes?
Sure, I'll keep it short. I run a hedge fund called Convex Asset Management. I started out as a prop trader in the late 90s. I was a market maker, did a lot of stuff I worked on the floor, ran an entire prop firm, hired something north of 100 guys, was involved in high frequency trading and the genesis of that in Chicago. And now I run a hedge fund.
Yeah, we've had several great conversations over the past several months, maybe even years, around volatility and what you're seeing. And I really love your views. They're very interesting and dynamic. So what I wanted to start with here is we have FOMC tomorrow. Obviously, there's the Treasury announcement that people, I think, are maybe making a bit too big of a deal around. But I'm not qualified to make that. I just say that because vols were not very reactive to that announcement last night. We had a very quiet vol regime, I would say, at least from the index side, into April. And then with April, things started to get a little bit wobbly and vol moved up a little bit, at least implies did. Can you sort of set the stage for us now where you think we are, the barometer of, reaction to things? And what you're looking at now, just with the general environment, what could be triggered with tomorrow's announcements, how the next couple of days and weeks may play out.
So if you said to me, here's the future, and we went back to when we had 6.5 rate cuts priced into the marketplace, and then you said, okay, we can go to April 30th. What's your book? Tell me the trade. And I would say the market's down. I would say the vol is higher. The market's down more. And it just goes to show that even with that foresight, even if you told me what was going to happen in the future, I still don't really know that I would have got the trade right. Yep. Because I would have expected a lot more volatility. We had some, but not that much. And if you look at the forward volatility, it's not that high. And things aren't really all that crazy. So to answer your question specifically, obviously vol's not that chill. Obviously vol's not that high. If you look at we could talk about this for an hour, but if you look at the vol complex writ large, it is just not really all that dangerous.
Yeah, and my view, and I'd love your interpretation of this, is that in April, even though yes, the VIX went up towards 18 and vol implied vol moved up, realized vol S&P index just seemed very sleepy through the entire move down. And yeah, we lost I think 4 or 5% at the lows into April when we hit 5,000-ish in the S&P, but there never really seemed to be that kind of forced short cover move and real big vol spike, realized vol spike on the index side. We saw NVIDIA in the single stock side really move a lot, but index vol really seemed to be rather sleepy, and that's in the face of geopolitics, rates creeping higher, correlation started to sneak back up a little bit. What do you attribute that? Number one, do you agree with that view? Of course, feel free to say no. I obviously will if you say so. But what do you think was like a driver of that? And do you think that's going to be a continued relative reaction? In other words, index vol is going to remain sort of benign or contained rather versus single stocks?
There's a handful of questions embedded in your statement. So the amount of kinetic energy that requires the marketplace to keep going up, I think it's kind of fizzled. We went to kind of a more of a stall speed altitude. And then if you couple that with some of the geopolitical risks, and also some of that happened overnight, right? When some of this stuff was happening, and the markets went pretty crazy overnight. But by the time people figured out what was going on, and it was more a bit of political theater or war theater with very little actual damage, things chilled out quite a bit. And if you look at what was oil doing overnight, it was very busy. What were E-mini futures doing overnight, it was very busy. Everything was very busy. And then by the time the market opened, it wasn't that big of a deal. So do I think, to answer the question, do I think that we go crazy or chill out from here? Of course, I have no idea. But in terms of how to trade it, there is nothing saying that the market is imminently going to crash or imminently going to rally right now from a volatility lens. And bear in mind, the reason I traffic in volatility and not macro, I know a lot of people like to talk about stories and stuff like that. I love a good story as much as the next guy. And frankly, as humans, I think it's easier for us to connect on that. Like, if this happens, then that will happen. Maybe. Again, going back to my original analogy, if you told me that all the price cuts were going to be priced out of the marketplace, I would have told you that the reaction function in the marketplace would be substantially worse for the market. And it really hasn't been. We're down a few points, no big deal. But if you're looking at it from a mechanical standpoint, what is volatility right now? What is forward volatility right now? It's really just not saying that you have to worry about too much.
Yeah.
And I think the election also probably goes into that.
Yeah, we had touched on the election a little bit earlier. And it's, sorry, three thoughts came out at once. When you look at the reaction function, I think that's a great way to place it or frame it, is that a lot of times, even from a macro perspective, you can be right and the market still just doesn't care. And so that reaction is important. We did see term structure kind of elevated a little bit around this morning's data versus last night's close. And so I think some of that, next week's ISM suddenly is pricing a little bit more movement. So there's some small reaction in there. But you brought up the election, so we can kind of latch onto that. If you look at term structures, they're starting to elevate, or there's a kink in those term structures tied to the election. When do you start to think of that having an impact, and from maybe a positioning perspective? Is that supportive for the markets here over the next couple of months? Are we still too far away from that event? How do you look at the election and position?
Well, I think that you could trade it at any time. It's always going to be roughly fairly priced. If you look at where's the kink, it's in October, because it's a 30-day hence saying that the election might be busy. I don't think the election is that big of a deal, because we already know what a Biden presidency looks like. And honestly, we already kind of know what a Trump presidency looks like. And we've very rarely been in this situation where we kind of have seen both data. And I think where the real volatility might come from is if there is some kind of totally exogenous event, like a contested election, attempted or consummated assassination, something that's actually crazy that nobody is really expecting. And I think that if you look at the October and November VIX futures, they're probably going to carry. I can turn my head and look at the quote, but I'm pretty sure I'm right. The November VIX future, I think, is like 1820, and it's down about $1 in the last 30 days. And the October future is about 19 and high change. And both of those are about right. And if you look at a call spread structure in those things, they're carrying pretty well. So if that's what you want to do to hedge, if you hedge today or a month from today, it's not going to be that different. You're going to pay, 48 to 54 cents for a $10 wide out of the money call spread in the VIX. What are you going to do? You're going to wait 45 days to get 43 cents? Sure, maybe. But then if something actually does happen, you're going to waste it. It's just not that big of a deal.
Mm-hmm. And so we've sort of been shrugging off higher rates, geopolitical escalations and the like. When you look at sort of the reaction, the volatility reaction to some of these events, and we know that we have the election, coming up in a couple of months, you're sort of inferring that the market not reacting to anything is a signal in and of itself. If I take you, if I take it correctly. And so if we clear FOMC tomorrow, I sort of read it as like if Powell's sort of like neutral to dovish, that's positive for the market, and unless he's like overtly hawkish or catches people off guard, then that should release some event vol, and that should be a little bit of a tailwind to markets. How do you look at trading an event like tomorrow? And I know, do you trade a very short dated options around this thing? Or are you considering more out, a month out in time? And what's the general way you look at tomorrow and how you would generally position around events like this?
Going back to the reaction function, okay, you have to game it out. Every scenario. If he says this, what does the market do? If he says that, what does the market do? And he says nothing, what does the market do? What if he says three of those things? What does the market do? Mm-hmm. And what the market is basically saying is that we're in the middle of a political season. The RNC and the DNC convention straddle FOMC. What is he really going to do? Is he really going to chop rates 100 bips? I mean, that's priced out to 2025, to the end of next year. It's just not that much. And the other side of that is he going to raise rates 100 bips? Okay, fine. Say the jobs number comes in 3x what it's supposed to be on Friday. It's 750 grand. Is he going to raise rates 100 bips? Well, again, even if you have the future knowledge, what is really going to happen in a political season? And the marketplace is saying not much, because he wants to keep his job. And even if he doesn't care about keeping his job, the apparatus around him probably does want to keep their job. So what they don't want to have happen is, the administration just come in and take their arm and sweep the whole desk clean of all the personnel that are relevant to this business. And the marketplace, and I would agree personally, says that probably not much is going to happen, barring a real war in the Middle East, and then therefore oil shock price up, and which means a new spiral in inflation. Okay, that's new data. But so far, the conflict in the Middle East, insofar as oil prices and bond prices have been involved, it hasn't been that big of a deal.
So somewhat related to this, we tie back this idea about index volatility versus single stock volatility. Certain measures of dispersion were rather high throughout this year as chip sector stocks and the like really moved a lot higher and faster. And index vol seemed to be a little bit lagging. Number one, do you sort of agree with that statement? Obviously, feel free to say that you don't see it that way. And do you think that there's a chance that we kind of rebuild or continue on with that structure, particularly in light of earnings season coming up now? And I would just say the reason I bring that up because I'm curious, if you're just an equity investor, does that force you having to take more of a kind of a specified approach? In other words, like a factor approach. Like I really need to get into chips here. I can't afford to just hold the index here. I really need to chase sectors that are working.
I think your question is saying, is it better to be a stock picker or an index picker right now?
It's a much more succinct way to put it. Thank you.
So if you think about, again, everything is a reaction function. So if you punch me, what's the reaction function? Do I cry? Do I punch you back? Like what you're doing is you're giving me an input, but now what you're waiting for is my output. Mm-hmm. And that's the thing. So if your input is rates aren't going to change that much, what is going to change? And what is their function in the marketplace? How do I trade this? Ultimately, this is what all this is about. We're trying to figure out what is the trade. So that's why I don't really delve that deep into macro. I love good stories, but I can't tell you how many macro stories that have been so logical to me that have just never worked out, or some other random story that I wouldn't even have thought about that did work out. And at some point, you're just like, I have no idea. Like the Bill Ackman Herbalife short. That was a great story. I mean, if you thought the thing was going to go to zero in a day, and it just never did. Well, it took a long time. But my point is that will it be a good time for correlation dispersion trading? I think it will be. I am talking my book. I have it on, but I could take it off in 5 seconds if I didn't like it. The idea that you're going to have a reshuffling of the deck chairs with the boat still basically staying on course, I think is the case. And the reason I think it's the case is because you look at like the ZN futures volatility right now. The tomorrow volatility in the options on the 10-year note is about 10 1/3 vol. That's what that's saying is that, the straddle is being priced in X amount of ticks, and it's going to come in on Thursday and come in even more to probably something around 7. And if you look at the vol structure after that, it's about 7 from here on out. No problem. That isn't that big of a deal. Right. Everybody loves to like talk about negative stuff because there's something in humans that gets a better reaction out of it. And I can be like a talking zero hedge, right? And just always be scaring people, but there's no data. We want to try to keep this in the domain of data and what is actionable. What is actionable is the data isn't freaking out. What is actionable is dispersion is working right now and will continue to probably work for the same reasons they've been working for the last 24 months, which is to say that there is uncertainty in rates, the trajectory of rates, the rate of the trajectory change in rates, and then all the things that go with inflation or whatever else, because the economy is hotter than what was anticipated 6, 7, 8 months ago. Rates have not come down. They're probably not going to come down anytime soon, at least not at the rate of change that people have talked about. And we're kind of in a holding pattern. So what does that mean for the trade? I would say that it is a stock picker's environment. I would say that picking your sectors and then the names within those sectors is favorable. And if you don't know how to pick names or pick sectors, correlation is an excellent way to trade that.
Yeah, and to somewhat to your point, tail risk that was prevalent just a couple weeks ago really collapsed pretty sharply. I want to touch on the topic of correlation and dispersion because a lot of what's been going on in the options space, recently was discussions around call overriding funds, obviously with like JEPI adding a lot of, in theory, positive dealer gamma to markets, and you have zero DTEs and different things like that. Do you think that those are factors at all in the way that S&P volatility is reacting relative to single stocks, or do you think it's more of a function of trading flows, like people running dispersion strategies?
It's always both. So I was just at a thing with the SIBO, and we were kind of going through all this data, and the story part of this conversation wants to say something like, well, if the market dumps a zillion Vega on the marketplace, or then it's going to have a net effect. But if you look at what's happening in like zero DTE, what's happening in the Vega space with correlation trading, it's pretty balanced. Mm-hmm. And if you look at, the percentage and the number of options being traded in zero DTE or near tenors is high and higher all the time. But what is the actual effect on that in terms of gamma? Well, you would say if you, again, you called me 2 years ago and say, listen, I got the future. Here's what's going to happen. We're going to send, 50% of the volume is going to happen in zero DTE. I would say, well, they're going to take front week vol down to 3 because if that's all they ever do. That's just not happened. So if you look at the narrative, which is to say there should be a lot of effect because of this stuff, but then you look at the actual data, it hasn't changed anywhere near as much as I would have predicted. So is there an effect when the marketplace has structured products that come in and there's a different reaction function? I feel like such a talking head, but it's true. So what is going to happen with some of these structured products? Well, if you got a lot of these like buffered and collared strategies where people are protected down 10%, so they don't have to wear a helmet for 10%, well, maybe 12% is the new 10%, or the 12% is the new 2%, right? Because what's happening is you're sliding stuff down and people are going to they're going to be compelled to freak out at different new levels. So what was a vol shock where VIX was 35, maybe that new vol shock is VIX 45. What is the price of the skew on the out of the money call in variance space in VIX? It's going to be higher. And the reason it's going to be higher is because the reaction function has been pushed. That risk, Chris Cole used to say this, risk is never created or destroyed, it's just kind of transmuted. I totally agree with that. Which is to say you're not going to beat the marketplace. You're not going to just totally hide invisibly in the marketplace if you have any kind of size. You're going to transmute your risk at someplace, whether through price, time, or price and time. And structured products can push some of this around, but it's not ultimately going to change what happens in the marketplace. You're looking at 2020 versus 2022. The rate of change in volatility in 2020 with COVID was extremely high. It was, the market went nuts. Vol went nuts. In 2022, the market went down about the same amount, 20%. But vol didn't go nuts at all. Right. If anything, a lot of those puts, went away and went to money heaven. So that's what I'm talking about, the reaction function. What's the trade? What are you going to do with this stuff? Well, I would say that you can price VIX call spreads because owning VIX outrights is kind of tough. It gets expensive. Or ratio structures like that. I think they have a better payoff now than they did before a lot of these structured products came onto the marketplace. And I do think they will have an effect. Specifically, I guess the number one thing to consider with this is that if you have a market maker trading with a market maker and both of them are delta hedging and doing their thing in busy land, then there's no net effect in the marketplace. But if you have somebody who's selling a bunch of volatility and then somebody who is doing stuff with that volatility, they're actually doing different stuff. So if you're a buy writer, you're not delta hedging. You sell your options and you wait for them to go to zero. That's it. But if you are a buyer of those options, then you want to buy them at a gamma that you can hedge and make money, or at least cover your theta. So those parties are doing different things in real time. that can have a different effect. And a different effect meaning the structure of the marketplace will change as a result of their participation in the marketplace.
It's an interesting idea because those funds, particularly if you look at JEPI and QILD, they're the largest systematic kind of call overriding funds, and they've been able to gather these assets at a time when the S&P itself was just going lights out north, and I think from a total return perspective, those things haven't fared as well as S&P in whole. But if the S&P sort of just starts to track sideways, you could almost make the argument that JEPI would be a better investment because you're in theory getting this yield or dividend that they say of 7 or 8%. In which case then Gamma would sort of grow, and in theory that just sort of creates more of like a reflexive feedback loop. And so, I mean, I guess my question to you is that if you start to build on these things, how much more can these things really start to build on themselves? I mean, do you think of this space kind of like everything else, like 0DT immediately went to 50% of volume and leveled out? Like, how much more asset space can this stuff take up, do you think? Or are we sort of maxed out in this systematic, strategies, do you think? Or is there really a lot more room for growth?
I look at this stuff and I think about it and I don't know. I think there is room to grow. And I think that, again, because if you look at who's buying this stuff and who's selling this stuff, well, if you have a $1 billion ETF and you're trying to sell 10,000 options a day or 10,000 options a day for a week for your ETF or something like that, who's buying it? Well, the market makers are buying it, right? It's not just all retail gobbling all this stuff up. The market makers will act as an intermediary, and then they lay that off on the public. But that's fine. Like everyone, ideally what they want is to be long gamma and have it carry. Still not a problem. So if you wanted to sell me 1,000 options and I thought they're overpriced, I wouldn't want to buy them. But if you wanted to sell me 10 million options, but I thought I could carry them, I could sleep at night as much as anybody because I'm not worried about that thing really costing me too much money. The reason you don't want to buy options is because they're going to die and you're not going to make any money. But if you can buy options and have them bleed very little or maybe even make money because you're scalping stock around it, because what happens is if you're looking at a day-to-day volatility, it might be closer versus the intraday volatility, high, low, close. It might be a wider range and maybe more opportunity there if you're a market maker. So market makers, if you look at Jane Street, Virtu, Citadel, Susquehanna, they're doing fine. So the idea that they can't absorb more gamma right now, I just don't think is there. I don't think we're at our limit.
And is that so? If you think about JEPI again, they run things through equity linked notes. These structured products. They're not actually hitting bids and lifting offers or whatever. And I think QILD actually does. You can see their fingerprint in the market. But do you think that they get disadvantaged in terms of price through that structured product like that? And if gamma sort of does get filled up, that the prices will change accordingly.
Well, let's invert the question. Do you think they're being advantaged? No way.
I'm trying to let you answer that question.
No, there's just no chance. So, I mean, if you're a market making firm, right? Yeah, what you want to do is it's just dead common sense. You want to not scare them away. You want to get the business, but you want to give them the worst price in which you can continue to get the business and continue the relationship.
Right.
So they're going to be that increment of disadvantagement isn't necessarily punishing to the point where they're going to go out of business. But nobody's going to be doing anybody any favors.
It helps the supply if you can have a little more spread, I guess.
Absolutely. Why would the parasite kill the host? It makes no sense.
Yeah, and the last question I was just asking this one only because I know you've been doing a lot of work with the SIBO recently. Is they recently changed tax treatments on overriding. Do you think that's so? It seems like a lot of the exchanges want to continue to build into this derivative linked space. And offering more short-dated products possibly, and so this tax treatment on overriding seems to be another step to help increase those funds. Is there any sort of major flows that shift the result of that, or is that mainly just kind of like a side note?
Well, the OCC is part of what's going on with risk and and with the SIBO. The SIBO's job is to try to do as much business for the SIBO, come up with new and innovative products, which they've been doing a great job with. But they also have to work in tandem with the exchanges, with the OCC, with the government. So it's not like they work on an island. And just because they want a more favorable tax treatment doesn't mean that it's going to work the way they want it to. But their job is to try to create as much liquidity, because what they don't want to do is launch a new product or launch a slightly different version of the same product and have nobody trade it. There's nobody cares, right? The spreads are really wide. It's kind of dumb, and it doesn't do any business for them. So do I think it will help? Of course it will. If there is a more favorable, if you have two products, one has better, the same product, but one has better tax treatment than the other, clearly this one is going to do better if it's got better tax treatments. Why would it not?
Yeah, makes a lot of sense. And we are talking to Mandy Zhu from the SIBO a little bit later this afternoon, so everyone can tune into that. We're excited for that conversation. As we sort of approach, 30 minutes went very fast. We've been asking everybody kind of this one thing question. And as you step forward again at FOMC tomorrow, and it doesn't have to be a very short dated view, but sort of what's one thing you're really paying attention to, or one thing you could flag for us that we could all sort of watch that maybe we're not paying attention to now? What's kind of one interesting dynamic that you're picking up on?
And I love good takeaways. The marketplace right now is basically not freaking out. There is no reason not to continue to trade. Everybody loves to have a great story, and everyone wants to have an angle. But the reality is that the reason I trade volatility is dead simple, is because it's one of the few things that's purely mathematical, and it's forward-looking. If you look at implied vol, it's forward-looking. And jobs aren't forward-looking. Owner's equivalent rent isn't forward-looking. So these are reasons that you can be a participant in the space. If you look at structured products and you look at how they can affect the marketplace, that is something you might want to look at. As these things, kind of mapping your logic to 2018, but it's not the same. If they can act as a catalyst to kind of turn the boat over, and you get a feel for where is the size and where that size might become too big. But the difference is those people were rolling their futures in a 15-minute window after the close. Just there's so many differences. And to say that, JEPI's the same as that, it's just not the same at all. It's a totally different trade. Even SVIX, which is a similar thing, still isn't the same. It's a much safer product. Or SVXY, now it's been nerfed by 50%. Again, a lot of the mistakes have been learned from. So the new mistakes are, I think that if the market really does start to fall apart for whatever reasons, and there are these buffered products, I think that there can be a liquidity vacuum down for a while, because a lot of the hedges are in place. So if the market was going to go down 12%, it might actually reach further, because a lot of that stuff has been buffered out. There's been a lot of protection in the marketplace, and that manifests in reversals, risk reversals, and skew. You see it everywhere. You see the fingerprints of hedging are all over the place behind me.
Do you think there's still a big short put complex out there? I mean, that was kind of the strategies that worked the best. No. And so the reason I ask that is because do you think that the dealer community or market maker community just has a big kind of long Vega position on, or moderate long Vega position on, and so they can provide liquidity better as the market goes down, and that just helps to contain realized vol? No,
there's 3 tiers of firms at the OCC. Tier 3 firms have been getting really punished with some of the regulatory changes that the OCC has instituted. The ability for someone to go out there and just sell a zillion puts and have that be useful from a capital usage standpoint is not as good. And not just that, but if you look at, as interest rates go up, that means calls get more expensive and puts get less expensive. So these collar trades are working. So think about what is that doing? When you take interest rates up, you're pricing a forward, and a forward will go higher in price. So even if you just think about this intuitively, calls go up, puts go down. So what you're getting for your puts is even less. So that trade is an inferior trade. It's been working for a long time, but it is. I don't see there's tons of short puts out there where the marketplace is just going to start to go down and then whoosh. I don't see that at all. If I did, I would trade it. I would put it on. So I don't have a dog in the fight. If I saw a dog, I'd go fight it, but I just don't see it.
Yeah, because I think some of the conversation last week turned to testing that. I think it was this JP Morgan strike last week at the 49.80, if I remember correctly. And so those conversations kind of crept back in about the ability to supply liquidity as a way to suppress volatility, I suppose.
Market making firms are very smart, and they have a ton of money. And if you look at, even if my opinion aside, just look at the numbers that are public. They're strong. They are just not in it. You'd be shocked how risk adverse large market making firms are. They don't let stuff go far at all. So the idea that market's going to just go out there and crash, and then Jane Street and Citadel are going to get ruined today, it's just not going to happen.
Yeah, and to that point, the research we've done recently on zero DT suggests just sort of backs that point that it's kind of just a money making machine, and that makes sense. Condos in Miami Beach are expensive, and
Getting pricier every day, man. Private school is up 2x in Brickell.
and the market making firms are buying up those beachside condos, I guess. So
Absolutely.
it's going very well. Well, no, I can't thank you enough for taking the time to join us here today. How can people get a hold of you on Twitter, your website, et cetera, and learn more about you and Convex?
Yeah, well, on Twitter, I'm at Noel Convex, and our website is convexam.com, convexam. And that's probably the best way to get a hold of me. We're a private hedge fund. We only deal with qualified investors. But, we're always happy to chat and talk about new ideas.
That's awesome. I know you're going to be out at the EQ Derivatives Conference in about a month, and I'm going to be out there too for the first time in about 5 years. So I look forward to seeing you there. And
yeah, that'll be cool. I'm speaking with the SIBO, I think, about dispersion, but I'm not really sure. So I'll probably find out an hour before I have to get up on stage and do my dog and pony show.
You can wing it like we are here. All right. Well, thank you all very much for joining us for this conversation. If you enjoyed the content today, please head over to youtube.com/SpotGamma, and you can hit the donate button. And obviously all donations are going to the Susan G. Komen Breast Cancer Foundation. So far, the donations have been great, so thank everyone very much for that. Also, these conversations will be available for replay on YouTube. So if you missed some of what Noel had to say today, you can pick up on rewatch those conversations, over the coming days. I think Jack is going to come on now, and then we will have QO.
Asking you shall receive, Brent.
Yeah.
Okay.
Hey, Jack.
Thanks, guys.
again, Noel. We'll see you soon.
All right. Bye-bye.
All right, let me let Justin in here. He's coming in too.
All right. I get a brief break
Right,
again here.
You get a little respite here.
Yeah, that's right. And I'll be seeing you in 30 minutes for Darius. So enjoy your conversation here, and we'll see you around
Sounds
30
good.
minutes.
We'll talk to you then.
Hi, Clay. Oh, you're on mute.
I think you're on mute.
Okay. Is this better?
That's perfect.
Thank you. Great. Thank you very much for joining us today, Clay. Let me give you a little intro here. You are CIO Equity Strategies at Research Affiliates, where you lead the cross-sectional research and strategy design team. Sounds like a cool job.
Pretty cool job. I love it.
Pretty awesome. So just before we dive into it with you, just a reminder that this event today is to support the Susan G. Komen Foundation. Quick statistic, 1 in every 8 women in the US will be diagnosed with breast cancer in their lifetime. So foundations and organizations like this are super important, and we really appreciate if people that have the means to do it can donate on YouTube. There's a link at the bottom. And, we're seeing some donations come in. We have a goal of $20,000, and we're hoping to get there, throughout the day to day and over time. So, Quay, let's start out. We're going to talk about investment strategy and research and design, but where I think we want to start with you is more around artificial intelligence. We haven't talked to anyone today yet about AI. And obviously AI is going to have a massive impact on our lives in many different ways. But figuring out the investing opportunities around it is probably a little bit more tricky. And so maybe to start, what is your view on the potential that this new technology has, and also how it relates to investors?
So, we've been increasingly using AI in our daily lives, right? If you think about it, autocomplete, self-driving vehicles, these are all early applications of AI. But I think generative AI is what people are excited about. That I think has the potential to be truly a big leap forward in AI and truly world-changing. But if it is true that it is world-changing, then I think the benefits that it has to society and to investors will be extremely broad, and they'll be long-lived. but these benefits are not going to be easy to forecast or to anticipate how it evolves. And so what we say is that if it is world changing, then there's going to be some winners and losers. The winners will tend to outnumber the losers, and the amount of money that you make by winning will dwarf the amount of money that the losers will lose, right? And since you just don't know how it's going to evolve, you just don't know who's going to be the winner and the losers, it's hard. The best way of doing this is to say it's going to be broad, it's going to be long-lived, and so what you want to do is you just want to buy the equities. You want to buy them early on, you want to buy a diversified basket, you want to rebalance. Don't get too greedy and try to concentrate in just a few stocks, and then don't sell out at the bottom. Stay invested for the long term. If you look at the internet bubble of the bust and the recovery afterwards, those were the lessons that you can really draw, from, for investors that aren't experts in technology, that aren't futurists.
Yeah, I think that's a good point. It's like that internet, it's never the exact same in terms of the way that these new technologies are going to develop, but you can draw some interesting parallels. It was very hard to pick out the winners and losers back in 99 and 2000, but if you would have bought the broad basket, stayed invested, you would have gotten the benefit of those big winners when a lot of those other companies just didn't make it.
That's
but
right.
Yeah, do you feel like it's the AI sort of revolution is, do you have any sense about the vastness of it? Do you think it could be bigger? Some people say it could be bigger than the internet. I think McKinsey's out there saying it could add $4 trillion in terms of profits or something across all different industries. Do you have any opinion on that?
Well, I will say that I'm no futurist, and I have often been accused of being a technology skeptic. But having said that, I think from a productivity and economic point of view, I would say that this is at least as revolutionary as the cloud, and likely as revolutionary as the internet. So, from what I'm seeing now, I think it's somewhere between there. I think, could it be bigger than the internet? It could, right? But I'm not your typical futurist that's going to be able to describe that for you.
Yeah, that's fair. Are you guys using it in any of your investing processes now? Yeah, go ahead.
So, we already use a variety of AI tools in our work. So examples are, Copilot on GitHub, autocomplete for coding, things like that. And these tools right now I think of as being useful, but I think they're going to get much more advanced and they will become much more ubiquitous. It's not just going to be the people on the technology and development team that have access to these types of tools. In terms of using AI and generating signals, I think the investment management industry has been doing that for some time, natural language processing. I do think that what is happening now could increase the use of that and make it more readily available to a broader variety of people.
Are you using it a lot in your everyday life? Because that's something I've been doing a lot more and more, I find. As I see what it can actually do, I'm like, oh, I could do this too, and it could do this too, and I keep adding to it. Like, are you using it a lot in your everyday life?
I will say that in my household, the AI engine that we've been using a lot, and it's not a generative AI engine, are the chess engines, because my son is an avid chess player. Those engines are fantastic. And, with generative AI, I can definitely see it increasing. I think that the power of generative AI is going to be when people are using it and they don't even realize it, right? The power of the internet is not that you say to yourself, I'm going to get on the internet today, but you get on the internet just like you get your morning cup of coffee or tea. You don't even think about it. It's just part and parcel of everyday life. And so that's, I think, when generative AI becomes a really, really big thing.
What do the chess engines do? I haven't heard of that. So how do those work?
Oh, chess engines. So the difference between chess engines and generative AI is that chess engines are an AI algorithm, but it's very closed form. There's only so many moves you can make on the chessboard. The chessboard is finite, right? Generative AI, it's a lot broader. It's more expansive and it can expand in terms of its knowledge. But the chess engines are the ones that are designed to basically tell you you can play against it, right? You can set a level and say, my rating is this, and it'll play against you. So you can train. You can also input your moves from a live tournament match, and it will tell you, are you winning at this point? Are you losing at this point? What's the next best move? All this kind of stuff. So it's
Yeah,
very
at this
cool.
point, chess it's better than the best human, right? At chess.
Oh yeah, absolutely. The best human can never beat any chess engines. And in fact, the best humans, the top players, they actually use the chess engines to train sometimes.
Yeah, that's
Actually,
very cool.
all the time.
So switching topics, one of the things Research Affiliates does a very good job of is looking at valuations and other things with the market in a historical context. And we've seen a lot of people talking recently about the Mag 7 and about how the largest companies have become a huge part of the S&P 500. So before I ask more questions about that, I'm just wondering, can you put that in a historical context? I mean, is this unprecedented in terms of what we're seeing, concentration in the largest companies?
No, I mean, we're not. I mean, if you really think about it, the market's always gone through cycles of massive concentration and then massive deconcentration, right? So the biggest examples are things like the Nifty 50. That's something that everybody sort of knows about, where it was just the 50 stocks just kept going up and up and up, and you had a huge amount of concentration. Same thing is true for TMT, right? A massive amount of concentration there. But I do think that what is unique this time is not that there is sort of an enthusiasm and a concentration around these 7 stocks, but that these 7 stocks have gotten to be 30% of the S&P 500. It used to be that if there was a sector that got to be 30% of the S&P 500, people would start to take notice, right? But now it's just 7 stocks that are 30%. So the trend towards concentration and deconcentration isn't unusual, but the level of concentration, I think, is pretty significant.
Has there been any research into what the forward returns look like? So in periods where the S&P becomes very, very concentrated, like are the forward returns lower?
Well, yes, for those who own the cap-weighted index, right? But it doesn't necessarily mean that the forward-looking returns at the average stock is lower. And so, that's what's different, right? So if you own this very concentrated thing, and the things that it's concentrated in don't perform as well because they're overvalued, then this index doesn't do well. But if you own the average stock, an alternative weighting scheme that doesn't cap weight it, then you end up doing okay.
Yeah, this is one of the things I struggle with because, if you look historically at the top 10 companies in the S&P 500 and then look a decade further, they're basically gone, or most of them are gone. So the returns of investing in the top 10 companies is not good. But I do wonder if like the edge these companies have, the moats they have are so substantial because of technology, then maybe that changes going forward. I'm not sure I'm a value guy, so I would probably vote against that. And I would probably if I was sitting back in 1980, I probably would have said the same things about whatever the biggest companies were then, that their edge is too big. But how do you think about that? Do you think there's anything different about these companies?
Well, these companies are very impressive. They are, they've got large moats, they've got large capital bases. But one of the things I would say is that every great productivity or technological revolution creates new moats and new vulnerabilities, right? So if you really look back to the internet bubble, right? HP had a great moat. Its market cap was much larger than that of Apple. And, now nobody really thinks about HP. Everybody thinks about Apple. In fact, they don't even really think about Apple. They just use it without thinking about it. That's how great it is. And so moats really need more care and feeding than people think, and really a lot more care and feeding in a rapidly changing environment. So yes, these large companies, they have great businesses, great capital bases. They will be able to try to adjust, but that has been true in every iteration. And yet what we've seen is change of leadership every decade.
Yeah, HP is a great example. I think back to when I was a kid, like GE. GE was this massive conglomerate. I'm like, nobody's ever disrupting GE. And now if you look at it today, I mean, obviously I was completely wrong about that.
Yeah.
Yeah, I want to ask you about this period compared to the late 90s period, because you see a lot of people comparing that right now, saying, what we're in right now is very similar to the dot-com boom. How can you compare and contrast what we're seeing now versus what we saw then?
So, in some ways, I think the release of ChatGPT was kind of like the release of the Mosaic browser. I mean, the internet was always there, right? It's just that nobody knew what was on it and what they could use it for. And then Mosaic released this browser. It was so glitchy, it was terrible to use, and yet it opened the doors of the internet to everyone. And in some ways, that's what ChatGPT did. Generative AI was around, but it wasn't really accessible. And now it's accessible. People are beginning to realize that it could have a huge, huge impact. So, if this is going to be a world-changing technology, we're going to need a lot more investment and capital deployment in it. The Mosaic browsers was just the beginning of the unleashing of a huge amount of capital deployment. I think that we're at the beginning stages of that for generative AI.
Yeah, and it's challenging. When people refer to something as a bubble, or they refer to the late 90s, which did end up being a bubble, like in real time, it's hard to figure out, what do I do about that? And, I know Rob Arnott has done a lot of work around this. Like, it's great that we might be in a bubble, but realistically, bubbles can run a lot more than you think they could. So it's hard to take valuation or anything like that and bring it in. I mean, I don't know if you agree with that.
I think that that's right. And, we are value investors. So again, it's ironic that you're asking me about this bubble. Now, what I would say about bubbles is this, is that bubbles, you can't have a technological or productivity revolution without a bubble. And what that means is that all of these revolutions require a lot of investment. So you look at anything, electrification, railroads, the internet, required a lot of investment. And so how do you get that money to the places that need the investment? You need people to believe. You need people to be enthusiastic. You need those animal spirits to get loose. And then people open up their checkbooks and they're writing checks, and the capital is available and it's cheap and it's invested. And yes, we have no idea how to use this thing, right? So we're going to make a lot of bad decisions in that investment. And that creates the bubble. But at the same time, we're also going to make investments that become extremely useful. And then it builds on itself. And that's what people build the productivity enhancements on. And it benefits society for a very, very long time.
One of the things you alluded to earlier is we kind of have a bifurcated market right now. Just because the most expensive stocks are really, really expensive and the market averages are expensive because of that, that doesn't mean there aren't things that are cheap, within the market. You guys have a great tool on Research Affiliates where you can look at kind of some of this stuff. What are you seeing as areas of the market right now that are attractive on a valuation standpoint?
Well, within tech, there are still some interesting places to invest. If you really believe in generative AI and the investment that you need there, you're still going to need a lot more chips. You're going to need a lot more enterprise services. There's many companies in there that provide networking, that provide equipment, that provide chips that aren't NVIDIA. Some of these companies are relatively inexpensive. So I would start there. I wouldn't discard the technology ecosystem. Another area where we're seeing interesting opportunities is healthcare. Healthcare had this massive boom in COVID, and then it came back down. I think at this point, a lot of these companies, look pretty good, and we're not looking at Ozempic or anything that's fatty. I mean, we just want to look at companies that provide. You can find companies that provide very basic, necessary services that are priced relatively cheaply for what they offer in terms of cash flow.
One of the interesting things you guys do with respect to the fact that there's many large companies that are over-concentrated due to their market cap is you've introduced this idea of fundamental index. So can you explain what that is and how that differs from a market cap weighted index?
Sure. So if you really think about a market cap weighted index, well, let me just back up. So I forget who it was that said that in the short term, the stock market is a popularity contest, but in the long term, the stock market is a weighing machine, right? So market cap weighting is a popularity contest. The more the stock goes up, the bigger the weight it gets in the index. So the fundamental index tries to get away from being a popularity contest and more towards being a weighing machine. And so what we're looking at is a company's economic footprint. So it's sales, it's cash flow, it's book value and intangibles, it's dividends and buybacks. How big are these numbers relative to everything else? And you weight it based on those fundamental metrics. And so large companies will tend to get larger weights, right? So Apple is going to be a pretty big weight in the fundamental index because they have great sales, great buybacks, great cash flow. Smaller companies that aren't as profitable, companies like Snowflake, right? That's a great company, good growth, but it just doesn't have as big a fundamental footprint as its cap. Another example of that might be Tesla. So what will end up happening is we'll end up holding pretty much all the same stocks that any well-known index like the Russell 1000 or the S&P might hold, but we just hold them in different weights. So a great example of that is the fundamental index in the U.S. We hold all the Mag 7 stocks. It's just that the Mag 7 stocks in the fundamental index sum up to about 12% of the fundamental index compared to 30% of the S&P.
Do you see it as kind of a blend? It seems like it's sort of a middle ground between like a value approach and a market cap weighted approach, because you are getting the stocks based on their economic footprint, but also when you move away from market cap, it seems like you are introducing value into the equation. I mean, is that a fair way to look at it?
I would say that well, first of all, it definitely has a value bias because you are getting away from market cap. But the second thing I would say is that we look at it really more as a more sensible approach to value investing, because value indexes don't just look for stocks that are cheap. They also look for stocks that aren't growing. So the question is, why would you want to own a stock that's not growing? Because the ideal stock to own is something that has growth, but its growth is underappreciated by the price in the market, right? Value indexes basically say, yeah, we want the cheap stocks that aren't growing. And what we're saying is we want all the stocks, because in general, all the stocks are growing. We just want to own them in their appropriate economic weights.
Just one more for me before I hand it back to Justin. I want to ask you about inflation, because inflation is something I hadn't seen in my investing career until recently. And I think a lot of people are in the same situation. So I'm just wondering, as someone who builds portfolios, how do you think about inflation? On one hand, you could say, well, if we've got a portfolio that's robust to inflation, I don't really need to do anything. On the other hand, you could say, if we're going to get an extended period of inflation, maybe some changes are needed. How do you think about that?
Well, I have to be very humble about inflation forecasting, because I don't think that on the equity side at RA, we have a particularly strong insight into the inflation cycle. And so we just focus on the fundamentals of the stocks and build portfolios that we believe will get us through any cycle.
Do you have any opinion on whether it could be good or better for value strategies? So higher rates, this relates to interest rates, actually, not necessarily inflation, although they're tied together. So the higher the rates, the argument is, the more that should affect growth stocks, which are, tend to be valued on cash flows way out in the future. They're more sensitive to that interest rate level versus value stocks, which are kind of more valued on the here and now. What is your take on that?
Well, I would say the high unexpected inflation or high unexpected real interest rates, they're bad for all stocks, right? This is not something that makes the S&P go up 25%. But I would say it is less bad for companies that have pricing power and defensible margins. So if you really think about those companies, they're not necessarily value stocks. They're more quality-ish. It is worse for companies whose valuations, as you say, rely on getting to significant profitability very far out in the future. So it just depends on what's priced in the market, what's priced cheaply versus what's not priced cheaply at the moment. And I think today a lot of high quality stocks are expensive, and a lot of low quality stocks are cheap. So it's not clear exactly how helpful inflation will be or higher interest rates will be this time around, but I don't think it will be a significant negative for value stocks.
Research affiliates, you guys do give expected return projections or estimates on like value and growth stocks, correct?
Mm-hmm. Yes, we do.
Yeah. So where is that sort of right now when you're looking at returns over the next 7 to 10 years, let's say, versus value and growth in the market as a whole? What do those possible returns look like, given where we are today?
Yeah. So right now we have a massive dislocation between value and growth stocks in terms of their starting point valuations. And so over the next 5 years, we think value can outperform growth by about 4 to 5% per year. And, that's, you can overshoot, you can undershoot, but, the dislocation is an enormous opportunity right now.
You wrote a recent paper, I think it's recent, Active Value Investing, Avoiding Value Traps. And this is something that we find very interesting because value traps are like, it's tough. I mean, some of the best value performers come from maybe that value trap segment of the market. But can you just talk about what you sort of summarized in that paper and what you found?
Sure. So basically, value investors, we're value investors, right? Value investors sometimes get into hot water because a cheap stock is really just a bad company, right? So you look at Bed Bath & Beyond. It looked really cheap. It was $1 a share, but it was just a terrible company. So if you are a value investor, then what you should do is not just look for the cheap companies, but you need to remove the bad eggs from your portfolio. So how do you do that? And we really show two ways of doing that. One is just to screen out the really poor quality companies. And there we're looking at distress and capital efficiency. And then also screen out the ones with exceptionally poor momentum, because those are the ones that are just getting hammered and nobody's coming back to them. So there are other ways you could do it. These are just our approaches. And what we find is when we do this, it significantly increases returns to value investors of around 2 to 3% per year. This is over a 30-year period. And more significantly than that, it actually also reduces your volatility. So it's one of these things where sometimes a cheap stock is just exactly deserves to be cheap. What you really want the cheap stocks that have room to shine.
But it's great if you can get that dual benefit of higher returns, especially over 1 or 2% compounded over 30 years is huge. But then you get the lower risk. So that's a win-win all day long for investors.
Exactly.
We've had Rob on the podcast. How many times, Jack? 2 or 3 times excess returns? I think 2.
I think 3. Yeah,
three. Okay,
he just did his 3rd.
Yeah. So and we know he's been pounding the table on his international value, his own personal. This isn't necessarily the firm's view, but he's a big believer in international value investing, and I think specifically emerging markets. At least this was maybe a year or so ago, given where valuations are, and that's how he's managing his own personal portfolio. But can you just comment on international markets? I mean, they've had a really horrible, might even be like 15 to 20 year period relative to the US. So they've been a big return drag if you've been just trying to diversify smartly between US and international. But just from a, expected return perspective, and why international kind of should still be part of the discussion with people's portfolios.
Well, I'm going to tell a personal story that shines a light on my biases, right? So about 50 years ago, my family came to the United States as refugees of the Vietnam War. Life was really hard. We were trying to learn a new language. My parents were struggling to get jobs. We were living on public assistance. So my mom, and we had no family around, my mom wrote a letter to her sister who had been living a middle-class life in France since the 1960s and said, should we move there? And my aunt, who was a stay-at-home mom, wrote back and said, yes, life would be a lot easier for you, but if you could make it in the United States, the future is much brighter for your children. So 50 years ago, an immigrant housewife in France knew that betting against American exceptionalism would be a bad idea. And so the question is it a bad idea now? And it's true. The U.S. looks like it trades at a big valuation premium to other parts of the world, but a lot of that is because we have the growth stocks and we have the quality stocks. And so if you actually were just to reweight the sectors across the various regions to have similar sector exposures between, say, technology and banks, for example, and calculate valuations, a lot of that gap would go away. And then you add to that our deep capital markets, our flexible economy, and the rule of law that protects shareholder rights, then the U.S. in many ways is still the best house on a bad block, right? So, you do have occasional exciting growth areas. Emerging Asia is one of them. I know that China has some challenges, but still, I think that you are seeing a lot of growth there. And you do add diversification because there are some companies that emerge from these areas that are world leading. companies like TSMC, ASML, a lot of the healthcare companies, and also the consumer discretionary companies in Europe. So you do want to own them, right? It's just that, it's hard, I think, to bet against American exceptionalism right now.
Love that story, Quay. Thank you for sharing that with us. In the last 1 to 2 minutes here, there's a standard closing question we're asking all of our guests, and you can go anywhere you want with it. You can stay in investing, you can go outside, but what is the one interesting thing you're seeing right now that you think others should be paying attention to?
So I try to pay attention to good news as well as regular news, and a couple of things spring to mind for me. One is that there was a recent study that was done that showed empathy among young Americans is on the rise and has actually rebounded to the highs that we saw in the 1970s. I know there's a lot of anxiety around the political process in the United States and the social media creating like tribal camps, but I think that this kind of news should give us reason to have optimism around the fabric of our society, right? So I thought that was an interesting piece of news. Another one was that there are some scientists that believe that we could be reaching peak emissions of greenhouse gases in the next year or so. Now, the scientists could be wrong. Scientists have been wrong before, but I really hope not, because this would be a great achievement, I think, for our society.
Thank you, Quay. I really enjoyed this discussion. This is great. Thanks for coming on.
Thank you.
All right, let's.
All right, Jack, you're transitioning, and
Yep.
all right,
Brent.
Hand the baton to Brent for the middle of the 4x4. All right,
Brent, we're back to macro, Brent. We're
back.
Let's get Darius in here.
Oh, Justin there too? What's up, man?
Justin's kind of frozen. I think your mic might be. Do you hear his mic muted?
I can hear Darius. Yeah, if you could turn your mic up a little bit.
Just so we're not.
Last time we were accused of speaking over everybody, so we don't want that again.
You and I are just too loud, Brent.
Yeah, nobody wants to hear what we have to say anymore. We're done.
There it is.
There you go.
How about this? 1, 2, 3.
That sounds a lot better.
Awesome.
Maybe down a little bit from there. Sorry. This is what we get. We do it live. We have always but both on our side and on the guest side, we always have a couple things we got to work through.
People appreciate the authenticity, man. We've all been through it.
I also appreciate the tie, man. Way to show up with the most professional look possible, Darius.
I appreciate you, man. Thank you. It's good to see you guys, man.
It's great to see you as well. So most everybody watching this probably already knows who you are, but why don't you give us a quick little bio and we can take it from there.
Yeah, I appreciate you guys, man. Thank you. So my name is Darius Dale. I'm the founder and CEO of 42 Macro. 42 Macro is a investment research company that specializes in quantitative macro risk management strategies. We have clients all across the investing spectrum: institutional investors, investment advisors, retail investors. One of the things that we pride ourselves most on is compressing that information gap between our highest end institutional asset manager clients and our our retail investor clients, and we try to use a lot of the same tools, techniques, and frameworks to deliver alpha to our retail investor clients as we do to our institutional investor clients, and it's a wonderful community that we built.
And just before we get into it, I just want to remind everybody we're here for Susan G. Komen today. So if you're watching us on YouTube, there's a donate link next to the video. If you're watching us on Twitter or LinkedIn, you can go to YouTube and hit the donate link. If you get any value out of what we do today, we would appreciate it if you would give some money. It's a great cause. I guess as we start out, I want to ask you about what you just mentioned, this whole idea of systematic, because we're quant investors and we love systematic. It's my favorite thing. So how do you think about what do you think of the advantages of applying like a systematic approach to macro?
Yeah, absolutely. So for me, it's a lot about creating signal and separating the signal from the noise. There's an infinite amount of data, as you guys all know, to analyze when it comes to not just the macroeconomy, but also how asset markets are responding to the macroeconomy in terms of pricing and different distributions on the growth, inflation, and policy outcomes spectrum. And so, what we try to do by creating systematic tools and signals is trying to create, real clear and cogent signals for our investors to respond to, as opposed to what I think a lot of other people are doing, which is well, I woke up today and my kids pissed me off, so I'm now a little bit more inclined to be bearish, or some positive thing happened to me today, so I'm now a little bit more inclined to be bullish. And we try to remove the emotion from investing. I think the number one thing that we do as systematic investors, Jack, and I think you would agree with this, is create rules and stick to the rules. No matter how you feel in the moment, if you don't want to be violating and overriding your rules, because those rules, if they're carefully back tested and come from proven quantitative frameworks, then they typically will give you a better opportunity to maximize upside capture and minimize downside capture over time. You're not always going to be right. Your rules are not always going to be perfect, and they're not always going to execute better. But what we've found here at 42 Macro, and what our clients have certainly found, is that our systematic processes have definitely helped them, create maximize beta and also generate alpha much better than what I could do just thinking about macro for my brain.
And to your point about the volume of data you guys look at, I think if I had to rank every human being I've ever met based on how many PowerPoint slides they've created,
a lot of slides.
I think you might be first. I think you would be the winner by a very, very large. I mean, I've seen some of your decks and they are like hundreds of slides. So you've done an amazing job of that.
Yeah, I appreciate you. And that's one thing I'll say as well. And we have some slides we can walk through today here as well. What we try to do for our clients at 42 Macro, and I think this is something that a lot of investors could potentially learn from, because I've learned it from some of our top clients across the global institutional asset management space, which is separating your research from your risk management. And what that means is, having those rules, having those clear, cogent, actionable signals be different from your fundamental research process. What you think is going to happen from a growth, inflation, and policy perspective, or where you think we are in the positioning cycle, those, in my opinion, are separate and apart from, what you need to be doing today or tomorrow or the week after tomorrow in your portfolio. You can use, those types of those qualitative factors, those fundamental factors, to inform your expectation on how those signals are likely to evolve, which is what we do and we do for our clients here at 42 Macro. But ultimately, it's the signal itself that has the most value and helps investors, sort of maximize that value.
Before we kind of look at where we are now, can you talk about this importance of cycles? Because I know you look at different cycles that are playing out simultaneously, and then you kind of put them together to get your overall view. So can you just talk about the importance of that?
Yeah, 100%. I'll just show my chart. It's a lot easier to speak to a slide deck here. Let me just share this chart here. So there are a number of cycles that matter in the economy at any given time. We call them principal components. These are the things that over time tend to have stable and clearly defined relationships with respect to producing dispersion within and across asset markets. On the real economy side, you have things like growth, inflation, the labor market, so the corporate profits and fiscal policy. And on the financial economy side, you have things like liquidity, credit, interest rates, and then just the general positioning cycle where they go in terms of swinging from fear and greed. And so we built our macro weather model as a systematic quantitative tool to help us, identify where we are within all those very important cycles in the economy, and ultimately how those cycles are evolving in a way that could produce real clear signal for asset markets on over a medium-term duration. And so when you go and you kind of think about this in terms of how each of these principal components interacts with each of those asset markets on an independent basis, the key takeaway here is that the stock market and bond market have negative 3-month outlooks, which means you should be, as an investor, expecting higher volatility, lower than baseline returns in that asset class over the next 3 months. Dollar, it's the opposite. You should be expecting lower volatility, higher than baseline returns in that asset class over the next 3 months. And then for commodities and Bitcoin, it's neutral. And so, we refresh this model 6 days a week for our clients at 42 Macro, and identifying and helping them identify, okay, when something important changes, how does that important thing that changes, that important cycle inflection, how would that ultimately impact asset markets? And so this has definitely helped us stay on the right side of market risk. And more importantly, it's helped us, sort of proactively help clients proactively prepare for regime change in asset markets. And obviously this is a really important, last couple of weeks, and this week in particular is very important because we could be on the precipice potentially of regime change in asset markets, if we get the wrong types of signals from a cycle standpoint, particularly on the policy side.
Darius, what are you looking for from the policy side that would usher in that regime change? I mean, we've seen some, we called it before, rolling spasms of volatility in different asset classes over the last few weeks. Is there any kind of one or two major sort of headline points that you can flag to say, watch for this as a persistent marker that we're in this regime change?
Yeah, 100%, man. Appreciate you. Brent. So yeah, the what we're looking forward to in this week in particular on the policy front is how the Fed and the Treasury are going to respond to structurally above target inflation, and more importantly, accelerating inflation, because we've seen obviously quite a few nasty inflation prints back to back to back. When you look at whether, pretty much any inflation statistic, but whether it be supercore CPI, supercore PCE, median CPI, trim mean PCE, pick your inflation indicator, they've all accelerated 4 to 5 months in a row on a 3-month annualized basis, and are now tracking, most of them, double, if not more than double, their pre-COVID trend rates. And so we've moved in the wrong direction on inflation by a considerable degree on an annualized basis in the most recent 3 to 4 months. And in our opinion, how the Fed and Treasury decide to respond to that is the sort of kind of linchpin between whether or not markets can remain in a risk-on condition, or if they'll transition to a trending period of risk-off. And I'm not talking just 1, 2, 3, 4 weeks of risk-off. I'm talking something that looks a lot more like 2022 or 2020 or 2018. In our opinion, and that, in our opinion, is the kind of risk-off period that you need to risk manage from the perspective of reducing your gross and net exposure to the broader risk markets, and ultimately finding, asymmetric opportunities in derivatives markets to protect your portfolio. So let's start, if we can, with the Treasury, because we got a very important update out of the Treasury yesterday afternoon in the form of the first part of the Q2 quarterly refunding announcement. And so for those investors who may be not familiar with the quarterly refunding announcement, that's where the Treasury Department outlines its net marketable borrowing targets and its Treasury general account balance targets for the current and upcoming quarter. They'll revise their estimates for previous projections, and then they also go into detail on some of the dynamics that are taking place within the economy and asset markets that are influencing their decision to either, supply themselves in the bill market or the coupon market or the bond market. And so just kind of unpacking this chart here, a few key takeaways that I thought were hawkish. Hawkish from the perspective of either sending a hawkish signal to asset markets, or hawkish from the perspective of potentially creating indigestion in asset markets in a way that increases bond market and currency volatility, two factors that have been positively correlated with the dollar over long periods of time, and inversely correlated with global liquidity and U.S. liquidity over the long period of time. So the first thing we saw was we saw a significant increase. Oh, sorry, my pen ready. My apologies there.
No problem.
Yeah, no worries. So we saw a significant increase to $847 billion for the Q3 net marketable borrowing estimate. That's up $604 billion quarter over quarter. So in Q3, the U.S. Treasury is going to issue $604 more billion of U.S. Treasuries than they issued in Q2. That Q2 estimate of $243 billion was revised up $41 billion from the prior quarterly refunding announcement that we received in late January. Another hawkish indication that we saw here was the end of Q3 cash balance or Treasury general account balance target was revised up $100 billion to $850 billion in Q3. So that's an indication from our perspective that the Treasury is no longer explicitly targeting net financing policy that is supportive or additive from a liquidity standpoint. We can sort of see this better characterized here in the slide 2, where we show the dynamics and the features of our net liquidity model, which has become everyone's net liquidity model.
That it has.
So, you guys heard and saw it here first, folks. But in terms of how folks calculate net liquidity, or we have calculated net liquidity for quite a while here, it's the Fed balance sheet, the total assets on the Fed's balance sheet, minus the Treasury general account balance, minus the Fed's reverse repo facility balance. And as you can see, the black line being in the second panel being the reverse repo facility balance, the Treasury Department has done a tremendous job of targeting and tapping into those funds, those excess liquidity that's being sort of mopped up by the reverse repo facility in order to finance itself over the past, let's call it, 5 quarters or so. We've seen the the RRP balance go from about 2.5 trillion to only 506 billion currently. So that's been a very positive force for asset markets, because what we see here in terms of net liquidity, which is, a slight, kind of flattish to up trend, not quite trending higher, but a real flattish trend. And in our opinion, that's one of those dynamics that has caused the decline in bank reserves that we've seen since the start of 2022 to cease. We've kind of had, more or less stable bank reserves since then. And it's in our opinion, it's been a big function of Treasury net financing policy. No better way than you can see that than in the composition of borrowing. And so in this chart here, we show the bills and coupons divided by net marketable borrowing. So bills plus coupons equals total net marketable borrowing. And so when you look at it from the perspective of bills, on a trailing 12-month basis through Q1 of 2024, the bills of divided by net market borrowing, that ratio of bills was 69%. 69% is more than it's exactly 3 times the total overall share of bills in the U.S. Treasury market in terms of the marketable Treasury market, 23% to be exact. So that was an explicit policy by Janet Yellen to increase the supply of zero to very short duration assets that the reverse repo facility balance could really find itself into, and obviously increasing that supply would create a very positive spread dynamics as well for money market fund and participants. So in our opinion, it's very much looking like she's now starting to move in the other direction in a way that favors coupon supply, in a way that would potentially cause the reverse repo facility balance to stall out. And ultimately, we know the TJ balance is actually going to rise from the end of Q3, or from the end of Q2 to the end of Q3. And so in our opinion, when you put those 3 things together, that's sending a signal to investors that the Treasury might want to tighten financial conditions over the medium term.
And are you expecting any update tomorrow on this? I know there's another kind of announcement at 8:30, right?
Yeah, absolutely. So that's a great question. So the next step of the QRA process are the actual composition and the TBAC discussion charts, the Treasury Borrowing Advisory Committee discussion charts. And so tomorrow at 8:30 a.m. tomorrow, we'll learn exactly how Janet Yellen is deciding to finance that $847 billion of net marketable borrowing in Q3. In our opinion, any increase in coupon supply would be an explicitly hawkish signal because there's no economic reason to increase coupon supply. And the reason we say that is because the bill market continues to provide the Treasury with the highest discount, really the only discount across the Treasury curve in terms of financing. And so in this chart, we show Treasury yields. So the observed, the current market yield in the Treasury market minus the weighted average interest rate for the various segments of the Treasury market. And so if you look at the 7-year Treasury yield minus the weighted average interest rate on total marketable debt, that's right around the duration of the weighted average duration of total marketable debt, about 6.5 years. At 93 plus 93 basis points, the Treasury would be paying a higher rate relative to its total bond portfolio if it was issuing 7-year Treasury securities. If the Treasury issued at the 12-month T-bill yield, then they would actually be issuing at a lower rate than what's on their current bill portfolio. So that's positive at the margins. But all the rest of the segments of the markets, whether it be notes at plus 180 basis points, bonds at plus 108 basis points, or tips at plus 114 basis points, every other segment of the Treasury market, the Treasury Department will be walking into sort of a higher price, a lower price for the bond, but a higher price in terms of the yield, and that would not necessarily make economic sense. And so in our opinion, if Janet Yellen wants to piggyback on yesterday's sort of upside surprise in the end of Q3 TGA balance estimate by saying, hey, we're actually going to finance that increase in the TGA balance, not necessarily with just primarily bills. We know bills are going to go up from the minus $245 billion we saw in Q2 because they typically do go down in Q2 and go up in Q3. But is the coupon total going to rise from $447 billion? And if that's the case, then we might have some problems this summer in asset markets.
Darius, it's an incredible amount to digest here with the issuance. I would say one thing I saw in the vol space I'd be curious to get your update on is this morning it seemed like not only did option implied vol lift for around the FOMC statement for tomorrow, but also for the ISM, I think is the PMI next week. Is that actually going to be a material factor to everything that's happening in the next couple of days, or is it really more just based about whatever the Fed and Treasury may update tomorrow?
Not at all, man. So in our opinion, there's a lot of important economic information we're getting this week in particular that could potentially change the dynamic in terms of asset markets, in terms of the risk-on condition that we've seen on a trending basis in asset markets. So this morning, one of those important dynamics features that we got was the Q1 employment cost index report. We saw that accelerate to plus 4.4% on a quarter-over-quarter SAR basis for the private sector. That plus 4.4% is 200 basis points faster than the pre-COVID trend rate of 2.4%. So we are not only moving in the wrong direction, we are significantly and structurally elevated relative to the longer run trend that is more consistent with 2% inflation. So in our opinion, we know that the Federal Reserve, the members of the FOMC really heavily weight that employment cost index report because it is the broadest measure of wages and compensation and benefits here in the U.S. They really heavily weight that in their deliberation for monetary policy. So it could be the case that tomorrow, right now, they're deliberating right now, and we're going to learn tomorrow what they decide. But it could be the case right now that they decide to materially change the Fed statement, and or Jay Powell has a material shift in tone in a hawkish direction in tomorrow's FOMC event, which will start at 2 o'clock. I think Powell's presser is at 2:30. So that's one, Brent, one data point that we're going to get this week. Immediately following the Fed on Thursday morning, we get Q3 productivity and unit labor cost inflation data. And those data points are incredibly important from the perspective of understanding, what the likely Fed reaction function will be over the medium term. Because I think we've had this sort of kind of, I don't want to say parlor game because that's a little bit too dismissive of what I think is happening amongst investors. But I think it's been, we kind of lost sight on what we need to be doing. Not we, but the general investor has sort of lost sight on what they're trying to do with respect to understanding policy dynamics, which is, where's policy going to be over the medium term? Whether or not the Fed decides to hike the interest rate in June or July, or if it's 1 cut or 2 cuts in 2024, that's a sexy thing to talk about on Twitter and on financial media. But the reality is what is the general sort of slope and direction of the forward rate curve? And that, in my opinion, is a more important dynamic that we need to ascertain, that we ascertain for our clients here at 42 Macro. But going back to the productivity data point that we're going to get at 8:30 a.m. Eastern tomorrow morning, on Thursday morning, the reason productivity matters is because if productivity is high, it allows above target wage inflation to not necessarily crimp corporate margins in a way that forces corporations to pass on price increases to consumers. And so in this chart here, we show the blue line is the spread between private sector average hourly earnings, the year-over-year growth rate of that, minus the year-over-year growth rate of non-farm productivity. As you can see in the chart, most of the time, at least for most of the great moderation, it was negative, it was nonsense. It didn't really have any material impact on inflation data. But whenever you see the growth rate of wages spike in excess of productivity growth, which is the output per hour of work in the U.S. labor market, then that's when you have these big spikes in inflation dating back to the late 60s. And so the most recent episode seems to be getting kind of cooled off. If you look at the most recent value of this blue line here, about 100 plus 160 basis points. But if we saw productivity growth slow from its current above trend rate, we're currently tracking at 3.2% quarter-over-quarter annualized and 2.6% on a year-over-year basis. If productivity growth slows enough to cause that blue line in this chart to actually start to rise back up again, it could be an early indication that inflation, which is currently tracking at 3.5 on a headline basis of CPI or 2.8 on a core basis or core PCE, the Fed's preferred inflation target, it might be suggestive that those are now the kind of bottoming type levels for those time series, and that we may be entering a new regime, and which we argue we have entered a new regime, that inflation, the trend of inflation is likely structurally higher than the prior trend of inflation. And if that's the case, then the entire forward rate curve has to reprice higher and to account for that over a medium term duration. It's not going to happen overnight, but certainly relative to the Fed's kind of 2.5%. Neutral rate target of 2.5%, which is with our 2.56% to be exact, which they outlined in the most recent dot plot.
So the takeaway from you is it seems like we have this kind of bearish equity environment. If we could talk about equities for a minute here, bearish equity environment potentially, or regime shift, I guess, potentially happening maybe now. And is this the sort of situation where we would end up, and this is kind of an extended recessionary period? It's just simply a short-term kind of consolidation window that you see, and we can kind of right the ship, clear up some of the inflation narratives. Rates can be maybe seen on a little bit more of a stable path. And then 2025 would be okay after the election? Or is this sort of like you have this 3-month window of we got to digest this new data, and that has nothing that we can really extrapolate or interpolate in terms of forward projections in 2025?
Oh, great question, Brent. So just in terms of the actual outcomes for the economy, we use advanced statistical processes and on the econometric side to forecast growth and inflation as well. We try to put the piece together both from a quantitative standpoint or qualitative standpoint, but we also use quantitative signals to forecast growth and inflation as well. And on the growth side, we continue to be above consensus on growth in terms of the delta on growth, and we continue to see a high probability of a no landing in inflation as well. So we're not concerned about a recession. We're concerned about asset markets, aggressively repricing the forward rate curve in the same way that they did in 2022, because again, we have a significant amount of cuts being priced in. If you look at Fed funds futures, we're currently pricing in 2 cuts for 2024. We're currently pricing in another 2 cuts, a little bit over 2 cuts for 2025. Let's call it another cut for 2026, and then another cut, maybe 2 cuts for the longer run estimates. So those cuts could go back to a much more flat structure in terms of the forward rate curve, or on a medium term duration over the next, let's call it 3 to 6 months, if the Fed and Treasury are no longer implicitly supplying asset markets with dovish net financing policy and dovish forward guidance. In our opinion, we don't know the answer to that yet, Brent. So I don't know if we are on the precipice of regime change in asset markets. That's why I'm going to wake up, at 5:30 in the morning tomorrow and do my job. And to actually refresh all the models and the quantitative tools that we use to get out in front of this stuff. Because again, 9 times out of 10, not every time, but 9 times out of 10, the market signaling process, our market signaling process, is a leading indicator for some of these, sort of big major changes in these economic cycles, whether it be growth, inflation, or policy. Sometimes, the markets just get surprised because, markets don't always know what Janet Yellen's thinking or what Jay Powell's thinking or Donald Trump is thinking at any given time. But the reality is most of the time, there's enough information in asset markets to kind of figure this stuff out ahead of time. And I will say, we're not quite there yet from the perspective of regime change, but we are certainly inching close in that direction. And how we determine that is using our global macro risk matrix. This, in my opinion, is our probably our flagship tool in terms of keeping our buy-side clients and really all of our clients on the right side of market risk. This tool helps us identify and position for the market regime. And how this tool works is we're scoring 42 of the most important markets across the economy through the perspective of our volatility adjusted momentum signal. You can just sort of see a quick overview of how that looks in S&P terms here or in Bitcoin terms here. And so it's a very accurate and stable signal in terms of helping investors stay on the right side of market risk. And we do that same signal for all the major equity markets, volatility products, commodities, currencies, and fixed income, rate spreads, et cetera, in the global fixed income market. And so we're doing that every day to tally up which regime actually has the highest sum and share of the total. And right now we've been in a situation where reflation has had the highest sum and share of the total for a little over a couple of months here, and we're starting to see evidence that inflation may actually overtake it. And inflation is a risk-off regime. That would represent what we call a row phase transition, going from a risk-off condition, which is Goldilocks of inflation, to a risk-on condition, Goldilocks of inflation, to a risk-off condition, which is inflation and deflation. And that causes the maximum amount of pain in investor portfolios because that's when most factors flip their relative and absolute performance. And so we have to be very cognizant of that over the short to medium term of that potential outcome. This may be a head fake, right? This may just be a correction. You have corrections in risk-on regimes that happen all the time. And so we don't want to be overly concerned about a mere correction. What we want to be concerned about is a trending period of risk-off, most likely inflation, because that's the second highest probability here. And if that's the case, then we know what to look for in terms of what's driving that. And ultimately, we know what to look for in terms of when that's likely to kind of conclude. So that's our process in a nutshell. If I can leave you guys with one slide, this is our risk management process. This is what we do every day for our clients behind our paywall, that people don't see, which is we help them identify and position for the market regime. And then we use our macro weather model, which we talked about. That was that first chart with all the cycles in it to help them prepare for regime change. And then we help them prepare for regime change using qualitative signals as well, which is, talking about productivity, unit labor costs, and all those types of dynamics.
It's been an incredible deep dive, Darius. Thank you very much. I think with the few minutes we have left, let's say for the average equity investor, I think that's probably where a lot of us watching today are focused. Is there a level of rates or a specific phrase, signal, 1 or 2 things that we can latch on to say, hey, look, the 10-year just went above this, or Powell said this, or whatever it may be, that from an equity perspective, we want to say, okay, time to buy some puts or reduce my risk or whatever it may be. One signal or one thing that we can really latch onto or pay attention to out of the next few days' data points.
Yeah, so within the context of our KISS portfolio construction process, which takes all of these different signals and distills them into a very very easy, actionable to execute sort of 3 ETF portfolio for the average retail investor. It's SPY, Ag, and Bitcoin, 60, 30, 10 there, and we use dynamic position sizing that's guided by these signals. In terms of the signals that most correspond to KISS, are that market regime identification process. Are we in a risk on condition or risk off condition? Because that will determine the target allocations in that KISS portfolio construction process. And then at the individual ETF position as well, what is that individual ETF's volatility adjusted momentum signal? And so, the individual ETF's volatility adjusted momentum signal will determine its own dynamic position sizing. It's separate and apart from that target allocation. And so, those are the two signals that in our process, if you're just a regular equity investor or just a, regular 60-40 type investor, those are the signals that have been proven to be the most powerful in terms of keeping them on the right side of market risk, helping them maximize upside capture in bull markets and blocking out all the noise while they're doing that, but also helping them minimize downside capture when we're heading into these potential risk off periods.
That's amazing, incredible insights there, Darius. Your slide deck did not disappoint. We were waiting for that to come up. Bust out the old pen and then just overwhelm with data, give us an overwhelmingly amazing amount of data. So thank you very much. Where can people go to learn more, sign up, or check out your briefings?
Well, I appreciate you, Brent. Thank you so much. And thanks again for putting on this wonderful event, man. I know you guys are raising a lot of funds for a wonderful cause. So I'm just grateful to appreciate the opportunity to be here with you guys. So definitely come check us out, 42macro.com. As I mentioned at the outset, our research process was born in institutional Wall Street, but we, obviously service and cater to the needs of our retail investor and investment advisor friends by, creating smaller, more bite-sized, actionable signals for them to take advantage of in their portfolio. 42macro.com.
That's amazing. Thank you so much, Darius. And as Darius mentioned, we are doing this for the Susan G. Komen Foundation. And so if you're interested in donating, like what Darius had to say today, please consider giving a few bucks. If you go to youtube.com/SpotGamma, there's a donate button over there, and you can click and donate a couple bucks. I think Darius just gave us a bunch of alpha, a bunch of things to watch out for. So hopefully you'll easily make those donation dollars back. And we will be pivoting now to Meb Faber, and Jack and Justin are going to be bringing up some more macro insights. Hard to follow up the incredible job by Darius here, but we'll see if Meb is up to the task.
Hey guys, thanks so much for having me, guys. Best of luck.
Good
Appreciate
job.
it. Thanks, Darius.
All right,
see you soon.
Cheers.
All right.
All right, guys. Jack, looks like you did a little tech swap there. Is he with us?
Jack, are you with us? I don't. He can't hear us. Let's see. We'll maybe give him 30 more seconds.
All right, should be good now. Can you hear me now?
Okay.
There we go.
We can. Yep.
Yep, we're in now.
All right.
Good.
That was awesome, Brent. Sorry about everything that could have crashed there.
Darius is incredible. You just kind of wind him up and let him go. And so,
Nice.
He had
he
some,
basically gave the
flow
interview.
there. I'm like, I'm not going to mess with that. I'm not coming back in. So
He thankfully gave the interview basically by himself. Incredible deep dive into that in the stats and data there. So super grateful for him for joining. I'm going to hop off now and pass the baton to you all.
sounds good. I'll let Meb in right now.
Meb, how are you?
What's up, y'all?
What's up?
How's it?
All right. Good. Thanks for jumping on with us. We appreciate it. Probably don't need to give you an intro, but I'm going to anyway. Meb Faber, everyone, founder of Cambria Investments. Cambria has, I think I counted 14 ETFs today with almost $2.5 billion in assets under management. We're going to talk to Meb about endowment investing, and get some of his thoughts on what individual investors might be able to do to replicate some of these strategies and a bunch of other stuff. But before we get into that, just a quick reminder that today's event is to support the Susan G. Komen Foundation. There were over 7.5 million breast cancer survivors in the world in 2022. So obviously this disease affects millions and millions of men and women. And today's event is to just try to lend some support to this great foundation and cause. So if you can, there's a donate link at the bottom of the video on YouTube. Please consider donating if you have the means to. So Meb, let's talk. And a lot of this kind of comes out of your the Ivy portfolio, which is a book that you wrote, but you're pretty vocal about sort of pensions and endowments and trying to help investors understand the ways they invest and the ways that an individual might be able to replicate some of those strategies. So, but let's start with an overview of how these pensions and endowments actually do invest their money.
Sure. So great to be here, y'all. If you look back at the long history of the big money in some of these endowments, not just talking about the past 10, 20 years, but really like past 50 years, some of these early pioneers like Harvard in the early days and more in the recent few decades, Yale, helmed by the late, great Swinson, they definitely took a different path than most traditional institutions. You have this benchmark historically of the 60-40 portfolio in the US and kind of how that's evolved. And the decision was just almost always how much stocks and how much bonds, and that was the seesaw lever, and that was it. And a lot of these kind of real money institutions said, let's be a little more open-minded about what we can invest in, which is essentially everything. And once you expand sort of that worldview, then anything is on the menu. And the endowments, I think, have a spectacular track record. When we wrote the book, we said, look, there's some things we think they do that's really thoughtful and some things that they do that's probably not the best idea. And then, we said, how can like an individual investor really replicate the best of what they're doing with sort of minimal effort, as well as avoid some of the struggles that they have when most of us are not at 40 billion or something. So the things that an investor can do at 100,000 may be a little easier than what they can do at real scale and size. So the main things that they did and continue to do is have a long-term perspective, hopefully. And they understand that their greatest enemy is inflation. So making sure they maintain their purchasing power. And so the biggest kind of umbrella is that they say, we want to make sure we own assets that have equity-like returns over time. On average, the portfolio, we want to outperform inflation over very long periods. And we can dive into what that means. But that's sort of really the backdrop, is these really great performers who have done a great job at compounding for many decades, long-term horizon, and have the full secret menu from in and out of any possible investment in the entire world.
And, so their goal is, they're looking at a multi-decade type of, or maybe even longer type of time horizon and trying, the reason that they would include other asset classes is just for like diversification and trying not to get like blown out of the water. Is that, what you would say?
Yeah. So if you look at the broad menu choices, the entrees, they're always usually pretty heavy in something global equities. So not just US, but around the world. Now, if you look specifically at something like Yale's, you say, well, Meb, what are you talking about? It says they only have 5% in US stocks or whatever it is. So we say equity-like in things that look like equities. So the main favorite of the past 10, 15 years, probably the savior for many, I think that they hope, is private equity, which a lot of the endowments, we tend to disagree a little bit here, where they think there's going to be this magical 4 or 5% outperformance from private equity forever, despite the fact they're all putting money towards it. So equity is obviously the big one. Second, and the things that are essentially equity, private equity is equity, just happens to be private. The second is real assets, so in the early days, if you go back and look at some of the books written about Harvard a long time ago in the 20th century, real estate was certainly one that's obvious, both public and private. Then you have things that are sort of inflation protected sort of securities, so TIPS or commodity and commodity-like equity type of offerings. Fixed income still plays a role to varying degrees in various portfolios. And then you have this big, giant slop bucket of other, which many different endowments describe in different ways. Some call it absolute return, some call it hedge fund type of strategies, but it's just that whole, side of the menu that's kind of like today's specials. Here's what are offerings that are somewhat different. It could be aircraft leasing, it could be all cat bonds, it could be all sorts of things that are meant to zig and zag. And so you referenced, is it something that's meant to be an outperformer, or is it meant to be a diversifier, or both? It really depends. When you start talking about hedge funds, we always say the analogy is like, it's like talking about the average dog. A poodle looks nothing like a beagle, it looks nothing like a Great Dane or a Mastiff, right? And so just saying hedge funds or absolute return means a million different things. So the main things they got right: true diversification, long-term period, equity-like orientation. We think those are all really great choices. And then there's some things that they probably, we think, don't do so great. But the good news is most individual investors could replicate that today. It's the best time ever to be an investor with a portfolio of ETFs that's, let's call it, I don't know, 5 basis points, so 0.05%, which is pretty incredible. That's also the challenge too. The 10,000 plus funds out there, it's easy to get seduced by a lot of choices, but it's a pretty awesome time, and you can do it pretty easy.
Justin, are you hearing Meb quieter than us?
No, he sounds good to me.
Then. I just want to make sure I wasn't an issue with that, because we got a comment earlier about that. But yeah, I want to ask you about how does this work? So they're obviously doing a lot of different things. They've got pretty big staffs. They're hiring managers that have high fees in a lot of cases. Is there any aggregate data that tells us is this adding value relative to what you talked about before, which is a lower cost ETF portfolio?
Sure. So as you mentioned, we've also been a bit critical of a lot of the big institutions. The favorite punching bag for me historically has been CalPERS, which is located in my home state. And CalPERS is what, let's call it a $500 billion pension. As big as you get, as many resources as you could possibly want, the best in the world if you wanted to, managers at your disposal. Assets certainly give you a ticket to opening any door. And then we talked about how is CalPERS done historically, how have the endowments done. The average endowment does a good job, right? But you can replicate the average endowment fairly simply with a portfolio of ETFs. You have the Yales of the world and to a lesser extent the Harvards of the world that have outperformed substantially over time. The question, of course, is, will that last going forward with increased competition and increased, pressure on all sorts of things in our world, TBD. But so we wrote a piece called "Should CalPERS be managed by a robot?" We did the same with the world's largest hedge fund, Bridgewater. Their all-weather and pure alpha portfolios. We said, you can get pretty close with just a portfolio of ETFs. So the replication of the beta of what they're doing, we think, is totally obtainable. So then it becomes a question of why do people spend so much time and effort on this decision, this asset allocation choice? And we had a recent podcast with the Nevada pension fund guy, Steve Edmondson, who I love dearly, and his story is the exact opposite. They're the true foil to CalPERS has hundreds of employees, hundreds of millions in fees every year. Their position sheet is 200 pages or something. He's like, what, we're just going to index the vast majority of this for as low cost as possible. And sure enough, they beat CalPERS in the average endowment over time. And usually it's by about the difference in fees, right? The ones that pay more, not surprisingly, it's a higher bar. And they only have
Isn't it
one
just him
employee.
and one other guy or something?
Yeah, they now have 2. Sorry, so they now have 2 employees, but
It's
for a
crazy.
while it was only 1. So the good news is you can be totally average, which is a compliment in our world. Average is not so bad in the investing world, and you can mimic the best of the endowment portfolios. But let's be clear, there's a giant elephant in the room, and the elephant's named SPY. And we have this very unique period in history. It's not totally unique, but the S&P has just steamrolled everything else in its path over the past 15 years. Has done 15% a year since the bottom in 2009. Now that's awesome, particularly for American investors that put most of their money in American stocks. God bless you. But also, it's only happened a few times in history. It's happened and they all have names, you know, the Roaring 20s, Nifty 50s, Internet bubble, and whatever we're calling COVID meme stock mania. So diversification has not been rewarded for the past 15 years, which is a lifetime for most of us. Like, it's careers for many people, 15 years. And so we actually have a piece coming out called The Bear Market and Diversification, where you look at any investing strategy, not just endowment style, but it could be risk parity, global market portfolio, 60-40. And so for the advisors listening to this is probably going to generate a little PTSD. So I apologize, but you know, every client conversation you've had in the past 15 years has been, why do we own foreign stocks? You know, remind me, what are these REITs doing in here? Could you explain commodities? Like, you got to be kidding me. Emerging markets, China's down like 60%. Why do we own that? Everyone knew bonds at 1% was stupid. Why didn't you? So you've had to apologize every quarter for 15 years, and that's get old. These portfolios, most of them have had the longest streak of underperformance in terms of years in a row, as well as magnitude. I think the global market portfolio underperformed the S&P in something like 11 of 13 years, like, right? Not one or two, 11 of 13. Now that ended really in 2022. Well, TBD. We'll see what happens this year. But so this endowment style portfolio has done fine because of the equity orientation, but still S&P has creamed that as well for most of the styles and strategies. But over time, diversification, it certainly has been a much better choice.
Didn't you you put in an application to CalPERS, didn't you, a couple times? Just to see, I don't know if you got a good response from them, but didn't you, I think they had like a CIO open or something at some point, you put your name in?
Yeah, you know, I've been very public about this, which I'm sure has not helped my chances, but I said for the last three, my criticism about the CalPERS approach, and here's the struggle, by the way. Most listeners, the only person you have to answer to for your asset allocation decisions is the person looking at you in the mirror, maybe your spouse, and that's about it. Like, your children will be really unimpressed if, you know, you do poorly and bankrupt them, but really it's like a small universe. The incredibly challenging problem of something like a Harvard is you not only have the investment committee, then the investment professionals, you also have current students, you have alumni, you have future students, you also have university employees. So there's like 10 different conflicting interests that are going on in this management of these portfolios. And so you've seen it with the challenges with Harvard over the past 10, 15 years, where it's funny because this article's old at this point, but we wrote an article where when Harvard was outperforming and doing great, you know, people were complaining about that the in-house managers got paid too much. When Harvard was doing poorly, there's articles in the Crimson about, hey, this is unacceptable. We shouldn't be underperforming these benchmarks, and Yale and everyone else. And it's like this hilarious back and forth. But it's a near unsolvable problem. Now, Yale has been able to navigate this partially because they've been like the Michael Jordan of you know, endowment management. But now that Swinson has passed, like, do they have an infinite leash? Like, we'll see. CalPERS has the same problem though. Like, it's infinitely complex for no reason. And you look at their position sheet. We always talk to investors, hey, you need to write down your investing plan, come up with the rules. Doesn't have to be hard. It could be on a note card. It could be 5 lines long. CalPERS is just, it's the most nonsensical investing document you've ever read. And so they've had in the past 10 years, like half a dozen CIOs. So I've applied to the last 3, but my joke that I put on Twitter, not a joke, I'm serious. I say, hey, look, tell you what, I'll be your CIO. I'll do it for free. So I'm going to save you hundreds of thousands of dollars right there, $1 million. I don't even know what they pay them. But I'm going to fire all your private funds over the course of the next 10, 15 years. I'm going to slowly move it to these ETF style portfolios. So I'm going to save you a bunch of money. We're going to automate it, make it systematic, you can run it by a robot. We'll do a meeting once a year. We'll talk about the portfolio. We won't do anything. We'll rebalance. We'll have some beers and we'll call it a day. And I'll save you, I don't know, $500 million a year. They've declined the last 3 times, not surprisingly, to even interview me. But we may have something coming out in the not too distant future that will be a really fun horse race litmus test that I've alluded to many times on Twitter, where I say, hey, when we launch this, I want to take out the biggest billboard right outside of CalPERS headquarters, which I've been to present many moons ago, and say, hey, you know, can you beat a publicly traded ETF? Let's find out.
Yeah, you wonder how places like Nevada even could do what they do, because you talk about all these layers of complexity. Like, how did they ever get through all that and get to the point where there's just two people like running it? I don't know if you asked them that.
My favorite part of the story, and this didn't make it into our podcast episode, and I want to preface this by, you know, there was a Wall Street Journal article about Steve about a decade ago, and it was basically like the guy who runs the Nevada pension and beats CalPERS and does nothing all day. Like, it basically was the name of the article. And there's so many quotes about this that John Bogle and Buffett and others have made about kind of the waiting and just, you know, not mucking around with your portfolios. Like, once you get things set up, you don't usually have to do much. And so this didn't make it in the episode because I didn't want it to sound, come across the wrong way. But Steve didn't seem to mind, and he was talking about it pretty openly in both the intro as well as the episode. But this to me is just the cherry on top, like just demonstration of it doesn't have to be endlessly complex for it to work. And we always say there's a million ways to invest that work just fine. So we have like a table, like comparison of Nevada and CalPERS, and so, you know, hundreds of pages, complexity, hundreds of, you know, staff and management, and then there's Nevada. It's like two people. You know, you could put the investment plan on one page, and it's like CalPERS, shiny, beautiful offices occupying all this space in Sacramento. Steve, who by the way lives in a trailer. And as like I'm like trying to say this way about Steve, like, and not be derogatory. Look, my brother's got a trailer on our farm in Kansas. There's nothing wrong with trailers, listeners. Trailers can be beautiful and wonderful, but the fact that this dude manages $60 billion, and he's like, look, I live in Tahoe. I got the world playground in my backyard. I don't need some grand mansion out here. My kids are in college. Like, this mindset, it's a very like Boglehead sort of mindset. I think is so fantastic, and I just love this story so much. So, but it applies to all of us. Like, you know, we talk a lot about investors and their portfolios full of clutter, because they've accumulated all these positions over the years. The phrase in the industry is always mutual fund salad. You know, like, there's financial advisors that have been in business 10 years and they got 200 mutual funds. You look down at your portfolio and you're like, God, I still own this. Like, if I cleaned house, if E-Trade went out of business tomorrow and my portfolio was zeroed, or I got divorced, or I had to transfer all this, whatever, like, would I go buy all these funds? Like, no chance in hell would I go do this. So I think the idea of taking a blank piece of paper, writing down what we would like our portfolio to look like is a very useful exercise, can be very cleansing. And then if it doesn't look like what you currently have, you know, there's time to make some changes.
I'm just curious, for one more before I hand it back to Justin. This idea of these portfolios that are very different than the S&P or very different than the 60/40, you know, we always struggle getting investors to stick with them because of what we just went through, these long periods where they don't work. I'm wondering, do you have any tips around that? Is anything you've done worked? Because I know you run a lot of stuff like this that is very different than the 60/40. Do you have any tips in terms of getting investors to stay through these periods where they're different than the market?
Yeah, and we're actually writing a piece on this. We've been busy lately.
Write a piece on everything.
We have 3 articles coming out this quarter. So we mentioned the bear market and diversification. The other one was called is an update to an old piece we wrote called "Nobody Gets Fired for Buying Vanguard. Maybe They Should Be," which is, we love Vanguard listeners, but it's a fun piece from 6 years ago. We've updated a current. And the last one is called essentially what you're talking about, which is, we haven't come up with the title yet, but it's something like a guide to buying Cambria ETFs. So, but really it's a guide to buying anything. And here's the struggle is, like, we work with professional investors. We have 150,000 investors all the way around the world. And I always don't want to shame the professionals. Always love to look down at the individuals. And we always say, these crazy individuals, they're so dumb. They're trading Reddit stocks and doing dumb things and chasing these hot managers. But, you know, the pros, I mean, look, CalPERS sold their entire tail risk position like the week before the pandemic hit. So, you know, I mean, or the month before. So it's like, you know, these institutions often are just as bad. They have fancier sounding names and sophistication. And so we've heard a lot of things over the years from investors where it's like the nails on the chalkboard. You know, it's like you hear something or you're just like, oh, I know how this is going to end. This is going to end so poorly. And so I said, this piece is not meant as a public shaming, but it's meant as a guide. So like we talk to an advisor, say they buy 10 million in one of our funds, hopefully it's 100 million. And we say, hey, look, this isn't directed at you, but like, take a look at this piece. Maybe it'll help you think through how to go about what you're going to do with this fund. Because here's what happens. Even if you're the most diligent investor, like the phrase we've heard so much over the past 5 years has been, you know, my investing decisions are evidence-based. I base them on process, not performance. You know, so let's say you come to Cambria, you read one of our books or white papers about one of our funds or strategies, you called us, you did a due diligence meeting, you came out to Manhattan Beach, we went and had a coffee or margarita, you did all your due diligence, you read the prospectus, which no one does, you did all this, and then so you say, I'm gonna buy it. And then I say, okay, and then what? Right? Most people say, I'm gonna buy it, and then what's the plan then? Like, I'm going to see how it goes, right? We hear that all the time. Hey, Matt, I like your fund, looks great. I'm going to buy it, and we'll see how it goes. I mean, like, what the hell does that mean? What do you mean, see how it goes? I'm going to tell you what that means.
We've had people too that are like, you know, put us in like a horse race. They're like, we're going to put you against this other manager for 1 year, and whoever wins, we're going to go. So people do that kind of stuff all the time.
That reminds me, I need to write that down because that didn't make it into our piece, and I need to add it because we don't hear this as much, but we still hear it. Say, hey, Meb, we're going to buy SYLD in cows, and we're going to compare you to these two. And I go, okay, and we'll reevaluate in a year. And I go, just to be clear, in a year from now, you're going to add to the one that underperformed, right? And they say, no, what are you talking about? I say, well, 1 year, like what could you possibly learn from 1 year? We recently had Ken French on the podcast, and he's like, he's got a great quote. He's like, 1, 3, 5, or even 10 years, anyone who tries to draw any inferences from 1, 3, 5, or 10 years from an asset class or an active strategy is insane. Who bases their decisions on more than 10 years? Zero people. Zero. Like, I've never met any advisors like, you know what? So anyway, here's what the document does. It goes through 4 things. It says, all right, 1, nobody has an investing written plan. None. So we do polls and no one does. We say, write down your plan. Doesn't matter what it is. Just very simple. Write down what you expect your plan to be. You're going to buy one of our funds or buy whatever, some ETF. Write down why. Doesn't have to be complicated. Just be like, here's why I'm buying this fund. Is it a Lego building block, in which case I'm going to sub out something in my portfolio in hopes that I think this is going to increase return or reduce volatility, right? Like, is it going to be a diversifier? So I'm going to write down why, you know. Or B, is it a totally new asset, so not a sub building block, but something totally new? I'm adding private farmland. I'm adding trend following. But why am I adding this, okay? And then what are your expectations? Okay, I expect this to have the same returns as the S&P over time, but similar volatility, and I expect it to, however, diversify usually in the bad times, but maybe not always. And I expect that this fund could go 3 years in a row underperforming the S&P. I expect that it could go an entire decade absolute underperformance and still be a viable choice. Whatever it is, write it down. And then next is like, how long do you plan on holding this? Like, what is your measurement period going to be? And how do you think about rebalancing? And eventually, how do you think about selling it? And I guarantee you no one's gone through this process, because if what they say and what they do is always opposite. I say, I'm process-based, not performance. And that's always true on the buy decision. People do make that. They do their homework on the buy. But on the sell decision is only one criteria. Did it outperform or underperform some arbitrary benchmark or your neighbor or what your client's complaining about, right? Because in many cases, it's like playing poker or blackjack, right? It's like, did you make the right decision ahead of time? The outcome, in many cases, is completely random or unclear, right? And so this document, I think, is a helpful. It's I think going to be, as with many of our views, non-consensus and some of the ideas about how to work through some of these challenges. This is a really long-winded deviation from your original question: is how do we get people to behave? I think the first is studying history and having some expectations about the markets as well as the strategies. So understand how crazy markets have been, understand how crazy strategies have been. And I'm not talking about for the last couple of years, the last 100 years. And even then, understanding 100 years isn't that long of history. And then putting it all together into a portfolio and trying to understand, how these pieces fit together and what the expectations are. And we have a long description. And so part of this is from Vanguard and others, where it's like, even if you pick a kick-ass active manager, guess what? They're going to underperform like half the time. And probably underperform, numerous years in a row. But how many people expect that? All the surveys we do say, hey, I'm giving someone 0 to 3 years, and then that's it.
Meb, these 30-minute conversations are kind of tough and they're tight, but
we had an hour. Come on, guys. I was just warming up. You said we got a tight three-page question document.
Well, that's why you're coming back on excess returns soon for us, hopefully. But in 60 seconds or less, sort of the final closing question we're trying to ask everyone is, what is one interesting thing you're seeing right now that others should be paying more attention to?
We have an entire Twitter thread on things that we believe that no one else believes, and we're up to about 20 right now. One of those, which I need to add.
How do we have a very broad-based portfolio without having to pick, a handful of stocks that outperform? The view of a safer market perspective is, let's get rid of stocks that we know are systematically doing the wrong thing on behalf of their owners and focus on the remaining stocks in the marketplace. The other thing about these companies, not just do they underperform, but in the classic portfolio construction arena, we would think, okay, well, maybe these stocks underperform on average, but they have redeeming features that when the market really sells off, these types of stocks hold up well or provide some risk attributes that are favorable. If we look to the next page, in general, these stocks are really bad from a drawdown perspective. Regardless of the factor, these stocks almost uniformly, consistently outdraw down the market or have greater drawdowns in the market through time. So even though they're getting lower returns, there's really not a lot of redeeming facts from the perspective of, well, maybe during a really bad time, these are okay stocks to own because you're earning lower returns on average, but they make up for it by saving your bacon when the market sells off. So these are just, in general, really bad stocks to have in your portfolio. And so when you buy an index, you're getting all of these. And it's what we call the passive performance tax. You consistently are over-investing in companies with really poor stewardship properties. So if we take the market and we bifurcate it just on the basis of stewardship, good stewards and bad stewards, we see this next chart here, which is really kind of nice. It shows very consistently, just regardless of whether stocks are over or undervalued, just focusing on companies that are doing the right thing on behalf of their shareholders, that's the blue line, they tend to do a nice job outperforming the market. Not only do they outperform, but they do so with a lower beta, generally lower standard deviation. So they have a lot of nice attributes that lead to what we would consider to be a safer market than buying the black line, which is the market. And then overall, that red line, which is the stewardship fails, really do a poor job in terms of protecting your wealth and growing your wealth. They significantly underperform. They have higher drawdowns. They have more volatility. We believe you're just much better off if you want a broad portfolio. Just think about excluding them altogether in your portfolio construction process. So we can take this one step further and start to think about you know, great companies don't always make great investments because they may be overvalued. So that's the last step of the puzzle in creating a safer market, is putting some potential guardrails in place to avoid really overvalued stocks at points in time. And the interesting aspect to this, again, is when we started our company in 95, we really didn't want to deal with the aspect of multiples. We wanted to have an entire look at the intrinsic value of the firm. So whenever we think of valuation, we don't think of cheap or expensive. We focus on the concept of, is the fundamental worth of the company more or less than what the market's paying for? So on the next slide, what we see is we just basically took the Russell 1 through time and segmented into the 30% most undervalued stocks and the 30% most overvalued stocks from the perspective of intrinsic value. And there's a couple interesting points here. One, intrinsic value by itself, regardless of whether a company management is doing the right thing, does a very nice job segmenting the marketplace. Undervalued stocks significantly outperform overvalued stocks. And while the intrinsic value as a metric did well when traditional value did well, when cheapness or multiple stocks did well, when you incorporate all the aspects that lead to understanding intrinsic value, profitability, growth, risk, and competition, what we see is during this period of the last 10 years where value investing sort of stumbled, intrinsic value was able to continue identifying what we think were really interesting investment opportunities. I mean, in a number of our live portfolios that we were delivering as model delivery products, it's owned Alphabet, Apple, Meta, going back to the early 20 teens. So even though they traded at very high multiples, they were fundamentally undervalued relative to their intrinsic value properties. And so again, similar to stewardship, intrinsic value has really nice attributes with respect to drawdowns. The most overvalued stocks have horrifically bad drawdown patterns. So even though you have these overvalued stocks, you're not necessarily getting compensated ever for owning them. You know, some folks would say that's mispricing. We like to think of it as these are just risky stocks to own in your portfolio. You're accepting risk that you're never going to get compensated for. Never is a harsh word, but rarely are you properly compensated. And over the long run, it's really worked out to your disadvantage to own overvalued stocks. So the second piece of the passive performance tax in terms of our research framework is that passive investing systematically overinvests in overvalued stocks. And again, in the same way that Warren Buffett always says, in investing, you get to be a batter that goes up to the plate and you don't have to swing until you get the right pitch. As an investor, you don't have to take all stocks that are public to own what we think is a superior market index. You can take the stocks that are being managed and run in your favor and give you a favorable risk return profile in terms of when you buy them. So when we put it all together, what we end up with is what we call an intrinsic value stewardship portfolio. The theory behind it is on the next slide, which is it's a broad cut from a valuation perspective. We're eliminating the 50% most overvalued stocks along with the stewardship fail stocks. And it's done a very nice job relative to the overall market. Low tracking error, nice alpha, similar beta, similar standard deviation. From our perspective, it's just really solid blocking and tackling to get at the problem of how do we own a big, broad, diversified portfolio of hundreds of stocks, yet still get alpha. And so on any one year, this last chart here, the next chart rather, is what we like to look at in terms of, we call it a consistency chart. And it basically looks at over different time periods, how does this type of a approach work? Well, in any one year, the batting average to this strategy, this process or this framework, this thought process to own and construct a portfolio is about 66%. But the longer we stay with it over different rolling time periods, the better and better the returns get. So in one year it's 66, It goes up into the 80s by 3. It's in the 90s, 95 by 5, and by 100, by 10 years, you've basically achieved 100% 10-year rolling outperformance relative to the base index with similar underlying volatility and risk characteristics and a very high information ratio. So we think this is a really unique approach that kind of takes all the strengths that we do as a firm. We're a very quantitative firm, but we spend a lot of time fundamentally analyzing data at company specific levels. We've maintained a very unique custom database of fundamental data for the S&P 500 since we launched a product dealing with the S&P 500 as a universe almost 20 years ago. So it's very unique, the combination that we have of fundamental and quantitative, the way we've really done a nice job combining the two to clean up data, move data from accounting to economics, and then lastly, avoid a lot of the problems that most valuation suffers at the hands of qualitative opinions from analysts. And one of the things that I think is so interesting about valuation is you have a lot of valuation experts out there, but if you ask them to demonstrate to you or prove to you they actually know what they're doing, they can't, because they don't have any data to consistently show. If they say a stock is overvalued, the market moves up to that price. If they say a stock is undervalued, the market drops to that price. We had a group of academics study our intrinsic value back in the 2000s from Michigan State University. And what they found was, after controlling for umpteen other factors, prices tended to converge to the applied finance level of intrinsic value at the rate of about 15 to 25% a year, which we thought was really satisfying in the sense of getting a third party to take a look at the efficacy of our intrinsic value and sort of risk adjusted and factor adjusted and reach that conclusion. That was a really gratifying academic result for us over time.
So when we looked, like people like me looked at value in the past decade and looked at it as cheap relative to growth because of spreads, I'm assuming your system did not agree with that, right? Your system was looking at intrinsic value and was saying, all right, maybe there's something going on with these growth companies that makes them warrant that higher valuation, and so it's not as cheap as someone like me might think.
You're absolutely right. I think it's funny, when we talk about one of our strategies, we have a slide where back in 2011 we were considering two stocks. We were considering Alphabet and Tupperware at that time, and when we looked at those stocks, Alphabet was trading at a 50% multiple premium to the market, and Tupperware was trading at a 35% discount. And then you fast forward from 2011 to 2019, Alphabet's premium grew and Tupperware's premium shrank. And yet, from an intrinsic value perspective, in 2011, Alphabet was undervalued, Tupperware was overvalued. In 2019, Alphabet continued to be undervalued and Tupperware continued to be overvalued. And the key difference there was Alphabet was an incredible wealth creation machine. They were earning 7, 8, 9, 10% spreads above their cost of capital, reinvesting in their business at 10, 15, 20% a year. That compounded wealth continued to increase their intrinsic value over that entire time period over the last 10 years. And I think the question you mentioned is really fascinating in terms of, what we think are some things to look out for and be aware of in today's marketplace that maybe other people aren't thinking about the same way we do. And this whole notion of the value gap, I think this became something that really came into prominence right before COVID and has sort of persisted since then. A lot of folks have been making a lot of noise about how attractive value stocks were relative to growth. And so this is a simple chart that we created to highlight kind of what's happening to growth and value portfolios from the perspective of economic profitability as opposed to just simple accounting profitability. And what I think is really fascinating here is when you go back to 2000, in the 2000s, when we had the second most historic value gap that people talk about. Today, they say the value gap was higher than it was in 2000. Well, what's fascinating about 2000 is that if you look at the chart on the left, the green line depicts the economic margin, which is kind of the economic ROI of the firm minus its cost of capital. The green line depicts that average economic margin to the portfolio of value stocks. The red line depicts it to the portfolio of growth stocks, and the gray line is the market. So in 2000, what's really interesting is you were buying value stocks with relatively similar profitability to growth stocks. Growth stocks had a little bit higher profitability on average, but for the most part, value stocks were really profitable on a relative basis. And yet you had this massive divergence in their multiple. And when you go back to what is intrinsic value is the present value of future economic profit and growth in those economic profits discounted to today. Value and growth were starting at very similar periods, yet their multiples were wildly different. Today, we're at a point where growth stock profitability is slamming value stock profitability. So yes, they trade at different multiples, but unless you take it all the way to understanding intrinsic value, what we see is that value stocks should trade at a significantly higher multiple because they're so much more profitable. And I think that's whenever you compare multiples through time and you're reaching a conclusion about today, your underlying assumption is that everything is the same. And more often than not, that's not the case.
That is a very interesting chart and very eye-opening when you look at those types of profitability spreads. Rafe, I know most of your business is done through financial advisors, but obviously individual investors can buy your funds or purchase your ETF. Actually, I think your ETF just hit its 3-year track record, right?
That's right. That's right. It did. Great. It's performed. It basically is the first implementation of this safer market set of principles, and it's performed just like it should. I think it's outperformed its index in the Morningstar universe by approximately 150 basis points a year after fees with lower volatility, which is exactly in line with the research.
Mm-hmm. If people want to learn more about applied finance, where can they go?
Appliedfinance.com.
And you are on Twitter. Try to find Rafe on Twitter handle.
It's hard to do. If you like to follow esoteric finance references and a lot of cooking pictures and food pictures, R. Resendis at Twitter. At R. Resendis is my handle.
Yeah, great. Thank you for coming to the table so prepared. You made this discussion super easy for Jack and I. Sorry about the presentation sort of thing, but
that's my fault. And thank you guys. What a great cause. Thank you for having me be a part of this. It's really an honor and it's fantastic.
Thank you, Rafe.
Thank you guys. Bye-bye.
Bye. All right, let's get Brent back in here.
Okay.
Brent.
All right, fellas.
We are,
you guys got to be.
I was being a tech ninja in like 2 different directions at the same time, like sharing a presentation while also trying to get the feed, which was down, back up with my other hand. But I believe we've accomplished that, Brent. Correct?
We did. We're back up on Twitter. They have a 6-hour limit, which we thought we could get around, but we didn't. So maybe next year we'll get the budget to.
How much of did all that get recorded?
No, just a second, basically. I just had to stop it and restart it.
Yep.
Cool.
All of it is on. It's all on YouTube. Everything is recorded there. So in case you missed a little segment of our last guest, then please make sure you check out the YouTube channel.
Right. Should have just been a few seconds. So
awesome, guys. Okay, I'm gonna let you guys go.
All right,
Good luck.
Cool.
Yep.
Thanks,
all right,
Justin.
Brent. I will get out of here and I will let Samantha in.
All right.
Hey, Brent.
Samantha, hello. How are you doing?
I'm good. Let's get you over here so I can see you better.
We have one guest that is sideways.
Say again.
I said we have one image of a guest that appears to be sideways, but we will move along at any rate. I'm super excited to talk to you. We did a fantastic interview. It was over a year ago now, which is kind of shocking to me. But before we get started, why don't you give everyone a little bio on yourself and let us know who Samantha LeDuc is.
All right. Well, thank you for the invite. I think it's fabulous. And yeah, we did have a webinar. I think it was right before the August swoon. So this is a good time to freshen up. I'm Samantha LeDuc, founder of LeDucTrading.com. and I'm a macro to micro strategist. I also run a live trading room for those who are active traders, not just active investors. And we use a macro backdrop to also identify with lots and lots of money flow options as well for lots of tactical trades and sector rotation, as well as some calls on volatility. I share those insights with clients from retail to institutional and can be found at LeducTrading.com.
That's awesome. And what I love most about talking to you is you make your views very clear and concise. No beating around the bush. We know how you stand, and that's awesome. You back it with data and years of experience and everything. And so I really have enjoyed our conversations and your Twitter feed as well. So for this conversation, we're going to do an interview. Do you want to share some screens, a little bit of both? What would you prefer to do?
A little bit of both is fine. We'll just where it goes. I
Excellent.
will give you my rundown, and if you prompt some questions, I'll bring up some screens.
Okay, fantastic. So we are obviously, as we've talked to some of the macro strategists, a couple of traders that we've spoken to so far this morning. Obviously, we have the Treasury announcement yesterday, follow-up Treasury announcement tomorrow. We have the big FOMC day. And your sort of stance, if I read this correctly, is that we're in a topping phase, I'll call it. You are trying to target out a top here. So as we head into this, is this the critical kind of pivot point? Do we need to have things play out a little bit more before we possibly pivot and have confirmed a top? Why don't you kind of lay out where you think we stand and what you think we see over the next couple of days here?
All right. Well, the days, it depends on the time frame, right? So when we actually spoke right before the August 1st QRA, I was very bearish, right? I was stalking a market top. And obviously it's not the top. It just means equity correction. So that did come to fruition, right? We pulled back August,
Indeed.
September, October low of about 4,100. I was shooting more for 4,000. It's not a game of perfect. Then November 1st, we got the Fed pause and what I call affectionately the Yellen Yahtzee, where instead of issuing more longer duration notes and bonds to fund this growing fiscal deficit, on November 1st, she issued the shorter duration, bills, which is basically liquidity infusing. So we actually get not only the Fed pause, which is bullish, and later pulled forward kind of 3 rate cuts into 2024, but we also got the Yellen Yahtzee, which was lots of liquidity versus the opposite, which is more of what we had on that August 1st delivery. So November 1st, it definitely not only excited the bulls because they still had that backdrop of AI, but they had a lot of shorts to cover. 3 months of built up shorts. We're not in that situation now at all. We do not have a large amount of shorts that need to cover. We also have a very different backdrop. We're at 5,100, not 4,100. We have absolutely had reaccelerating inflation versus back then. The big change actually was November 14th, was after the November 1st Fed pause Yellen Yahtzee, where we had the CPI show that we had decelerating inflation, which was this beautiful deflation impulse that also got the Fed cuts pulled forward. So we had that kind of trifecta of monetary with liquidity with short covering, and off we went to the races. This is obviously what propelled us higher through December, January, and even in February, because I had done a Bloomberg and a Market Watch thing going, I really see this market widening, broadening out. It's not just going to be the NASDAQ 1999, or maybe 1995 if we really get some IPO excitement and such. But it looks like that the market's going to broaden out until March. Everything petered out. It just started. Retail started falling off the cliff, and that call had to be pulled back. And then a lot of my intermarket analysis is very much focused on dollar, yields, breadth, volume, not just option flow, quants, and the rest. So March, I started to get really worried. And I'm like, you know what? My call for 53.40, which was my SPX call, bullish call for the year for 2024, I came close. But we didn't tag it. We started rolling over underneath the surface. There was net selling that was picking up. The breadth destruction was very clear, both in NASDAQ, not the leaders, but underneath the surface, and NYSE, which is a larger kind of way to, assess the market. So we basically had a lot of breadth breakdown and net selling underneath the surface that made me kind of pull that back and say, you know what, I think we need an equity correction. So we definitely had a string of outperformance, right, from that November 1st short covering rally right up until March 1st. And I mentioned March 1st because gold started spiking out higher. And I wrote on Twitter, thank you very much for the kind of succinct summary. I basically said, this is gold telling NASDAQ the crash up call is done. I might use different words, but the point was they were going to have to slow down. And NASDAQ literally stopped going up on that day. And so March 1st, gold took off like hot fire flames. Silver followed later. We had a beautiful squeeze in late March. Now that was all, excitement because, China is hoarding gold and they're basically, it's the new risk parity trade, long gold, short bonds. So by many estimations, and I'm very blessed that I work with two gentlemen who are macroeconomic wonks. I mean, they're just brilliant. And it was really this whole concept of the new risk parity is long gold, short bonds. So we had this very strong rotation into higher yields, higher dollar, and higher gold. Gold being the tell that NASDAQ was not going to run higher at that moment. And we have obviously fulfilled that, right? We've gone sideways to lower in equities. And then after a 3-week pullback, and it was very, very strong, right? So on April 4th, we had our first 2% intraday drawdown in the SPY. It was negative 2.07%. Otherwise, we have not had a 2% pullback during regular trading hours for, 150 days more, right? So it has been bid. But I noticed, following options, that trifecta of selling puts, buying calls, and selling calls was petering out. So not only was the intermarket stuff saying dollar was going to spike, yields were going to spike, net selling was picking up underneath the surface, the breadth was breaking down, but the options market was also at risk. So it was good to kind of time that 3-month pullback, a 3-week pullback of late in April, at which point we're always going to have these reflexive bounces. And that's what we're in right now. So we've gone from, 415 in NASDAQ, QQQ to 430. I still see a gap above that's going to get filled, about, 445. So I can see 5,200 coming back into play for the S&P. But I really think that that's just an oversold bounce to kind of relieve that excitement of the reflexive bounce. And then I think we're going to set up for more continuation selling after that. That's my baseline bet right now. Short term, we're halfway in this bounce. Let's get to those levels, and then I think we're going to start hitting selling again.
And you think the clearing kind of the FOMC, I think odds are generally betting that nothing big comes out of these FOMC events and you get a little event vol crush. And is that kind of the fuel to lift things up? Do you think that 5,200 comes over days, weeks, sort of?
I think a lot is going to depend. Honestly, right now, the Treasury, the QRA, the composition is not known, but the amounts are known. There was a bit more for Q2, but there was a lot more issuance that's needed for Q3. That was a big surprise. So it always comes down to the composition. We'll know that 8:30 tomorrow morning. And then, of course, the Fed does its announcement, and it's not expected to hike or cut. In fact, it's very, very slim pickings for a cut when there isn't consensus on the committee and when there is obviously reaccelerating inflation. I think right now the market kind of knows that. So eyes are now off the prize of, we know what Treasury, for the most part, not necessarily how many, the composition of the bills or bonds. That's definitely a concern, not just for, between now and July, but especially in July. but we've already kind of assumed that Yellen is political, that monetary dominance has shifted to fiscal dominance. There's definitely a politicizing of the Fed and Treasury in an election year. So I think because the cuts have been pulled back out, right, because of this very sticky inflation, wage inflation was reported this morning, and it's definitely outpacing productivity. Bonds hate that, by the way. Yields are a real risk for moving higher. So it is more than just, the yen carry trade unwind or just the composition of how Yellen's going to, finance the fiscal spending or the excruciatingly painful increase in fiscal deficits that have now interest rates that are really going parabolic. It is the fact that that Fed cut expectation has been pulled out.
Mm-hmm.
So now bulls are betting that we're going to have a really strong earnings season after season after season. In other words, the expectations are going to be that because of all this fiscal spending, we're going to have continued economic growth. We're going to have continued earnings delight. But the disconnect is where they think the Treasury financing of this, fiscal spending and also this fiscal spending is going to somehow lower yields. And that's where I think they're dead wrong. So I really have a backdrop that before, right, after that November, December, January timeframe where it looked like the market was expanding underneath the surface, and then everything stopped at the end of February and into March, gold shot higher. The breakdown started happening underneath the surface. Yields started percolating higher again to that 4.7. That's it. All bets are off. Now, I'm stalking a market top where we have this disappointment because the whole bull thesis is based on earnings reflecting economic growth, while Treasury and fiscal liquidity is somehow going to force yields lower. That's the disconnect. I mean, that's the disconnect. So for me, I see that we're going to have some disappointment as it relates to yields moving much stronger, which is going to put the bulls on the ropes as it relates to their main thesis that earnings have troughed and are moving higher.
The earnings part is extremely interesting because, as you mentioned, markets have been handling the reduction of the rate cuts, right? Like we were pricing in 6, now we have none, who knows what's going to come. But S&P is only 2-3% off of all-time highs.
Yeah.
And one of the things I found was interesting, as you mentioned before, was sort of like, look, semis and AI is going to save the world. That was the trade that we could all latch onto. And earnings kind of mixed so far. I was just looking at Microsoft actually, which had a nice pop, I think 6% after earnings. It's now down below 400. Google's still holding on. We get Amazon tonight, Apple obviously, AMD, SMCI. So I think that earnings as a catalyst narrative, we can really start to pull a lot of that information out today with today's numbers, and then obviously people are hanging on that Apple, hanging on Apple in a couple of days as well. So. I do take your point that if we don't have great earnings or some sort of real catalyst here, then what as a bull do you start to latch onto?
Yeah, basically stimulus, fiscal stimulus that is an economic growth engine, but it has diminishing rate of return because all the interest payments are still a big nut to crack. And basically we're going to have continued rising term premium and interest rates until they can get control, which means they stop spending. So we'll, for the most part, kind of have to look at earnings from a different standpoint as well than typical, which is right now the cash, right, that would be very, very instrumental to stock buybacks on balance sheets of a lot of earning companies is now being transitioned to CAPEX. So this is really actually another little headwind. We'll have to see how that plays out over time. But in the past, it really, it was a destructive use of capital to speculate. Now we actually have to get our act together as it relates to competing on the global stage. And we're really going to have to invest a lot more in everything. So issuing, Amazon leaked that they're going to issue some dividends might not be such a bullish backdrop given all the spending on CAPEX that they have coming down the pike. But earnings aside, the bulls are really, really expecting, what are they expecting right here? 20% EPS acceleration between Q1 and Q4 this year. So that's based on really strong economic growth. and I have, my intermarket tell says, that's going to be really tough. And my ratio analysis says, wait a minute, we're really actually lower than we were in November 2021 when we had all that, QE extravaganza bid up earnings and stocks. So I think we actually have a good test coming with this kind of, I don't want to call it liquidity air pocket, but you can see Bitcoin's losing momentum. You can see since March, NASDAQ has been losing momentum. The MAG 7 has actually started to lose momentum, but the breadth underneath the surface hasn't picked up as we need for this continuation bull market.
Yeah, and as we talk here, Bitcoin just above the 60,000 level. So that's
I'm short Bitcoin, long China. So that's a thesis right now. As well as I still think gold miners, silver miners are going to do well. Even though gold and silver right now are digesting while yields are moving higher, which was actually a baseline thesis a few weeks ago. So we were really in that trade early. So liking miners, definitely liking China over NASDAQ right now, and not Bitcoin because it's too much of a speculative asset when it comes to higher yields. So if my whole baseline bet, long story short, is that I see higher yields, and I've placed this in a year in advance, right? So a year prior to October of 2023, I said I see 4.7. We hit 4.7. We actually overshot to 5, right? Before we actually got a lot of intervention on that November 1st time frame in 2023. But same thing, expecting a pullback into that 4% area, and then I see it going up to 5.3 for the 10-year. Once we get above 5.3 on that 10-year, we're going to be very quickly accelerating to 6.5%. So every year I give like my next, as far as interest rate targets, and so far they have been really spot on year after year after year. So I am still very much an inflationista, for lack of a better term, and a rate bull. And that, I think, is going to start to challenge some of these earnings assumptions, which right now haven't been challenged because they have been beating, obviously, on a low bar relative to 2023. But they also have had a backdrop of still plenty of, Fed put, Treasury put, and that might change as we get closer to the election. And we definitely have some risks that the intervention tricks are failing. They have a diminishing rate of return.
Right.
So I think we're going to definitely get tested this year.
Yeah, I agree with you on that. That things seem to be sniffing out. That just statements don't have the same impact that they used to. I think you could kind of jawbone assets around, but people are starting to sniff things out. And on the earnings front, I just think that this market still very much hangs on NVIDIA. And so I think that people will be willing to look past a fair amount of, neutrality in earnings growth. If NVIDIA comes along and look at the AI story is super strong, and we made another, whatever it is, $500 billion in the quarter or something. And that may invigorate things. But at the same time, if you do look back at mid-March, it was NVIDIA earnings and then the NVIDIA GTC conference that really smashed semi-skews, and that really stopped the ball from rolling forward. And it's hard to regain that momentum, particularly with the macro backdrop that you outlined. Now, if we do get the 10-year or yields moving up as much as you said, I mean, what does that do for equities? I would have to imagine that you would view equities as having to be material lower, but correct me if I'm wrong there.
Oh, no, 100%. I mean, unless they come in with some, intervention, which is always what I look for, right? When yields get too hot, I am fully expecting intervention. And we had that, spot on when term premium spiked, 10-year went to 5%. And then lo and behold, Yellen came in on November 1st and really said, no, we're going to issue lots and lots via bills, and Bank of Japan also came in and did their intervention. So that kind of coordinated effort wasn't the same energy as October of 2022. October of 2022, we were in trouble. The gilts had blown out. Bank of Japan did its first, major yen intervention in 24 years, and basically the 10-year was spiking at 4.33. That was the level that was causing equity disturbance. And so a central bank global coordinated effort. Later, Matt King from Citibank said it equated to about 1.5 trillion. That is what I mean by intervention. We got it in October of 2022. We got it again, a bank backstop in March of 2023. We got it again November 1st of 2023 with the Fed pause and Yellen Yahtzee. So those are events where it is absolutely not productive to short. When we get into these higher levels where bulls are very long, quants are very long, CTAs and such, we don't have high levels of short. We have to look for a top margin debt to cash ratio. Again, breadth breakdown, and of course everything that happens underneath the surface with the Treasury market, and why gold is moving strongly higher, which is of course risk off as it relates to U.S. Treasury holders as well as dollar holders. Even though dollar has moved higher, it's in large part very strong to competing currencies that are devaluating in a competition to support their local economies, but it's very, very weak relative to hard assets. So, parsing some of that stuff out is part of the job of looking macro to micro to then find when we're going to have some good selling under the surface and the breadth breakdown, which we had really strongly during March, and then it fell apart for a few weeks in April, and now we're having a reflexive bounce. So after this bounce exhausts itself, I think in that 5,200, 445 area, we can short again.
Yeah, I'm with you on the reflexive bounce. I mean, to your points before, there was a lot of just oversold indicators, put levels, and put to call ratios and different things like that. I want to ask you about the yen, which has been moving a lot. I know that's something that you covered. We're currently at 157.6. We touched 160 before things kind of reversed rather violently with the intervention. This is not a space I cover, but I definitely want to get your views on it, as I know a lot of people are talking about that. What can we take away from this? What's happened over the last couple of days? Got any insights for us there?
Yeah, I think Japan, by the way, is liking this yen drop or devaluation, because the companies that benefit the most are the 5 largest trading houses, for example, of Japan that deal in commodities. The tourism business also really likes it. It's a way to compete with China. And it's a way to basically handle the higher yields that we have right now in the U.S. and the dollar strength. So I would say that they're okay with it. In other words, the yen falling, and the intervention that happened on a Sunday night in thin liquidity markets on an evening of a Japanese holiday isn't really yen intervention. So. And you can kind of notice that it didn't last very long. 160, 155, it bounced right back up to 157. So it's really not going to stick. It feels like they could do another one tonight, by the way, but they need some help. It isn't just enough for them to intervene. They really are not going to, I'm going to say this the wrong way, but I mean, they're really not going to get the job done unless it's coordinated with the U.S. So, and that's all there is to say about that. It really has right now a very, very strong chart read until much higher. So anything above 152, where they promised repeatedly to come in and tap it down. They did it in October again of 2022 and October of 2023. Now that is solid support for a much higher move. So the intervention has also diminishing rate of return, and the impact of that is a slow unwind of the yen carry trade, which is very, very supportive to higher interest rates here in the U.S. So that yield differential is between their 30-year, our 30-year, our 10-year, their 10-year is very predictable. So you can kind of from an intraday or a day or a week time, it doesn't matter. You can see the correlation is so strong with our 10-year yield. So I would say this is, for right now, short-term beneficial for them. For the reasons I just talked about it, right? Their commodity houses are making lots of money, of which Buffett is.
I was going to say it's the Buffett trade, yeah.
He's trying to bring it to 10%, and Elliott took a stake in one of them. They're benefiting from higher from this whole inflationary move of and deflation of the devaluation of the currency and inflation backdrop. They're printing money, but it will get to a point where it starts to unwind. And that will be very supportive of higher U.S. yields. So that's the risk. But that's a slow, then all at once kind of thing. It's very tough to time.
Those are really interesting insights, particularly linking those to the carry trades. As we got about 5 minutes left here, one of the things we've been asking our guests is kind of the one thing question. If you wanted to highlight one signal, one indicator, one idea for traders to look at, could be investment linked, or maybe even something slightly outside of investment arena. What's one thing you could flag for us to say, hey, everyone, pay attention to this over the next couple of days, as this will really kind of be a nice signal to kind of guide us over the next couple of weeks, let's say.
Goodness, I do this intermarket analysis, which is really cross-asset comparison, contrast, to see where there are divergences or strength, weakness, and sector rotation. Also volatility, when we're getting to a point where it's definitely looking very robust for a shakeout, up or down, by the way, because that's kind of the thing, right? You want to, for me anyway, I want to time sector rotation. Money is always flowing from one sector to another. Banks to tech, or growth to value. The point is, it's in lieu of sector rotation, there will be volatility. So when I start to see that there's no leadership, then that's the worry point. And then I know that the next level that's going to get hit out of sector rotation comes volatility. So right now, I have a growth value rotation ratio that I follow. I have a dollar yield ratio that I follow. And those are my two kind of go-to indicators that help me time and position for clients that energy, if you will. And I would say the biggest threat that I have right now is that dollar yield indicator that is moving higher, and it's in danger territory. So that particular indicator is basically flashing that it's not done going up. And that is one of my reasons for being strongly bullish the 10-year yield, bearish bonds. And I'm not talking about this week or next week. I'm talking about, for the next few months. And that was a surprise to me, because I actually didn't think we were going to get this higher 10-year yield until Q4 or Q5. It was pulled when I made that call last October. Okay. I really didn't think we were going to get this until the end of the year, toward the election. We got it way early. So that just, to me, it is a sign of how fragile the market is with all the other indicators. But that dollar yield one is percolating very strongly, and that says caution. That's my biggest tell right now.
Wow, those are some extremely interesting and unique insights. I learned a lot, and can't thank you enough for joining us. If people want to find out more from you, where can they reach you?
Website is LaDukeTrading.com, LADUC. Samantha LaDuke at Twitter, as well as Substack. I just launched a Substack recently. So
okay.
I've got those kind of three main points. And I'm not alone. I have a trading desk of 10. I have two hedge fund managers, Craig Shapiro and Jeffrey Fouvre, who are brilliant. One is a kind of a modern day hedge fund manager. The other is a classical economist. And then that's for our edge product. And then I have a club product, which is very much for kind of intermediate level savvy traders and investors, more active. And I run a chase, a swing, and a trend portfolio. And we go over all this stuff in the live trading room. So I have a whole bunch of excellent contributors. And it's a lot of fun working together and collaborating and finding things that I would never find on my own, and asking questions with a different perspective and getting that tested all the time.
Right.
So it's very profitable.
Takes a team, as they say.
It does. At least I like working in a team.
Yeah.
There's no question about it. We're doing good work for clients, and you can find me there.
That's awesome. Thanks so much. And if you enjoyed our conversation with Samantha and some of the other conversations we had today, please head over to youtube.com/SpotGamma. There is a donate button there, and that will allow you to donate to the Susan G. Komen Breast Cancer Foundation, which is a wonderful charity that we're working with here. Hopefully trying to do some good, as the PNL for Purpose title suggests. As we look to raise funds for charity. Again, they do that in association with Simplify ETFs. You can also look up the Pink ETF, and proceeds from that Pink ETF, or fees, I should say, do go to the Susan G. Komen Foundation as well. Next up here, we have Wes Gray, the Alpha Architect. And Samantha, I don't know if you've ever seen the Box ETF. It's one of my favorite ETFs.
I really thank you for doing this, Brent. Excellent cause, and I appreciate the invite.
Yeah, absolutely. Anytime, and I look forward to speaking to you again soon, Samantha.
Cheers. Bye.
And so, all right, Justin and Matt, you guys are here.
What's up?
For a conversation with Wes.
All right.
Yeah, and I'm looking forward to listen to this conversation myself. So I will pass the baton over to you guys, and I will see you. Actually, I got a little break now, so I'm gonna give my vocal cords a rest.
Hot tea,
Nice.
Brent. Hot tea.
It's not a bad idea.
Justin, it's good to see you.
Nice to see you too, Matt. I see the hair ggets messier and messier as the day goes on.
This is the way it goes. This is the way it goes.
That's when you know it's a good day, buddy.
That's how you know it's a good day. These are facts. This is also how we know we've poorly timed the haircuts. So what?
So it's going good. Let me look at while we wait for Wes here. Who was letting him in? Do you know?
I believe it was Jack, the gatekeeper of all
Okay.
gatekeepers.
Okay. All right. $4,000 raised so far, so that's pretty good.
Awesome.
Getting there.
Hey.
People are stepping up. Appreciate that.
If you haven't yet, if you're on Twitter or LinkedIn or YouTube, we're live in all the places. There's that giving button right there. I believe it is it just below on all the
Yeah, I think it's
all
just below the
platforms,
video.
Justin?
Yep.
Look where it says give some money. Susan G. Komen. This is a really special thing. Pretty remarkable.
So before Wes comes in, I won't go into this with him, but Wes is the reason, Matt, you and I know each other.
I took a screenshot of this and sent you a text a little while ago to just remind you, hey,
That's right.
This is funny, because Wes is the person who said, hey, you don't know this guy Justin? At the time, we were living not that far from each other, strangely enough.
Yep.
He was like, how do you guys not know each other? You got to connect. This is the power of networking.
Well, and that was a really sort of interesting time for you because you were going through the whole transition out of Merrill into Sunpoint and sort of had, gone through the process of figuring out how you were going to unwind and then doing it in all the ways that needs to be done from a compliance standpoint, who you were going to bring, who you're going to hire. I think, Ben coming from Vanguard. So that was, we were kind of a sounding board for each other, I think, at different points, right?
It was super important. It's surreal. I just noticed this. Do you know what date it was? We're 2 years and 1 day off.
No, are we? Really? So it was April 29th?
Time flies when you're having podcast. Yeah, April 29th, 2022 is when we first communicated, traded emails.
Okay. Yeah, that's now here you are co-hosting PNL with a purpose.
That's right.
Your 2 or 3 other different initiatives.
You too, brother. Yeah.
Mm-hmm.
Yeah. So, well, while we're waiting to see if Wes is going to magically appear in the box here, $4,000 so far.
Yeah.
Great to see the progress here. You want to talk about some other fun stuff while we're waiting to see if we have a friend for the next 20 minutes?
Yeah, we could maybe give him like 1 more minute. And if he doesn't come, then we might have to go to our backup plan.
The backup plan. Is this where we do the song and dance routine?
We could, or we could do, I'd love to test I want to test your knowledge of music and the music industry and the business and 80s and 90s rap songs and
oh boy,
all the different things that you know about.
Well, if we have to do that, we'll do something. We'll make sure we have some fun with whatever our surprise filler segment becomes.
I still go back. That was an interesting point that you brought up with the number of like artists and songs hitting, I think like that Billboard 100.
Yeah, there's a wild thing, and it was from this Priceonomics thing. So even if while we're waiting for this, and apparently going to talk music for a second, there was this incredible piece that looked at basically, like in markets, do we crowd out new entrants? So I think about this a lot in terms of startup or venture companies and the whole like staying private for longer, and how few companies for a while there and still now become like multi-billion, if not trillion-dollar companies, and this like crowding out that seems to take effect. And it's crazy because we've seen the same thing in music, and Priceonomics wrote this thing a few years ago that was looking at where did the one-hit wonders go, basically. Like in a given year, we used to have like thousands and thousands of artists competing for spots, the top spots on the Billboard charts. And now it's a shorter and shorter list, which is just utterly surreal in every way. And it's Jack Forehand.
You've got me for a second. You'll have Wes in 1 second.
Okay.
He was having a tech issue, and then my response to him about when to come in auto-corrected to 3 o'clock instead of 2:30.
Oh no.
So he was he's here now though. So the viewers can get rid of me and enjoy Wes.
Great.
A little less music talk, Justin. A little more Wes Gray talk.
I like it. Well, music would be good, but we'll continue that conversation. Wes.
Yo guys, what's cooking?
Hey man. How are you? Thanks for coming on. Really appreciate it. I know we're kind of running a couple minutes late. Sorry about the tech issues and miscommunication there, but all is good, man. Nice to see you.
Yeah, no worries. So you just doing these like back to back to back to back all day, or
12 hours of half an hour interviews. So it's a lot of content, man.
Holy shit! You're a maniac.
So quick intro. Not that you really need one, but Wes Gray, founder, Alpha Architect. I think you guys have about 3.5 billion in direct AUM assets. You also are a strategic advisor to ETF Architect, which has over 10 billion in ETF. What I guess I would call like white labeling assets, if you will. Those aren't assets under management. And you're representing over 50 funds at this point, which it's really been a fun, we're going to talk about that in this discussion today, but it's been fun to see the growth and the success that you've had with both firms. But, ETF Architect is the newer of the two for sure. And just a quick reminder that today's event, and people like Wes are joining us to help support the Susan G. Komen Foundation. It's a very important charity fighting breast cancer. We're trying to get to $20,000 in donations. We're at about 4,000 now. So if you can, and you have the means to, please, kick in some money, donate a little bit. You can donate right on YouTube. So we're keeping it right in the YouTube sort of ecosystem in terms of collecting those donations. All right, so Wes, we're going to talk factor investing a little bit up front, just because we always want to do that with you when we have you on. So let's talk about that. We're talking about value momentum, but let's talk about value specifically out of the gate. I think it's interesting. Value went through a really tough period, especially 2016 through maybe 2019. That was like the value winter, if I had my timing right. But it's kind of come back as of late. Like 3-year numbers on value look good, better. But I mean, what do you think when you think about value investing, your style of value investing over the last 10 to 15 years? I mean, what do you think the biggest lessons are there for investors?
I think it's the biggest lesson that you always reiterate, follow the process and stick with the process. It doesn't even matter what your process is, just identify a process you believe in, follow it, and then focus on minimizing fees and taxes along the way, and it's hard to screw up. But of course, as you know, like any process to include value, that's easier said than done.
You guys run a pretty focused, concentrated version of value investing, but just talk at a high level how you think about building a value portfolio.
Yeah, so it's pretty straightforward. I want to focus on the cheapest stocks in the marketplace because that's usually where a lot of the mispricing and hate and discontent is. And then amongst those firms, all of which, or none of which are going to be beautiful or amazing or, the Teslas of the world. We just want to find those that are the highest quality. So amongst the garbage bin, which ones, got the best balance sheet, best quality of income, are most likely to weather the storm that obviously they're currently enduring. Otherwise, you wouldn't be in the 10% cheapest of stock. So cheapest, highest quality is what we focus on.
Have you, since the publication of Quantitative Value, have you guys evolved your strategy at all? Like we had someone from Research Affiliates on earlier, and she wrote a paper on like avoiding value traps, excuse me, and she sort of talked about that. And I know that you might start with a specific way to select these value stocks, but maybe over time different things can come into the strategy as you look to maybe improve on things on the margin. Has there been any of that with quantitative value?
Yeah, so at a 40,000 foot view, the investment objective is exactly the same. Highest quality, or the cheapest, highest quality value stocks. The mechanics of how we've done that has adapted, where we have actually, we moved towards like a negative screening aspect where, instead of having a lot of filters on the back end, just up front, we avoid like, hey, if you're high beta, if you're low momentum, if you got terrible accruals, if you're extreme on any other value metric, just you're automatically out of the pool. So that kind of gets rid of a lot of the trash up front. And then because we do that now on the front end, it allowed us to simplify the rest of the process, right? So now it's just buy cheap, buy quality. But instead of having like 100 quality metrics, we just have like our core kind of what we call FS score. It's just the 10-point checklist. So fundamentally the same idea. It's just we've simplified and made it a lot easier and I think robust to a lot of like data issues and what have you. But it's 99% the same, I'd say.
When you think about putting together these tools, especially these really focused strategies for allocators, from the allocator's perspective, how do you want them to look at these things you're coming up with, especially focused factor strategies?
Yeah, they're basically, the best way to think of it is through the lens of capital efficiency. Whereas, I could go buy a closet index that's 99% S&P with a little bit of value juice, or I can just go buy a lot of value juice, right? I could go buy 95% Vanguard and 5% Focus, and I could probably, achieve the same thing as a lot of these closet index funds, but probably do it a lot cheaper and a lot targeted. So it's really just a capital efficiency tool where you can get a lot of, value momentum juice from, a 5-10% allocation. Whereas a 5-10% allocation on a closet index, smart beta, whatever you want to call it, that's basically just rebuying the S&P again. It's not doing anything. So that's really what the tool is used for.
If you're going to bottle value juice, do you picture like a 5-hour energy bottle or like an Ecto Cooler juice box? Like what would the ideal wrapper for the physical product value juice be?
I'm trying to, that's a good question. I can't remember, probably like a Monster energy drink.
Like a tall boy or like a Red Bull can?
like a lot of caffeine, a lot of vitamins, a lot of good stuff in there. But it's just, if you pound one of those all at once, you're going to be in for a ride. And some people just, they're not really ready for that ride. I'm on a road trip. I'm pounding a Monster energy drink and living the dream. It's all good, but like other people, they may need to take sips of the drink over a long time period. Concentrated anything factor, especially value, is just not, it's not for the faint of heart. If you care about relative performance versus like say a benchmark.
Well, let's talk about relative performance for a second. Sector, thinking about like sector and getting overly concentrated. How much should investors care about going like, I really like value, but if it all accumulates into, I don't know, the utility sector or something?
Yeah.
How do we think about sector concentrations?
Yes. So I think, we think of it from a long only context. If you ask me about like a market neutral context, I'd have a different answer. But from a long only context, which is obviously what we focus on, and a lot of people do, I think it's important that you go to where the cheapest, highest quality stocks are. So for example, if it's 99 and I'm sector constrained, I don't want to put 50% of my capital in tech when the cheapest tech stock is 100 times PE. That's stupid, right? So, and the reality is that pain, discontent, and hatred of mispricing is generally correlated in industries, right? It just is what it is. So I think there's a balance. Like we have a 20% sector constraint, where I think you want to concentrate as much as possible so you own the value factor as much as possible. But obviously, do I want to put 100% in the energy patch? Probably not. That's even too crazy for me. So I think it's just, it's probably more art versus science, but I do believe that unconstrained to a limit is probably the best way to go if you care about long-term factor premium harvesting. Obviously, if you care about tracking error, then you're going to sector constrain everything to minimize your beta exposure and your sector drift risk. But that's not really the game we're playing. We're doing the 20-year horizon thing.
And you're looking at it from I'm saying the product level, meaning like the vehicle level, not necessarily like the allocator might worry more about their tracking error and things like that, right?
Yes. Yeah, exactly. Yeah, you got it. So our product in particular, in general, well, not just our product, but just focus factors are going to generate a lot of tracking error. And most people, as you know, view these things as silos. So even though they should be viewing them in a portfolio context and being like, hey,
what fun is that though?
yeah, nobody actually does that. But if you were like a rational, like Eugene Fama student that does everything correct and rational, you should only be thinking about what's the contribution of this fund to my overall portfolio risk reward. But that's usually not what people do. So that's what I'm saying. Like these concentrated funds have a lot of tracking error in a siloed sense, even though maybe on a contribution margin it doesn't do anything in the grand scheme of things.
Yeah, just because you picked up the 6-pack of value juice doesn't mean you should pound your way through the whole thing. And I did realize it has to be the tall boy because to fit pain, discontent, hatred, and mispricing onto a can, you need a lot of real estate.
Yeah. You need a lot of letters to fit it on there. You got it.
Shift me to momentum for a second. Momentum is seemingly done not so bad in the last few years after getting a bad rap for a minute there. What's going on with momentum these days and building momentum portfolios?
Not much changes. We're pretty boring, right? Just buy winning stocks. Stocks that are moving, own them. Stocks that aren't moving, get rid of them. And so that fundamental concept still applies and always has applied, and that's what we've been doing. And, obviously it's been working. And, as you get in like super choppy markets with a lot of volatility up and down, momentum, isn't always the best. But, we've kind of been in this general bull market where there's a lot of trends. So momentum strategies have, held up.
When you think about combining, and this probably goes back, this might have even been how I initially found you. I'm thinking of post-financial crisis, the Asnes, Frazzini, I forget who else was on it, the Value and Momentum Everywhere paper. Yep. What are the benefits from your perspective, high level? Why combine value and momentum? Are they chocolate and peanut butter? How do you see this?
Yeah, I mean, whatever your peanut butter and jelly, chocolate, peanut butter, yin and yang, whatever the heck it is, like fundamentally, I just see value as a fear trade, right? You're going to have to buy ugly, nasty things that nobody likes. And I see momentum as the greed trade, like chase shiny rocks and hope for the best. And as you guys probably know, or anyone who knows if they've been in the market long enough, fear and greed tend to kind of be everywhere. And I don't know which is going to be working when the other one's not working. So instead of trying to guess on which one I want to exploit at a given time period, I want to take advantage of fear and greed, because I think fundamentally that's what's always going to be existing in financial markets, regardless of who's playing or what's involved and the level of technology, et cetera.
So I'm really curious, you changed something with the rebalancing process recently in at least one, if not a couple of the strategies.
Yeah.
What did you change and why? We were just talking to Corey Hoffstein earlier about rebalancing, and curious what you have to say about this.
Yeah, so on paper, it's always most factors, if they actually work, they should work better the more fresh they are, right? Like you don't want it to decay in the factor, but that, of course, that's operating in a vacuum, net of operational constraints, net of tax, net of frictions, all these sort of problems. And so, generally what we had done was quarterly, we felt very good confidence. And then now that we run like a massive ETF complex with a lot better technology, a lot more skills, a lot more knowledge, a lot more data, we basically came to the conclusion that we can cost effectively after tax, after frictional costs, after trading costs, et cetera, take advantage of, the benefit of higher frequency trading. So yes, it costs more, but we already knew kind of like the gross benefit. And if we got more confidence and fine tune our estimates of what the frictional costs are, and we feel that the net benefit is positive, we're going to do that. So that's why we've kind of moved it down, from quarterly to monthly across the board. And, TBD, but we feel pretty good that it was a good decision.
And that's in the momentum strategies, or is it in both?
It's in all of
It's in
them.
everything?
Now, yes. Now, organically, obviously momentum strategies just will always have higher turnover because they're just changing more often. Value, as you know, even if you reassess them more often, that doesn't mean they trade more often, right? Because a lot of like the cheap things nobody likes, they just stay that way potentially for years. So even though you may refresh your program every day, you're still going to be owning whatever cheap thing everybody hates for a long time potentially. So even though we've upped the frequency to give us opportunity to change it, to freshen the factor, for value, it doesn't actually make the turnover go up that much. For momentum, it actually does a decent amount. But we like that because momentum is a strategy we already knew you had to trade a lot to get it to work.
Could you just talk about one of the things that you guys outlined in quantitative momentum was consistent momentum was better than volatile momentum. So can you just kind of talk about that concept?
Yep. So there's basically, generic momentum from an academic perspective, like intermediate term momentum, like just say, hey, last 12 months, let's rank everyone from 1 to 100 by the ones that basically did the best, right? That's just generic momentum. But that's just kind of looking at a point in time in what they call like the cross section, like at a point in time across everybody. But intuitively, not just from academics, but like traders and people in the marketplace, well, why don't we look at the path, right? Because, you could have an FDA approval and a stock goes from, $1 to $2 in a day, or you could have another stock that kind of like slowly moves up over 2 or 300 days or 252 trading days and is also goes from 1 to 2. Well, it turns out that kind of smooth, slow moving momentum, like the path of how you got your high momentum actually matters for continuation. So all else equal, we want to stick with high momentum securities, but one of those that have like, I guess you call it smoother, less volatile paths to get there versus, FDA approval yesterday.
Yeah, I find that little interesting concept very intellectually stimulating for some reason. I think it's important.
Yeah, it definitely is. It ties a lot to the theory of why momentum works, and it makes sense to do it that way, which is why we do it that way.
All right, so let's talk about Section 351. Explain to those listening and watching what this actually is.
Yeah, so anytime you quote a tax code, you're going to put everyone to sleep. But Section 351 is basically allows you to fund C corporations with assets without having to incur a tax hit along the way. Well, why the heck would that be interesting in this context? Well, within 351, there's a specific regulation tied to RICs, registered investment companies, like i.e. ETFs. So basically what 351 allows is if you have a pool or a syndicate of like a bunch of people contribute where they have diversified portfolios of low basis securities, they can basically use those securities to seed an ETF. And you can imagine there might be people out there, I got a bunch of low basis stuff I can't do anything with. God, I would love to just dump all this into an ETF so I can regain, my tax efficiency, maneuverability, what have you. And that's what 351 allows in the infrastructure side of things.
And I mean, I could see family offices, that could make sense for, I don't know if there's ownership restrictions but could this also work for like RIAs, like to have clients?
Yeah, of course. We've done multiple, well, actually we're starting to do a lot of these now for RIAs, family offices, anyone that cares about they're managing their taxable wealth in a friendly way. Everyone knows you have to get into the ETF wrapper. It's just a question of how do I do that tax efficiently, but I know that's where my home is, especially with regard to equity or tactical. 351 is just a tool in which anybody that cares about tax efficiency can use to basically access the ETF infrastructure and the wrapper.
I mean, it's huge from a tax standpoint. If you have, very high net worth individuals that you have them in an SMA or something, and there's going to be some tax liability each and every year, and you kind of add that up over time, and you try to compete with the ETF wrapper. It's just hard, it's almost impossible to overcome that tax benefit of the ETF, I think.
Yes, especially if they pass a 45% capital gain tax or whatever the heck's in that recent, tax thing coming out of the Biden's commentary.
Yeah.
The ETF became a lot more valuable from a tax structuring perspective.
I know I'm probably missing a lot of use cases, but what are the most sort of common? We talked about the IRA, family office. What else?
I think just folks that, like, if you've been doing tax loss harvesting, or you run a whole bunch of SMAs and your traders are pulling their hair out and they're like, oh God, like I got to manage these 1,000 accounts with 50 random stocks. And now I got all these Frankenstein portfolios that are a little bit different. Great. Let's just syndicate all these, dump it into an ETF. And all you do is just send a spreadsheet to Wes and his team. Done. Right? It just solves a lot of operational complexity and allows RIAs and really anyone to just scale their business efficiently. It's just a great tool. It's like running one fund as opposed to 1,000.
Contrast that just for a second to the direct indexing solutions, because I think this is a really interesting nuance point where there might be an advantage.
Yeah, sure. So nothing is a panacea, obviously, right? So like direct indexing, specifically long only direct indexing, has two real core benefits, right? One is customization. Like an ETF, I can't customize. Whatever we're going to do, we're going to do. If I don't like Exxon, but we're going to have Exxon because we're trying to make money here, not like placate something. With obviously custom SMAs, you can do that. You can kick out whatever the heck you want. The other thing that's unique about an SMA is you can kick out losses. So ETFs cannot kick out losses. They're really good at having the fees are tax deductible and maintaining a deferral capability basically forever. But if I have a bunch of losses in a ETF, I can't kick those out, right? So if you're one who thinks a lot about tax efficiency, kind of your bottom tick solution is, and this is what's happened to a lot of people, is you run tax loss harvesting. Eventually what people realize is, oh crap, now I just have an overpriced index fund that has a lot of tracking error and I can't do anything because I'm out of tax loss benefits. Great, put it in an ETF and regain the efficiency of the ETF on an ongoing basis to trade it, actively move it, and not have to worry about taxes anymore. So you can kind of use both structures to come up with like optimal solutions. And I'm not going to say that ETF is always better, always worse. There's just different use cases where the two technologies, they could either be, complementary or supplementary, depending on what you're trying to achieve.
I think one of the, hurdles that a lot of folks looking to launch an ETF had is like the cost of it. There's obviously an upfront cost, and you got to get to a certain level of assets to kind of get to profitability, depending on what the fees are. And you got to have the capital to make it through. But I think over at ETF Architect, you guys have kind of, you're always looking for efficient. I know that's how you kind of run your businesses. Yeah. You run them lean, you run them mean. But just generally, like, what would you say your outlook is on the cost of launching ETFs going forward?
Yeah, so we've been in kind of like the power curve of dropping costs. Not just us, but everyone in the business is trying to make this more efficient. And kind of our core mantra is, how do we make this cheap, easy, and transparent? Which, as you know, is the opposite of what custody banks do. And I think we've gotten it 90% of the way there. The problem is we did all the like easy, base hit type work. And now, it's getting marginal. Like, how do we save $500 there? How do we save $1,000 there? And unfortunately, the very nature of an ETF, it's a registered fund, which automatically triggers massive compliance, massive lawyers, massive pain, anguish. So it's always going to be challenging, difficult, and the most regulated thing you could possibly engage in. However, I think we're making it easier and easier and easier. So, it was $300K a year, then $250, then $225, then $200. Now it's under $200. Could we get this to like $150, in the future at some point? Probably. However, what's counteracting that is our good friends that love regulatory capture. Not going to name names here, but they're all the people that have $1 trillion of assets or bigger. They like to add new things and new regulations, and that costs money, right? Derivatives management policy, liquidity risk management policy. Like, what other policies do you want? Because every time you do that, you're adding me $10K a year in a new form and a new filing I got to do. So while we're trying to get the costs lower, regulators and regulatory capture participants are trying to make the barrier to entry higher. And so I don't know where that equilibrium sits, but we're obviously always going to be on the side of making things efficient and better, but we can only do so much against the government, because I'm not in charge of the government. I'm not a politician. So that's other people's jobs, not mine.
Policies up the yin yang.
Yeah.
All right. So in the last minute here, Wes, I know this is a little bit short, and I apologize for that, but the standard closing question that we're asking all of our guests today is, what is the one interesting thing you're seeing right now that you think others should be paying more attention to?
Oh man, I'm boring. I'm all about tax efficiency, and I just see the landscape of the world. It seems like government's only getting bigger. Like, the politics are not on the side of entrepreneur, capitalist, and what have you. So it just behooves people more and more to find ways to make their investments tax efficient, and stop paying attention to alpha. That's not your problem. It's making sure the government doesn't take half your money. That's I feel like a very important thing that a lot of people just simply overlook, and they shouldn't be. But again, not that exciting, new or different. It's just, Warren Buffett type things. Keep it simple, stupid.
Yeah, well, you've been consistent with that. So listen, Wes, thank you very much. We really appreciate it. You're always welcome on here with us. So keep up the good work, and thank you.
Yeah, you got it, man. Appreciate it. Love the cause. Appreciate the time. Honored to be here.
Thanks, Wes.
See you guys.
The hits keep coming, Justin.
Oh.
All right.
Hey, that was good. Okay. All right, Jack. So you guys are
ready for Ben Hunt.
All right, gentlemen. And this is not a breaking news episode, so keep it positive.
See you just in a little while. It is not, but we might do it that way. All right, let's do this. Ben.
All right.
All right. We got the band back together. Good to see you, man.
Well, this is fantastic. We're all the way through to the 3 p.m. mark. Jack, do you believe you're still alive at 3 p.m. today? I mean,
I'm still going. I actually got some. I enjoyed a nice lunch of pretzel goldfish a second ago. So I think any dietitians in the audience will appreciate that. That was probably successful for me. So I'm still going. Amazing. No tech issues right now.
Yeah, nature's perfect food. Goldfish is perfect.
Yeah,
that's
give a man a goldfish and he'll fish for a day.
How long? When did you kick this off, Jack?
8 a.m. So we've been going for a while now. We haven't been going the entire time. We've been rotating in and out. But yeah, we've had a couple tech issues along the way. But for the most part, we've been able to resolve them quickly, and we're still going. Ben, we'll make it to the end.
Very nice. Well, I'm here to do my part. So thanks for doing this, Jack. Appreciate it. It's great.
Just a reminder to everybody.
Cause.
Yeah, the wonderful cause. And just a reminder, if you haven't given, take a look somewhere on the page around, depending if you're watching on YouTube, Twitter, or LinkedIn, there is how to give. There's a button for the Susan G. Komen Foundation that's right here on your screen. So send the donations in. We're doing this for a reason. Now, with us right now, founder, Epsilon Theory, former hedge fund manager, all-round narrative expert, best Hunt brother since the Hunt brothers, Mr. Ben Hunt. Thank you for joining us today.
It's good to be here. Yeah. Nelson and Bunker, they were the original Hunt brothers. Yeah, I always had a soft spot for their sister Rose, though. I think she was the smart one. She was the one who did the hotels in Dallas. So.
Well, the Hunt sister deserves her own series at some point.
For
sure, so we're gonna do a little bit of a breaking news type thing here for you today. We want to kick this off and talk a little bit about the inflation map versus the inflation territory right now, because everybody's talking about CPI, PC, and all those fun things. What's
Mhm.
what's the difference here, Ben? What's the map versus the territory, and what's up with inflation?
Yeah. Well, so look, this distinction between the map, our measurements and the like, and the territory, I think is so helpful when we're thinking about issues like this, because what we've built is not just in economics, and it's not just around inflation. What we've built in our whole society, we all have our jobs and our focus and our attention. It's all on maps and very little on the actual territory. I get it, right? I mean, you go to school, you get an advanced degree, you do a lot of research on a topic. You're trying to understand it. And to understand it, to communicate it, you're looking for indicators, you're looking for measurements. Again, it's not just in economics and not just around inflation, but our whole society, we look at measurements. We don't look at the thing itself. We look at measurements. Think about sports, right? We can rattle off, wins over replacement. We can, sabermetrics, stats. We gamble on it. We focus on it. It's very different from just watching the game. We're just watching the game. We try to calculate everything in our lives. Polls on this. What is politics? What is politics? What is a market? And I've been thinking about different ways to talk about this, and one of them is the distinction between map versus territory. You want to get from here to there. You want to understand the actual land or property. We spend all our time studying the map, and we make these incredibly detailed maps. Some maps are of one aspect of the territory, some maps are of other aspects, and we confuse the map for the actual territory. That's one way to think about it. Another way to think about it, I want to suggest here, is we have this metaphor in our heads, our mental model of things like markets as a machine, which is a simplification of the way to think about markets. And what I mean by that, Ray Dalio is maybe the one who's most famously promoted this idea, but it's not Ray. It's not just Ray. It's all of us. It's everything we read about in the Wall Street Journal, everything we watch on CNBC. We talk about the economy, or we talk about markets as if they were a machine with levers to pull, with gears that click in, with moving parts that function mechanistically. So how many times do we talk about, the Federal Reserve will pull this lever we call interest rates, and it'll raise it 25 basis points. And then that will impact the economy in these mechanistic ways. Or, if they pull this other lever and lower interest rates, there's a mechanistic effect on the economy in XYZ. And we talk about everything that way. We talk about inflation that way. We talk about wages. We think of it as a machine, with these moving parts that are related in knowable ways. And that's just not true. It's another way. It's not a map of the territory, but it's another mental model we use to create abstractions of certain elements of the economy to have it make sense to us, or more easily make sense to us. Again, I get it. It's how we've thought about the world, frankly, since the Industrial Revolution. It is research. When did we start talking about the world in terms of a machine, in terms of abstractions of pulling levers, and if this happens, then that happens, and it all happens around, as you expect, the Industrial Revolution, when we started turning our own lives and labor into cogs of a machine. It's not just in our work, but it's also in the way we think about the world. Now, the problem with this is that's not the economy. The economy is not a machine. What the economy is, in the American economy, is millions of households and corporations and individuals making decisions about what they buy, what they make, how they value their labor, how they value, how they price stuff, what they're willing to pay. That's the economy. That's the economy. And when we have this mental model of a machine, and we have a mental model of levers and pulleys and, as you're describing, a map, we think in terms of, oh, this is this module of the machine we call inflation, and here are the mechanistic aspects of this, and here's how we measure the gauge. What's the value on that reading, Scotty, for our inflation reading, as we understand the machine of the economy. And I say, I get it. We all do it. There are advantages to this, but there are enormous disadvantages to it because we lose sight of what the actual economy is. And what the actual economy is are these decisions, the behaviors of households and corporations in how they buy and sell and consume. That's what the economy is. In that world, in the real world, inflation is, I think, prices of stuff is going to be higher. That's what it is. That's all it is. And once that thought, once that perception of the world that prices are going to be higher, so I need to charge more for my labor, or prices are going to be higher so I can charge more for whatever it is that I make. Prices are going to be higher so I need to worry about that. Once that's in our heads of actual real world decision makers, it sticks. And we can talk about raising inflation, raising interest rates or lowering inflation rates and what that does to the price of money, which is a really important aspect of all that decision making. What's the price of money? But ultimately, when we're talking about decisions, we're talking about inflation, the territory, the real world, it's what is in our heads. And I think that what we lose when we talk about this measurement of inflation or that measurement of inflation, we lose sight of what is inflation really. Now, again, I'm not saying anything that's crazy. Or is it when Ben Bernanke, God bless him, talks about how the most important thing for understanding inflation is inflation expectations, he's right. He's 100% right. I mean, this was actually Bernanke's main academic contribution to the field, that, if you're going to be thinking about inflation, we can take a monetarist approach, a Friedman-esque approach. Inflation is always a monetary phenomenon. And that's right also, but only right as a tautology, as something that is correct by definition. Yeah, of course it's a monetary phenomenon. That doesn't get you anywhere. Inflation as being our expectations, our human expectations, that gets us somewhere. It's a more accurate reflection of what inflation is, what the economy is. But then, of course, it goes off the rails because then you start, well, how do I measure inflation expectations? And so the way you measure inflation expectations is, there must be a price for that somewhere. Yes, let's look at 5-year forward, 5-year, tips as my measurement of inflation expectations. And it's not measurement of inflation expectation. It's measurement of the, maybe inflation expectations of the people who actually trade interest rate swaption contracts on Wall Street. Let me assure you that is not reflective of the overall economy. But this is the way we've built our world, that even if we can conceptualize what it is, which is expectations and the behaviors and decision makings of real people, we immediately lose sight of that and start looking for a gauge or a measurement that we can actually make of that. So, long introduction, but it's such an important thing, right? Because all this argument over, oh, is it, mean trimmed PCE or, annualized 3-month CPI core, it all misses the point. It all misses the point. Inflation is expectations of households and corporations of how they value their labor and how they value their goods and services, and whether they think prices are going up. That's it.
And when you think about that, you think inflation is going to be higher for longer than people expect, correct?
Yes. Right, because I live in the real world. I live in the real world, and this is what gets so frustrating over arguments over this data series or that data series, this map, that gauge, this gauge. We live in the real world, people. I think about myself, right? Do I expect the price of everything to be higher? Yes, I do. And once you expect that, the rational reaction is, I got to get ahead of that. I got to get ahead of that. So, and again, this is not crazy talk. This is like what Ben Bernanke was talking about when he became Fed chair, is that we need to focus on inflation expectations. Then we get off into academic ease about how do you measure it. But the basic idea is absolutely right. And the corollary to this, he did his research because he was looking at Japan. Because Japan is what happens. There are two very persistent things. When you let the inflation genie out of the bottle and everyone expects prices to go higher, that sticks. That really sticks. The other thing that sticks is when you think that prices are always going to go lower. That also sticks. And that's what we had that's what Japan had for 40 years. And so their big issue was, how do we break deflationary expectations? And what breaks these expectations, the only thing that breaks these expectations, is a really, to use the technical term, big ass shock. Just an enormous shock to the system. That's what it takes to break these expectations. What broke the 1970s expectations of inflation? Just a horrible recession. That's what it takes. And interest rates at 15, 16%. That's what it took, right? What did it take to break inflation expectations in 2007? A nationwide crash in home prices. And so what that did, that big ass shock of your house is now worth half what you thought it was, that you're underwater in your home, you owe more on your home than it's worth, that created enormous deflationary expectations in the United States. Enormous. We became like Japan, where whatever it was that the Fed did, here's free money. It didn't matter. We couldn't get inflation, even if you're saying the price of money is nothing, is free. And then we had the COVID shock. And that shock was, we're going to do helicopter money. We are going to rain trillions of dollars. We are going to give it away. We're going to literally give it to households and corporations. You don't have to pay it back. We're going to give away trillions of dollars. And that broke the back of the deflationary expectations. And now we're back to inflationary expectations. And the only thing that breaks it, Jack, the only thing that changes this is a big ass shock going the other way. We're going to have a nasty recession, and we're going to have the price of money a lot higher than it is today to break the expectations we all have that we need to be charging more for our stuff, whether our stuff is our our labor or whether our stuff is a good or service that we provide. I wish I had a better answer, but that is the answer.
So
Do you
how
want to make
think-
a comment?
Go ahead.
Do you want to make a comment on, because I think what just
Stunned
happened
into
with
submission. I love this.
stunned into submission. Well, I'm trying to decide how much I want to not derail this, but take this in the what just happened with the Bank of Japan, because you've been talking about this too. I see it with the ET Pro people. What just happened with Bank of Japan?
Well, the Bank of Japan, yeah, they've been, trying to get their Japan is a different animal than the United States because Japan is dying. And I mean that in the non-pejorative, just clinical sense. They're dying. It's they're dying. Right? I don't know any other to say it than to say that. There is no growth from population as there is in the United States. Japan is dying. So Japanese monetary and economic policy is it's hospice care is what it is. That's over a very long period of time. But what they've been trying to do is to try to do anything to get out of the trap of saving. They save too much. How do you create some inflation and some investing? And the problem is you want to do it organically. You want to have real growth, even against a backdrop of shrinking, which is what they're doing. The problem is if you have inflation that comes in from the outside. And, it's one of these old stories it's called Triffin's trilemma, or the trilemma, right? You can't control everything in your economy if you're open to the rest of the world. And so you can either try to maintain your interest rates, you can try to maintain your balance of trade, or you can try to balance your currency. And you can probably you can probably manage 2 out of those 3, but you can't manage all 3. Can't manage all 3. So Japan has said, we're going to manage interest rates, and we're only slowly going to let them go up. But if you're doing that, you can't. It's hard to manage the rest of it. And so Japan depends on being an exporter. Japan depends on keeping interest rates low, and you can't manage that. Something's got to give on your currency. And that's what's happening. That's what's happening. This happened before. The last time this happened, right? We got everyone together at the Plaza Hotel, and basically all the Europe, the U.S., Japan said, okay, we're basically going to fix or have a loose peg of our currencies to each other. And just by saying that and committing to that, you kind of got them to where you wanted to be and be stable.
This is mid 80s, right?
Yeah. This is 82,
early to mid 80s,
I think, something like that.
Yeah.
85. And so something lasted 40 years. It's pretty good. Well, all that's breaking up now. Because we're in an inflationary world, particularly in the United States, which is the economic engine that matters. So that's the problem for Japan. They're a strong country, but they're a shrinking, dying country, and you can't control it all. And so they've got a real problem with their currency. They've got a real problem. I don't know how to get out.
It's really interesting to step back and see these kind of completing inflation story narratives, how they're playing out around the world, and just even the problems on the doorstep and on the front page of the most popular paper in Japan versus the Wall Street Journal are treating these as same terrain, 2 different maps.
And they're crossing in two different directions, right? I mean, it's they have Japan has a very different monetary and economic task ahead of them than the U.S. does. U.S. has all the advantages in the world. Big problem for the U.S. right now is politically it's impossible to generate the pain that's necessary to put the inflation genie, well back into the bottle. And that's rough, right? Because if you're not willing to take the political pain, then what you end up doing is you end up papering it over, which is, it's what we're doing. We're papering it over. It's fine. I mean, it's manageable, right? If you're in a position where you have financial assets that can also go up in nominal price, like if you're rich. The rich do fine in this inflationary environment. They do absolutely fine. The non-rich do not. The middle class does not. The retired and the old non-rich do not. They do really poorly. And so what the government has to do, because they're doing poorly, is we've got to give them more money. Forgive student loans, do a cost of living adjustment on, insurance, retirement accounts, meaning Social Security, do all of this. And there's no taxing to make up for that. Okay, we've crossed that bridge. We've snipped that cord so long ago. There's no relationship now between taxing and spending. So taxation, if there's no relationship, what is taxation for? Taxation is for whatever conception of justice the ruling political party has at the time. That's what taxation is for. It's to satisfy a conception of justice. And spending is to, bread and circuses, man, and to keep the economic pain from being felt by voters. But just like Japan, you can't control everything, right? I mean, at the same time in an open economy. So right now we have a deficit that is insurmountable and increasingly difficult to service. And you'll hear a lot of economists say, well, that doesn't matter. The deficit doesn't matter because what you're paying on the debt, you're paying to ourselves. And that's exactly right. But you're paying it to rich guys. You're paying it to rich guys. You're paying it to the people who own the debt of the United States government. Right? It's just redistribution, but in the way that people don't think of redistribution. It's not from the rich to the poor. It's from everyone, particularly the middle class, people who actually are paying taxes, to the rich. It's that redistribution. And add the tax cuts, which I'm sure will be renewed. You get that. And then you get other taxation proposals, at least, that are just used to satisfy some sense of justice. Like, a cap gains tax of 45% or whatever bizarro proposal the White House is floating. I don't know, man. It's when these relationships get snipped and cut, when there's no relationship between taxation and spending, when the inflation genie is totally out of the bottle, but everyone says, no, it's fine. That's when enormous dislocations build and build and build until they break.
Yeah, I wish we could go on for a while about this because this is really interesting stuff. Unfortunately, we're like less than 2 minutes to go, and Matt will actually not have notes this time, unlike our breaking news episodes. Although I did threaten Matt that I may need him to have notes for the entire 12-hour live stream at the end.
Oh my God! Yeah,
See if
sorry
you can
guys,
do it.
you got me wound up on this, and
It was great.
I get wound up because I just want to throw my head out when like today, wages are increasing by call it 4.5% a year. I mean, no shit. Of course they are. Everyone in the real economy knows that what they have to pay people has gone up around between 4 and 5% a year. And yet we have this insane world where we're told, no, that's not true. Yeah. You got me wound up again.
I will give you the 30-second cultish corner on this, which is that because I keep looking at this. I've got this. This is the single for the TLC hit. I don't want no scrubs, which the important thing, extra Ben Hunt, extra why am I reading this now? And I'm dawning on me thinking about this inflation thing. Like what's so important is we get the story, we get the song. And what does this song do? Call it the Harvilla Doctrine after Rob Harvilla, the journalist. A scrub is a guy who thinks he's fly, also known as a busta. It tells you exactly what it is right at the beginning. People are constantly trying to tell you how to think about this thing. And you got to step back and see if that checks out. You got to step back and see like, yeah, what is this scrub doing on hitting on Chili? She is a pop star. This doesn't make sense. Say the same to your central bankers. Do we have a closing question, Jack?
I think we've got to wrap up.
Top that, Jack. Top that. Yeah.
No, I can't top that. And what other financial live stream are you going to get TLC and no scrubs? Only Matt Ziegler. But thank you so much, Ben. This was great. We really appreciate you spending the time with us.
Anytime, Jack. Thanks for what you guys are doing. I really appreciate it.
Thanks, Ben.
Bye now.
See you later. Except hit the red button there.
The fun just keeps coming, Jack.
We are ready. Perth is in the waiting room. Are we ready to go? Can't wait to find out what musical references you've got for her.
We're going to check in on how much she either likes or dislikes TLC. Let's do it.
Perth.
Wow.
How are you?
Good. Hold on. Let me adjust something here before you bring me on. Okay. All right. Okay, that's better.
How's it feel to be magically
I
appeared?
need to turn off the other.
You're on.
I need to turn off the other device.
It's okay. We can talk while you get everything ready.
Okay. Hold on.
So just a reminder for all these interviews. We're here today for Susan G. Komen. If you're watching us on YouTube, there's a donate button. If you're on desktops, to the right of the video, and if you're on mobile, it's below the video. If you're watching us on Twitter or if on LinkedIn, you can go to YouTube to donate. If you've gotten any value out of what we're doing today, we really appreciate it. It's a great cause, and we'd love to raise as much money as possible. And with that, we welcome Perth Toll. Perth is the founder of Life and Liberty Indexes. Perth has pretty much taken an ETF product and thrown it on her back from nothing and created it into a massive product. And it's a really cool story. And we're going to talk about that today as we go on. So thank you, Perth, for coming on with us.
Thanks so much for having me. And just on that, I know I always say this, and it gets maybe old, but it's not just on my back. You guys shared your platform with me when we, were very small, and so did Bill, like a lot of other people. We have great partners in ETF Architect, so I credit all of the ETF community for supporting us the whole time.
And Wes should probably thank you for the ETF Architect thing as well, because you were the first, right?
He thanks me sometimes.
So to start, I want to take a step back though and just talk about kind of how you got here. So you grew up in China, right?
Yes.
Yeah, and how did that experience?
I was born in Beijing, and I came here when I was 9, and then I went back and lived in Hong Kong after college.
How did that experience sort of get you to where you are today, starting a Freedom Emerging Market Index?
Yeah, so having grown up in both countries, experienced the changes that happened in China during the last 3 or 4 decades, and then going back after college around 2003 and 2004, at a time when the China business was still very exciting and just everybody wanted a piece of it, in Hong Kong at least. I remember going to Bloomberg offices in Hong Kong at the time. And their recruiters were telling us that one of the perks of working there is you get free Mandarin lessons at lunch, right? I mean, we all know Bloomberg has great perks, but that was like the Hong Kong office, the Hong Kong bureau, one of their perks. So at that time, China was a very exciting market, but my experience growing up my formative years here in the U.S. and then going to live in Hong Kong for a while and traveling to Shenzhen, Beijing, Shanghai, I saw the difference that freedom made in my life and how these policies impact markets in, China market versus Hong Kong market at the time versus the US. I know that gap is closing over there, but, for example, I had a friend whose name, we called her Maggie, and I think I've told this story before. She doesn't exist on paper. She was the same as me in every other way. Same age, everything else the same, doesn't exist on paper. No birth certificate, no school records, no social security benefits, because she was born the second child. And so because of the one-child policy, there's 30 million missing women in my generation, causing a massive demographic time bomb, which is going off now, and will continue to for a while. So these policies, I realize, have a huge impact on the future of a country and an economy. So that's when the seed was planted. But it's not till after 10 years after I was working at Fidelity here in the US that we ended up here with the ETF.
Go back there for a second, because you finish school, you go back to Hong Kong, and then you come back here.
Yes.
That move back, when you came back to go work at Fidelity or wherever you decided to go work first, what triggers that decision at that point in life for you?
Yeah, so I followed family back to Hong Kong. So basically, my dad wasn't around when I was growing up, didn't know him at all. And I found him, and he happened to be I found him, he had a house in California. I found him at that house.
Facebook find him?
Actually, my mom went back to China and visited his parents before they passed away. And they gave her the address to his house in California. It was in Danville, California. So it was the summer before I was about to start law school, and I was trying to schmooze my way into UC Davis. And I MapQuested, if you guys remember MapQuest. I MapQuested this address that I had in my head. I actually went up to the wrong house. This house had a green Range Rover parked in front of it, and I was like, this does not look right. It seemed like
You're like, Dad did okay. What's
not
going
what I
on?
envisioned. Very tall, very blonde lady answered the door, but she's like, hey, there's an Asian family that lives across the street, but they're only here a couple weeks out of the year. They live in Hong Kong. And that's how I found my dad. And he was like, what are you doing with your life? I said, going to law school. He's like, no, you're coming to Hong Kong to live with me. So I went to Hong Kong to follow my dad, who I always looked for. That didn't, there's a reason why he wasn't in my life. That didn't work out for very long. And I came back for family, for those reasons. I basically gave up on Hong Kong. I didn't have a work visa. I had given up law school to go there. And I couldn't work legally, and it just wasn't sustainable. So I was only there for about a year, and then I came back, not to work at Fidelity, but after I came back, I ended up working at Fidelity.
So I think it's so interesting, because I think it feels like if you don't have these types of formative experiences, I feel like all this had to shape the way that you started to approach this thing of how you think about the Freedom Fund and all the stuff that you did. Am I reading too deeply into this?
No, you're not at all. And I'm glad you're talking about that, because I've never talked about this on, what I just told you, that story on any podcast before.
Okay.
But
because that's
we're
crazy.
raising money for charity here, so we can
Yeah.
say. I think I'm really grateful for all those experiences, right? If that hadn't happened, and now we have our own kids, and our kids have more responsive, sometimes, in my opinion, maybe more responsible parents than I had. How are they going to learn anything? They need to be more hard, So yeah, I do wonder about that. But as far as the China experience, absolutely that colors how I invest. Absolutely, it colored how I came to do this. And at the time that I started this, it wasn't just my experience. It was also, I had clients. I worked in the LA and Houston markets at Fidelity for a total of 10 years. And I had clients who, were from Russia, who said, literally, their words, I don't want to invest in Russia because it's like funding terrorism. And I felt that way about China, because in China, the companies there, don't have, they can't put their own interests in the interest of their stakeholders, like their customers and shareholders first. They have to put the interest of the state first. So if the state comes and wants something that is detrimental to your customers, they have no choice but to give it to them. And so, and also due to laws regarding like civil military fusion, opaqueness regarding ownership structures, we really don't know what we're funding when we're investing over there. So, so for that reason, I think, it's difficult for me to invest in the emerging markets if we didn't have something like the freedom weighted strategy.
So,
go ahead, Jack.
Can you walk us through the idea when you came up with the idea of a freedom index and how sort of you took that and started thinking about implementing it in the real world?
Yeah, so with the rise, I was an advisor at Fidelity, and with the rise of indexing and ETFs, at the time I was also married to someone who was studying for the CFA, so he was going through indexing and that portion of the exam.
Really interesting dinner table conversation,
Yes.
is what you're saying.
So
Yeah, fascinating.
actually,
right.
it eventually just came from that, and after I had my child, I ended up leaving Fidelity to be a stay-at-home mom. And so I started thinking more about doing this full time at that time, and it took a long time. I was an advisor. I was on the kind of buy side of this, and now I'm on the other side, and it's been interesting. So, I think for someone who has a finance background, people have asked me like, why didn't you go into government to do something like this, right? Somebody asked me that yesterday, and I think I'm grateful that I was in a space where there was a need that my skills could meet. So there was nothing that existed like this. Like if I wanted to invest in this way, like express my belief that freer countries will do better over time, that countries with higher, human rights protections and property rights protections will do better over time. Stronger institutions, stronger rule of law, stronger individual and investor protections matter. I could not have invested in this way in the emerging market space before we existed here. So the fact that like this product didn't exist and I felt that it needed to exist, and I was in this space where I was familiar with how to make it exist. Like I'm extremely grateful for that. So I think that we just have to. It seems like a small thing compared to what government does or what maybe NGOs do and nonprofits do, but it's not. If you're in a position to direct assets, whether it's your own or other people's money, that's a position of power and privilege, and we can use that to impact things that happen in the world. And right now, looking at the emerging markets like Russia, emerging markets like China, and the axes that they are a part of, right, and causing some of these things to happen in the world, I think investors are realizing that more and more.
Can you talk about what it took to get it to market? Because I can remember back, I don't know if you remember, like the original Democratized Quant conference that Alpha Architect put on. I remember you were there and you hadn't launched anything yet, and you were talking to everybody you could talk to try to get the product to market.
17 or 18, something?
I think it was something like that, yeah.
Yeah,
I kind of wish, by the way, if Wes is listening, I kind of wish that thing would go back to an in-person conference because that thing was a lot of fun.
Yes.
And hopefully
we
can
should bring it back in person, maybe in Puerto Rico.
Yeah, actually, you should definitely do that. That'd be a perfect reason to go to Puerto Rico. But
room. So yeah, I remember that conference, and I had just the previous year I was shopping. I had the index in 2017, and in all of 2017, I was shopping it to different issuers, and I talked to literally everyone I could talk to, everyone that would talk to me, and like I talked to iShares, I talked to SSGA, like literally everyone, and everyone said no. It was like 99%. Like a couple of mid-sized issuers kind of thought about it, and then one of them was like, okay, we'll do it. Here's the deal that we'll give you. And it was like this horrible deal. And I was like, yes, let's do it. And then that happened around Christmas. And then January at the ETF conference, they backed out. And I was absolutely like very depressed. But I knew by then, and by then I had met Rob Arnott, which is a whole different story, and he had committed assets and to a non-existent fund, with credit to him for seeing the vision before anyone else did. And I knew that it would be okay, all sad as it was. And so at that point is when I went to the Democratized Quant Conference that year. It was March of 2000, I believe, 18. And I asked Wes, like he was still in the garage, the basement at the time. And I was like, yo, after the conference, literally, I was like, do you want to partner on this? Like go 50-50 maybe? And he was like, no, dude, like you need to do this on your own. I'm like, what are you talking about? Like you have 7 PhDs here. I'm literally a single mom.
This
You
is
know?
this is a
How am I gonna
great
do this?
Wes impression, just for the record.
Yeah.
Let this show that yo dude was very Ninja Turtle enough.
Yeah.
Good job.
Ninja Turtle is a good way to put it. Yeah, he didn't want to do it. And he was like, I'll teach you how to do it. So he taught me how to do it on my own. He literally like was talking to me every other week, consistently teaching me every step of the way, helping me negotiate contracts with US Bank and stuff. And I'm like, wow. And then by Thanksgiving, I was ready to go out on my own. And we were drafting my exemptive relief, right? And then we're having a conversation. Wes is like, hey, great idea. Brilliant idea. We should do this together. I'm like, did we not already have this conversation, right? He's like, oh yeah, blah, blah, blah. So yeah, that's how we ended up working together.
I just want to go back and touch on the Rob Arnott thing, because that's a really cool story. It involves private planes and all kinds of stuff. So I think we should at least cover that before we move on.
Yeah, so Rob Arnott I met in 2016 at Camp Kotok, and how I got invited to Camp Kotok is I spoke at a CFA society. This was like my first year trying to do this. I spoke at a CFA society in Tampa. And on the panel was David Kotok, who runs this camp. Excuse me. David Kotok, myself, BlackRock, and Morningstar. I had no idea what I was doing at the time. And after the panel, David Kotok invited me to this camp. And I was like, who does this? Like, fishing camp in the middle of the woods, like 5 minutes from Canada. There's no Wi-Fi anywhere. And I was like, and so my friend Christian Magoon at the time, who runs Simplify ETFs, he was like, you should go because Barry Ritholtz goes to this camp. He's like a big fan of Barry's. I was like, okay. So I go to this camp, and you had to take a seaplane to get in there. And I call the day of to get a seaplane. And I'm like, is it too late to get a seaplane? And they're like, no, you can share with Rob Arnott. I'm like, what? So after I left Fidelity, I called research affiliates. So this was 2014. I called research affiliates, and I said, hey, you guys do non-cap weighted indexing. I do non-cap weighted indexing. Do you want to, partner together? And they were like, no, please go away. And so 2016, they're like, hey, we have a plane with another seat with Rob Arnott. I'm like, okay, great. So I literally am on the seaplane with him for 30 minutes going into Camp Kotok. I intercepted him at the airport. They gave me his, American Airlines flight number. I was like, hey, did they tell you we were going to be riding together? And he was like, yeah. So, so literally I had a captive audience, on the seaplanes. There's a two-passenger plane. And and so I asked, I was like, here's what I'm doing. He loved the idea. He loves emerging markets. He loves freedom. I mean, it was like the perfect thing for him. So we fished together for the next 3 days. He ended up getting I was like, do you want to hop on a call with me? I'm trying to raise money for seed. He hops on a call with me after camp. The people that we were on the call with did not commit seed. After the call, he emails me and says, I'll put in $1 million. So he ended up committing seed. The seed did grow between that time and the time of my launch. He ended up also at the, after I decided to do this on my own at Wes's encouragement, I said I'm going to have to raise capital, and he ended up becoming capital partner. So he's been an extremely great partner, by the way. He leaves me all the freedom I need to do, make all the decisions. And he's not involved in the day-to-day, but he's always there if I need advice. So yeah, it's been great. But that he was only at that camp that year. And before that, it was like 7 years prior that he was there. And after that, he never went again. And this is not something I could have orchestrated. He literally just went there to pay a bet that he lost to Barry Ritholtz. So I guess we can credit
in
Barry.
Cash, right? Wasn't it cash settlement on that bet, as legend has it?
Yeah, $10,000 bet that he was paying to Barry. So so that's not something I could have orchestrated, and that's what I mean is things like that were happening to kind of let me know, hey, you're gonna have what you need to do this, and this product needs to exist. So I the whole time that I was launching it, never doubted that the product needed to exist. Even if I failed, I would have regretted it had I not tried. So I was like, I'm going to do it because if I don't try, that's what I'll regret. If I do it and I fail, I won't regret that. So that's, yeah, how we ended up there.
Say what the product is. I know we're going to run out of time,
So
and we're going to have to figure out another better way to talk about all this.
Strategy
Yeah, say what it
is
is.
a freedom-weighted emerging market strategy. So we use quantitative third-party freedom metrics from think tanks, the Cato Institute and the Fraser Institute. It covers 83 variables of personal and economic freedom. And countries that are the most free country set in the emerging market space are included and weighted according to their freedom levels. So all the information with compliance disclosures are on freedometfs.com and or lifeandlibertyindexes.com.
And say this too, because I think this is super important. You have a fun way of not going by just like the market cap weightings of these things. Like you think very differently than so many other people who are even remotely in this space.
Yeah, so we are 100% freedom weighted. So what that means is the freer countries get a higher weight, less free countries get a lower weight, and it's a cascade. It's not like we assign this, top quartile to this weight, second quartile. It's literally according to how it falls, how their scores fall in line with their peers. The above average scoring countries are included, and their weights are determined by their composite freedom score based on the 83 variables that are included.
And what's cool about this too is both from a long-term and a short-term perspective. I mean, obviously we know in the short term, Russia was not a great place to be invested. China hasn't gone very well. So it's worked out very well in the short term, but I think you have data as well that like the freer countries do well over the long term as well, right?
Yeah, so, there's a lot of data that shows the benefits of freedom. The freer countries in general have higher life expectancy, lower infant mortality, higher income per capita, higher GDP growth, lower poverty rates, and their lowest quartile of income, so their poorest people are richer in the freer countries. They have lower gender inequality. So there's all these kind of nebulous benefits to freedom that until now hasn't been able to be kind of tracked by investors. So what we hope to be is a running scorecard for freedom in the investment space, starting with the emerging markets, because in the emerging markets where that universe is so rife with autocracy risk. And so there's also a higher freedom premium because of that dispersion between freedom levels in the emerging markets universe. You don't find that dispersion at all in the developed market universe. So that's why we started with the emerging markets. So we hope to be a running scorecard to help, I guess, have a more hard, concrete way to see that freedom does lead to better results, even in markets.
Just as a way to understand how this works, could you maybe give an example of like a country that is in your index right now and one that's not, and maybe some of the major differences between them that would lead to that?
Yeah, so the poster child example is always China is not in the index, never been in the index. Russia has never been in the index. Saudi Arabia has never been in the index. Taiwan, South Korea, Chile, and Poland have always been in the index, and they're always high. So a lot of these countries, like Taiwan, is obviously on the forefront of fighting for freedom in their region. When I bring up Taiwan, I always have to address the, what if China invades them question. And, if you look at the Russia invasion of Ukraine, the investment risk lies with the aggressor. So if you're asking that question, look at your, emerging markets fund that is cap weighted and look at the China risk in there. Focus on that, look at that first, and then let's talk about Taiwan. And also, let's try to allocate and support the markets that are supporting freedom in the world, because our dollars do make that impact. So Taiwan is it continues to do well. It's always consistently done well, and it's one of those smaller markets that focuses on technology and innovation, but specifically has a very a thriving semiconductor industry, right? So it's kind of become like a critical technology for the world, and that has really helped our fund. Chile is an interesting case. So Chile, in the past several decades, have enjoyed business-friendly policies that have led to a lot of its prosperity, and we've been concerned, investors that are freedom-minded have been concerned that recently the Boric government, which came into power in 2019, may roll back some of that. But because we invest in the countries that have the higher, the stronger institutions, rule of law, and so forth, their institutions, their checks and balances, and voters have proven a effective check on government power. Every time this new government that's more anti-business has come out and tried to do something, voters have come out in droves to vote it down. And this government, since 2019, has been able to accomplish basically nothing. So that's kind of the benefit of investing in countries that have these strong checks and balances and strong institutions. Poland is similar. It had a government that rolled back a lot of freedoms in the past 8 years. And just last year in October elections, it was a historic turnout, about highest turnout in history. They voted in a more balanced government. And so now the prime minister and the president are from different parties. There's more checks and balances. The EU has come back and approved funding. So they're going to continue, I think, to do well. I'm bullish on these kind of smaller countries like Poland and Chile that don't get a lot of play at all in the cap-weighted indices.
Are the ratings pretty consistent over time? Like, will you sometimes see countries get their act together and like rise up, or does it pretty much stay the same? Like the bad players stay in the bad section, and the other, the higher freedom countries stay in the better part.
Yeah, so we find that increases in freedom are very gradual, and decreases can be faster. So this is why there are sections. So the top 4 that I just mentioned have always been the top 4. Poland did go from number 1 to number 4 over time. So they were number 1 in 2018. That's before the fund existed. And because that PIS government that came into power and got, ruling majority, it did kind of go down in the scoring. But the borderline countries can change from year to year. So these are countries like India, Thailand, Malaysia, Colombia. Sometimes can be in, sometimes can be out. Brazil has also been sometimes in, sometimes out. So yeah, it's a borderline country. Sometimes, because remember the algorithm is taking the above average scoring countries. So if you're around that average score, sometimes you can get switched in and out. We do have a methodology rule that says you have to go below a certain score after you're included to be excluded, just to avoid unnecessary turnover. And then there's also another methodology rule that's a freedom decline momentum rule. So like if you're in the index, but your score declines by a certain number, in that measurement year, then you're kicked out, like if it's a too quick decline. So that's like a stop loss. The only country that's ever triggered that was Turkey in 2018.
So we just have a couple minutes left, and I just wanted to ask you, we're asking a standard closing question of everybody today, and I wanted to ask it to you. What is one interesting thing you're seeing right now that you think more people should be paying attention to, but are not? And it could be inside or outside investing. It could be anything.
Okay, so I'm seeing a lot of interesting, maybe it's because of my, where we are in the space, but I'm seeing a lot of variations on kind of our strategy, and also other strategies that have non-traditional metrics as part of like the investment strategy. So things like the decarceration index. I don't know if you guys heard of this. This is something new.
No. What does that mean?
It's like they're looking at companies. They have developed a score that measures companies that have more people that used to be in prison that have come out back into society, and
sure, okay, like reintegrated into society successfully. Reward the companies who do that.
Ex-cons, I guess. So that's something that caught my attention, and I think that the reason why that catches my attention is not only because that's non-traditional, but also because it's kind of different kind of freedom related. But the founder there, Tanae, has a story similar to mine, where she's taking from personal experience and developing something that speaks to that, to the form of expression. So indexing or investment strategy as a form of expression is extremely interesting to me, because I think that we're all expressing a point of view, right? We're all expressing something we believe. And, you know, you don't have to be an ESG investor to do that. Everything you do is an expression of something that is a part of you or your beliefs. So you can do that, you know, even in investment strategies. And as quants, you know, you guys know, like, value guys are diehard, you know, they're expressing something. So, so I think, you know, investments are a form of expression, and that's something that I'm noticing more and more that people are doing.
I love this so much because there's so many, there's tried and true diehard value bro. And then there's also like the worst form of ESG, which is like the completely like formulaic, like somebody wants to buy no tobacco, quit, let's make a product and jam it down their throats. Whereas like and say the word again, decarceration.
Incarceration.
I'm learning a new word today. And yeah, because at first I'm like, what is this? Con Air, the ETF? Like, where is this going? But no, there's beliefs, there's an actual thing behind it. And this isn't a bad thing, especially when we get into capital's a great way to vote.
Yeah. So voting for a form of expression, you know, so yeah, I think, and I do have like a kind of I almost went to art school and I have that kind of background as well. So I do think of it as expression. Yeah.
Thank you so much for doing this. I've actually now received 2 texts during this interview of how great it is. So thank you so much for spending the time with us. It was awesome. We really appreciate it. Thank you for coming out to support Susan G. Komen.
This is the first like phonathon or podathon I've been on. So this is a great concept, and thanks for having me.
Thank you.
Thanks, Perth.
Bye-bye.
All right, Matt. Time for
We're getting all the stories today.
That was an awesome episode.
That was really fun.
Yeah, so time for one of my other highlights of the day, which is you one-on-one with Jim O'Shaughnessy.
Well, this is going to be a party if ever there was one. So
we are going to get Jack out of here. We're going to get Jim in and have at it.
Swapping Jack for Jim. Let's do it. So as a reminder, Susan G. Komen, how to give, look at the page around you. There is a donation button. You want to click it, whether you're on YouTube or LinkedIn or Twitter or wherever you're watching this. And without further ado, founder O'Shaughnessy Asset Management, O'Shaughnessy Ventures, author What Works on Wall Street. I didn't make it back to the shelf back behind me where I have my copy, of course. Jim O'Shaughnessy, thanks for coming on today.
Oh, thanks for having me.
We've got a million things we could talk about, but perhaps I'm getting delirious. Perhaps the coffee is wearing off. I have not been going since 8 a.m., but I feel like I have almost. I want to talk to you about kind of like the areas that I see you focusing on, because I think this is so interesting. You did the public markets thing. Comment on that. I'm not saying you don't do the public markets thing, but you had a really unique way to think about public markets. Why was that an insight then that's a different insight today?
Well, back then, I just was lucky enough to be born at the right time, to be really honest. You know, if Ben Graham had had access to huge databases and computers like I did, he would have written What Works on Wall Street. So I have no illusions about the fact that super smart people, had they had the tools, would have done all of that homework. And I was just lucky enough to be able to be the first to kind of put 2 and 2 together. Standing on the shoulders of those great early proponents of a more systematized, detailed way of looking at investing. So public markets are huge and massive and liquid and wonderful to invest in. Our particular approach was quantitative, factor-based investing. We basically, I used to joke, you know, would you go to a doctor who said, you know, I just got these little yellow pills in and I'm going to wing it. I'm going to give them to you. No, you're going to run for the hills, right? But what you would like to go to a doctor who says, these pills are perfect for what you have.
Wait, what color are they though? What color? Are they yellow?
They're still yellow, yeah.
Oh, they have a stripe though this time, right?
But you want to see all the double-blind tests, right, that prove the efficacy of that particular treatment. And that's kind of what we're trying to do with factor investing, which has obviously done pretty well since I started in it back in the dark ages of the 80s.
Do you feel like back in the dark ages when you're doing this, I've always wanted to ask you this question. Do you feel like back in the dark ages, it was just because not everybody had access to the data? Like people would have been smarter if more people troubled to gather the data?
So That's a great question. I think about that a lot. When I started out, I really started out overhearing a conversation between my dad and uncle. And this was in like the late 1970s. And they were talking about IBM, I think. And the entire argument was about the CEO or about what new products IBM had coming. And I kind of thought, I'd rather know how much I have to pay for every dollar of earnings or sales and that type of hard data. So I think it took people a while. There's always cultural lag. When something comes on the scene, it's different, like factor investing, et cetera, for people to, get tuned into it. But yeah, I suspect with the explosion that you've seen and all the tools for individual investors who don't want to hire managers like myself, I definitely think that the availability of data, the availability of tools, switched on people definitely would have ultimately gotten involved. Like I said, I was just lucky to be a little bit older than those folks.
Okay, but were you lucky too then to hear conversations like that between your dad and your uncle? Because it feels like this is the evolution. I'm not saying you're not taking this data-driven approach to some of the stuff you're doing in the venture space, but like as you've evolved, you learned some of this soft data to look for too. You learned how to think forward in a way that traditional old school value investing, it's a different type of forward looking that it seems like you're all about today.
Yeah, and I call that imbued or saturated intuition. When you see a pattern repeat itself time after time after time, you start being clued in maybe a little bit earlier, just because you've seen it happen so many times. And so even though we ran all of our public market investing based on quantitative models that we did not override, 35 plus years in the public markets, you see the same thing happening again and again and again. And that informs your intuitive side, right? That informs what we're doing now, which is much different. Quantitative tools can be helpful, but they certainly are not the final decision maker in the venture investing we're doing today.
I'm sure no one has asked this question today. What is intuition?
So it's interesting that you asked me that. We are looking at doing a project with the famous, heretic scientist Rupert Sheldrake, who's done an amazing amount of actual scientific work looking at what is intuition, right? The hairs on the back of your neck. We've all had that experience, right? When somebody's staring at you from somewhere and you don't see them staring, but the hairs on the back of your neck stand up. I find that very interesting. And so what I'm interested in is, can we adequately define it? If we can adequately define it, can we improve it? If we can improve it, can we do tests to see how much we're improving it and in what ways? So I think that intuition, back to my earlier statement, really is kind of seeing the same type of thing occur again and again and again. And you just get so used to that pattern that you might see it out of the corner of your eye a little faster. I'm not saying that you're going to see it a lot faster, but a little faster. And so I'm fascinated with, if that is true, can we kind of get some empirical numbers around that? And more importantly, can we build an app that would help people improve their intuition? That's something that we're actually looking at doing right now.
Very cool. Have you come across, do you know Natalie Nixon or her work at all? Did you run across the Creativity Leap?
Yes, I have run across her work. I don't know her personally, but yes, very interesting work.
She frames it because one of my favorite definitions of this, and she says you have to toggle back and forth between wonder and rigor.
Yes. Oh, I love that. That is so true. Because you when I talk to a lot of people, I do find that people tend to be on one side or the other. People tend to be rigor, just rigor, or, just go with the flow, man. Just it's all wonder. And I'm just really seeking, and a lot of actually what we're doing is seeking to unite those two. I think that there's truth to both sides of the argument, and obviously I come from the rigor side, but I'm really interested in the wonder side as well. And so trying to holistically build them in repeatable ways, that's clearly important to us in investing. That really attracts me.
And it's really curious because in that toggle between the two, like some of the stuff I see you focusing on with O'Shaughnessy Ventures, the adventures, the films, the media, these are all places where you seem to be asking this question over and over again about where does the wonder actually fold in with the rigor? Is that the way you see it?
Well, maybe not that specifically in films or media. Listen, O'Shaughnessy Ventures is focusing on all the things that I've loved all of my life, but didn't have the time available to focus on those other things. So films, for example, I have nothing against Hollywood. I love movies. I've always loved movies, but I want to see movies that are inspirational again. Where are the Rudies of today? And if you haven't seen Rudy, that's about the kid who goes to Notre Dame and as a
lifer in a Penn State household who was taught every Thanksgiving
right
to hate Notre Dame, I give that movie a pass. It's fine. I can't hate Rudy.
Hey, so maybe we'll make one about Penn State.
We got to get over some things. We're slowly being redeemed, but
that's true. That's true. But we want to make stories that inspire again. We want to focus documentaries on things that are super interesting, but also inspirational. We're currently making a documentary about Dr. David Roney, whose life is like an incredibly inspirational tale. And we just want to see more of those in the world. And we're doing documentaries. We're focusing on things where I say this often, but it's a good shorthand. We are trying to make and look for things to root for as opposed to against. So many people today, it's pretty easy to root against things. I don't like, fill in the blank. And we prefer to find things that we can root for, and we think that will inspire other people as well. Same with media, same with what we're doing with podcasts and Substacks and YouTube. We just think there's a lot of room there. And then we also have Infinite Books debuting, and same sort of thing. It's like I've written 4 books, and the publishing industry, traditional publishing industry, hasn't really changed at all since I wrote my first book back in the early 90s. And we now have the tools and technology to really invert the deal for authors. We think that authors should be getting a lot more of the revenues than they're getting under a traditional publishing agreement. We think that they should have tools like dashboards so they can open their computer every day and say, oh, wow, my book just 5x did sales in Omaha. I wonder why. And so we're going to be building all of that into Infinite Books.
And it's so interesting, especially in books and publishing, because these are some of the data questions where you're asking, why is this margin still this way? Why are we counting in the book sale numbers like audio, print, and Kindle all in one place and enshrouding this from the authors making these things? I can't help but feeling like you're bringing some of the rigor to some of these places and going, it's a different type of disruption, the way I feel like you're attacking this.
I think that's right. I think that what we want to do is look at things that fascinate me, so books, films, early stage investing, et cetera, and then bring a little bit of my old quantitative background and just say, wait a minute, why are authors still getting just a fraction of the sales of their books? That doesn't make any economic sense, right? And so if you look across our verticals, you'll also see these are areas where I feel that there's a huge arbitrage ability if you do it right? So let's stick with books. The fact that the traditional book publishing industry hasn't really embraced a lot of these changes kind of baffles me, because like you can improve the model for readers, You can improve the model dramatically for authors. You can improve the entire experience. For example, audiobooks. Why aren't audiobooks living things? Why if the author is on a podcast where he or she is particularly great, why isn't that added to the audiobook so that the listener can hear the new of what's going on? How about interview tapes? Like my friend Jimmy Soni has hundreds of hours of interviews with guys like Elon Musk. I'm sure you might have heard of him. And why aren't those on the audiobook? They should be. Why aren't audiobooks published in every language that is spoken today? With AI and with the translation getting better and better and better, that's very conceivable to do right now. And so we just think that there are so many ways to improve the experience for the reader and for the author. And like everything we're focusing on, we do have a rule, which is we are only going to look at opportunities that we feel can be win-win, right? Win-lose, zero-sum opportunities we think are of no interest to us anymore because we don't have to live like that anymore. And so we're just trying to practice what we preach.
Inside of this, because it feels like, how do you make this an investment and not just a hobby? Like, it's one thing to just throw a bunch of money at this and make a bunch of cool stuff, but you're also trying to build businesses here.
Mm-hmm.
How do you think about, like, on the publishing, just on publishing alone, how could you do that and make it profitable? And yes, win-win for everybody consuming the things in the ecosystem, maybe not such a win for Penguin or somebody, but like, how do you build a business around this and make it competitive?
So I think you build the business by offering much better products, right? And what does that entail if we just stick with books for a minute? Well, a better publisher is one that is better for the author, offers more choices, like I just mentioned, and enumerated for the reader or listener. And given the tools and technology that we have today, it can be a massively profitable enterprise. Let's say, for example, we do a split of 70% of the revenues to the author, 30% to Infinite Books. We are still going to be very, very profitable because we don't have to do it the old-fashioned way. It no longer takes a year to print a book, and yet.
Right.
And yet that still seems to be the general rule of thumb. So what we're doing is we're simply looking at inefficiencies and saying, there's a much, much better way to do this part of the process, this part of the process, and this part of the process. And so, it's Schrumpter's creative destruction. It's basically, there's a huge opportunity here. Can't really imagine why the existing players and dominant players in the industry aren't doing it. But I mean, that's human OS, right? Like GE and transistors. Why didn't GE own the transistor market? Because their vacuum tube division was their most profitable. And so it's really, really hard. If you're making a boatload of money doing it the old-fashioned way and using the old playbook, it takes a lot of gumption to be able to say, you know what? We're just going to tear up that playbook and we're going to do this new one.
And those play all the way forward, right? I think about Blockbuster passing on Netflix and some of the really fun things.
Exactly. And, we can all feel like we're very clever because everything is obvious in hindsight, right?
Right.
And so, God only knows how many stupid things I passed on that went on to be like really great.
That's part of the experience, though, right?
Of
Like,
course
you have
it
to
is.
pass on.
And it also kind of feeds back to your earlier question about intuition, right? When that happens to you enough, you're kind of like, boy, this looks and smells a lot like that deal that I said no to 15 years. Well, I'll give you a great example. When ETFs were coming out, I got approached by the American Stock Exchange, and they said, hey, we'd love to do a suite of what works on Wall Street ETFs. And I'm like, yeah, no, thanks. Don't have time for that.
You guys and your acronyms. Always coming up with a bunch of letters. Alphabet
Exactly true, though. And it was like, no, I can't believe it. It's like, I have a friend, a long-term friend, who was teasing me about it the other day. He goes, "Do you ever think about the fact that you said no to the American Stock Exchange when they wanted the whole debut of ETFs to be using what works on Wall Street data?" I'm like, yeah, I try not to think about it every day, but it's a great example of I learned a lot, right? Wow,
Right.
I should have paid much closer attention to that.
When you think about this and just like what surprised you the most? So now that you're actually actively doing it, because it's also another thing to talk about making these private investments or talk about starting to seed these ideas. There's a big difference when you start to do it. What surprised you the most about getting your garden gloves dirty here?
So I think what surprised me the most, and this is probably also due to my longer career as like an empiricist quant, right? What surprised me the most was how important optics and narratives were, especially in seed investing. You know, you often hear people say you got to get your idea down to an elevator pitch, but I don't know about that, because a lot of the best ideas that I've seen are they take too long to do a good elevator pitch around. And so I'm fascinated by the amount that narrative drives seed stage investing. You know, everyone, it's a you know, axiomatic in public investing that, you know, narratives matter and whatnot. But I always believed in public investing that narrative followed price, not the other way around, right? I'll give you a great example. In the early 2000s, one of our more aggressive growth strategies was loading up on tiny steel companies. And like me and my analysts were like looking at this and we're just like, what the heck is going on here? What? Steel companies in our growth? And then like 9 months later, of course, all of the stories and all the magazines and the journal and everything else, China is building the equivalent of one Boston every month, and they are consuming all of the world's steel. And we're like, that's why the price was going up back then. In seed stage and early stage investing, the stories are much more important in driving interest, I guess. But we try to just look beyond the underlying narrative and just think, okay, is this like really a great idea, or is this just like, I don't know, what's the old saw? If reality differs from the legend, print the legend. We want to try to overlook and being too credulous around, wow, this is going to be the best thing since, you know, fill in the blank. It used to be sliced bread.
It used to be sliced bread. Then it was steel companies. Now it's probably something else. I like to say, because I really hate the everybody needs the elevator pitch thing. And so when I'm talking to like my marketing friends or other people, I'm like, you know what elevator pitches are for? They're for people who ride elevators. So unless you're pitching on an elevator, I'm sorry, I don't need an elevator pitch. I don't really ride elevators that much these days, but I have the go out to dinner pitch, or I have the walking down the street on my phone while you're, you know, on your treadmill pitch.
That's the good pitch. Walking around, just listening to them, and like, we always try to have a real in-depth conversation with potential founders that we're thinking about funding. Because the other thing that we're noticing here on these early stage investments, like the idea, of course the idea's got to be good and appealing to us, but ultimately the team, it is people that ultimately are going to make or break that particular idea. So that's been really interesting for me, because as a quant, you know, we were like, we don't care who the CEO is. It's just numbers. Just give us, we don't even care what the ticker is. Just, you can give us numbers and numbers alone, because obviously you're dealing with a much larger data set, right? And things tend to cancel each other out. When you're specifically looking at things like synthesis schools, for example, we made an investment in that because we thought the idea was great, right? It was Elon Musk's old Ad Astra concept, but we loved the team and we loved where they saw what their North Star was, which was we can customize learning down to the student. because everyone has a different learning style. And what they're doing with AI tutors, for example, they're actually training on their students. And the lesson changes as it learns more and more about the student that
A
they're trying to
whole
teach.
different feedback loop. Like that's that's why
Very,
as a previous
very cool.
knuckleheaded student, like that's probably
Well,
valuable.
exactly. It's very valuable because, you know, the one size fits all, that's dead or dying.
It's like elevator pitches. Why are you doing it the same way? Yeah.
Exactly. We're moving from mass customization or mass production to mass customization. And I think that that is amazing, not only in education, but in medicine. Right now, there are some incredible, we haven't made a big investment because like biotech, but
I hear there's
but
losses there. Like it's not all grand slams. I heard a thing about that.
there's a few.
Worse than venture numbers. Yeah.
But what's interesting is what is going on. I really believe we are on the cusp of an incredible revolution in healthcare, because as we learn more and more about individuals' genomes, as we learn about the ability to create a digital twin of me or you, Matt, and then test those meds on the digital twin, not on us, right? There's a lot of super cool stuff going on right now in medicine and healthcare that, again, stays true to this theme of customization to the end, in this case, patient.
I'm fascinated by this idea. This will be a conversation we'll have to continue at another point about how, like, understanding, because you were manually at one point uploading like the data, manual enter into spreadsheets, because here's this data that everybody has access to, but we haven't loaded it in the same way to start to understand it. It feels like the next advent of data, now that like you don't have to go build a friggin' server room anymore to do your startup. It's like, oh, no, you talk to AWS? Yeah, it's done. Like 10 minutes on the internet and I have all the servers like I need practically.
Exactly. And that's
we have a whole new data set.
Yeah, we do. And that's the, you know, they used to say information is the new oil. I think that clean data sets are really the new high grade crude, if you will. Because you're
West
kind of
Texas
garbage.
Intermediate.
There you go. There you go. But, you know, garbage in, garbage out, right? So if you look at, for example, training a large language model, if you train it on what they call the pile, which is the everything that's on the internet, it's going to be cool. It's going to certainly be a lot cooler than a lot of stuff we worked with in the past.
Could be Gomer pile cool.
Exactly. But how about training it on some of the greatest works of the greatest minds of history? How about training it on all of the various philosophers? Or more prosaically, how about just training it on Will and Ariel Durant's The History of Civilization? There are some really, really cool things to train these large language models on that give you very, very different results. And so I'm kind of like, I often just pinching myself that I'm lucky enough to be alive at this time in human history. It's really, really cool.
Guns, germs, and O'Shaughnessy steel stocks. Look at this. All the growth is here at our disposal. So, standard closing question we're doing for today. What's an interesting thing you see going on right now you think others should be paying attention to? Maybe it's some amalgamation of this. Maybe it's something totally different.
Yeah, no, I think it is kind of the amalgamation of what we've been talking about. I think that we now are at a time where small groups of individuals can create things that just a decade ago took hundreds, maybe even thousands of individuals to do. And connected to that is this idea of what they call smart swarms. In other words, not like the old traditional corporation where, you know, you worked for it for 25 years, you got your gold watch, you always worked with the same people, et cetera, et cetera. Smart swarms are where people who have a particular interest all come together, work on a project, and then kind of dissipate. The project gets done. It often gets done a lot faster and in a much cooler way. But yeah, the tools and tech available to all of us now are like incredible. And I think that we're only going to see more and more of this happening. And that's where I would keep an eye out, because that is where a lot of cool stuff is going to be happening.
So because we're not totally out of time yet, does that mean like in the smart swarm thing, we're not building a hive, to keep using the metaphor here, that has to like scale. Like I don't need the next Airbnb or I don't need the next Uber. We can come together, solve a problem, integrate it into the broader network, and just move on to other things. Like we don't have to wait for the golden watch. I think you just repackage why I don't wear a watch in like the greatest way ever, by the way.
I don't have one on either. I think so. I think that the idea of cognitive diversity is really important, and
Right.
that's a big part of smart swarms as well. There are people who think very differently than I do or you do, and adding them to that type of team can be very, very helpful for getting the project going faster, better, building something that is going to last longer. But the idea that they don't have to stick around, they don't have to learn to hate the HR department. They can move on. I think that the time of people being able to have kind of like multiple careers at the same time is at hand.
Yeah, /careers. Here we go. Jim, I want to thank you so much for your time today. This has been an absolute blast.
It's been fun for me too, Matt. And have another cup of coffee, and good luck on staying coherent.
We're going to keep it coherent. We're going to keep the donations to Susan G. Komen flowing. Go ahead. I think there's a red button somewhere on your screen. We're going to issue in the next crew of guests any second now.
Thank you, Matt. Great to see you. And
You
great
too,
cause.
Jim.
I will be contributing.
Fantastic.
Cheers.
Thank you.
Bye.
Cheers. Mr. Carvino.
You
the hits
survived.
keep coming.
That was great. Good job.
Oh, yeah. It's a good time. It's always fun to talk to Jim.
Nice.
And look who it is.
Howdy.
The man, the myth, the legend himself.
What's up,
Maybe.
Justin?
Obi, what's going on?
Am I too zoomed in here? Hang on, let me see if I can back out a little bit.
You're looking good. Up close and personal. That's okay.
My giant head looming over you two guys. That's not going to work. How are you? We haven't met before. How are you, Justin?
Good. Good. Thanks for jumping on with us. We got 30 minutes to jam here, so let me make an intro. Not that you need one, but Tobias Carlisle, founder of Acquirers Funds, author of multiple books, including The Acquirers Multiple and Quantitative Value, host of Value After Hours. And did you podcast today? I think you might have had one today, right?
I did.
Yeah.
I did.
Yeah. Kind of competing with the marathon here, buddy. But no. Hey, and just as a reminder, the purpose of today's event is to support the Susan G. Komen Foundation. People that have the means and are willing to, please consider donating to a great cause and a great charity. You can use the link below on YouTube, and you can donate right on YouTube to keep it nice and simple. So appreciate everyone who has donated so far. I think we're almost across the $5,000 mark, which is great. And yeah, thanks everyone for supporting us. So let me ask you this, guys. I'm thinking of, and I specifically AC/DC because they're from Australia. So I'm thinking like value investors, the 3 AC/DC songs that probably best capture what value investors have had to deal with over the last decade: Highway to Hell, Back in Black, and Thunderstruck. Yeah. What do you think?
Yeah.
Wait. I'm interrupting. It's definitely not You Shook Me All Night Long, right?
Right.
Because value did not, it shook you, but in like not the good shook way.
Exactly.
And that song, correct me if I'm wrong. Yeah, I mean, do we have some like Let There Be Rock, like in some of the resurgence? Maybe that's a short-term hit. What do you think, Toby?
I think Back in Black is that's a long bow from where I'm sitting.
That's true.
I just posted 2 charts because I talked about them on my podcast, and I thought it'd be fun. Maybe we talk about it a little bit here too. It's a Yardeni chart series where they've taken S&P 500, that's the largest 500, S&P 400, that's the mids, S&P 600, that's the smalls. So of the top 1,500 names, divided like that. So clearly, there's a big universe underneath that as well. So we're not really talking micro or nano, but we're just talking in those ones. It's striking to see the earnings of those three cohorts, because the S&P 500 has completely recovered and has gained new highs in terms of its earnings, whereas the 400 and the 600 are yet to recover to where they were in 2022, early 2022. So I just think, and then when you look at the multiples also reflect that the S&P 500 has the earnings the multiples are high, and they're higher than average, and the mid and smalls are much below average, well below average. It almost looks like it's like a little 2020, 2009ish, 2008ish. So I think that its value tends to be towards those in those sort of smaller groups, and I think
Mhm.
you know, as much as it's value that's sucked, it's also a size issue. Just the smaller companies aren't getting the love. What do you guys think about that?
I just have to point out, you just made the ultimate argument for it's a long way to the top. Because that's what I'm saying. I don't know.
It's a long way to the shop if you want a sausage roll. That was...
If you want a sausage roll. The answer was you did want the sausage roll, though, right?
And you do.
You do.
But I think, that's kind of consistent with some data I've seen that, in these large cap, especially the dominant growth names, I mean, the earnings are there for the most part. They've come through. And then you pile on the really good, strong performers, NVIDIA and some of those others. And then you look in like the small to mid cap, value area, and it's just a lot of like companies that are kind of just, along like the flat line, if you will, from a profitability and growth standpoint. And there's, more junk there, certainly. But I don't know. I think it's kind of consistent. But eventually, maybe what you need, I don't know, Toby, you tell us, like, I mean, maybe where the value premium comes from out of that group is you need more of a washout, maybe, of some type to get the reversion out.
That's what I've been saying.
What about the?
I was just gonna. Yeah, I think that it's a lack of risk appreciation. There's not enough sort of love of risk. I got to trying to reconnect here. Hang on. Have you guys lost?
It's okay. I'm getting the same thing too.
Come
went away.
You're good. Yep.
I think that they say capitalism without bankruptcy is like Catholicism without hell. Like you need the downside risk to be real for people to get them to behave, in a way where they would buy the stocks that I want them to buy, basically. And so without the risk of the washout, you're free to go and buy these things that are riskier because they're early stage, haven't, succeeded quite as well. And that's the stuff that seems to attract a lot of the money, although NVIDIA's not that at the moment. NVIDIA's having a pretty good run. I don't know. I tell you something funny. I looked up the other day. I was looking at the four horsemen of the apocalypse. Not to get, I was going to tweet this out, but I thought I use the Twitter account so infrequently these days that if I tweeted this out, people might think that I'd lost my marbles a little bit. But I looked these up. The four horsemen of the apocalypse. I'll give you the names of them. So they're typically conquest, war, famine, and death, and then they have names. They have Greek names, and I'll give you the Greek names of these. I'm gonna lose them.
I'm pretty sure it's not NVIDIA, Amazon, Apple.
No joke. The first horseman of the apocalypse is NVIDIA.
There you go.
Interesting.
I didn't want to tweet that because I don't want people to think he's gone nuts. But that's the case. I just thought that was bizarre. I told my wife about it. I said, it's completely insane that where did they get NVIDIA from?
That's a great question.
It means to conquer, I think. It might be Greek for to conquer.
Interesting.
So what about I'm really curious about this with that divide sectors. So as we look down, because the sector composition changes as I move down from S&P 500 into 600 and all the way down. What are you seeing? Like what looks cheap and doesn't look like a complete veritable disaster as we get smaller?
The things that I have tended, I'm largely systematic. I'm not macro. I'm not directing the investments this way. I'm buying things because they get I'm buying things individually, bottom up, that get cheap, and then the outcome is sometimes there's a concentration in a particular sector. But it's certainly, there's a lot of energy names in there, and there's a lot of financials in there. There's some industrials too, but clearly it's underweight tech and those kind of names. There's also, just in those smaller companies, it's one of the unique things about the States versus the rest of the world, that you get those huge consumer discretion, where you sort of lump them all in together as being tech, but Google and Microsoft, and I guess like Google's almost a consumer goods company. They've got a big business component as well, but there's Gmail and YouTube and all those sort of things. The equivalents don't exist in other countries around the world except for China. They have the local version of those things, and so the same thing happens as you go down the market cap structure. As you get closer to the bottom, there's just fewer amazing businesses down there. There are some good little niche businesses that'll probably remain niche businesses, but there's nothing like. And then you have the effect, like Facebook doesn't come in as a small cap, where previously they might have listed that pretty early on, and it could have grown through all of those layers and become what it is. But instead, it comes on the board as a big company, fully valued. These things are private now. Like OpenAI is like 100 billion private. SpaceX is bigger than that. When they come on the boards, they're S&P 500 companies.
Yeah, you don't get that benefit of that value migration that you might otherwise get if they were smaller companies, riskier companies maybe, or cheaper companies maybe to start. Let's do this, Tove. Let's talk about the acquirer's multiple just for a second and set up like what that is and why you've chosen that's your primary value metric in your strategies.
I've done a lot of back testing, and the back testing that I've done is fundamental back testing. So rather than looking at just price movements and trying to predict things from price movements, we ignore all of that sort of stuff. So look at fundamentals. If you look at fundamentals, it's pretty clear that the biggest returns accrue to value-based fundamentals. So very simple price ratios like price to earnings, price to cash flow, price to book. Even though price to book's got lots of problems, it's still reasonable. It does work as a price ratio. There are others that work better. Flow metrics work better. So price to cash flow works very well. Price to free cash flow. When we ran the test in 2010, we found that the price ratios that worked the best were operating income defined as either EBIT or EBITDA or any other construction of it versus enterprise value. And the reason is probably that there's quite a lot of information in enterprise values, market capitalization, plus any cash, minus any liabilities like debt or preferreds or minorities and so on. And the EBITDA number gives you earnings before interest and taxes, depreciation, amortization. So there's more information than in like a price earnings ratio. We compared, so those are obviously very simple price ratios. Then you would say, well, there are some simple things that you could do to improve just the price ratio. And naturally, then think like a value investor. You'd say, well, healthier balance sheets are better cash flows are, the more of your revenue that you convert into cash flow, free cash flow, the better your business is, the fatter your margins, all that sort of stuff. The funny wrinkle to it though is that the magic formula was the first sort of quantitative strategy that I had ever heard of. That book came out in 2006. And then there was an analysis of it that was done by James Montier, where he said, if you just look at the value metric there, the EBIT to EV, you get even better returns than if you use both the return on invested capital and the EV, which sounds counterintuitive, but it's probably because the magic formula is finding stuff that's closer to the top of its earnings cycle, closer to the top of its business cycle, whereas EBIT's really finding stuff that's really bombed out and has the potential to mean revert at a business level and at a price discount level. And so that's why I prefer the acquirer's multiples, just simply that very simple cut to start off. And then I look sort of at the cheap stuff, try and find the stuff that's otherwise healthy, got a pretty good balance sheet, pretty good cash conversion, because that's ultimately what business is. That's what you want. And we form portfolios on that basis. And so I have two. I run ZIG, which is mid and large cap. You can think of it as like the largest 25%. It's equivalent to the Russell 1000, but it's that kind of universe. And then I have Deep, which is small and micro, which is equivalent to the Russell 2000, which is the smallest 2000 out of the biggest 3,000. So there's still some companies beneath that, but it really does run into that thing that I was talking at the start, where it's exactly the same strategy in both funds. But ZIG has done much better recently because it's got access to, it's just in that part of the market that has moved, and Deep has suffered because it doesn't collect any of those names. And it's funny that over the course of so I've been running ZIG for coming up on 5 years now. And I track little statistics, and one of the statistics that I track is the median market capitalization of the portfolio. And it's been amazing to watch it crash over the last sort of 18 months from median market capitalization. That portfolio was something in the vicinity of $40 billion for market cap. And I think now it's down around 9 or 10. So it's come in a great deal, which is just the market expanding, all of the bigger companies expanding and leaving behind all of the small and mid and micro, nano type companies. So I think that's a mean reverting phenomenon. I don't think that that's like a secular phenomenon. There's a lot of people who feel like that is, like they're just not getting flows. They're never going to get flows. It's all over for those companies. But I think it's mean reverting. It's happened lots of times before. We saw something similar in the end of the 1990s, early 2000s. And that was what I think created that sort of golden era of private equity taking public companies private, and activists, all of those activists like Bob Chapman and Dan Loeb, when he used to send the poison pen letters, they'd attach the nasty gram to the 13D filing just to draw attention to something, often it was pretty egregious. It was worthwhile. And then it spawned a whole industry of that. And I can easily see that happening. And I know that there are people out there who are looking at these companies. That's been one of the funny things. Private equity's got so much money, but private equity really hasn't done a lot. And I think it's because these businesses, even though they're small and micro, they're still quite big. And it might be one of the reasons why the cohort that is listed hasn't performed as well. There is a little bit of adverse selection going on where the best are taken private. The rest are sort of able to run amok. It's a little bit frontier, the small and micro stuff. They're not they're not as well managed as the bigger companies are.
I'm going to kind of pivot here for a second. How long have the two ETFs been around? Remind me again. ZIG.
ZIG is coming up on 5 years in about 2
Love
weeks.
the name, by the way. One of my favorites.
Yeah.
As a Ziegler. Really pro.
There you go. Zig and Ziegler.
Endorsed.
It's hard to cut through. It's hard to have something that people remember. So that was why I got that one.
Yeah, and good job not picking Ziggy the cartoon as your logo, because that would have been terrible marketing choice.
You may not interface with most or the vast majority of your shareholders in either fund, but how have they done sort of just from a sticking with it behavioral standpoint? I mean, you obviously know the creates and redeems as they've come in and as they've kind of gone out. I think you've had more creates obviously than redeems, right? And you do a great job of educating and being out there and being out, the public face of the fund. But I'm just curious, when you happen to have these one-off conversations with a financial advisor or a large investor that's kind of been there since the beginning. I mean, especially during the period when value was really struggling, how was that? And do you think people were kind of committed going in?
I think a lot of people understand that there is a cycle and that they do believe in mean reversion. These things don't just get cheaper forever. Eventually they catch a bottom. Everybody's scared though. Nobody knows where the bottom is, so they don't want to be the first person in because and clearly it's been a very long drawdown for value, right? Because it's the longest in. Mikhail Samanov has this 200 years of value analysis where he says this is the worst one in 200 years. The data, as you go back further, it gets less and less reliable, but it's still kind of an interesting analysis. And then Momentum had the same thing in 2000. Momentum was down like 90% in 2000. So value just sort of followed on a little bit behind that. I think there's a lot of people out. I think there's a lot of common sense in it. If you have the less you pay for cash flows, all else being equal, the better you're going to do. And so you pay less for cash flows, you do better. The cash flows get cheaper, you should be doing better. And I always do this analysis where I point out that there's two sources of return. There's the shareholder yield, which is buybacks, dividends, anything like that. And then there's the reinvestment rate in the business. And the reinvestment rate turns a little bit on the ability of the company to maintain a high return on invested capital or to grow its return on invested capital over time. And the thing about these businesses being beaten up is that they're at a point in their cycles where their returns on invested capital aren't great, but they're not always bad. If you look back through history, I mean, everything like energy had a shocking 2020 when energy traded at a negative barrel of oil out of the ground because there was no storage anywhere for it. That's clearly going to be a short-term phenomenon. And we've seen $100+ barrels of oil since then. Through my investing life, which is now sort of 20+ years, I've seen oil do crazy things like that. Oil is up and down and all over the place. And when oil is up, there's a lot of investment in the sector. It's true for every other industry. They're all a little bit cyclical. Some are more cyclical than others. When they're down, they attract no attention, no capital, and their cost of capital is high, and then you want to be a supplier of capital to those guys at that price. And then at some point in the future, it recovers. I think that most people sort of do understand that. They're just worried in the immediate moment that they haven't yet found the bottom, and they feel like they can divine the bottom when typically, you're never going to pick the bottom. You just got to find, when the opportunity looks good, then it's time to put the trade on. That's been my experience. And sometimes you get lucky and sometimes you get a year or two ahead. People who say early is wrong don't know what they're talking about.
And they just haven't been early for long enough yet to convince themselves they're right. How do you reconcile like the flows solving the problem of new investment dollars coming to the States to want to own the stocks itself? Like, do you differentiate that between maybe it's the next boom in private equity that wants to come scoop a bunch of these companies up, and maybe it's not LBOs this time. Maybe it's coming and like consolidate a bunch of these. Do you care which way it goes?
I don't think you even need that analysis that I gave before, where I said it's the two sources of return are shareholder yield and reinvestment in the business. There's no multiple expansion necessary in there to generate returns. And I assume there's no multiple expansion in any of the things that I buy. And I can look at the forward returns. I think that an elite long-term track record for an investor is somewhere in the vicinity of 15%. If you can sustain that, you'll do pretty well. And you can invest I think that the nice thing about a 15% bogey is it stops you from reaching to, if you're going to aim for higher than that, you've got to do something, you've got to be off the beaten track a little bit. You've got to be really doing something. I think it makes you a little bit more aggressive than you probably want to be over the very long term. So I think 15 is a good bogey. I think you can use that in your analysis of these companies, things that get over 15. And I can always find there's enough businesses around that I think you can get over 15 pretty well, pretty safely. And then I'm focused on surviving. So I want the businesses to survive. I want the balance sheets to be able to survive. I want the management teams to survive. I want all of it. And then if I own a whole lot of companies that look like that, then the fund should survive. I should survive. It all should work like that. So I think that multiple expansion is a nice thing to get, but it's sort of like it's something that you can't rely on. And it could be conglomerates, it could be buyouts, it could be activism. There's lots of venues potentially that could materialize, and it'll be some fad. Somebody will do something and make a lot of money, and then there'll be a whole lot of people who follow on behind them. But I don't mind. I think that the returns are already embedded in. So this is why I sound bearish a lot when I talk, but I think lower prices are better. If you're an investor, you want lower prices, because when the prices go down, the forward returns go up. It gets easier to generate those forward returns when you got low prices. Without the multiple expansion, you don't need the multiple expansion, even though then you get the multiple expansion as well. It's crazy. You get it when you don't need it.
I think we need like Greenblatt to go teach a new class to a new crop of academics. He needs to go rewrite Stock Market Genius, go teach it at whatever the new online Columbia Business School is, and get the next Greenblatts and or Greenhorn or Einhorns and everybody else out into the field for us here.
Every time they publish one of those, that little anomaly goes away. You know, that
right.
The one that I always love was the accruals anomaly, where, you know, if you're reporting earnings that aren't translating into cash earnings, you have to create an asset somewhere, and so you get an accrual, and then that's people started using that as an investment strategy and arbitrage it away, but clearly it still works. So at the moment those guys publish those things, that little arbitrage will be gone for a while, but it'll come back eventually.
It'll come back.
I think we're in a funny time because I think it's what has worked for the last decade is not really what has typically worked in the markets. This is an unusual period of time, and particularly after 2021 or 22, whenever the mania really finished. And then we had 22 was sort of a down year for everybody, but then 23 it's all come back to life with Nvidia probably and AI leading that. Everybody's back in the growth bucket, but that's not typically been the place to be. You don't want to be in the highest, fastest growing stocks because they tend to disappoint, and I'd be surprised. Maybe this time will be different, but I don't think so. I'd still rather be in the value stuff. And I think value turned the corner in late 2020, and it's sort of been working since then. It's worked more or less. We're probably pulling back a little bit from where we could have been, but we're doing pretty well.
I think one of my favorite parts about your work is the idea that you said before, like you specifically never want to rely on multiple expansion to solve the problem. That's a really different view than what you would have than any like growth investor or many tech stock investors or other things where it's like, no, we want price to outstrip earnings growth or multiple other things to get there. You're saying I don't even care about that. I just want the business to compound cash on cash.
I think to be fair to the growth guys, they would say we're in these businesses because the businesses are growing very quickly. I think it's less about multiple expansion for them. And I think the criticism of value has been that it's about multiple expansion. And I think if you look at, O'Shaughnessy Asset Management has a great paper where they break down the returns to value and to growth. And the returns to growth are, you do get, in fact, faster earnings growth than the rest of the market, but you get a little bit of multiple compression because it always disappoints. It's just growth tends to slow as companies get bigger. And so it just tends to disappoint, and that multiple contraction tends to overweight or override the earnings growth. And in value, it's the reverse. You do get, the market isn't wrong. They do tend to have some earnings compression. It's just that it's not as bad as the market thought. And so they get the multiple expansion at the same time. And the multiple expansion outweighs the earnings contraction. It's not as bad as everybody thought it was going to be. So value tends to outperform and growth tends to underperform, despite the fact that growth does deliver earnings growth and value delivers earnings contraction, which doesn't really make any sense. It doesn't sound like it should work, but it has traditionally. But that relationship has probably broken down a little bit over the last few years. But I think since 2020, it has it looks more like a more traditional market to me.
Speaking of surviving, I know and we've talked a lot about Buffett in our conversations, but what would you say are the biggest lessons long-term investors can take from Buffett from your perspective? And by the way, while you think about that, and it's all getting blurry to me because we've talked to so many people today, but somebody was saying, like, if Buffett launched Berkshire in a mutual fund, him having a company was much better than a fund because those fund investors wouldn't have stuck with him in the early days. Obviously, his shareholders did, but so I don't know the huge difference, but that's what the point that the guest was making. Anyways, so I don't know. What do you think with Buffett?
Yeah, so survival is a huge thing. The no donuts. He doesn't do so many different things that everybody else is doing at some time, and sometimes he'll follow on after the fact. But it extends. He thinks about. I think nobody thinks more deeply about risk than Buffett, and he'll find it in every. He says if you're looking to make an assessment of a partner, whether it be a CEO for your business or an investor in your firm or whatever, like any sort of partner. You want energy because you need people who can get stuff done, and you need some sort of level of brains because they need to be able to direct that energy in the right place. But then you also need them to be, people who've got good character. You need people who are honest, because if they're not, and they've got the other two, the energy and the brains, then you're in a lot of trouble. And so he's, and then he does this thing like I don't want to be naming the names of the people who but there's a pretty famous story how he thought that he had too much risk concentrated in the Twin Towers. And he asked his CEOs of his insurance companies, just not thinking, this is pre-2001, not knowing that anything was going to happen, not thinking that anything was going to happen, just if something did happen, we've got too much risk there. And so he instructed two CEOs who had the concentrations to take down their exposure to the Twin Towers. And one did, and one didn't. And you can read the letter that he wrote just after that. He's effusive in his praise of the one who did, and the one who didn't doesn't get mentioned at all. And that's the way he operates. He's praising by name, criticizing by category, as he says. But I think that he's aware that you don't want to be creating enemies either. You don't create enemies. Do business with people. Like, he's thinking about it in so many different dimensions, and I think that that's underappreciated. That part of his success is just simply his longevity. That you can have bad periods where mutual fund investors would pull money out, but provided you survive through, it could be a decade of underperformance, if you get out the other side, then you probably have a market that's now cheaper and more suited to your style. You could then have your very good run, and he's managed to do that. He's managed to survive and compound, survive the bad periods, do very well in the good periods, and that's sort of one of the underappreciated secrets of his success, I think.
I think that's a great response. I know these half-hour sessions are kind of tight, so we have like maybe another minute. Sorry to rush you off here, but the last sort of standard closing question is, we're asking everyone this: what is one thing that you're seeing right now that you think others should be paying more attention to?
Yeah, that's interesting. Well, I'm probabilistic in the way that I invest. I don't anticipate I'm not trying to prepare for any great crash or anything like that. I think that if you should expect a 50% drawdown in the markets at any given point in time, and make sure you can survive that. So just putting this aside, then here's my macro prognostication. I've been watching, the 10-3 has been inverted for a very long period of time. If you look at where that front end is pinned, it's higher than it was 12 months ago. The rates that the market are paying are higher and higher. And the back end is starting to respond to it a little bit. As the rates come up, if you can get a better rate risk-free or low risk with government treasuries, and you look around how risky the stock market is, there should be a little more of a discount in the stock market than there is. And I think that we see it already in small and mid, we just haven't seen it in the large. And when the large goes, then the indexes go too. So I think that that's probably... I think that there's some math to this, like there's some gravity to this market. At some point, the gravity catches up. It's like Wile E. Coyote and the Roadrunner. It doesn't necessarily know when it's going to happen, but it does eventually catch up. How are you guys feeling? How are you feeling, Justin? You're a good athlete. Are you hanging in there?
It's been a long day.
It's a
Let's just put
marathon.
it that way. Yeah.
He's
Matt
playing
and
a lot of AC/DC in between.
Well, I was going to say, and thank you very much, Tobe, for doing this. We really appreciate it. I'm going like AC/DC, who made who. I kind of like that one.
I like that.
Like, who made
Better
who,
choice
who made
than
you?
big balls. I want to just create
All right, Tobe.
Thunderstruck for me. Thanks,
Yeah,
fellas. That was
love it.
really
All
fun.
right. Thanks, Toby.
Good seeing you, Justin. Good seeing you.
Good seeing you too.
Bye now.
What's up, Toby? How's it going, guys?
All right.
All right. Best of
Good.
luck closing out your day.
Yeah, thanks, Matt.
I'm
Great
bowing
job.
Thank you. Yeah, Matt, you're done for the
Keep
day.
rocking. I'm going to go
Nice work
watch
today,
those
Matt.
donation numbers keep ticking up. See you guys
All right.
later.
All right. See you, bud.
Thank you for all the help today. All right, let's let Bob in. Hey, Bob.
Yo,
Sorry we are a little bit late.
what's going on?
We are
Bob, how are
9
you?
hours deep in this thing today.
No worries.
So
Yeah, I can't believe you're within 2 minutes, 9 hours in.
we've
It's
actually
like
been pretty good. We
landing an
haven't.
airplane on a postage
I
stamp.
don't think we've been more than a minute or two late ever. So we've We've been forcing people out if we have to, to keep things on.
Throw them out of the room. Forget it.
Exactly.
Had enough. On to the next.
Well, I haven't been able to figure out how to throw them out of the room, so they have to leave on their own volition. So if somebody did want to stay and join us for the entire day, I probably couldn't figure out how to get rid of them. But it's good I'm only revealing that at the end of the day. Just so no one stayed with us all day. We would welcome all our guests, obviously, to join us all day if they wanted to.
So quick introduction, Bob, founder of Unlimited Funds, former member of the investment committee at Bridgewater. We like to bring you in, talk about macro-related themes and how investors should be thinking about the current environment and landscape and investing. And just as a reminder, and we've done this in every single one of these, this event is to support the Susan G. Komen Foundation, supporting the fight against breast cancer. You can donate at the bottom of the video. And I think maybe we crossed 5,000, but it's been, decent. Of course, we'd like to get more if possible. So if people are willing and able, please consider donating. We very much appreciate it. Okay, Bob. So, yeah, there's been some interesting developments, macro economy related. It seems like inflation is coming in maybe a little bit hotter or stickier, and growth looks like it's coming in a little bit slower. I don't know what the GDP print was, like 1.6 versus 2 something, if I'm getting the numbers somewhat right in there. So I'm just, and I think the market is somewhat reacting to that, it seems like. And just, can you give us an overall view of where you think we are economically?
Yeah, I mean, I think from an overall economy perspective, we're still very late cycle. Unemployment rates at secular lows. Income growth as a function of that is still relatively elevated, which is leading to nominal spending that's too high relative to the productive capacity of the economy. And the combination of that means that inflation is still elevated above what the Fed's target is. I think I think the resilience of the economy has surprised many folks, given that we've basically have been at this higher rate environment, for 18 months or so. And, there's nooks and crannies of the economy that are weaker, for sure. If you're a loss-making, debt-laden, private equity-backed company, life's a little tough for you. But if you're if you're a cash flowing business, if you're a big business, if you're a household that's got, decent income growth, you're employed, decent income growth and a 3% mortgage, and your 401k zooming up and your house price going up, things are going pretty well. And so I think that all speaks to the sustainability of this current expansion being much more fueled by income growth than most of the expansions that we've seen in our careers, which are much more debt-oriented expansions. And, income-driven expansions, they can last a long time. There's no unsustainable activity when you have an income-driven expansion the way that we're having.
Yeah, so that's a big part of the resiliency, is this income levels have stayed up, employment has stayed relatively healthy in most areas. And so people have money coming in, consumers are spending money. Because, it is, if you think of it to your point, it's like how much rates moved, the cost of borrowing. You would have thought that there would have been more pain in different areas. There's pockets of it, commercial real estate in certain areas, even though that's being, so yeah, it's interesting how resilient it's been.
Yeah, and I think in many ways, this expansion, I think a lot of people find this expansion to be very confusing, and then they're sort of fumbling around to find the explanatory dynamic that's going on. Oh, it must be fiscal, but the fiscal position of the U.S. is actually, the deficit's actually been contracting for the last couple of years. Or it must be interest that's funding everything, but that has added at most 50 basis points of GDP growth over the last few years. That people are fumbling around, they don't understand it, and that's because the cycle we're experiencing today is actually much more akin to the old time cycles of like the 50s and the 60s, where you have these sort of income-based expansions, and they're quite persistent. And it doesn't mean that monetary policy is totally ineffective. It has its effect to some extent, but when you have borrowing as soft as it already is, the borrowing channel is not going to be the big channel for creating the slowdown in the economy. Basically, what has to happen is interest rates have to rise enough to start to create a drag on asset prices, and that drag on asset prices will then create a desire to save more and spend less, and that'll create a slowing of spending, which will create a deterioration of earnings, which will create a deterioration in employment. But when we look at that cycle, like, where are we? We squint at the S&P 500 every day, like, we're not at peak, but heck, we're percentage points below peak. And we look at house prices, they just keep going up, right? For most people, hardly a flesh wound there in terms of the tightening that's gone on so far.
On Twitter, you outlined a framework where you articulated a way that inflation ultimately might get stomped out here. Can you just talk about what that was?
Yeah, others have that you've talked to earlier today have slightly more elaborate, works that they've created, scripts they've created.
You're talking about the acts of the play. I like the acts of the play.
That's right, the acts of the play. Which much respect for Andy. Everyone should read the acts of the play. I'm more of a fits in one tweet kind of guy. So basically,
Nice.
what has to happen in terms of the ordering, and the ordering matters. I wrote this back when people were like, "Well, I should buy bonds because eventually there'll be a recession." And I'm like, no, that's not how it works. You have to think about the ordering. And the ordering is that interest rates have to rise, and then asset prices fall, and then spending slows, and then earnings deteriorate, and then hiring deteriorates, and then spending slows, and we get that negative self-reinforcing dynamic. And that once there's enough slowing of nominal spending growth relative to the productive capacity of the economy, that will start to create a slowing of inflationary pressures, both because wages will come down, and the overall nominal demand will also come down with it, leading to price pressures that are softening. And so far we're just not there. Like, if you look at what's going on with nominal GDP growth, if you look at end demand, which is different from GDP. GDP's, whether there's inventories or not, and whether there's foreign demand or not, it's not that important. Like, if you're trying to understand sort of the durability of the economy, you want to look at, final sales of domestic producers, or you want to look at, end demand, nominal demand, domestic demand. And if you look at those, basically we've been in this 5 or 6% nominal demand range for a while, right? And it's no surprise that is happening at a time when wages and salary growth from the PCE report are also showing 6%. So we've got essentially 6% growth in wages and salaries, 6% growth in spending, roughly stable savings rate, and a nominal GDP growth at the aggregate economy level of about 6%. Okay, well, there you go. Like, it all ties out very nicely, and that will persist until there's a good reason for people to stop spending.
What do you make of Justin mentioned the weak GDP print earlier. What did you make of that? I mean, Twitter immediately erupted into stagflation. That's what we're going to see. So was that kind of a one-off thing, or is there something we should read into that?
No, that was not indicative of stagflation at all. It was, the fact that this is a problem with GDP. I mean, GDP is a fine measure, but you got to know what you're looking at. Like, GDP has all sorts of issues related to the fact, like, if inventories are up or down. Like, who cares if inventories are up or down? It affects GDP, but it doesn't really affect my underlying sense of what's going on with aggregate demand. And so that's why I like to look at numbers like, real final sales to domestic producers or real final sales of domestic product. And also, to be honest, look at nominal final sales of both of those, because that gives you a sense, like, in general, they do a fine job figuring out how much is inflation and how much is real goods, but you never know, and there's lots of adjustments to that. So go to the number that's like the most basic number that represents the domestic demand story. That's final sales to domestic purchasers is what they call it, and final sales of domestic product. And what you look at when you look at there, we've basically been across those two numbers, a little downtick last spring, but we've basically been at the same level since Q1 2022, basically the same, about 5 to 6%. It's not very interesting, and that's the thing I think people get confused about, because they think, if you read Twitter and you are in every day, you think, the economy's booming, the economy's in a disaster, it's booming, it's a disaster. Like, the economy, absent an acute external shock, is very slow moving, very, very slow moving. I like to joke with people, someone's like, tell me what's going on in the economy. I say, well, the unemployment rate has been at secular lows for 18 months and hasn't moved. So the answer is not much. It's just kind of doing the same thing. But when I write that on Twitter, I don't get too many views or impressions. So
doesn't get the engagement, right?
Mm-hmm.
You need
the
people like
engagement
me
rate's a little soft when I'm like, actually nothing has changed in 18 months. So why are we all hassling each other about this stuff?
It's the same thing with CNBC. The guys that go on CNBC and have the strong opinions get a lot of views. The people that go on there and say, there's not really much to say. Everything's just going along.
Not much to say,
right? And nobody wants to see that. I would think when you talk about the way inflation is going to get killed, it seems like it would be very bad for stocks and probably bad for bonds as well. Although I think long rates are coming up enough that maybe at some point they become attractive. But how do you look at what this means for stocks and bonds?
Yeah. Well, I think what I'm describing is initially bad for bonds and bad for stocks, and then eventually there's a tipping point where. And that's because the rise in interest rates has to then create a fall in asset prices. And when I say asset prices, mostly that means stocks, to some extent houses, but mostly stocks. So there's a period of time where bonds and stocks underperform. And I think if you look at the board today, it sure looks in that direction, right? We had a higher than expected inflation print, essentially, right, through the ECI numbers. And what did you see? Stocks and bonds both sell off. And that gives you an indication of how sensitive the equity market is to the current level of the bond yields. The big problem right now is we're in a bit of an air pocket, particularly when it comes to both stocks and bonds, which is yields have risen enough so that when they rise more, they start to create a drag on stocks, which is what we see in the market action recently. But the yields haven't risen enough and stocks haven't fallen enough to create a drag on economic activity that would then create this type of easing that then supports financial asset prices. And so we're in this air pocket where, the Fed put is, at least 20% below where we are today, right? And, maybe further given the inflationary pressures, and where the pressure on the bond market persists because growth remains okay at this level of bond yields. And so I sort of like to say, the problem we have is that yields are too high to let stocks continue to appreciate, but not quite high enough to slow the economy and get the easing that would be so beneficial. And that's a sticky pickle right there for a lot of investors, because you get days like today where basically dollar cash is the biggest winner in the world.
You mentioned the Fed. What do you think about the position they're in here? I mean, we've been getting these rate cuts are supposedly coming. They keep getting pushed out. There's a lot less priced in. Andy had mentioned earlier when we talked to him, he thinks maybe not enough, going into 2025 are priced in, which is why he left the higher for longer camp. But what is the Fed going to do here? I mean, are they just going to keep pushing this out and out and out into the future?
Nothing. The Fed is going to do nothing. And I think, I think if you've been through a few Fed cycles in your career, I think the sort of two things that the reaction function, let's say, of the Fed is often to do nothing until there is such a significant growth or inflation dynamic that it motivates them to move rapidly. And so Well, it's very typical to see these periods where essentially nothing happens for, it can happen for years on end, because as long as growth conditions don't deteriorate, there really is no motivation. Like, why, if you're in the Fed shoes right now, like, why would you change monetary policy? Like, what would be the reason? Like, unemployment's at secular lows, growth is fine, and on the margin, inflation is a little too high relative to what you'd like to see. Why would you cut when you can just sit and wait? And I think that's what we're seeing. That's sort of the big surprise, I think, to the market really in the last couple of years, is that particularly when it comes to pricing in what's in the short rate market, expectations have been wildly, all over the place in terms of expecting huge cuts and then hikes and then cuts. And today we're about zero, when in reality, like, what's happened over the last 18 months is like not much, right? Really not much. So not much is going on with the economy, and not much is going on with the Fed. And so, we've got this like not much world, but expectations are wildly moving around everywhere, right? And so the trade has been to fade the expectations, not to run with them.
Yeah, I mean, I can't really come up with the only argument I've heard to cut, and I don't think it's really valid anymore because we've seen inflation come up, is the idea that if they think, and you're going to tell me they're probably not, but if they think they actually are very tight where they are right now, and they want to stick the landing, and they see inflation coming down, they would want to ease into it as opposed to what they usually do, which is something goes horribly wrong, they cut a lot. But I think unfortunately that's probably not valid anymore. I mean, inflation's going up, not down. So there's probably not much of a case to be doing any cutting right now. I don't know if you agree with any of that I just said.
Yeah, well, I think a lot of people, particularly those who are asset holders, really hoped that what was being said by some governors, I call them the real raters, was true, and sort of forgot the fact that, like, it doesn't really matter whether the Fed thinks monetary policy is tight or easy. It really doesn't. The Fed responds to the data that it sees. If growth is okay and inflation is too high, then, at a minimum, it doesn't do anything. Maybe it hikes, but at a minimum, it doesn't do anything. They and the 500 quants with PhDs can sit around and, pontificate about whether monetary policy is tight or easy. It doesn't make any difference. It doesn't make any difference. What makes a difference is what's going on with growth and what's going on in inflation. And so you got to focus on those things, because that is what's going to determine their policy. To be clear, like, the real rate situation in terms of, the Fed's view of real rates today is basically no different than it was 4 months ago when everyone thought that there were going to be 7 cuts, right? The thing that's been different is measured inflation is a little too hot and growth continues to be pretty good. Right? That's what's going on, and that's what's motivating their behavior. Too many people, way too focused on some random academic theories being promoted by these governors. It would be so much better if they just stopped talking. Then people wouldn't be confused by their totally misleading either expectations of future conditions or their misleading frameworks of how the decision making works.
I'm just curious, when we think out longer term, like structural inflation, we've had these forces that have driven inflation down, technology being one, globalization was one in the past, and demographics. Like, those are kind of the reasons we're always given as to why inflation was low for such a long period of time. Like, when we come out of this period, I mean, do you think those are different now? I mean, do you think we have a higher level of long-term structural inflation than we did in the period before?
We may or may not have higher structural inflation. It comes down to whether the Fed or the central banks in the developed world want to choose to accept a higher level of inflation, or if they're willing, or if what they're going to do is constrain nominal demand relative to what it would have been otherwise, in order to keep inflation down. And the reason why I say that is it's clear that some of the big disinflationary pressures that have been so beneficial over the last 20 years are not repeatable. Trying to enter the WTO, that's not going to happen again. We had a massive boom in cross-border trade where production went to the cheapest to produce areas of the world. That's not going to happen again. We had 30 years of the most peaceful time in U.S. or in global history over the last 1,000 years in the last 30 years. maybe that happens, but it sure looks like we're moving in the opposite direction. And so you put all those things together, and the disinflationary impulses that existed before are unlikely to persist into the future. I think the interesting question is, what does the central bank do about that? Because part of why we were able to have such high real growth in the 90s and 2000s was because central banks were getting the dividend, the peace and disinflation dividend, and so they let economies run hotter than they otherwise would be. But if that's not there, are they going to choose to constrain economic growth, or are they going to let inflation run hot? I mean, so far they've let inflation run hot.
So you're not a believer that the idea that AI is going to save us on the inflationary front?
No, I'm trying to get the AI to rewrite my bio into 100 words from LinkedIn. So far, no luck. Sounds like a kindergartner writing it. There's a lot of people. That's kind of serious and kind of a joke. Like, look, there's been lots of technology improvements. I don't know how many times I've heard that technology is going to radically change how everything happens. Like, maybe we'll see. I just.
Yeah, I'll let Justin go here, but the one thing I have noticed with AI is like whenever we use it to look at any of our guests or to try to get like their bios, like it's always making up a degree or two. There's always some degree from Harvard that doesn't really exist or some sort of.
That would be great.
Yeah,
how many degrees from Harvard do I have? Because right now,
well, you actually have the degree, but a lot of other people, it's like.
Well, I have a botany degree. That's not so helpful. Maybe you could put in like a PhD of econometrics or something, legitimate. That'd be great.
I mean, one of the things that maybe the Fed kind of dodged here was, if they had started to lower rates, some may have looked at that as a political thing in front of the election. I don't know. Did you see, I think it was last week, there was a Wall Street Journal article that they were saying that in the Trump campaign, there's some strategists that are floating the idea that the Fed chair would kind of have this handshake agreement with Trump if he wins, that ultimately it would be like, they would agree on the level of interest rates. I couldn't help but think, and I'm just saying this, not for or against Trump or Biden, but like, I just couldn't help but think like Trump would be like, lower the rates. I want better rates on my real estate holdings.
Yeah. What could go wrong with that, Bob? Nothing, right?
Well, I think, in the spirit of things that we've sort of taken for granted during the course of our careers and lifetimes, that aren't necessarily going to be true into the future, like central bank independence it's by no means a given. In fact, if anything, if you look through time, there are waves of greater independence and waves of lesser independence, and then there are just consequences of those behaviors. Like, it's not surprising that if you go back to the 70s and see the significant relationship and engagement between the Fed chair and the president during those periods, it also coincided with elevated inflation, a period of elevated inflation, and then that started to turn as the desire to bring inflation down and enforce independence started to pick up. But those waves happen, and I by no means would think that I wouldn't take for granted that the Fed is a independent agency that is going to behave separate from the presidency. I don't think it's behaving that way today. I think the values of the existing governors and Powell are incongruous with being political reactionaries, but there's certainly no reason why it couldn't flip that way. And as I said, there are just consequences. There's just if Trump puts himself onto the board of governors as the chair, there'll just be consequences of what his prioritization is and his decision making, and so you just have to. I think the natural reaction is like, oh my God, that's the end of the world. We're going to have a monetary inflation no matter what. It's like, if you're trading markets, like you got to get out of that. You just got to diagnose what is likely to transpire and the probabilities, and understand the participants and their decision making factors and what the likely consequences are. Like, I think it would be a reasonable conclusion to suggest that would probably lead to monetary policy being easier than would otherwise be the case in an independent agency, and that's got second and third order consequences in the economy.
What are your views on just the level of national debt and how that might play out here over time? I think, with interest rates where they are, it's obviously much more expensive for us to service the debt. I think some of these auctions are still very healthy. I mean, I'm not like a bond market, I don't follow it that closely, but you do wonder if at some point borrowers wake up to the level of debt we have as a country and sort of how that sort of plays out. I mean, there's been a lot of alarmists for maybe 20 years that have been saying like the level of debt is too high and there's going to be these consequences. But I don't know, just do you have any insights into that?
Yeah, well, I think often people will talk about how extreme the U.S. debt is, and so just to give some perspective, the level of government debt in Japan is multiples of relative to the economy, relative to the size of the economy is multiples of what it is in the U.S. And yet Japan has the lowest interest rates in the world. So, before you just like rush and be like, well, it's clear that we're going to have a debt crisis. Like, let's first talk, start to talk about what that means and the consequences of it. I think it's important to recognize, look, from a supply-demand perspective, to the extent that we're running larger fiscal deficits and issuing more duration, it is a bearish pressure on bonds. And we've seen that as they acknowledge and actually do issue more bonds, term premiums rise, as you'd expect. But this idea that we're going to have an incredible crisis of confidence in our bonds and yields will skyrocket to, what did somebody say, 17%? That's not going to happen because the Fed has the tools. If that's not consistent with the monetary policy that's appropriate given the domestic economic conditions, the Fed has the tools in order to manage that. And what that is they'll just buy the bonds in the same way the BOJ has bought the bonds for 20 years, right? If interest rates are at the improper level and you need to engage in more financing, the central bank buys the bonds and they're essentially retired from the private sector. And as long as domestic residents are willing to save and borrow in the domestic currency, which, my guess is in the dollar, we're not likely to see immediate capital flight given the size and depths of our credit markets. It can be fine, just in the same way it's fine in Japan. And so it's just really a question of what is the right level of interest rate given the economic conditions and how the central bank responds to its reaction function like that.
Bob, thank you very much. These 30-minute windows are tight.
They are, man.
And trying to keep on. I know they go fast, but thank you for joining us. Really appreciate it. Always great to see you. Always great insights, and we'll be reaching out soon to try to get you on excess returns maybe later in the year.
Awesome. Great to talk to you guys. Love what you're doing, and I guess best of luck finishing it up.
Finish strong.
Power through, baby.
Thanks, Bob.
All right. Thanks, Bob. Have a good day.
Get a cup of coffee.
Should see a little red button. I think the little leave red button.
Yeah.
Oh, I'm.
All right, Jack. All right, buddy. I'm going to let you guys roll. See ya.
All right, Brent, you ready to
Brent,
go?
bring it in. Bring it in strong, guys.
Let's do this.
All right. Thanks, Justin.
Hey guys.
Hey, Mandy.
Hi, Mandy. How you doing?
I'm good. Can you hear me?
I can. I can hear you great.
Okay. Perfect.
Yeah. Thanks so much for joining us today. It's a real pleasure to get to talk to you. I've read a lot of your research. Excellent research that you provide. And fortunately, Vault popped a little bit into the close, giving us maybe a little bit of extra pizzazz on our conversation here today. So I don't think there's many who aren't aware of who you are, but if you want to just let everybody know, give a quick background, it would be more than helpful.
Yeah, sure. So I'm currently at the SIBO, and I run the Derivatives Market Intelligence group here. So in charge of providing timely and actionable market commentary and analysis around SIBO's leading, suite of products, which include SPX and VIX, futures and options. Prior to joining SIBO last year, I spent 13 years on the sell side. So most recently running equity derivative strategy at Credit Suisse, where I was in a very similar role in terms of producing kind of tactical trade ideas and market commentary, but in that role primarily aimed obviously at institutional clients.
Awesome. So there's so many things I want to dive in with you about, and I wanted to start because today we had a bunch of earnings, and some of those earnings reactions are mixed. And in your recent commentary that you put out, you made mention of the dispersion index, and so SIBO, you can look that ticker up. It's DSPX, and you made a mention that the dispersion reading had declined recently. But if you kind of bring up a longer dated chart of that index itself, it is still at highs, even though it kind of had a recent decline. And so I wanted to start the conversation because I think it pertains to just larger flows that we've been seeing in the market. Could you kind of let us know why that dispersion index is high, that reading is high, how that pertains to earnings, and maybe what investors can take away from that?
Yeah, sure. Maybe let me take a step back and just talk a little bit about fundamentally what is dispersion, and then I'll go into kind of what our dispersion index actually measures. So dispersion, for those who don't actively trade it or look at it, at a very fundamental level, just measures how much single stocks are moving relative to each other, right? And I think of the most simplistic case, if you get an index of two stocks equal weighted, one stock goes up 10%, the other stock goes down 10%. At the end of the day, index actually doesn't move. So you would say there's zero vol in the index. But if you look underneath the index surface, there's actually tremendous amount of volatility. In this particular case, a 20 percentage point difference between the winner versus the loser. So, for a fundamental PM, if you're a stock picker, dispersion actually is a really good measure of what I would call stock picking alpha or stock picking opportunity set, right? What you really are hoping for is a high dispersion environment where there is a lot of movement at the stock level underneath the index surface, where if you're, if you are able to correctly pick the winners and losers, that's when you get the biggest spread or the biggest potential P&L. Now, what our dispersion index measures is it's a forward-looking measure of expected dispersion of the stocks within the S&P 500. So think of it almost as a complement to the VIX, right? So the VIX measures how much the index, the S&P index, is expected to move in the next 30 days. The DSPX index, the dispersion index, measures how much the stocks within the S&P 500 are expected to move in the next 30 days. And to your point, one of the things that we've been highlighting for the past year that's been super interesting is, even as the VIX has fallen quite dramatically, and obviously in April this month, we've gotten a little bit of an uptick, but overall, the trend has been volatility falling at the index level, but dispersion, if you take a look at it, dispersion actually remaining very, very elevated on a historical kind of look back. So a lot of questions around what is driving that. Certainly, I think earnings is a big part of it, especially now with kind of, higher rates and the macro environment kind of shifting a little bit. People are looking to earnings as kind of the next catalyst for potentially taking us higher in this market environment. But if you just look back in the last 2 years, a lot of the macro risks that we're talking about, right? Higher rates, higher inflation, the way that a lot of equity investors have been playing or positioning for those catalysts is not long or short the index. It's actually long or short specific sectors, specific styles to specific stocks, right? So think about like 2022 when we had, rates going higher and tech selling off 40%, energy up 50%. That was a spread of almost 100 percentage points, right, between sectors. And then think last year, right, tech had the huge reversal. And some other sectors pull back. So that tremendous kind of sector and stock volatility means that, obviously there's still a lot of opportunity at that level for stock pickers, even though, the VIX, up until, very recently was, back down to the low teens.
So we could think of it as market breadth a little bit, I guess, is in similar ways possibly.
Breadth. I mean, that's a tricky term because obviously there's incredible concentration in terms of market cap. Obviously, the Mag 7, Nvidia being very outsized in any measure of market cap weighted measures of volatility. So not quite that, but yeah, and the breadth in the sense of kind of just the underlying like the divergences that we're seeing between stocks. And in full disclosure, so the DSPX index doesn't measure all 500 stocks because there's not sufficient option liquidity in all 500 names. So what we're actually looking at is typically about between 70 to 90 of the largest names in the S&P, where we are able to get very, very robust, option liquidity at the single stock level. Without getting to the weeds, but the way that we calculate DSPX is by basically looking at single stock vol relative to index vol. So you want to make sure there's sufficient option liquidity at the single stock level. So we're really looking at the top 90 names within the S&P, but by market weight. But that gives you a pretty broad, segment of the market.
So related to that, I'm trying to figure out how to phrase all these questions to see if they all kind of end up with one similar answer. You also have the correlation index. So there's core 1M and core 3M, both of which are at lows, multi-year lows, depending on which one you look at, which in a way sync or maybe tell us an interesting story when you look at the dispersion index and compare that to the correlation index. And so I'm curious if there is something that you could tie together, flows that you could tie together that draw us a picture that say, hey, this is why correlation low and that dispersion is high. I think that the two may be related in some way. And I also want to ask you about the flat skews you saw. And I don't know if you want to tie all those together or we can maybe answer those separately. Or
We'll do it all together.
All right.
So correlation is for sure a related concept to dispersion. So it measures kind of how much the tendency of stocks to move together, right? So I think everyone's pretty familiar. 100% correlation, everything moves together perfectly in sync. 0% correlation, they all move together independently. So what we've observed, very similar to high dispersion, we've observed very low correlation of the stocks within the S&P 500, right? So that's what core 1M and core 3M are measuring. Those are implied correlation indices that look at the implied correlations of forward-looking expectations of how stocks within the S&P 500 are going to be correlated. And both measures are at extreme lows. In fact, core 3M, I think when I looked at it, is currently at an all-time low. And that's really, I think, the biggest takeaway is that as much as we talk about low VIX, low index vol, correlation is even more extreme low, right? So implied correlation is lower today, right now, than it was in 2017 when the VIX was at 9. And in terms of drivers, it's very similar to the drivers of high dispersion. It's the sector rotation, the stock, the stock selection that's been going on underneath the index surface that investors are using to kind of play these macro themes. So it's absolutely not been the case that stocks are moving together over the past 2 years, right? We know there's been incredible divergences, incredible rotation. So I think that's just a measure. But we want to talk about why is VIX so low, why is index volatility so low. Correlation definitely plays a big part of it, because all else equal, if you just ramp up the correlation, hold single stock volatility constant, but increase the correlation of stocks, that will lead to a meaningfully higher VIX, right? So what's been really interesting to me is that over the past year, we have not seen a meaningful pickup in correlation on market pullbacks. And that's unusual because typically, you expect low correlation in rallying markets. When markets rally, there's a lot of dispersion, low correlation. But then when the index sells off is typically when we get correlation really picking up. And we're not seeing that. And that, to tie it to the concept of skew and flat skew, one of the drivers of why skew exists, in equity options is the idea that stocks sell off together, right? The markets, take the stairs up and then the elevator down, or the escalator up and the elevator down. Right. And we have not really been doing that. And if you actually look how the market's been behaving, it's been very unusual in that the most violent moves have actually been to the upside. So when we do sell off, for example, in October last year, right, it's a grind lower with a lot of dispersion, very low correlation type of sell off. And then when we rip higher, like in November, December, everything rallies. So it's kind of a flip of the traditional dynamic. And that's why skew has been so flat in the options market, is because if you look at realized volatility in the market, we're actually seeing higher realized volatility on market up days than we are on market down days. And that's, extremely unusual. Like when we ran the numbers, this is, we haven't been this kind of environment in over 20 years. You have to go back kind of to the early 2000s to find an equivalent period of time where we saw higher volatility on market up days and down days. And I think that's one of the kind of the fundamentals that's been underpinning the low skew environment that we've been in.
Yeah, it's funny you said that this environment is the escalator up now and elevator up, escalator down.
Yeah, exactly.
Sorry, I just screwed it up. It's the opposite of what we all normally expect.
Yeah.
And I was looking at the charts, the exact quote that basically I pulled from your recent one of your recent notes, and that period that you just mentioned in 20 years was kind of the .com bubble. And I don't want to talk about whether or not this is a bubble or not, but back then obviously there was a concentration of the internet theme, and I think now we have a similar thing with the chip sector or AI stocks that are really drawing a lot of the attention, a lot of the investor focus. And so I think, is that some of the parallels you could draw here where, back then, 20 years ago, there was a sector that really received asymmetric attention, I'll just call it.
Yeah, like
similar now.
I know people, there's a tendency to try to kind of draw parallels, and I would argue from a fundamental perspective, like the kind of the rally and the insane price action that we've seen in the Max 7, the tech sector today, is very different, right, from the tech bubble back then, in that the companies today are actually generating profits, or actually generating free cash flow. So, not to say this is bubble, exactly your point, not to say it's bubble, but certainly from a timing perspective, it is very interesting that this happened, right? Again, this happening now, and it's a similar magnitude as what we saw kind of in the fallout of the tech bubble bursting in the early 2000s. I do think part of it is to do with positioning, right? So at least to me, and I can't comment, what happened in the early 2000s, if that was similar, but like, if you look at the past year, at least part of the reason why I think we saw higher vol on the upside is that coming into like 2022, consensus was so bearish. People had de-risked so broadly in 2022. Everyone kind of sold equities, moved to cash, didn't really need to buy protection in terms of, index hedges, but then no one really was thinking about the upside risk. So then as the year went on and the soft landing narrative became more and more evident, right? And people weren't positioned for the upside, that's when you started to see more of that chase going on in the options market, where people were kind of grabbing those upside calls in S&P to really help manage that upside risk, because that was the risk that they were not adequately kind of hedged or exposed to, or haven't adequately managed, whereas everyone had managed kind of to the downside and not to the upside.
Right, and that plays into the elevator up, escalator down. I thought I was just going to screw that up again.
The squeeze higher and the grind lower type of environment that we've been in. And it'll be interesting now to see if that's turning a little bit, right? Because I think coming into this year, especially after Q4 last year, where the narrative definitely got, maybe a little bit too constructive with, the Fed's going to cut 6 times this year. Definitely, I think positioning has moved quite a bit. So now you're starting to see the more frequent 1% pullbacks in the market. But last year, certainly, the consensus and the investor sentiment was overwhelmingly bearish going to the year. So I think that explained a lot of the price action.
That sort of ties into the next question or set of questions, I guess I wanted to ask you. Some of the discussions recently are obviously on the call overriding impacts and zero DT and those kinds of things. And you've given so many great interviews on those already that I don't want to drag you into another one of those conversations. But one of your points that you push back on in terms of volatility, just generally speaking, is that, yes, index S&P specifically, vol is low, but we've really been in a low vol regime across assets. And arguably globally as well, if you look at certainly, I guess the Western markets. it seems like we're starting to have some spasms in your notes. We had kind of gold breaking out. Now there's like some yen volatility, and the move index is starting to shift a little bit. Do you think that there is kind of and we've used this term a couple of times today, but a regime change kind of underway in some of the things that you're seeing, like correlation did start to lift a little bit off its lows, those kinds of things?
Yeah, so for sure. So I think the low vol, like why is vol so low? That, the question that, I got a lot over the past year. The thing I kept pointing out is that low vol was not unique to equities, right? It was really broadly felt or observed across asset classes. So to me, that spoke to the fact that it was very much macro fundamentally driven. The fact that we went from, kind of expecting a hard landing to now kind of pricing a soft landing. But then as we sit here now today, right, that soft landing narrative is getting a little bit challenged. And I think it's not surprising that volatility has reacted in response to that, right? With inflation becoming a little bit more sticky, and potentially, I don't think the Fed's going to hike, but, the higher for longer, I think people are definitely reassessing, how much longer are we going to be in this rate regime for. So to me, it's not surprising that volatility is reacting to that the macro environment. Now, when people talk about, is this going to be a shift to a different vol regime? I think it's going to take a lot more to get VIX sustainably above 20, right? I definitely think we could be in this choppy 15-20 range for a while as we digest, more macro news, more earnings, is the earnings story kind of holding up? I think that's going to be key because Q1 rates went up, but markets, didn't care, or equity markets were very resilient, right? Because we had very strong earnings on the back of it. So, now as we go through earnings season right now, I think that's going to play a big role. And obviously the macro outlook is going to play a big role. But to me, I think the 15 to 20 range for the VIX is certainly reasonable for the near term. And that's actually kind of my core expectation. I think it's going to take a lot, though, to get it to sustainably above 20. It's going to take really people start fearing recession again. And I don't think we're there. Nothing in the kind of economic data, at least, suggests that we're kind of, in that approaching kind of that risk. It's just more like, the inflation is, the economy is too strong, inflation is too sticky, the Fed's going to have to hold rates higher for longer. That's kind of the regime that we're in right now.
And I think to your point, and Jack, I'll loop you in after I fire over this last question here. In the sell-off last week, or kind of mid-April, I guess, when we saw the S&P really trade down, fairly about 5%, right? It was the staircase down. It was pretty slow. And vol never really, S&P vol never realized. I mean, we're still at like a 12, but the VIX did pop to like 19. And I think if you compare those two, VIX and 1 month vol, that was a pretty high level, or high pad or high spread, I guess you could say. And so to your point on, it's going to take a lot to get, I guess we really need realized vol to start cooking in order to start to draw out some of that implied vol. Are there levels in the market you think where you could start to see maybe that put demand pick up and that realized vol? I mean, I don't know if you look a whole lot at positioning itself, but are there signals there where you start to say, okay, this is the environment where that VIX could really start to get over that 20 level?
Yeah, it's interesting. So you mentioned the sell-off, and one of the things that I want to highlight about the sell-off that we saw, this month, like we had a very modest pullback in the market, right, down 5%, and VIX did pop, right, a pop to 19, which it's elevated relative to where we've been recently, but it's not that high on a longer term look back. But what really was surprising to me was the incredible amount of VIX option volume that we saw on the back of it. So I think 2 weeks ago, that Friday when VIX popped to 19, we had 2.6 million VIX options trade on that day, higher than any point in March of 2020 when VIX traded above 80, right? Almost 90 at that time. So to me, that was a pretty incredible. That was actually the single day volume was the highest since Volmageddon in 2018. So like a 6-year high. I think it speaks to how people are hedging and what are they concerned with, because we talk a lot about low skew and people are not really hedging in SPX options, or it's not really evident in the pricing in the vol market. But one of the things we've been highlighting, at least for the past year, is that we've been seeing a huge uptick in VIX call buying. Right, last year VIX option ADV actually was higher last year in 2017 in the lead up to Volmageddon, right? Because that was a year with like record VIX option activity as people were positioning for this potential blow up in the VIX ETP complex. Last year was higher ADV than 2017, and then this year in Q1, even though VIX volumes were VIX levels were very low, VIX call volumes continue to grow relative to Q4 last year. And then obviously when we did get the big pop, the small pop, relatively small pop in vol, incredible amounts of turnover in the VIX options. I think part of the reason is the embedded convexity in VIX options, obviously a lot more attractive in a low vol environment versus high vol, right? So people buy VIX options to play for that doubling or tripling of volatility, which, if your starting point is, VIX 15, VIX 13, it's easier to get, the kind of catalyst to get vol to like 20 to 30 versus, if you're, VIX already trading in the mid 20s or the 30s, right? To really play for a doubling or tripling volatility from there, it's going to be a lot harder. But also I think people were frustrated with like the grind higher in the market, and if you were buying a vanilla S&P put, right, like your put's going to be pretty worthless pretty quickly in terms of that strike getting further out of the money. So the path dependency there was frustrating, I think, for a lot of the traditional vanilla hedges. So people then looking to VIX because even if markets were to go up 10%, how low can the VIX go, right? So I think they were pretty comfortable, say, buying a 17 strike or 20 strike call in the VIX and just holding it, and seeing it kind of hold value a bit better than, say, buying a VIX SPX put. So I just want to put that out there because I think it is important when we talk about put demand and put activity. When we talk about low levels of hedging interest, hedging demand. It's not across all products, right? And there is definitely a time and place for more linear instruments versus more convex instruments.
Those are some amazing points, and I would just add that I was told 0DT was going to kill the VIX, but apparently not.
Not at all. I won't go into 0DT, but one thing I will say is that people focus on the growth in 0DT volume, but if you look at non-0DT options, that's also growing. So it's not that people have stopped trading longer dated options. It's not the case yet.
Yeah. Jack, I hogged almost all of our time here. That
was actually, considering I'm a long-term fundamental guy, it's probably good you hogged all our time because I don't know if I would have had as many questions as you did or as many intelligent questions as you did. But I am curious, just one thing from that perspective is, one of the things those of us outside of the options world see a lot is these charts about the usage of options and that it's way, way up since 2020. And I'm wondering what should we make of that? I mean, is there any market risk associated with that? Like longer term investors, what should they make of the fact that people are using options a lot more now than they did before?
Yeah, sure. I think that's a great question. So if you look at like SPX option volume is doubled in the past couple of years. I think it's on the back of a couple of reasons. So one is within the people who are already trading options, we're just seeing more volume because of increased, use cases, utility with the introduction of 0DTE options. People were able to actually deploy more strategies with options that they were not able to do, right? So for example, yes, you were always able to hedge, but now you can more effectively hedge an event risk, or if you want to hedge an FOMC meeting, a payrolls number. If you were running a yield harvesting type of strategies, instead of selling 1 month or 1 week options, now you can replicate that strategy on a daily basis and capture a different risk premium that you were not able to. And then my favorite, of course, with the 0DTE is that now there's intraday strategies that people maybe used to deploy with futures, with Delta One instruments, but now you can do so with options and get more leverage and more embedded, risk reward with that type of strategy. So a lot more strategies opened up as a result of 0DTE. But also the user base expanded a lot. So it's not just institutional. We're actually seeing a huge growth on the retail side with a lot of retail investors becoming active with options. And one of the more interesting trends is that a lot of the retail investors, what we typically classify as retail, are becoming more and more sophisticated. So now there's almost like a middle category, what we call pro-tail.
Hey, Jack, you still with me?
Yeah, I think she froze.
Oh, no. Just about to hear the pro tail and see if I qualify.
I know,
I was hoping. While we wait to see if Manny's connection refreshes here, We just want to point out that today's streaming event is for a great cause. It is the Susan G. Komen Foundation. And so if you've found these conversations helpful, please head over to youtube.com/SpotGamma or youtube.com/excess returns. And there is a donate button next to the live video feed that we are streaming now, and you can leave a donation for that great cause. And we're very appreciative to I don't know exactly how many people have donated because the money goes directly from YouTube down into the Susan Komen Fund, but it's clear a lot of people are being very generous today. And so thank you all very much for that.
Yeah, thank you. It's been great. This has been a lot of fun, and we can raise money at the same time, which is very, very cool.
Yeah.
So,
and so even though,
so
please go ahead, Jack.
So as we look forward here, we're getting towards the end of the day here, Brent. We are at 6 o'clock. You and I are on our own from here on out. I think you're on your own for one by yourself, but the other guys have left. It's you and me. We're gonna bring it home.
Yeah, and we're not slacking in terms of quality here the entire day, but we still have Colin Roche up next, Joseph Lang, Mr. Fed Guy, coming up at 6:30. We got Victor Jones, who can carry an entire 8 hours probably by himself. From Tasty Trade, and then we rounded out with a very interesting conversation with Doug Clinton, who's really going to dive into technology. And we thought that was just sort of a fascinating step away from the markets a little bit, and you brought up bringing up those views that are a step outside of the investing realm, so to speak.
Yeah, what's really cool is Gene Munster, Doug's partner, was able to come on
That's
for
right,
last minute
that's
as
right.
well. So, and I remember Gene from back in his tech analyst days. Like he's definitely a famous guy in the tech space. So it'll be very cool to get their take on, what's going on with tech, what's going on with, all the Apple thing, whatever that thing's called, the Vision Pro, Tesla, like all that stuff, stuff that's a little bit of a change of pace from, I think we've gotten a lot of macro takes that are really awesome, and we're going to get some more macro takes, but it'll be good to close things out with something a little bit different.
Yeah, and I would just say, in terms of tech, we have Amazon only up 50 bips post-market after earnings. It was up a lot more. AMD is getting, that's taking the elevator down 7.5%, almost 8% now. And so there's a lot of earnings movements. SMCI down 13% post-market. So, some stuff is really moving there after the market.
Over, I guess, right?
Yeah, and S&P took a pretty nasty spill today, down 1.5%. On the spiders is what I'm seeing here. So volatility is picking up a little bit. I wanted to ask you, while we wait for Colin to join us, is there one sort of theme that really jumped out today? I mean, so far we've done about 20 different conversations. Is there one theme that kind of jumped out at you that you thought was surprising?
Yeah, I don't know, surprising. I mean, definitely with all the macro guys. I mean, I think the higher for longer theme, was pretty consistent across everybody. And then these are guys that are all very, very smart and very well versed in this stuff. So that has to indicate something. I mean, I think across the board, that was something we heard. So that was really interesting. I really enjoyed the interview with Perth Toll. I thought that was awesome. She has such a really cool story. And it's just like what she did to grow, from where she came.
It's inspirational.
She was born in China. Yeah, it is. It's a very inspirational story, and it was really, really cool. And I'm happy Matt was able to do that interview with me, because Matt is very good in those types of things. He's a really strong interviewer. So that was very cool. That was one of my highlights of the day. And I think actually Cullen is here, so we can let Cullen in. Cullen. What's up?
Hey guys.
Can you hear us?
How are you?
We're doing all right. We're operating on a little bit of fumes here. We've been going. We're doing good. We've been. What are we at? 9 hours now, Brent? Of
I think
or 10 hours now.
Somewhere in that realm, yeah.
So you're going to interview yourself at this point. We've run out of gas in the tank, but we're really excited to have you. We're really excited to get your insights on everything. And we're actually gonna do something very cool with you, because you built your own little macro dashboard here. And so I'm gonna share my screen, and or you can, either way, and we're gonna dig through that, and a lot of the charts you have on there will kind of get us into some of the issues that are going on.
Yeah, hopefully
in the
make your
macro
job easy. You guys can take a
Yeah.
nap. Take a nap.
Yeah, exactly. But it's nothing to get if we're
It'll
sleeping.
probably be a
halfway through
higher
the
quality,
interview.
yeah. If we don't
nothing
ask
against
questions,
you, we're
it'll be
sleeping during the interview, But before we start, we just want to remind everybody why we're here. We're here to support Susan G. Komen. If you're watching us on YouTube, there's a donate button next to the video. Please donate if you can. If you're watching us on Twitter or on LinkedIn, you can go to YouTube, and the donate button will be there. If you've gotten any value out of what we'd done today, we'd really appreciate it if you could donate whatever you can. So having said that, let me, I can share my screen here and bring up your...
Amazing cause, by the way, guys. I don't want to be morbid, but somebody very close to me just was diagnosed with leukemia, and it kind of brings all of this front and center and how important, we'd spend a lot of time thinking about money and stuff, but for me being, not just a portfolio manager, but also a financial advisor, it really brings front and center how important estate planning is. A lot of people, I can't tell you how many times I've run into situations where an estate hasn't been properly planned in advance, and something like this happens that is totally unexpected and is hugely traumatic for everyone involved, but especially for the people who have to deal with the succession planning. So, it's not only important to contribute to causes like this, but it's also important to accept the reality that this is something that impacts millions and millions of people, and you just can never plan exactly for something like this. So being forward thinking about something like this is hugely important in terms of, not just the way you plan for your investment portfolio, but the way you prepare for your entire estate planning situation going forward.
Yeah, that's a really good point. Pretty much all of us have been touched by cancer in some way or another. And it's such a great cause. But to your point also, but planning for these types of things is so important as well. And that's something that, like, you as a financial planner and a lot of other financial planners add a lot of value in. So we wanted to start. First of all, I'm very excited here that you actually have your own recession rule. That's something I've really wanted to have for a long time. I don't know how you get that. I don't know if there's like an application process where you go through and get your rule approved by the recession board or something. But you have a very cool chart here of the Roche recession rule, and so I'm wondering if you could maybe explain what we're seeing here and what it's indicating.
You just to get your own recession rule, you need a one-person board of trustees who approves the rule and then names it after themselves. So in that case, I am the singular member of the board of trustees of the Roche recession rule, and determined that this was a sufficient rule to be named after myself. So
I assume it's like the yield curve conversion. It's 100% successful as well in predicting recession.
Oh God, the yield curve. Well,
maybe we shouldn't get into that.
Yeah. So anyways, this is basic. I mean, all recession rules will be virtually coincident indicators. So, there's very few things that are ever going to actually tell you when a recession is coming, in large part because a lot of the data that ends up confirming a recession ends up getting revised so many times over the course of the periods over which they actually roll out this data that by the time it actually confirms a recession, the things that are important, like for instance, the stock market, will have probably already reacted to things like this. But anyways, it's kind of useful. This was weirdly sort of useful last year, actually, when a lot of people were declaring that a recession was inevitable, and a lot of even coincident indicators never said anything like that was coming. The one that I've always relied on the most was jobless claims. When you look at the 4-week moving average of jobless claims, for instance, it sort of budged higher at points last year, but never really reached a point where it was confirming a recession. It's certainly not like a huge deterioration in the labor market. And that's one of the main criteria that goes into the way that the NBER, the National Bureau of Economic Research, actually determines whether a recession is going to come. So I like using, looking at a lot of different indicators. So keeping this one sort of simple, I use what's called the long-term unemployed rate, which is basically the percent of people that have been unemployed 15 weeks or longer. You can combine that with unemployment claims, and you get something that when you actually back this out, the screwy thing with all of our charts now on, especially Fred and any data, is that COVID ruined them all. So like this chart, you basically, you can slide the scale underneath to actually look at when the recessions are relative to when this reading actually goes over 50%. But it basically is always right. So whenever you actually see the combination of these two metrics moving over 50% year over year, we're already in a recession. And so, if you look at this last year, we got sort of close-ish, but never really got to a point where this was indicative of a recession. And so, my working theory for really the entirety of COVID has basically been that we're we're mean reverting back into sort of the pre-COVID style economy that as supply chains sort of normalize and even things like the budget deficit normalize, government spending normalizes, you'll see everything sort of moderate back into a lot of the trends that we were all sort of accustomed to in the pre-COVID environment. And so we're still working through all that. So we've digested this huge amount of stimulus. We're still digesting it. We're digesting huge supply chain shocks. And that process, as everybody kind of knows now, it's just taking a lot longer than expected. And, you know, it's taking a lot longer than the Fed expected. It's certainly taking a lot longer than people like Team Transitory expected. So, but at the same time, the process is still very much in the works, I think. And so we're still in this process of sort of mean reverting back to the pre-COVID environment.
So this second chart kind of gets at this idea of what people are hoping will happen if we migrate back to the pre-COVID environment, which is that inflation will go back down to 2%.
Yeah.
And, you know, when you look at it in this context, it has gone down, but, you know, some of these recent prints have not been great. You know, people are seeing a resurgence in inflation. What's your take on where we are right now with inflation?
Yeah, well, it's weird. Inflation came down a lot faster last year than I think most people expected it to. And so I think a lot of the first, you know, especially the initial months of this year are sort of a little bit of like give back from that. The rate came down so fast, and then expectations kind of got out of whack there that people, I think, were expecting that trajectory to continue. And now we're seeing that, you know, the one of the common narratives last year was that the last mile was going to be the hardest mile, and we're seeing that's true. It's a lot harder for inflation to come down, you know, to be cut in half from 6 to 3% than it is to go from 3 to 1.5%. And so we're in the midst of that sort of last mile here. You know, a lot of people are worried about a sort of flare up of inflation or the potential for, you know, like a sort of a 1970s or 1940 style double bump in inflation. I don't see it. I just don't see where it's going to come from. I think you'd have to get either another big spending package or maybe you know, I guess the most probable cause of something like that maybe would be oil prices. If oil prices went to, I mean, that was really what happened in the 1970s was you had just this non-stop oil price boom where oil prices went up, you know, basically relentlessly for 10 years. And, you know, it was more complex than that, but oil prices, especially with the economy being so oil sensitive back then, that was the primary driver of inflation back then. And so you'd need oil prices, though, in the equivalent world, you'd need oil prices to go to like $300-400 to cause something that looked really similar to the 1970s, where we got another flare up where core PCE inflation goes back to like 5, 6, 7%, you know, really, really high levels. So, you know, could that happen? I guess, yeah, sure. You know, certainly if, you know, tensions flare up in the Middle East further, that would be a catalyst for it. But, you know, I think the baseline assumption right now is that that's not happening. Global demand is not strong enough to drive oil prices that way alone. So you'd need some sort of really unusual supply side shock to cause something like that. So I still think, you know, we're going to get to the Fed's target. And it's a question now of, are we going to get there through the Fed, you know, really keeping their foot on the brake of the economy through high interest rates? Or do we actually just continue to sort of ease into that 2% just through slowing demand that gradually eases us back there? So looks like the latter's probably the more likely scenario, but there's still that outside risk that, you know, a lot of people think that, you know, we talk about the long and variable lags of monetary policy, and a lot of people think that, you know, a lot of people are even saying Fed policy is broken now, you know, which again, I don't see. I think that the Fed seems to be doing a much, much better job than anybody expected them to. And the last few months have been sort of, you know, a little worrisome, but, you know, I think the baseline trajectory is still there, that we're headed to 2% probably some point in 2025. And now it's a question of, do we get there in this nice sort of, you know, soft landing scenario, or do we get there in more of a bumpy scenario where, we kind of maybe in 2025, 2026, we look back and we say, maybe the Fed was a little too tight for too long.
Do you have an opinion on which one of those two we might get? Do you think there's a chance they could stick a soft landing here?
I mean, it's not the historical norm for them to, they tend to be so reactive. Betting on recessions is usually a bad bet. But my baseline view here basically is that the economy is soft, and that makes the potential for turbulence higher than usual, just because when you've got, especially when you look outside of the United States, everywhere else looks really, really soft. The economies in Europe, China, the UK, virtually Canada, you look at everyone else who has raised rates pretty sharply, they all are following a much more textbook sort of scenario where growth is slowing very quickly. They're having asset prices and borrowing that is slowing very rapidly. The U.S. has been a lot stronger for a lot of different reasons, but I think that the broader sort of aggregate global story is telling a more accurate story in terms of what's going on and how effective the rate hikes have been. It certainly worries me. The longer they continue to keep rates at like a very high level that looks overly tight, I think it's almost irresponsible not to consider the risk that they're making a mistake of being too tight for too long.
So this next chart, you have the misery index here, which sounds pretty painful. What are we seeing with this?
Yeah, so this is a common metric of really sentiment is generally the thing that it tries to measure, and it measures unemployment plus the rate of inflation. So typically when this is very high, it's indicative of sort of like if you look at the 1970s period, that was a classic stagflation where you had very high unemployment and you had very high inflation. This is actually a super interesting environment because people are really pissed off about the economy, and when you look at a lot of the underlying data, like simple metrics like the unemployment rate and inflation, things don't look very bad at all. So there seems to be, there's a lot of debate about this especially on Twitter and in the media about, a lot of this seems to just depend on which political party you're in. Whichever guy you're rooting for in the next election seems to be the one that kind of drives the narrative here. But again, I think this is just COVID has been such a strange environment. I think that I try to put myself in other people's shoes in a lot of situations, and I always try to consider the people who, say you make a median income, say you've been really prudent over the course of the last 5 years, COVID happens, the government blasts all this money into the economy, home prices go up by 50%, wages are kind of just keeping up, and you feel like you've done everything right financially, and all of a sudden you have to sort of adopt the reality that like you might rent your house or you might be a renter for the rest of your life because home prices have just run away. There's all sorts of scenarios like that and there's tens of millions of people like that who feel like they're either people who are locked in their current home or people who are locked into renting and being forced to accept higher perpetual rental rates going forward. And those people are really mad. They feel like the stimulus that, we spent $7 trillion over the course of COVID. And I think a lot of people look at the COVID stimulus and they say, what did this do for me? And I think it's hard to judge the counterfactual because the counterfactual was probably like a horrific recession that, would have been even more traumatic. But people still objectively look at the current environment and they say, we spent all this money and what did it do for us other than, make everything really expensive? So it's almost like there's a lot of misery despite indices like the misery index actually saying there shouldn't be a lot of misery.
That seems to be a common theme here. People are just pissed off, just about whatever. It's a theme that sort of popped up a couple of times here, I think, today.
Yeah, that's what makes the financial markets great, right? Like, I mean, 50% of the people are probably going to be pissed off about something they've done because they're either in the right trades or they've gotten out of the right trades.
It's also the joy of price. There's some truth in price. You can be angry about it or not, but it is what it trades for.
Can you talk about this next one, the Taylor rule? This is something you heard a lot when inflation spiked a lot because people use it as an argument that rates had to come up a ton. But can you talk about what the Taylor rule is?
Yeah, so this is a metric by economist John Taylor, and he basically tried to create a systematic rule by which the Fed would be able to determine what the overnight interest rate should be in more of a systematic way. And I think that, I've always liked the idea. I can't, the Taylor rule's got plenty of problems, and like I would argue that its variance tends to be much wider than, like should the Fed funds rate have gone to, what does it say, 12% in, 2022? Probably not. You probably would have, you would have crushed everything in the whole economy if they'd done that as quickly as the rule said. But at the same time, I think there's a lot to be said for having systematic rules, not just in terms of monetary policy, but especially, in portfolio management and anything that involves the behavior and the management of especially like lagging data like we tend to get with a lot of economic data. And what we tend to often find, especially with Fed policy, is that they tend to lag so badly with a lot of this because they're reactive to the data that it's not unusual for the FOMC and the Federal Reserve to make policy mistakes, just by nature, just by the way that they are sort of, with a lot of discretion navigating the interest rate environment. And so I've always loved the idea of a systematic rule, and this rule is just trying to measure where potential GDP is relative to inflation and where the overnight rate potentially should be, to try to really measure whether the economy is hotter than it should be. And so, this one was especially interesting back in 2021 because, a lot of us were saying, hey, there's, I think people, especially in finance, with everything that was going on back then, were very aware that things were screwy, things were arguably way out of control. And the Fed weirdly was sort of sitting on their hands and saying, there's no reason to overreact to this because it's all going to be transitory and supply side driven. And it actually looked like, especially from the financial market side, that a lot of the craziness was demand side driven. People just sitting at home, with too much money to spend and doing, outlandish things. And the Taylor rule was way, way ahead of the curve on this. And so, the rule is interesting now because we finally, in the last sort of like quarter or two, got to a point where the Taylor rule says that monetary policy is sufficiently tight. So this will be interesting going forward because we're kind of in that period now where we're seeing whether monetary policy really has these long and variable lags. And we're going to find out in the next 6 to 12 months whether the Fed is too tight now or if they kind of just have things exactly right.
How about this? This next one is average hourly earnings. And this kind of paints a little bit of a different picture of what's going on than what I've seen in some other charts. So can you talk about why you think that's important?
Yeah, this has been one of the narratives where people have said that monetary policy hasn't worked. They've looked at the labor market and they've said, hey, the labor market is still strong, and that means that the Fed funds rate is having no impact. But when you actually look at things like average hourly earnings, well, you can see it's come down pretty sharply. And this is sort of consistent with the whole inflation narrative too, that wages have come down a lot. So, we're a little over 4%, where we've come down from, 7% or so. So we've made good progress in terms of bringing down wages and bringing down the rate of inflation, but it's just taking longer than expected. Things are a little stickier than a lot of people expected them to be. So it tells the same basic story, though. I think that I'd be shocked if average hourly earnings don't mean revert back to, say, something more like 3.5% by the end of this year, certainly by 2025. But the macroeconomy is just a huge, slow-moving beast, and I think that a lot of us get so impatient with all the things that are going on because we look at all this stuff every single day. It's easy to forget, hey, this is a $30 trillion economy, it moves, like a big lumbering beast at this point. It's not this nimble little, ship that moves around quickly by any means. So it takes a long time for these trends to play out. So again, I think the average hourly earnings are consistent with the sort of inflation story, that the trend is in the right direction, and it's just trending a lot slower than a lot of us would hope.
Can I ask a question on that topic, Colin? And I don't want to politicize or anything, but is there an immigration side of this as well? I mean, it seemed like there was some legitimate comments about that, and feel free to say a stupid question. Let's move along to that one. But I was just curious your take on that.
No, I mean, I think that I think it's fair to at least, is it the dominant driving factor in wages? No. Is it an impactful one? Yes. And I think that's, it's fair also to look at, I've been kind of critical of the deficit we've been running over the course of the last 18 months. Like if I say this all the time now, but if I was running the Fed and I saw the deficits that were being run, I would be furious. I'd march over to Congress, the White House and Treasury, and I'd be like, guys, you have an inflation problem. You want to win elections? Bring inflation down. That's what people are pissed off about. And so it's sort of strange that we call it fiscal offset, but the thing is or monetary policy offset or fiscal offset, depending on which side of the coin you're looking at. But during a high inflation, you should not have fiscal offset where the Fed is trying to bring down inflation and the Congress and Treasury are continuing to run huge deficits that basically counteract a lot of what that's doing. So, yeah, I mean, I think it's fair to be political in this environment because inflation has been the dominant theme, and inflation's not coming down fast enough, in large part because we've enacted some pretty silly policies that are not targeted towards helping inflation come down.
It's interesting. Like if you were on that point about the election, if you were in previous elections, if you could argue that everybody's in cahoots, the Fed and the government, and they want to juice, do whatever they can to get elected, what to do was obvious before when there was no inflation. Like obviously you juice the economy and you go, but now it's maybe a little bit more questionable. Like even if they wanted to do that, what would they do? Because there is an inflationary price to pay for what they're doing, and inflation obviously, oil prices, all that stuff, it's not great for your average person. So there's some debate. Even if they were going to do that, what would they want to do at this point?
Yeah, and I don't know. I mean, it's complex. I mean, you can argue that the U.S. has done a lot better than other countries. I mean, I would argue that's probably in large part just because the private sector is so healthy and vibrant right now. But yeah, I mean, I don't know. The political situation in this country is a disaster and seems to be getting worse and worse every single day. So I don't know. It's probably best not to even talk about it.
Yeah, that's probably true. We should probably stay away from that. So we'll move on to your one-man investment committee, which has approved another rule here, the modified Roche rule. So you've got two, actually, which puts you above a lot of other people. What is this rule?
So this is an alternative, or there's all sorts of alternative versions of the Taylor rule. And basically, I created this back in 2016 because there's a lot of criticisms of the Taylor rule, and my biggest criticism is that it can create these sort of like extreme moves in the way that the rule actually would dictate policy, which to me almost negates the effectiveness of a systematic rule when you've got these bands that allow the rule to create these really extreme measurement readings. And so it's an alternative that sort of throttles the rule a little bit. I actually liked it. This chart doesn't actually show it, but I actually would, if it was my preferred way of running it, I would basically create a lower bound and an upper bound of the Fed funds rate where, for instance, if on the lower bound, it's kind of well known in economics that 0% is kind of the natural lower bound. So you shouldn't go below 0 probably. And then in terms of like a modified rule, like I like the idea that the absolute like peak of a Fed funds rate should probably be something like 5%. So you actually create, you would use this rule, but you would actually create an upper and lower bound within the rule where you sort of throttle how much the Fed funds rate can actually move, because I think there's certain periods where, let's say, for instance, you had very, very high inflation, say 20%. You were sort of like a Turkey or an Argentina or something like that. There's a certain threshold where a very, very high interest rate simply does not have any effectiveness and could actually be so high that it's detrimental, that the interest payments on that are so high that it's almost counterproductive. And so creating this sort of upper and lower bound sort of throttles the way that the interest rate can actually impact the economy. And the basic thinking there is hey, when you've got if you've got an inflation rate that is so high that a 5% overnight rate is not sufficient to bring it down, you need to be doing something else. And so that kind of goes back to our point here that, we had a high enough rate of inflation here that even having a 5% overnight rate has not been sufficient to bring inflation down very effectively, which should be telling policymakers, hey, we need to be doing something else. And in this case, it should have probably been reducing the deficit more, less government spending, and more counter-cyclical policies outside of the interest rate variable. Because that's the other thing. The interest rate variable is it's famously blunt. And so its imprecision is very well known. And it makes sense to force policymakers to think outside the box at other things and not just have the Fed, running this ship all alone.
So as we close, we've been asking the same standard closing question to everybody today. That question is, what is one interesting thing you're seeing right now that you think other people should be paying more attention to? And it could be inside investing or outside investing.
Yeah, I mean, this is just front and center for me, and it kind of goes with the whole theme of the day. I think that our time here is so limited. I've gotten hyper focused on thinking about things across time horizons, and we've talked in the past, Jack, about my concept of defined duration investing, but I think this is useful for a lot of different aspects of life. I like thinking about investing not just across, diversifying across asset classes, but I think it can be really useful for people to think about diversifying across time horizons. It's something that, we don't talk about enough, and I think part of that is that it's hard to quantify, say, the time horizon of things like the stock market or, even certain, types of contracts that we use in finance that don't have a defined duration or a defined maturity time horizon. And, I try to steer people to think of a diversified portfolio, not just across diversification of asset classes, but diversification across time, because ultimately time is the thing that we're all trying to navigate here. And the greater that you can create clarity across time horizons, I think the better you'll perform financially and behaviorally. And, going back to the whole estate planning concept, I mean, that's all temporal control. Buying life insurance is getting temporal control. Having an estate plan is having certainty of time horizons across, succession planning and, the beneficiaries and the way they're going to navigate things. And so, don't just think about diversification across asset classes and, the sort of traditional metrics that a lot of us talk about, but try to focus more across time horizons, because especially, we're all kind of getting to the point where we're becoming old men, and, that temporal uncertainty kind of lops you over the head, and, you wake up one day and you realize you're an old POS, and you got to start thinking about, multi-temporal time horizons.
Mike Taylor this morning told me I'm going to live forever, so I feel all right.
Oh, that's right. Yeah. Hopefully those developments come fast enough for us.
Somehow, yeah. Hey, we're all going to be robots, and we're all going to have a Neuralink and a robot, a Cullen robot that it becomes the one-man investment committee. So,
well, thank you so much, Colin. This is great. Thank you for joining us.
Thank you, guys.
You just have to hit the red thing. Leave. Their little red thing there. You see like a little red phone thing that says leave? There we go.
We'll rename that the Cullen button.
Yeah, exactly. Let's let Joseph in here. You ready to go?
Just a moment. I'm adjusting something really quickly.
Can you
No
hear me?
problem. We can hear you,
we can hear
Joseph.
you. Yep.
You are live, so.
Oh, I'm live. Okay.
Yes, sir. Take your time adjusting. Just want to make sure you
Take your time. We can talk. Yeah, so before we talk to Joseph, we want to just remind everybody why we're here today. We're here to support Susan G. Komen. So if you're watching us on YouTube, there's a donate button on desktop to the right of the video, and on mobile, I think it's below the video. If you are able to give any money, it's a great cause, and we would appreciate it. And if you're watching on Twitter or on LinkedIn, you can go to YouTube and you can donate there.
Yep, I think Joseph had to pop out and pop back in. So we just had Colin, super interesting conversation with him, obviously, with Joseph now, Victor Jones, and then Doug Clinton and Gene Munster to round out the day. So we're coming out to the final. What do we got? 2 hours left here.
Yeah, well, I remember in the morning where our upcoming list was just this massive list, like we were about to get through for the whole day. And the upcoming list is down to 3 people, or 3 different episodes at least. So we are getting towards the end of the road here.
Yeah, and the feedback's been amazing. I also feel fortunate that there's so much going on right now. Not only the Treasury and FOMC, but again, with the market sell-off, we did see the volatility assigned to Friday's jobs numbers, non-farms, as well as the ISM PMI. Those vols picked up around there, indicating that there's a little more consternation around those numbers. Maybe Joseph can give us some feedback on those. But at any rate, hey, Joseph, how you doing? Thanks for joining us.
Hey, Brent. Hey, Jake. Nice to meet you guys. Congratulations on a successful live stream. You got an all-star panel. It's my honor and pleasure to join you all.
Thanks so much. We're super excited to have you. Super excited that you were willing to come up here and anchor us later in the day. And obviously, to have you, Mr. Fed guy, right before the Fed is super exciting for us. So if you could just start quickly, I'm sure, again, like most of our other guests, everybody knows who you are, but just in case, let's give them a little background.
Sure. So, as you guys know, my name is Joseph Wang, and right now I run a research service called FedGuy.com, where I teach people how to understand markets and write about the Fed. Before I started doing this, and of course I also have a really nice book called Central Banking 101 that is a bestseller on Amazon in its category. So before I did this, I was a trader on the open markets desk at the Fed, and what that means
Let's bring
is,
my copy up as well.
Oh, thank you. Very flattered. Very
Nice.
flattered. So being on the open markets desk, what you are is basically you're the team that goes and executes transactions on behalf of the Fed, and you are also the point of contact between the Fed and the markets. So what we would do is we would talk to all sorts of market participants, from banks to hedge funds to foreign central banks and so forth, figure out what's happening in the markets, look at our data, write reports, and things like that. So it's a really good experience in terms of learning how the market works, how the Fed works. And before that, I was a lawyer and a credit analyst and some other consulting jobs, but that's in a past life.
Yeah, so everyone, when we hear about the Fed, everybody pays attention to what's going to go on tomorrow, the meetings and interest rate changes and potential for interest rate changes and stuff like that. But I know the Fed does a lot more than that. So I'm wondering, just to start, if you could talk about like what the primary roles of the Fed are.
Yeah, so the Fed right now, it's really changed a lot over the past, say, over 100 or so years. So at the beginning, as we all know, the Fed is really just a central bank acting as lender of last resort, right? So in the case any bank has some need for liquidity, they go and can get an emergency loan from the Fed so that their depositors don't panic. But over the past 100 years, the Fed has really grown its role significantly. So in the 1970s or 80s, you added the price stability for employment mandates. But now you also have all these other things, such as trying to maintain financial stability and increasing its role as a banking regulator. One of the ways you can see this is how the Fed has expanded its role through every crisis. Now, beginning, the Fed was just lender of last resort to the commercial banks, but if you think back at 2008, during the financial crisis, the Fed became the lender of last resort to not just domestic banks, but foreign banks as well, through the FX swap facility, money market funds, through special facilities, primary dealers through all sorts of dealer facilities. So they're basically extending their footprint to being the lender of last resort to even more entities in the financial markets. Now, fast forward again to 2020, the Fed rolled out these new facilities to lend to corporations, so it's corporate credit facility, and even tried to be the lender of last resort to more mom and pop enterprises through its mainstream lending facilities. So you have a Fed who's basically growing steadily and having a greater role as lender of last resort, basically to everyone in the financial sector. And in addition to that, they're becoming more involved in how I think banks operate through the amount of regulations that are being rolled out. So you're thinking back to 2008, banks actually were quite lightly regulated, and so they were free to make all sorts of loans, lever it up and so forth. They were often a source of instability in the financial sector. But now, after a lot more regulation and after the Fed has a lot more power over them, you can see that, for example, in 2020, the banking system was totally fine. They're a lot more constrained. And so I think the Fed's role today is just a lot bigger than it used to be. And yeah, it's actually why so many people spend so much time watching the Fed, because what the Fed does, whether or not to hike rates, lower rates, what they do with their balance sheet, really has a huge impact on assets, not just in the US, but throughout the world. I think a really easy strategy would have been over the past decade to just buy when the Fed is easing, sell when the Fed is tightening, and you would have done quite well. Everything seems to have been very much Fed focused. But I think that's changing right now, though, as we see more and more emphasis has been put on what the fiscal authorities do, be it Congress or be it the US Treasury. And so we may be at the apex of Fed power right now.
I know you're on. Oh, go ahead, Brent.
No, please.
I know you're on Twitter regularly, so you're exposed to people like me who think they know a lot about the Fed but don't actually know a lot about the Fed. and I'm wondering, like, what do you think the biggest misconception for like your average investor out there is about the Fed?
Well, I think there's a lot of misconceptions. I remember over the past few years, people were always adamant that the Fed is there buying equities, you have the plunge protection team and so forth, or maybe the Fed has some kind of playing 3D chess, doing some kind of complicated thinking. My experience at the Fed is a lot more post office than bank. So the people there, nice people trying to do a good job, but I think it's a lot simpler than people make it out to be. And I think what they say is largely what they think. And also, to the best of my understanding, the Fed does not buy equities.
Do they care on that point, though? Do they care? A lot of people will say the Fed does care a lot about where the equity market is. Like that's something that plays a role in their policy. Do you think that's accurate?
I think that is accurate. And I look at it in a couple ways. So one of the Fed's mandates is financial stability, and the equity market is a big part of the financial system. It shapes perceptions that people see the equity market is tanking. That bleeds into other assets as well. And I think that is one aspect. The other aspect, the other aspect is when you think about full employment as one of their mandates, a lot of the U.S. economy, I think, is in some relation related to equity prices. For example, if you look at the tech sector, what they do is they pay their employees in tech stock, right? So the higher the tech stock are, basically the more money they're able to print by issuing shares. And so that directly impacts things like employment and also impacts things like investment, right? Right now, all the tech stocks, they're spending a lot of money buying stuff, doing capital expenditures and buying stuff related to AI, like NVIDIA chips. So there is that angle too. And the US is traditionally, I think, so every country has a different favorite asset. In Canada, it would be real estate. In China as well. But in the U.S., it's a stock market. So I think it has an impact on consumer sentiment. So when you have it fall too much, I think it does impact the overall sentiment, which does bleed into their other mandates. And lastly, the truth is the Fed are comprised largely of government employees. Many of them who in decision-related making roles have spent their entire careers in the Fed. So, their retirement is basically in the stock market. Now, nobody likes to see the stock market fall as we approach retirement, right? Everyone, when you're approaching retirement, would like to dream of, getting that yacht and sailing out into the sea. The difference is that if you are a senior person at the Fed, you can actually do something about it. So, in my experience, we brief senior policymakers in Washington all the time. I've never really heard them concerned about anything until they see the stock market drop a lot. then like, oh, is there anything we can do about this? So there is some self-interest there. It's kind of, it is kind of a conflict of interest, right? So you have an organization of people who make big decisions that impact the stock market, but they're also heavily invested in it themselves. It's a human thing, I think.
I think on that theme, there was a little mini bubble was burst, I think, yesterday with the Treasury refunding announcement with people assuming that there would be that the data would support this idea that, hey, we're going into an election, and so we're going to have policies that are accommodative to the election, and that idea seemed to be kind of zapped yesterday. Do you think that there is any kind of a policy adjustment or I'm trying to think of the right way to phrase it is, but there's kinder policies or supportive forces at play into an election if there's a kind of an incumbent running?
Yeah, so I think that's already been done by the Treasury a few refunding statements ago. So as we all know, the Treasury quarterly refunding announcement has been a point of focus for the market. It's during those announcements where the Treasury tells the public how much debt it's going to issue, and more importantly, its composition. The thinking is that if you issue a lot more longer duration debt, it's going to put upward pressure on longer dated yields, and that would be negative for risk assets. Whereas if you issue more short dated stuff like bills, that's going to be pretty market neutral, because right now there's a lot of demand for bills in the money markets. Now, the Treasury's self-imposed guidelines are to have about 20% of its debt in bills and the balance in coupons. Now, over the past two quarterly refunding announcements, they've basically expressed a willingness to significantly deviate from that, and they've been doing that. So right now, bills are more than 20%, I think 23% something like 22, 23% of the overall outstanding Treasury. So they are deviating from their from their guidance, and that is providing some support for duration, all things equal, putting a bit more downward pressure on longer dated yields. Now, I think that is their move to be more accommodative, because if you look at, so the way the Treasury looks at this would be standard models like the term premium model. The term premium is quite low, so there's really no reason why you couldn't just maintain your self-guided 20% portion of bills and issue more longer dated duration coupons. So that's that seems to me to be their effort to try to bring some stability in the Treasury market. Remember, the last quarter of last year, we did see 10-year yield go up to 5%, and there's a lot of panic there. So I do think that's already there. I don't think it's going to make a big difference this week. What they've done is they've already laid their cards out. They're saying that, we are going to have coupon sizes, basically stay the way they are for about, let's say, the next year. And so I don't expect the QRA to have a big impact on markets simply because they've laid their cards out already.
What is your take on where we are with inflation right now? I mean, inflation seemed to be coming down pretty well. We've had a little bit of the last few reports haven't been great. What is your overall outlook, and where do you think we are with inflation?
So inflation, I think, has been a big problem for the Fed. So look at it from their perspective. Their target is PCE, right? Now, for the last 6 months of 2023, it was bang on at 2%. So at the end of last year, the Fed was feeling pretty good. But then when we come to the first quarter of this year, it looks like inflation was not really going to stay at 2%. Right now, it looks like it's about 3%. And it's a volatile series. So my view is that it's really difficult for the Fed to get their target back to 2% simply because of all the fiscal spending that's happening. So, this is kind of a strange thing that I see right now. And it's really a big issue for the Fed because they're given the mandate to have stable prices, but they don't actually have the tools to do that. Now, if you look at the annual reports of the Federal Reserve from the 1940s, they'll tell you that, getting inflation under control, part of it is credit policy, part of it is interest rates, but, that's just one part of it. You got fiscal spending, you got maybe price controls. It's a whole of government approach. It's really not so simple. I move something in interest rates and inflation goes back down. That's actually really silly and has never been true. But the thing is, that's the only tool the Fed has, and they have a mandate, and they're the one that has responsibility. So on the one hand, they're keeping interest rates around 5.5%, but on the other hand, the Treasury keeps creating dollars and spending it through deficit spending. And the expectation right now, and this problem was become so much of a highlight, there's actually a section in the latest IMF report on it. And the IMF is projecting a 6% fiscal deficit for the U.S. for the foreseeable future. Now, if the U.S. is deficit spending at 6% a year, inflation is not going to go back to 2%. That's really difficult, even as the Fed toggles interest rates, because you're just basically printing so much treasuries. Now, I mean, one way to think about this is treasuries are dollars, right? Treasuries is a liability of the US government, US dollars, credit risk-free, very liquid. When you're deficit spending, you are printing dollars. You are basically depreciating the currency. And when you do that, it's hard to get inflation under control. Now, the Fed could go super extreme, hike interest rates to 10, 15%, but then they push against their other mandate. So at this point, I don't think that inflation is going to go back down to 2%. I think maybe 3% where we are, it makes sense until sentiment changes.
Is there a case to be made that that's okay? Like, I mean, I know 2% is the target, and I'm not smart enough to understand why 2% is the target, but is there a case to be made that like allowing it to remain at 3%? I mean, it's obviously not the 5, 6 it was before, that's okay as an economic outcome?
Yeah, totally. So, just a little bit of history. The Fed rolled out its 2% target. Well, actually, they internally thought of it as 2% in the Greenspan era, but didn't officially announce it in 2012. Now, there's some research looking at the past Fed discussions and minutes on this, and what they found is it was really hard to get consensus for 2%. It was hard because some people wanted 1.5, some people wanted maybe a range and not a target. And more importantly, the personnel on the FOMC was changing throughout time. So it basically took a decade-long process to get the right people at the time to agree to 2%. Now, look at what we have today. The composition of the FOMC has changed significantly. President Biden made a lot of appointments, and if you look at the CVs of those guys, they basically don't have any experience in monetary policy, I think, except Jefferson. Everyone else is basically a labor economist. So you can see that the composition of the people there are changing towards maybe more pro-labor. Now, to the extent that you think there's a trade-off between inflation and unemployment, you're getting an FOMC that is going to weigh employment more heavily than inflation. So I think, we can easily make an argument that they could accept that, hey, why don't we just have 3% inflation and make sure the unemployment rate is as low as we can there. So I think that's totally reasonable outcome for the future. And we already hear very important people in the policymaking circles like Jason Furman writing op-eds in the Wall Street Journal, suggesting that we could just raise the target a little bit, right? So why do we have to raise unemployment just to squeeze out that little bit more of inflation?
I'm just curious, when I look at the Fed meetings, I look at the high level, when they announce what they're doing with rates, like someone like you who's been inside the Federal Reserve, when they announce what they're going to announce tomorrow and there's the press conference, like what are the most important things you're paying attention to when you look at what they do tomorrow?
Yeah, so it's going to depend on the context, right? So, okay, so tomorrow's not a dot plot place. If there was a dot plot, I would place a lot of emphasis on the dot plot, just where the distribution of the dots are, and so forth. But for tomorrow's meeting, this is what I'm most interested in. So as we all know, heading into this meeting, inflation has been higher than expected, and the Fed has a dual mandate, both stable prices and full employment. Now, we know that they're not doing that well on their inflation mandate, and Chair Powell has already warned us during a meeting he had with Governor Tiff Macklem of the Bank of Canada. He basically made it a point to tell everyone that he was not happy with progress on inflation, so he was being more hawkish, and that's going to be reflected in the discussion he's going to have tomorrow. Now, what I'm interested in, though, is how he's thinking about employment. The reason that I think about this is that we had a recent GDP print. Again, on the headlines, it was 1.6% quarterly growth, far below expectations and far below the potential growth of the US economy. But on the other hand, the economists who study this note that a lot of this is just more volatile aspects like net exports that are making the print look worse than it actually is. When you look at the underlying core, let's say private final demand, it seems like it's quite good. So at this point, I'm curious to see if the Fed is going to put more emphasis on the weaker headline, 1.6, and that would give them a reason to argue for, maybe a little bit more dovish policy, because at that point, although inflation is still high, you're getting a bit more concerned about your employment mandate because growth is slowing. Or are they going to take the other route and just look past the headline and look at this, just the core underlying private final demand and say this is still strong, so I'm going to push forward on what the market is pricing, which is maybe just one cut this year. So this, I think, how they interpret this GDP print is what I'm going to be most interested in. Now, the second thing that I'm most interested in is that we've had tremendous changes in the labor market here in the US. So one of the big things that's happening, we've seen huge employment prints, right? Last month it was 300,000. How does that make sense? It makes sense because there's just been millions and millions of people entering this country. And because they're illegal, we don't really know how many, but we know it's a lot. Let's see.
Yep, we're up.
Awesome. So we'll get the...
So that'll prevent us from having to change it before the last one because we were going to hit our 6-hour limit again on Twitter. So if you get another feed up on Twitter, we should be good to go.
Change it before the last one.
And then let me check if Victor is here. Can you hear me?
Yeah, I had to mute that one to prevent some background noise. So we're back up on Twitter now. If you did miss the end of the Fed guy, Mr. Joseph Long, please check those out on YouTube. So all of the recordings will show up on YouTube. Is that right, Jack?
Yeah, that should be right. And we're also going to package these into individual recordings because outside of YouTube, we actually have the root files in Riverside. So if there is any parts of it that we missed, we'll repackage those together and we'll get them out over the next week or so.
Okay. I thought you were going to do it all tonight so that we'd have it for the Fed tomorrow.
Yeah, I should. I'll release starting 1 a.m., 2 a.m., 3 a.m. I'll do hourly releases of all the videos while I don't sleep. No, I think I'll start putting them out in the morning. But
yeah, I support you not sleeping. That's good.
But we'll get there.
All right. And speaking of YouTube, if you did find some value in today's conversations, we've had over 22 of them at this point. Please head over to youtube.com. /excess returns or /SpotGamma, whichever one you choose, and you can donate to the Susan G. Komen Foundation through that link. We've had, we don't know the exact number of people. It looks like, I don't know, hundreds at least, because there's been a great number of donations so far today. And so thank you everyone for that. We're very happy to be helping out that cause.
Yeah, and we're going to keep that running as we repost the videos individually, over the next 10 days or so. We're going to keep that running. We'll keep the donation link up. And hopefully over time after the fact, we know everybody couldn't come out today or couldn't watch us for, 12 consecutive hours. So hopefully those individual videos will help us, continue to raise money because there's a lot of great stuff in there.
Yeah, I did want to give a shout out to my dad. My dad did send a text message question to Cullen. I missed that one, unfortunately. So maybe I could submit that via email. So I know at least one person's watching this stuff.
Next year we'll get our parents texting questions as we go, and we'll read off their questions.
It's a pretty good. He asked a pretty good question.
Oh, good. So I think Victor is here now. So I will get out of here, and I will let Victor in to talk to you.
All right, we will see you shortly.
See you. See you at 7:30.
There he is.
How you doing?
I'm doing great.
Are we live already?
We are live. You just jump into the deep end of the pool over here.
That's how it works. All right.
Yeah, I know we're at Tasty Trade. You get the fancy production and someone kind of helping guide your way. Not over here, my friend.
I don't even know how to spell my first name, Brent, so I need hand holders at every point in my life. Ask my wife, man. Without her, I don't know where I'd be.
Of course, this is Mr. Victor Jones of Tasty Trade fame. And I will pause briefly and let you give a little background on yourself. So for those of you who I can't believe who know who you are already, fill them in.
For 99.9% of you out there, let me introduce myself to you, except my mom, who's likely watching. She might be the only one.
Well, I was just talking about my dad. My dad sent the question. And so, Dad, if you got another question for Victor, lob one in.
So my name is Victor Jones. Previously, I was Director of Trading and Education at TD Ameritrade. I was there for maybe 12 or 13 years, ever since I was 20 years old, if you can believe that. After I left there, I started a little company called Doe. So we were a commission-free brokerage firm. We competed with Robinhood and the like. That company was a wholly owned subsidiary of Tasty, and Tasty Trade and Tasty Live was purchased by IG Group. And I've been rocking with that squad and content creation. I'm the host of a podcast called The Price of Truth at the moment over at Tasty Live every Monday through Thursday.
Yeah, that's a great show. You've been kind enough to have me on there as one of the lowbrow names that you've brought on, along with actually many of the names that we've had spoken with today. And so it's a great program. And you are overseas, right? Is that public information, Singapore?
No, it was not.
No, now it is. So I
thanks
just
for
doxed
doxing
you.
me
Okay.
to the public. No, I'm over in Singapore right now, so I'm 13 hours ahead, about 10 or 11,000 miles away from you guys.
Yeah, so it's bright and early, so you're getting your day started is why I was bringing that one up.
Oh, yeah.
So what's your take on stuff now with so much stuff going on yesterday with the Treasury announcement everyone's talking about? Suddenly that's the most important thing. It was CPI not too long ago. Andy Constan was talking this morning about QRA, just being this thing that no one ever cared about. Now everybody cares about it. So tomorrow we got a big FOMC. We got the QRA coming out again. We were just talking earlier about vol increasing for the non-farms number coming up here on Friday. Vols are starting to move everywhere. We got a little late day sell-off. What's your view of this landscape here? You always have some great takes, and so walk us through what's going on in your mind.
I don't know if I have great takes. I just listen to really smart people, and so I had the opportunity to talk to a lot of the guys that you've had on today. Whether it was Andy Constan who came in and he helps guide us around the SEPs. I think the most important thing is that we've been doing is not paying attention to the mainstream narrative. And that's a mainstream narrative from the Federal Reserve and whatever their forward guidance has been, which has sort of been awful. That's mainstream narrative with all the people that are out there hawking, the AI will save us narrative, which again, I understand that there are fundamentals that are supportive of that narrative. But, we've been having discussions with Jem Karsan, who's been talking about the potential for us to land in a stagflationary environment. And I know we're really early, but you're now starting to see some whispers, given last week's GDP, slowing growth, higher inflation. We've seen higher inflation numbers since January. Everything's been coming in hot, and this morning was no different. Housing prices hot in Case-Shiller, housing prices hotter in FHFA this morning, employment cost index, which nobody used to pay attention to. Chris and I were just talking about. Now all of a sudden that warrants a market reaction. People are reacting to that. And so, or whether it's having conversations with Jim Bianco, who had called very early for a potential 5%, Treasury, or 5.5% Treasury yield for the year, when everybody was saying that's absolutely insane. And as we inch closer and closer to 5%, he doesn't seem so crazy anymore. So, what we try to do on our show is the same thing you've been doing here, which is try to get non-consensus, critical thinkers to come on and help us understand how they're thinking about marketplace. Because, we say this on our show, consensus is often the least profitable opinion. So if you're going to come on and just tell us how great NVIDIA is, that's not exactly the most insightful conversation.
That's right.
And if you're going to come on and tell us, whatever, you tell us Tom Lee is bullish or Dan Ives thinks that tech stocks are going up 20%. No disrespect to either of those people. I respect them very much, but that's generally what they're going to say. And I think in a market that has had, it's highly cyclical. The narrative, the macro narrative is changing every 3 to 6 months. I think you have to be dynamic. I think you have to be talking to non-consensus thinkers. Daniel DiMartino Booth has been saying we've been in a recession since last October. So I think getting multiple people's opinions are sort of, what's the goal of our show, and seems to be what you've done a great job of doing here today.
Yeah, that was one of the big takeaways today was, just the data-driven approach, because you look at Twitter and you do tend to get riled up, which I guess is the cause of the platform. You said one interesting thing that I didn't get a chance to ask enough of the guests today, was that I think there was 5-6 cuts being priced in late last year, and now that seems to have been all but abolished. I think at this point, and people are thinking, well, maybe we get 1 or 2 cuts later this year, whatever it may be. But the equity market, I would just say, has digested that pretty well, and rates have gone higher. Kind of in kind. We're at, I think, 6-month highs, at least in the 10-year, and we continue to digest a lot of just issues, be it geopolitical issues, higher rates, whatever it is. And equity markets, S&P still only a couple percent off of highs. And so, I've thought a lot about did the Fed really anticipate lowering rates or adjusting rates? Or is a lot of that just dialogue? Sort of you just send your messaging out in terms of, this is what we're planning to do. And just what they say has been enough to, support markets in that respect. Well, we all know the Fed's looking to cut rates as soon as they get the chance, even if maybe they don't believe. I mean, maybe that's just a very kind of naive take on things. But do you think at some point, there's a credibility issue there, that starts to evolve? I mean,
yes, 100%. As soon as I believe it's in the March meeting, and not too long ago, Chairman Powell started to describe the warmer than expected inflationary prints that we had seen at the beginning part of this year as seasonal. I had PTSD, man. Instantly had PTSD, saying seasonal is effectively the new transitory. Like, why would a Federal Reserve chairman, or why would a Federal Reserve in general, sort of assume a short inflation position? Every time they've done this, it's gone back and it sort of bit them in the ass. Why do it again? And I think unless it's purposeful, unless the forward guidance, in which they, we all know their tools are sort of famously blunt. And so maybe you move rates. I think our last move was June or July of last year. They haven't effectively moved them for close to a year now, but forward guidance has been all over the place.
Mm-hmm.
To your point, cut and hike expectations. Larry Summers are, assigning a 15% probability that the next move is actually a hike instead of a cut. Forward guidance is absolutely all over the place. And at some level, call me conspiracy theorist or whatever, but when you are seeing decelerating, or when you were putting out an SEP where you're increasing growth expectations, you're increasing inflation expectations, and I get that they were truing up to the data that they are already seen, but when you're doing that and you're also starting to see commodities ripping, cocoa's at like 10,000 a ton or whatever it was at the time, crude oil was approaching $84, $85. And you're still telling the market you're committed to 3 cuts into the end of the year, at some point you got to look at that and saying, are you antagonizing the long end? Like, is that effectively, your short end has a lag to transmission, your long end has a more immediate impact into the economy? I have no idea, man. I'm not smart enough to be anywhere close to those buildings, to the Federal Reserve buildings. So the way that I look at this is always just a poker hand, the same way I approach the marketplace. You can't predict the next card, and you just look at everything through the lens of a distribution. And it just seems like as commodities started to rally, as gold started to rally, as equities started to push, these levels near 40, 50, 52, 5,300, it starts to look like you might have a problem on your hands in terms of inflation again, and the Fed seems like they're not being as responsive, which makes tomorrow really, really important. If you see the same narrative, which is we're data driven, we're meeting by meeting, perhaps they're giving a tacit blessing to where we are in terms of the long end yields, And if you start to see them pivot away from the pivot, perhaps that, approaching 5% this time around is maybe making them a little bit nervous. So we'll see. Normally, a Fed meeting, an FOMC statement where you already know you're not going to get any cuts and you're not getting a dot plot or SEP, they're the most boring things in the world. Why the hell would you listen? But for whatever reason, tomorrow's going to be a really interesting, pivotal day.
Yeah, and as we mentioned a few times, on the back of that too, you have non-farms and then ISM PMI immediately after, and so implied vols are a little bit elevated for that. And I know obviously Tasty Trade's a big options firm. And so, when you look at and your show is called The Price of Truth. And so, we were just talking again with Colin recently, we brought this up that, price in a lot of ways strips emotion out, right? Obviously there's supply and demand factors in there, but what vol is doing or what skew is doing tells you exactly how people are thinking about things or how they're positioning, at least. There's a great RBC analyst, I forget the woman's name, I apologize, but she basically said that, when you're trading something, you're putting money where your mouth is. And so, Twitter does exchange a lot of ideas, but you could see, hey, look, if someone's willing to pay, 25% implied vol for a 1 month put, that's real. That's a price that's trading. And so, do you look at the options sort of, or how do you look at the options market into these kinds of events to really glean whether it's important or not? I mean, is that something that you pay a lot of attention to when you're saying, hey, I'm trying to weigh the importance of this. There's all this macro sentiment I need to think about, and this is what the options market's telling me, but maybe the options market is priced correctly or, not correctly. So how do you wade through that?
I suppose it depends on the audience. I think for me personally, do I look at the vol to help assess risk in the markets? For sure. Whether it's looking at sort of like the series volatility or effectively what the expected moves are into certain events.
Mm-hmm.
We do that, whether it's looking at VIX term structure, we've done that. You saw a little kink in the VIX term structure like April 16th, or what was that, like a week or so ago?
Yeah, 2 weeks ago, yeah.
Yeah, I mean, we look at a lot of those signals. The problem is they help to assess that there is risk in some areas. They help to assess magnitude of risk, but other than that, you still, at the end of the day, you got to make a binary decision, right? And they can help to assess strategy. We do something called IVR, which is implied volatility rank, and that helps to drive a lot of our decision making. A lot of tasty is selling vols, selling tails. So you might be selling strangles a lot of the times, and if volatility rank, or effectively where vol is relative to where it's been over the last 52 weeks, if it's higher than 50, those might be decent shots to sell those tails. And then if you get lower than 50, you might not be necessarily getting the right risk to reward. That's effectively some of the elements we use to drive strategy and trade strategy into these types of events.
So if you look at an event like tomorrow, skews haven't really been moving too much. Vol's been the projected price distribution, in my view, has been pretty calm. And
surprisingly
we had
so, you could say. I don't know.
Yeah, and I generally think when that starts to contract and you get these events is when you could start to really get a pickup in risk, right? When people are expecting 50 or 60 basis point daily moves in the S&P, and then you start to get 1% plus moves.
Right.
Yeah, that things start to shake up, and this feels like a little bit of one of those times because we had reached oversold levels. I think when you look at put call ratios and the spread between implied vol and realized vol, and now we kind of bounced from that level, and that oversold condition sort of really shifted away, and it feels like it's a very pivotal level and a pivotal time with about 6 months left to the election, and vol very neutral, I think, at this price. It's not, 1 month 25 delta puts, so slightly on the puts are in the S&P are 14 and a half vol. I mean, I didn't see right before the close we sold off a little bit, but that doesn't seem to be all that expensive. And so the market really seems to be at the spot where it just doesn't have a direction, right? Like everything, the takeaway from everybody that I've had today is just like, we're waiting for the next data point or the next thing to determine what we're going to do next.
I agree with you 100%. So I agree with you in that there seems to be, I don't want to call it complacency, but it does seem like the market has a lot of known knowns right now, right? You've got the Bank of Japan situation, the potential of a reverse carry trade, the potential of a yuan devaluation, the potential of escalating geopolitical conflicts in the Middle East, the potential, just the unknown, really, of what the rate trajectory is.
Yeah.
The unknowns. Are you still in a Goldilocks economic environment? I know Darius Dale does a lot of really detailed work to show that the economy, from his point of view, has still been relatively supportive. I don't know if his point of view has changed, but the last conversation I had with him a couple of weeks ago, that's what it had shown. So for that reason, yes, 15, 16 VIX, given all the potentials in the market right now for something to go left, it does seem a bit complacent. On the flip side, you also, on the back of, we just talked about April 16th. Well, April 18th was when you started to see, I think, the bottom in the marketplace. When we were at a 20 handle in the VIX or vol, if you want to use the futures as well. And you got like 4 or 5 straight sessions where they just pounded that.
Yeah.
And you can't necessarily blame the marketplace. That's been a decent trade. Pounding vol as you get up to that 20 handle has been the trade for maybe a couple of years now. So you don't necessarily blame it, but it does feel like, given the fact that the technicals don't look great, that you have a completely uncertain path for rates, even though rate vol is nowhere near what it was in 2022, it certainly hasn't gotten back down to its historically low levels. It's still relatively elevated, and a completely uncertain election where, in both of those scenarios, you have the potential, does Biden reappoint Jerome Powell? Maybe. Does Trump? Absolutely not. And what does that mean for the future of monetary policy? And if we have a discount, the market is effectively a discounting mechanism for 9 to 12 months in the future. 6 months from now, 8 months from now, you've got a complete unknown with what that could potentially mean for monetary policy. That, to me, seems like another known that the marketplace seems to be a bit complacent about. So, look, the price is the price, though, man. So 16 VIX is what you trade, and you look for 1% moves, and you get 2% moves. To your point, clearly the market wasn't hedged for that type of move and got caught slipping today. Got caught lacking, as they say in Chicago.
I was thinking, and some of the things that came up in this conversation is that really it was post-COVID and all the liquidity that was sort of thrown at every aspect, and Joseph Wang just basically said that the Fed has gone from kind of a national bank, a steward, so to call it, to a global bank steward, to now even sort of functioning to provide capital and resources to the mom and pop businesses, and so their mandate has really expanded, just everywhere, right? It is like the entity at this point. And what was interesting to me about what some of those statements is that it felt like the cat was let out of the bag. If you look at any money supply charts or any of these things, everything changed at COVID. Vol changed during COVID. Like everything changed after COVID, and we're still digesting a lot of those problems, I think. And I had an interesting. I've been listening a lot to some of these. There's a Grant Williams podcast series, The End Game, and in it there's Chris Cole's I'm getting somewhere with this, by the way, PM of Artemis. He was talking about how the liquidity that was provided would drive inequality, and the idea of populism has come up a lot, unwinding globalization. There's all these massive sort of themes that are changing and unwinding, and I think day to day we lose those themes a little bit. Like we all know what the themes are, but we lose sight of watching those themes on a daily basis. And you see all the protests happening at the college campuses, and wages and employment and inflation, and people upset they can't afford houses and these different things. And ultimately, it came to this idea, and this is what I want to get your idea on, is that the choice is going to come down inevitably to a choice of tails, and they can either say, look, we're going to allow kind of like a major recession and deflation, an unwinding of all of these policies and liquidity, I guess, provisions or whatever you may call them, and that's kind of the left tail where assets reprice or shock lower, which is probably politically pretty unpalatable. Maybe not for an incumbent, but I don't think politicians are really going to make that adjustment in austerity. Or there's the right tail where you just have monetization of debt, in which case then you have to own assets to be able to hedge yourself. I spoke a lot. That was a giant word salad. Hopefully you could parse through that. I'm curious about your take on that idea, because I know you think a lot about a lot of all these themes. do you think we come down to that sort of point where, like we got to pay the piper, or we can sort of keep this course and have like a softer landing, I guess you call it?
So first of all, I'm a huge fan of Chris Cole. And I'm a huge fan. I think the first time I got exposed to him was the paper he wrote, The Alchemy of Risk, which I think was just preceded Volpocalypse.
Yeah.
And the line in that paper that I'll never forget, which took Vol from basically this two-dimensional magnitude of move to basically, I took it off 2 dimensions, put it in a 4-dimensional plane, and turned it into physics for me, is he said that, and many people know the quote, that volatility cannot be destroyed, it can only be transmuted.
Right.
His point was effectively that in trying to prevent asset volatility, that you transmute it into other things, potentially geopolitical volatility, social volatility through wealth inequality. And I think there was a moment in 2022, I believe, when I was having a conversation, Chris Vecchio and I, we were having a conversation with Brent Johnson, who at the time came on to talk about the dollar milkshake. And that's exactly what we talked about, the tails. The left, basically this is a choice between 2 horrific potential options. The left side is deflation and this is deflation at a time when we're a 4x leveraged global economy. Or on the right side, just to continue moving in the direction that we've effectively been moving in since 1913, accelerated in the 90s under Greenspan, and just lit kerosene, or threw kerosene on a fire in the last 10, 15 years. I do think at some point that there's going to be a crisis big enough that we have to make that choice. But I think here's the difficult part, and 2023 taught me this. Just because you have that realization, and whether for some people that moment was in 2022, or whether it was 2020, or some macro guys are brilliant and they can think in these 10, 20 year cycles. Ray Dalio, Neil Howe, and many others. I'm not, right? I'm a day-to-day guy, but I do think while you may at some point have that binary discussion, the mistake we can make is forgetting about that distribution that exists in the meantime, and the when is always the question. And if you thought about those binary outcomes, you would have been freaked out in 2020.
Yeah.
You wouldn't have participated in the rally in 2023 or in the early part of 2024. So do I think it ultimately comes down to a bigger crisis than the ones we've had in the past? Yes, because that's the system that we've engineered. And the difficulty of this cycle is we've had stimulus first. COVID was almost this weird anomaly where you ended up getting this massive liquidity injection. And then what normally happens in a cycle? You walk rates up slowly, you go a little bit too far, economy crashes, you take rates down the elevator. Well, we did everything about this cycle has been the exact opposite of what people have come to expect throughout the lens of monetary history. You got stimulus up front. You got rates that went up the elevator that are projected to come down the stairs, and we have not started that descent yet. So I just think, do I think ultimately, because of the fact that we've blown these bubbles bigger and bigger and bigger with each crisis, that we come to a binary decision point? 100%, because that's the way the game works. But it's sort of a mistake to fast forward there, and I think you have to, as a trader, trade the days and the weeks and the expirations in front of you. Otherwise, you just bury your head in the sand. You go buy gold, or you're buying iodine tablets, and you're hunkered down waiting for the event, or you're buying a bunker next to Zuckerberg's place in Hawaii, or some of the people on the East Coast are buying properties in New Zealand. You don't want to live that life, Brent.
No, you don't, and you want to try to be positive and live a happy life rather than think about the end times. But it comes up for me when you have these kind of moments that feel a little bit pivotal, you know what I mean? Where, we'll see the path of things sort of unfold. And I think what they had outlined, or Chris had outlined in that conversation, and I'm doing this from memory, so forgive me if I'm a little off here, but basically you get something of the deflationary shock first that would force the right tail, because we can't allow assets to decline like this. The U.S. is too stock market based.
You need the fear for the congressional response.
Yeah.
For the monetary policy. If you don't get the deflationary shock, you don't have the catalyst to go to the right tail.
Yeah, and it's been hard to generate that deflationary shock. I mean, I think even in 2022, there was pain for sure, but it didn't feel like, previous sell-offs where you're sitting there and you're just like, oh my gosh, like 2008 felt like the world was ending, and I never really felt like that. At least, it wasn't apparent to me that it felt like that in 2022.
Do you think, I'm just curious, 2008 seemed like it caught most of the marketplace off guard, whereas 2022 felt like, at least from a lot of the very smart macro minds that I follow, was sort of predictable after you get this massive increase in money supply on a 12 to 18 month basis. You're going to expect the inflation. If you're going to expect inflation, you're going to expect a monetary policy response. And so the Fed was very slow moving and when they gave you the monetary policy response as well. So it almost seemed like you had a well-hedged market in 2022.
Yeah.
So you got an asset price down, vol down type market, which made 2022 feel a bit like an outlier, a bit different than a 2008 scenario.
Yeah, it never felt like there was that margin call. I mean, there was no credit event really. Felt like there should have been some credit events maybe, but it never happened. And even last year in the bank crisis, vol remained pretty muted, I would say, through that. Considering how large some of those banks were that went kind of belly up. And I think maybe some of that is credit to more reactive policy now, and so some of these shocks can be just absorbed a little bit better. But you make a very good point there that it was a gentle decline, relatively.
I think, and I know you got a new guest coming in, if I'm not mistaken. We have a half hour, right?
Yes, sir. Yep.
So the last thing I'll say is the other difficult part about this cycle is when you get inflation over 3%, you get a different stock bond correlation, right? So your normal stock bond correlation in a normal inflation, in a normal inflation regime, you've got a negative correlation. That's not playing itself out. That hasn't historically played itself out in levels of high inflation, and it's not playing itself out now. Again, all these things make it a little bit more difficult to navigate this cycle. And I've been choosing to deploy more risk towards bonds, and trading the bond market feels a bit more contained to me than equities. Equities seem like they'll do whatever the hell they want to. It's very hard to predict.
See AMD today, that's for sure.
Yeah, you come out and you say, I got $4 billion for AI, and they're down $10 or something and extended. So. Yeah,
it goes fast. Well, Victor, I can't thank you enough for joining us today. Talking to you, time goes like that. The Price of Truth is your show on. You can get it on YouTube there. It's amazing. You have excellent guests. Unfortunately, you've had me on there as well, so you can lump me in there.
You are an easy crowd favorite.
Yeah.
And I appreciate that you even gave me the show to come on here and be included in such esteemed guests. So thank you very much for having me on, and thanks to everybody for listening.
Absolutely. So please go over to YouTube, check that out. And Victor, I hope to be talking to you again very soon as we kind of move towards the last segment here.
Peace.
Again, thank you all for joining us today. We have one more segment left. Very excited to have these gentlemen on, Doug and Gene, and we're going to talk about technology. And I will just say that if you have enjoyed some of these conversations today, including the great Victor Jones, who we just spoke to, please go over to youtube.com. You can go to /SpotGamma or /Excess Returns, either one, and there's a donate button there, and you can donate to the Susan G. Komen Foundation. And I will stop talking now and pass the baton to you, Jack.
Well, thanks, Brent, and thank you, Gene and Doug, for bringing us home today. You are the final guest. We are in the home stretch.
Love it.
Love it.
How long you guys been rolling for?
Since Brent's been going since 7:30. I jumped out at 8 a.m. We have had other hosts that got involved, so it wasn't.
So you've been going all day today.
Yes, yeah, it's a 12-hour live stream.
Oh man, Jerry Lewis would be thrilled.
Jerry Lewis is raising a little bit more money on us, I think, but we're learning.
I figured I needed like one of those phone banks behind me with like people accepting calls or something to do it the way they used to do it back in the day. But
speaking of phones and phone banks, I saw a payphone in California. I was there last weekend. Somebody had a payphone still in the.
Do you think it was operational?
It wasn't. It wasn't.
Was not. It was just for
no dial tone, but it was still sitting there on the wall.
Okay, sitting on the wall.
Yeah, my daughter did, no concept of what it was. I went and got her and showed it to her.
You explain to her what it is.
Yeah, and she was not interested.
How old is she?
She's 8. Yeah.
8.
Yeah.
It says a lot. Would she know what a record player is?
She does actually, because those have come back into style a little bit.
Gotcha.
Yeah.
Well, there's going to be a lot of those phones when we think about what's all going on in AI and those relics of the past and, that we're using throughout the day to day. They'll soon be those things that kids don't know about. It's pretty exciting times.
That is very, very true. And I'm actually interested in this conversation because you brought it up, because I think as we're sort of educating, particularly, my daughter's age, they're in elementary school or middle school right now, how do you educate somebody into this new regime of AI and what's really going to be valued 10, 15, years down the road? It's something I've been thinking about a lot. So really interested to hear your takes on that, if you have one.
I think it depends on the age of the person. If somebody's been around that knows what the PC was about and the internet, you talk about those waves and kind of gives some context. And then we put a scale of 0 to 100. Doug and I agree on most things. We disagree on how this scale plays out. And we're in agreement that 100 being electricity, we'd put the PC at like a 25, mobile at around a 25, the internet around a 50. I've got AI at 90. I think Doug has it at 99, if I'm not mistaken, and has famously said it would be 100 if not for AI needs electricity. So that's the context for, I'm 53, people my age typically kind of understand that in terms of educating. I think when it comes to anybody under the age of 20, they just soak this stuff up. And recently we had a high school senior as an intern. She shadowed us for a day. And she spent the first 2 hours talking about how her and her classmates are using generative AI. Bottom line is Duke University no longer sees a written essay as informative about a student's ability to write in the entrance application. And I think that is representative of what is rampant use of these generative tools for writing papers, for doing homework outside of math. And I think for anybody under 20 years old, there is no education needed. They just glamp onto these tools and immediately understand the value of them.
Are we past the point where they can, they used to have AI that could figure out the essay was written by AI? Like, are we past the point?
Really good. Yeah, I asked that. Like, it was fascinating, the whole conversation around cheating. And she says it's not cheating because they're tools that everyone's going to use and you're going to be left behind if not for that. But I asked about that, and there is it's called Check-In, or it's an application that's been used for a long time. Turn-In, I think it's called Turn-In, and came out amongst when the internet was getting more popular and people were searching and using cut and pasting from the internet to write papers. And they're still using that for trying to catch generative AI. But what the students do, there's third-party apps that they can go and further essentially cleanse their generative AI. So GPT will write the paper, then they'll go to a third party and they'll scrub it through that. And then at that point, they turn it in and they can check to see if any flags will come up. And at that point, it reaches plausible deniability, as she described it, that if you're even accused of it, since it's been scrubbed, it's so hard to do that. And she said, no one's getting busted.
I'm just curious, have you guys, Doug, have you guys noticed that Claude seems to be a big improvement over GPT? I've been using Claude Opus recently, and it seems to be really, really good. Have you guys noticed that as well?
I think you could argue Claude is the best model right now. I know some of the benchmarks suggest that it's the most performant.
Doug, can you bring your mic a little closer? Apologies.
Yeah, no worries. Can you hear me all right?
Yep.
Test 1, 2.
Yep.
I think some people would argue that Claude is the most performant of all the models right now. And for me, I use the models for a lot of different things. You could argue that it's a form of cheating too. I do use them to pick stocks. But Claude right now is, I think, one of the better performing models for that task. I think both GPT and Claude are a little bit ahead of Gemini at this point, at least in my view.
Yeah, and that's I guess there's probably going to be this back and forth, right? The next GPT will come out and that'll be better, and they'll be battling back and forth, indefinitely going forward, I assume.
It is, I mean, it's a cat and mouse game. The whatever is the most recently updated model, I think, should sort of by logic be close to the most performant, if not the most performant one. And we just saw with Llama 3 and Meta. I mean, that obviously right now I think is the most powerful open source model, which is a little bit of a different game, a little bit less firepower that goes into those models. But I mean, it's evolving so fast, and we keep hearing how much all these hyperscalers are spending on building these models. I mean, we just got through earnings here through most of the hyperscalers, and we've got Meta spending 40 billion in capex. Google's going to be over 50. Amazon's going to be over 60, which includes some infrastructure for retail. But it's a ton of money that these companies are investing in building the next gen models. So they're going to be great. They're going to continue to get even better.
I'm just curious, one of you rated it a 90, and I guess Doug, you rated it a 99. Like, when we look forward, like those of us that are not in the tech space, like you guys, like when we look forward 10 years from now, like what are some of the amazing things that we probably can't appreciate it because with the internet, we couldn't have really appreciated what happened in advance, but like, what are some of the things these things are going to be able to do and how they're going to change our lives?
I think, Gene, you can go second, but I think it's a little bit of everything, which is sort of a cop-out answer. But I mean, you fast forward 5-10 years, you think about what the models are today. And I always like to use, like, this is the iPhone 1. We're literally in the iPhone 1 right now. We're not even on 3G networks. People don't even know what a 3G network is. We're 5G right now. And the iPhone 1 was 2.5G, just to put it into context. Edge, Edge, and it was really slow data, and it was awful. You can't even imagine it if you're a 20-year-old right now today with a modern iPhone. But that's what AI is right now. It is the first generation of the iPhone. So in 10 years, just think about how much it's going to change. And I think to think that it can touch every part of our lives might sound crazy today. People, skeptics might argue about hallucinations and limitations to these models, which are all true. But you think about the advancements that we're going to have over the next 10 years. That's what makes me excited, because these models are going to get better. And then we are going to get the iPhone 10, then we're going to get the iPhone 20, and it's going to be as much of a performance jump, if not more, than what we saw on that side with the actual iPhone.
From my perspective, I think that 10 years from now, students aren't going to be writing papers. It's going to be, the machines will write the paper. It's about how well you can prompt. You'll be chief prompters. I think from like the world is just kind of walking out and seeing the world, what's going to be different is we'll have autonomy. And I think that robots will be, in a decade, we'll start to see some robots. Elon thinks it's going to be by the end of 2024. I'll take the over, but it's, I think just the robots. And I think those are like the ones that are going to be more visible, but underneath it, it's any information worker, any skilled worker is going to be using these tools throughout the day. How we use search is going to be very different. And so I think that just would kind of scratch the surface, but probably be the ones. Other good news too is that I think we're still going to love our sports teams. I think people are going to still love to go out to dinner. I think that the world is going to be around in a decade. There's credible, level-headed thinking people that have a strong case that may not be true. The world may not be around. I believe that we're still going to be around here in a decade.
Hopefully we'll still talk to each other, and we'll ask you about the whether we're going to be wearing those Apple goggles in a little bit later on in the podcast when we talk to each other. But I probably should have asked. To be honest, the 10-year question was a bad question. I probably should have asked 10 months. Because if you look at the pace of this relative to other technological innovations, like it's just moving so much faster. Probably what we're going to see in 10 months is going to be something we don't believe right now.
I think that's true. I mean, the pace of innovation, and everybody says this in every technological paradigm shift, right? Like days feel like hours, and hours feel like minutes, weeks feel like days. And the acceleration of it is immense. I think that speaks to the reality that we're in this sort of arms race right now. Like there's only a handful of companies that have a chance at building any type of general intelligence. And those companies, they have to have infrastructure. They need capital to build out that infrastructure. They have to have distribution, and they have to have data. And the companies that have that, you're talking about Google, you're talking about Meta, you're talking about maybe XAI with Elon, and X Data from Twitter, OpenAI with its partnership with Microsoft. NVIDIA, there's rumors they might build their own large language model. But I mean, once you get past those five, the field narrows a lot. And I think that's part of the reason why you see such progress is because all 5 of them know that that is the reality, and they're just racing against each other to try to get there first.
Doug, do you think 10 months from now we're going to have agentic, personalized AI?
Not fully personalized, no, but I think we'll have early agents. I mean, I think that's probably the next frontier for AI is this idea of an AI agent, where right now, I mean, you think about AI, the iPhone 1 version of AI, it's just a chatbot. I mean, it can answer questions, and if you're creative, you can make it do a lot of different things. But the next generation of AI, in my view, will be AI that can sort of like self-prompt in a sense. That's really what underpins this idea of an AI agent. And so what that means is if you have an AI and you say, book a flight for me to go to San Francisco next week, right? Then it might self-prompt and go and find a bunch of tickets from different websites. It might look at my schedule and figure out when I'd want to be in San Francisco, when I'd want to come back, where I'd want to stay, and all those things. That's what's coming next. And do I think we'll see some of that, like some of the early pieces of that in the next year? Yes, I think we'll probably start to see that.
It's interesting. I was having Claude revise an article for me the other day, and it revised the article, but then it actually it basically created agents. So after it revised the article, another person commented on the article, another agent commented on the article and said, I would make these changes. And the other one said, then the next one said, oh, those are great changes. I would do this as well. And it was going back and forth with itself. It was basically, but by the end, I think it was basically just complimenting itself over and over again. There were no more changes.
It was just like, that's this. Did you ask
No.
for other input?
No, and I asked one of my friends who knows a lot about it, and he said that's something they're testing. I haven't seen it since. I saw it one time, and I never saw it again. But he said that's something they're testing, I guess, to have it spawn off these, I don't know if agents is the right word for them, but different things that actually try to refine the article once it revises it the first time.
Yeah,
Have you
I
seen it,
think
Doug?
we're going to see a lot more of that. I have seen it. I have. And I think that, again, we think about early windows into what's coming next. I think that is an early window into exactly what's coming next is iterative prompting behind the scenes, just like a human, right? You could prompt the AI over and over to improve the output if you wanted to sort of do that manually yourself, make it kind of review an article multiple times. And I think in this case, and in many cases now, we're going to start to see these AIs just do that itself to improve the output without the user having to do it for themselves.
How do you guys think about investing in AI? I mean, I guess, investing in the people that make the hardware has been a very strong thing so far, but going forward, how do you think about the different layers of, where you can invest in the AI space?
Doug, how would I talk about
There's-
the layers? You go.
Go ahead, Gene.
I was going to do the layers, then I'd love you to talk more about Intelligent Alpha. So let's do that. So in terms of investing in AI, I think that the kind of the well-traveled book is just to think about the different layers, the stack. Right now we're in the infrastructure place of this. Doug talked about the numbers that Amazon talked about tonight, what the other big tech companies have talked about, and put that into perspective. They're talking about huge CapEx numbers last year, growing 50 to 90% this year. So all that focuses on that first level, and I think that's pretty well trafficked, I think, in the investment community. And then on top of that, we start getting into the application, the data and application layers, which are other opportunities. So I think you should just think of it as a stack. There's a third piece to this, which is this is the venture side, the private companies, and so we traffic in there as well. But that tends to be about an idea and a founder, and these are like pure play AI companies. This isn't Azure buried inside of Microsoft or AWS 17% of Amazon's revenue. This is their zero revenue today typically, and will be 100% AI related, whether it's on hardware related or some of the models. So that's the kind of the high level from the invest in stack within AI.
Which part of that stack is kind of the biggest limiting factor right now? I mean, is it on the hardware side? Is it some other part of the stack? I mean, what is sort of the throttle here, or what is throttling things moving faster?
I think you could have a good debate between whether it's the hardware or the software. There are some people who would argue that we need some new innovations in the software side, versus, the basic way to explain kind of the software approach today is it's sort of brute force. It depends on these scaling laws. And I mean, OpenAI has talked about this, where basically just the more compute, the more data that you throw at these models, the better they get. But that's obviously, you're talking about kind of this linear reality versus if you have some breakthrough with a new model, that maybe creates a step function change in terms of capacity, in terms of capability, in terms of efficiency. I think consensus would probably suggest, though, that the limitation is on the hardware side. Like Microsoft talked about, they're still constrained in terms of getting supplied, building out their data centers. Obviously, NVIDIA has had just incredible demand, continues to have incredible demand for their chips. And so I think the answer is, and this is a bit of a cop-out, I think the answer is the hardware thing is probably the thing that is the near-term constraint. In the long run, I would argue there's probably a software evolution or revolution even that needs to happen for us to get to that next phase.
So on a related, just quick question. I mean, NVIDIA seems like to be, at least in terms of stock performance, the leader there. Do you think that they start to mean revert as competition picks up there? I mean, it seems like from my somewhat naive chair here that the bigger companies are starting to move in there and creating their own hardware and things like that. Is that something to think about just in terms of NVIDIA, which is obviously such a major stock?
It's still surprisingly inexpensive if you look out at 2025, calendar 25. They're on kind of a goofy fiscal year. But based on that, it's trading at, call it mid to high 20s. And the reason why it trades at that multiple, you asked about the fundamentals of the question. I jumped to talking about the stock. But the reason why it trades on that is that investors are scarred from the past. This has been a boom and bust business. The year before the takeoff, and so in 2022, NVIDIA's business was flat. It was zero in 2023, at least up until the 4 quarters before the liftoff with generative AI. It was flat. The 4 quarters after, it's going to be up about 200%. And what I think that speaks to is that the math behind this, or statistically, you're going to see a second derivative slow down. You'll see a blow up because that's what NVIDIA does. They stuff a channel and then they blow up. But in the case, what we've seen, I mean, I think Musk's comments on the Tesla call were telling, is that they're trying. They've been talking about a year and a half building Dojo and displacing NVIDIA. And on the last call, he said they're going to be buying more NVIDIA. And so I think that the reality is that they stand alone. NVIDIA stands alone. And we have a venture investment in a company that hopes to compete with NVIDIA someday. But we know how hard of a road that is. And Doug talked about Microsoft's comments about, some of the challenges that they've had. And so I think this is a company that we don't own it in our portfolio just because the boom and bust nature of it. We've just seen that too many times. But the reality is that we should probably be thinking harder about owning it, because this is something that is probably just going to keep grinding higher.
We only have about 8 minutes left with you guys, so I just wanted to ask you briefly about the Vision Pro. I've heard a lot of debate in terms of how much of a game changer that is. I don't know if you guys agree with each other on it, but I'm just wondering what is your take on the Vision Pro?
Hold that thought.
You've got one.
We do have one.
No, it's even better than having one. I've got one in the box that I've taken out a few weeks ago. I brought it home over the weekend to show my family, and it's still sitting in the box.
So I guess that tells us something.
Doug, you want to expand on that?
I'll take the sore subject because we don't agree, Jack, to your foreshadowing. Gene is optimistic about spatial computing. I'll use that word. You can elucidate more on that. I'm pessimistic on it. I think unlike AI, I've used the Vision Pro. I don't see a world in 5 years, 10 years where people are spending any significant amount of time with goggles on their face still. The challenge is there's just not a killer use application. And I don't know that we're ever going to find one at this point. I think, we've been sort of experimenting with trying to figure out, how do you use immersion in VR forever? The Vision Pro the graphics are better than VR, but fundamentally, I don't know that it's that much different than VR, just because it's, you know, mixed reality instead of virtual or augmented purely. So my view is I don't see it as a massive opportunity. If I had to scale it on that AI scale we were talking about earlier, where AI is a 99 for me.
Let me get my number before you get you say yours.
Yeah. And the PC was, I think you said a 25, the internet's
25,
a 50.
PC's at 25. I got mine.
Yeah, I think the Vision Pro is probably like a 3.
I had a 20.
Not even on the scale. Yeah. I think you're drastically overrating it.
Still
hence,
early.
Hence it's still being in the box that you haven't
still in the
broken out to show
box.
everybody.
The current form isn't, and we said this going into it, it's going to be Apple enthusiasts and developers this year and part of next year. And it's too heavy. People get dizzy in it. The applications aren't there. I'm most disappointed that in our venture business, we haven't seen startups coming to us that are building killer apps. I would have expected by now to be seeing one a week. I think we've probably seen one in total.
Wow.
And and we're out there on X telling them, putting the bat signal out, come over here, we have money, and we're just not seeing it. And so I think, Doug, we're on different pages here. I think long term there is a spot for spatial computing. Apple reports on May 2nd. You can just see it. It's like a coach after a game. You don't even need to watch the interview. You know exactly what they're going to say. Apple's going to say, "We're thrilled about the initial uptake. We believe in this long term, and we're not going to give any sales data on it."
Did you see better for him? Did you see better uptake with like the Meta goggles or whatever they may be?
Quest.
Yeah, I'm sorry, I don't know their name.
He did do Zuckerberg did do the video where he basically tried to explain why it's not any worse, right? It's way cheaper and basically the same thing.
No, I thought it was he had a compelling case. I was impressed by, but I think to the point, to Doug's point, where when I'm my 20 is based on 5-10 years down the road, which is an easy thing because people won't remember this conversation in 10 years. But I think this to me sums up the difference between Doug said AI, you just get it. A year and a half ago, Zuckerberg was asked about the metaverse. Last question on a conference call, why should investors be excited about the metaverse? And he fumbled the answer. This last earnings call it wasn't asked about AI, but he just kind of concluded and gave like the most compelling, this was like, what's the football movie you love, Doug? The Last Yard, or not the, Every Given Sunday.
Any Given
Sunday. It was
Sunday.
like, it was just incredible. Like it just naturally flows. So agree, Doug, this is orders of magnitude below anything AI, but I still think people love to be sedated by, sedated, I think is the right word, by tech, and I think they're going to, it'll have a spot.
Sedated by tech is actually pretty accurate.
I think it's sedated. I think that was the right word.
Yeah, that might fit for the goggles.
Just before we wrap up, because I want to ask both of you guys this question. We've been asking a standard closing question all day, which is, what is something you're seeing that you think is interesting that other people should be paying attention to but are not paying attention to? And I think it's particularly interesting to ask you guys because you're coming from the world of tech, which is different. We've been talking macro and value investing and stuff like that all day. So is there something you're seeing that you think other people should be paying attention to but aren't in the tech world right now?
Yes, and I'm going to start, and Doug, I want you to finish it. I think it's around using AI to pick stocks.
Yeah, we've been working on a project we call Intelligent Alpha. And as we've talked about with generative AI, I think it will change everything. It can touch, anything that humans do over time. I think AI will find ways to do it better. And I think that includes even potentially today. If you give AI the right structure, if you give it the right prompts and the right suggestions and you're creative enough, I think you can get AI to do a lot of incredible things today. You can make movies with it, right? And to Gene's point, we've found you can also pick stocks with it. So I track about 40 different portfolios or strategies with Intelligent Alpha using generative AI. 80% of them are beating their benchmarks, and on average, they're winning by 400 basis points. So it's already proven, and this is over about 10 months of data. So it's not an insignificant amount of data. We obviously need a lot more data to really know for sure, is AI a better investor, right? Versus indexes and versus humans. But that's something that I think we're going to talk a lot more about when we think about the next 10, 20 years of investing. I think that's going to be a big part of the story. And I even liken it to, if you you think about the last 20 years in asset management, the shift from active investing to passive has really dominated a lot of the flows, particularly in equities. I think as we think about the next 20 years, there's going to be a shift from active and passive to AI powered, because I think AI powered is going to prove to be that good at picking stocks.
Yeah, it's really cool what you're doing. And just if anybody's interested, we have a full interview with Doug on the Excess Returns channel from a couple months ago, where we really got into depth about this whole thing, since we had limited time here. Well, thank you guys so much. We appreciate you closing out the event. We appreciate you helping us support Susan G. Komen. This is really cool. It's cool to find out, as a value investing guy, it's cool to find out what's about to happen in the world of tech. So thank you guys. We really appreciate your time.
Well, thank you for what you're doing.
Thanks for having us. Go donate.
Thank you.
Bye-bye.
All right.
Talk
to you guys later.
Take care.
So you guys can just hit there's like a little red button in front of you. You can hit for leaving. See you later. Brent.
Well, Jack, that wraps it up.
We have reached the end.
Yeah, as somebody just texted me, you're sitting here in the dark, and indeed,
you are. Yeah,
I've gone from
the
the
sun
morning,
actually went down on you. We did this for so long.
gone from the morning dark to the evening dark. So it's been a great day. Knock on wood for us. I'll pat you on the back for this. Pretty limited technological hiccups today, so super excited about that.
Yeah, and and anything we did have, anywhere someone's volume was low or something, we'll be re-releasing the videos. All that'll be cleaned up. I don't think we had anything on a technological standpoint that we can't clean up after and repost the videos. So that's you'll start seeing those probably tomorrow. And also, I just want to, as we wrap up here, I just want to thank a million people for doing this today. First of all, I want to thank you. This was your idea. You and your team, Julia, Glenn, Matt, everybody was awesome with this. You guys did so much of the work that made this possible. Justin and Matt for co-hosting. You and I would not have been able to do this for 12 straight hours.
Definitely not.
I struggled doing it as long as I did. So we would not have been able to do that. So and they did a great job. Definitely Susan G. Komen. It's a great cause. If you listen to us today, if you got any value from this, please consider donating. We're going to continue when we re-release the videos, keeping the donation link up, and hopefully over the next couple weeks we'll reach our goal. Simplify ETFs for being our sponsor, making this possible today, particularly Eric McCardle. He was great in making that happen for us, and we really appreciate all their support. Who did I miss? Every guest who spent their time today, their valuable time to come talk to us for a half hour. We really appreciate that. Anybody who donated, anybody who watched. This was a really cool experience. It was an honor to be able to do it, and thank you to everybody who made it possible.
Yeah, I don't have anything better to add than that, Jack. Thanks again to you. You did a lot of prep for all these meetings and things like that. And obviously, the excess return platform, we're able to really flex a lot of that work you did in getting some of these great guests to come on. So kudos to you for that. And as you said before, you are be able to watch the stream in an entirety on youtube.com/excessreturns or youtube.com/SpotGamma. And then we'll be processing these videos over the coming days so that you can check out some of the guest speeches or interviews, I should say, individually. And again, if you are able to donate, please go over to those YouTube streams and click the donate button to give to the Susan G. Komen Foundation.
All right. Well, I think that's a wrap. Thank you to everybody. I think it now is officially time for a beer.
It is in time for a beer. I'm going to cheers on that.
All right. See everybody.